So you had the stickiness of one, major support from sovereign wealth funds and large investors. Number two, you didn't see outflows from the private bank. Recall that whether it's deposit institutions in the US or private bank around the globe, that's your liability stream. That's where deposits come. That allows you to buy assets and give loans and do all the things you want to do as a bank. It starts with the liability stream. UBS never lost their liability stream. Credit Suisse, my guess, has had serious outflows from their private bank. So a very different situation. And I know, Mario, we're going to talk about my view on the Fed and what they should do, but I'll pause there. So I just wanted to answer that question.
Robert, what is the level of support that Saudi was given? Because it says that they made an $8 billion loss net in the last year. So, what was the level of support, and then what is that support that they've removed?
So I don't know how much exposure they had. Certainly, losing money at Credit Suisse in the marketplace. All you have to do is look at the chart. I mean, it went from, north of 8 to mid 2s in just a 12-month period. Two, they've been under regulatory scrutiny. I think like all sovereign wealth funds, they have to relook at where they're putting the money each and every day. And at some point, it feels like, catching knives. That they have lost incredible confidence in the management. And there's certainly a high possibility that the government steps in, or you could see someone like UBS step in, but they're not going to take on any type of liabilities with respect to litigation. And my guess is they will get some sort of government support if someone steps in. Unlike, in the U.S., where, the government supporting depositors, but absolutely not taking on any type of litigation risk when it came to SVB or any type of other liability.
Jeremy, I want to just quickly welcome you before going to Stock Talk. I would love your thoughts on what we're seeing with Credit Suisse and the Saudi bank no longer offering support.
Yeah, no, I think there's all sorts of questions on how systemic, how contagious is this from the US, or is it all separate issues from the European perspective? There's a lot of overlap in terms of the key issues these banks have, which is that, the sort of both the Fed, ECB hiking rates, obviously the Fed hiking more than the ECB, but the same basic deposit stress that people can earn higher yields now without having to keep their cash at the banks. There is some funding issues at all these banks, and that the government obviously took a lot of backstops to try to stem some of the deposit flight at the big at the US banks, but there's definitely still underlying stress given that the banks aren't paying you the appropriate deposit rates, and you could get things like treasuries or other government bonds now in Europe also that actually give you yield when the banks aren't paying you anything. So that underlying stress, I think, is with us, for some time.
But the question is, how do we get out of this position? Like, is the only solution the Fed changing course?
I
can't think of any other solution.
The banks starting to pay more rates on their checking accounts, but then the issue is their profitability sinks, right? So they're sort of stuck between it's no-win situation really, because they don't want to sacrifice their profitability, but if they need that funding, they're going to need to start raising their rates. I mean, if you look at some of these charts on how much they've passed along of the rate hikes, I want to try to create a chart. I've seen some historically. The beta of what they're increasing has been going down and down over the last few decades. This is the lowest they've increased, and it's been the sharpest rate rise. And so they're not passing it along, which is just unfortunate for consumers.
And my next question is, is this becoming systematic? So I keep calling it systemic. Is the sentiment causing it to become systemic? Question goes to you, Robert, and obviously to you, Jeremy.
I mean, I just want to go back on the last question. I see it very differently. We have to separate monetary policy and what we need to do with global inflation versus financial stability, which is also under the federal and ECB auspices. I would have said after yesterday, if not for what's happened over the last 72 hours with SVB and then today with Credit Suisse, I've been very clear. I think they should have done 50 basis points, the Fed. I mean, we saw core inflation month over month go up, just so we're clear. Core inflation went up month over month. It did not go down. So that's one, and we still had year over year at 6%, although way off its peak. So one, I would have been higher. I absolutely think the Fed has to stay with where they should be. I would be 25 basis points, not 50. I know some people are calling for doing nothing or even lowering rates. I think that's absurd for anyone to start thinking about they should be cutting rates. We have core inflation, still way too high. That's one. With respect to financial stability, listen, they're going to have to play in this middle ground. And I would say what's happening in the U.S. has very little to do with what's happening with Credit Suisse. We're talking about a situation that's, yes, it's causing some of the European stocks to go down. But also, if you look in the U.S., you've had some of the U.S. stocks stabilize. Being down 1% or 2%, that's not contagion. Okay, we should just be clear. Credit Suisse is down 75%, 80% year on year. The other U.S. banks are nowhere close to that. Some are even up year on year, X the regional. So we're talking night and day situations here. Recall, during the Lehman crisis, all of the regulators around the globe put up their gates. They did not allow capital to move. That's not happening today. The banking system, yes, it's definitely hurting, but it's working.
Stock Talk, do you want to give us a quick... yeah, go ahead,
Can I
Jamie.
just take the other side of the CPI story? I put in the nest
Please
that, so we've been recalculating the CPI because of the very bad data that goes into the housing numbers. Like, there was so much more inflation in 2021 and 2022 than the official statistics when they were saying inflation was transitory. It was much more inflation back in the day. Now there's much less inflation. If you actually use what's actually happening in the real world in things like the Case-Shiller index, which have been declining for half a year, for the Zillow rental index, and you substitute that in, you've had 5 months where this sort of 3-month annualized change has been negative. It's not, the Fed is not, our view is that they've been overly tight for a while and that they're not looking at the right data. And so that, part of this overly restricted territory comes with these other downsides.
Evan, go ahead.
Very quickly, on the Credit Suisse story and the Saudi National Bank talking this morning, they said they didn't want to provide more money to Credit Suisse. They said they currently own 9.8% of the bank, and once you get over 10%, it's a very different regulatory area, and they don't want to do that. So they're looking to stay at the 9.8%. And then I wanted to maybe bring Stock Talk into this, if that is cool. And we got some new data this morning. We got PPI coming out. And again, this is for last month. But it kind of told a little bit of a cooler story. It came in pretty low, below expectations. So Stock Talk, if it is cool, I would love to hear some of your thoughts around the PPI we got this morning. I could read out what the number is and then anything else in the discussion so far.
Yeah. I mean, look, the numbers for PPI came in cool. Today, we had year-over-year number 4.6% versus 5.4% expected. Month over month, we had a negative 0.1% versus plus 0.3% expected. And then core,
have we had a negative number on PPI anytime recently?
I think there was one other one, but I don't think it's in any of the recent prints. I think it was maybe last year. There was one negative month over month print. I don't recall though off the top of my head. But yeah, I mean, look, we got a beat on PPI, and to the extent that you think PPI is a better leading indicator than CPI, which again, neither of them are leading indicators, but to the extent that you believe PPI leads the economy more than CPI, then maybe this is a good sign. But I think I agree mostly with JP Morgan's note this morning, which I pinned at the top. But JP Morgan said this morning, CPI doesn't really matter. What happened over the last 3 days has done Powell's job for him. Credit creation at banks will collapse and the economy will slow. Inflation will taper off as a result. Any rally on the view that the Fed doesn't need to raise rates anymore is silly. If they don't raise, it's because of a systemic risk to the banking system, not a positive. I agree with that almost entirely. I think that there shouldn't be a rally in equities based off this. But at the same time, I think that this is the start of what the global monetary system was trying to break. The things that break in the economy aren't always, trackable or in unison or the same things in every cycle. Sometimes it's banking. You can make the argument that eventually, any kind of systemic issue spreads to the financials. But, at least right now, this seems to be the focus of global markets. And, if you believe that this contagion will spread further to regional banks, which the price action in markets might be telling you so, I don't think it was at the top of everyone's narrative that Credit Suisse would be, on the brink of potential collapse this morning, and that this contagion would spread to Europe. But we've seen the reaction in European banking stocks, and we've seen some relative strength in some of the bigger American banking stocks, right? I mean, even as of just this morning, we had Schwab Green in the pre-market. I mean, it's down now at the open, but we had Schwab Green off the CEO buy yesterday. He bought about $2.5 million of stock yesterday and reiterated confidence in the bank's solvency position. We had Bank of America that saw, having 15 billion in inflows and deposit inflows. So, there's an argument to make that there are going to be beneficiaries here, that the big four U.S. banks will be beneficiaries, and that the globally important systemic banks, the GISBs, the question becomes if Europe will step up to the plate here to backstop this the way that the United States did in relatively quick fashion, and I don't know if they will. But as far as the regional banking contagion goes, I don't think it's contained with regard to regional banking. I think that the risk is still there. And I think that shareholders, again, I made this point yesterday, but the perspective is that the view for shareholders on these banks is dramatically different than the view of depositors. It is one thing to be a depositor in one of these banks and know, okay, look, the FDIC stepped up to the plate, I'm fully insured. And it's another thing entirely to own equity in these names and think that it's a good bet or a good risk reward trade. And so I think that's the dichotomy that's developing here in the banking names, just in my view. Neely, I see your hand up. What's up?
I have a question for you, Stock Talk. I keep on thinking about all of the billions of dollars that are floating around from bank to bank right now as people wake up, rebalance, go to flight to safety. And that money can't be put to work immediately, right? Because it's stuck in KYC and what have you. So are we even going to get a rally in the next couple days or week? Because functionally, we have this asymmetrical event where money is actually just possibly not even available to support some of these levels. And then does that actually make a near-term opportunity? I was just curious your perspective on that.
A near-term opportunity in what? And you mean in longing some of these banking names?
Yeah, I mean, possibly. Just because of the function of money flows.
I mean, look, I got short on the regional banking names about a week and a half ago. LOB was probably the trade of the week for us. And then, there's some other shorts I think are still interesting. But from my perspective, again, from a risk reward perspective, I don't want to touch these to the long side. Now, do I think that there's probably a lot of value in some of these names that have been thrown out like babies with bathwater? Sure. But as a trend trader personally, and, I think everybody trades differently, but for me as a trend trader, I'm moving on to the next theme. I've been targeting commercial real estate stocks for about a month and a half now. I'm looking on to some other commercial real estate names, especially the commercial real estate names that have banking exposure. I think that's the obvious crux here. And so I've started to look at more into some of those names as well, especially commercial real estate trusts that have outsized exposure to some of these banks. One I'm looking at today was SLG, which I got short at the open. We're already down about 3% here, which is SL Green Realty. Their biggest tenant is Credit Suisse. So I think that there are smart trades to be made here in both directions and sympathy to these banks. And I don't think you need to get ahead of the trend. I think, if on the day Credit Suisse is collapsing, I think there's opportunities surrounding Credit Suisse the same way that there were opportunities surrounding Silicon Valley. And so from a trader's perspective, I think this creates a ton of opportunity. From a depositor and an investor's perspective in these banks, it's not a pretty thing to see, but I think depositors will likely be okay. I think the real question is, has the investment thesis for these regional banks changed? And so I'll throw that question back to Robert and then Jeremy as well.
Yeah.
Hey, I have a question for Robert as well.
So first of all, I'm driving, so I don't know who was that, but I agreed with almost everything you just said. One, if the Fed decides not to make a move, and I said this the other day on Mario's call, I would view that as a negative. I think that means they think the financial stability is more broken than what we thought. I like to not think that's accurate, but certainly there's a possibility. I think number two, certainly the marketplace, what's happened in the Treasury market is helping the Fed decision. That's why I think they can move easily from 50 to 25. I think thirdly, and I think most importantly, I absolutely agree, and I said this the other day, I don't trade stocks, but I'm pretty negative on commercial real estate. If you want to recall, the biggest lenders to commercial real estate outside of some of the real estate firms themselves were regional banks. And the regional banks are going to absolutely watch where they give lending because of the deposit outflow, and they're not going to have a mismatch, like the old SNL days, not Saturday Night Live, but saving and loan banks. So I would just say that no question that I think there's going to be incredible opportunities from the unintended consequences that happened over the last few days. I'm sorry, there was a question from me.
Yeah, Robert, I wanted to, first of all, say that everything is with due respect, but wanted to push back a little on your thought that, that the Fed should continue its rate hikes.
Yeah.
The Fed has been working off of outdated data. We right now have clearly early signs of a deflationary period because of the bank collapse. As you know, there is nothing that is more deflationary than not knowing where your money is going to be the next day. In terms of consumer behavior, consumer spending, we know that this always, if you look at history, any sort of issues with the banking sector lead to significant deflation, largely due to concerns around financial stability. How could the Fed not completely change its posture based on this? And, they know better than to continue to work off of data that really was collected at a time when none of this behavior was priced in. Clearly, the bond market is pricing in. The 2-year bond dropped another 30 basis points this morning. How can the Fed not, and as you know, the 2-year bond essentially is pushing the Fed in a direction. How could the Fed not react?
So a lot of great questions there and a bunch to unpack. I would say a few things, and I said the other day, my view of inflation is probably similar to Larry Fink's view, what he put out today in his in the BlackRock note, which I said the other day. I think inflation is going to be more 3.5% to 4% for the foreseeable future. I think Fed has to get off this 2.5 rate. I think it's just yesterday's news. Number two, I think you're giving too much credit for the Fed. I've been clear. They were incredibly slow with they were slow getting off of QE. They were slow getting off on calling it transitory. And absolutely, they've used some blunt instruments to date. My view is a little different. I think inflationary is going to be longer. I have based that, as Mario knows, based on my view of what's going on in the energy markets over a longer term period because of geopolitical risk. I think it's much different. I also would say that I don't see the banking system collapsing, to the degree that you're all talking about it. I think I've said the other day, SVB was a non-diversified bank. Signature Bank versus many others was non-diversified. I think we saw some decent stability yesterday. We're talking about stocks. Remember, bank stocks trade at 1 times book, and most people think that's too high because they don't even mark to market. Most remember have their assets on not a mark to market basis. So that's just a few things. Most banks use FASB, not IFRS, so they don't have to mark to market their derivatives, their book. So there's just a lot more going on. I'm not as negative on the banking system in general. I think regionals are going to be under trouble. I think Credit Suisse is a real one-off. I just look at it very differently. I don't.
How many one-offs till it's a pattern, Robert?
Yeah, I think that's a fair question. I think, my biggest concern is the unintended consequences we're seeing, right? You have The large banks, for the most part, you could argue are too big to fail still and have a guarantee. And the regional banks, if we're being very honest, we cannot guarantee all deposits in the United States. It's somewhere around 17 trillion. What I would say to you with respect to what's going on in the 2-year, I mean, let's be blunt, the 2-year at around 4%, even though it was at 5%, is still attractive versus where a lot of banks are paying deposits. And it's I actually think that flight to quality and flight to short-term yields seems attractive to me. And recall, although I disagree, 50% of this country think we're going into a recession. I'm on the other side of that. So if you're on that side, then you actually think 2 years are cheap.
But again, the point here being that the 2-year has been leading the Fed along the way. And the fact that the 2-year has seen such a big drop, does it not automatically signal that the Fed will do as they have, follow the two-year? I mean, I think we still have an inverted yield curve and the 2-year is dropping.
Yeah, I think I agree. And that's why I'm at 25 and not 50.
That's fair. I just think that it's going to be a pause. But Douglas, you might think otherwise.
I mean, listen, that's what the market's telling you. The market's telling you it's going to be a pause. I think it's wrong. I think that would be a wrong move.
Robert, hi, Douglas Bonaparte. First of all, you're awesome for being here, and I find myself agreeing with a lot of stuff you are saying over the last few days. I wrote down a number of things, but to address the one of them was what you guys just said. 25 basis points, I think, is what threads the needle. I just don't see how Jay Powell can go from last Thursday saying we'll do whatever it takes, alluding to a 50 basis point hike, to 0 and keep his credibility. And I know, there's something to be said about their credibility. Robert, to your point, I agree with you. Late to act on a number of things before they, before you then had to take them at their word. And sure enough, if you didn't take the Fed at their word that they were going to raise rates over the last year, there was a lot of pain in the bond markets for not taking them at their word there. But to go from, 50 basis points being baked in pretty good, or at least a decent probability of it on Thursday to 0. Yes, I agree, Robert. It probably means there's something fundamentally wrong, and that could be scary. But really, the credibility of Jerome Powell to reverse that hard, I just do not see that. If there's going to be anything, it's that 25 basis point threading of the needle, followed by maybe then nothing or 25, depending on how things go. The second thing I wanted to say real quick is, really just focusing on how, and Robert, again, I agree that the Credit Suisse story is a one-off. I mean, this bank, it's like every 3 years, they're on the verge of collapse. It's how are they still around, I guess, is the joke over the last 15 years. But making sure that people really understand how it is a one-off, how it's separate from SVB and, kind of the bank collapse story that we've been following for the last 5 days, 6 days. And if anyone has to, take the other side of that, how are they linked? How are they linked together? Because that's something I personally would be very interested to know. And the last thing I'll say before I shut up is, what a lot of retail investors need to hear, because this is the position I'm coming from. If you're a market if you're a beta portfolio buy and hold investor, you need at this point in time to hear things like, obviously don't panic, don't bail on your long-term strategies because you see this kind of turmoil. I think something does need to be said for how emotions do run and how emotions don't need to be a part of this when making your investment decisions. And if anything, and I think you've all more or less said this, Stock Talk, you mentioned this, if anything, be on the lookout for opportunities here. Be very mindful of your cash. Goes without saying in light of recent events, but those are the 3 things I wanted to get across. Again, 25 basis point spreads the needle. If anyone has an idea of how Credit Suisse and bank failures are linked, I'd love to hear it. And then lastly, guys, stick to your strategies.
So, Douglas, to your point about credibility, what's really fascinating is that we may have all forgotten, but remember the first 75 basis point hike? How many of us were actually expecting 75 at that time? There was no choreographing. It wasn't very clear. And so, Jeremy, do you think that there's a world in which we see Powell reverse course significantly? And do you agree? First of all, do you agree that that's even possible? Or is it essentially, threading the needle, like Douglas said, to 25? Or do you think that there could be a pause? And is that a good thing or a bad thing for the market?
So many complicated questions. But I agree with the sentiment that Powell, in his mind, is saying that, hey, we've got to stick with this narrative and that we should do the 25, even though I do think that actually the correct thing would not be to do that and to pause and reverse. So you have to say, like, what are they going to do versus what you think they should do? What Robert was saying earlier on this, I think a lot of people have said this thing with Silicon Valley Bank is unique because of their undiversified depositor base, all these tech companies and venture capital things, and they were all these money losing companies. And I'm not so sure that that's the key issue. I mean, they were having this cash burn issue before recently, and it was because of these higher rates that people were going out and trying to get the actual cash at much higher rates because of the Fed hiking cycle, that they could earn it in treasuries or money market funds. And there's deposit flight everywhere. And so then the question is, well, how much more diversified is your funding? But it's different than just this diversified, concentrated depositor base. So that's the issues that's going to be with us because, again, the banks aren't paying appropriate rates on their deposits. And so that's going to continue.
But let me just take the other side on SVB's decision making, because I only can tell you my own portfolio. I've been very clear all along. You can look at my Twitter that I thought inflation was long tail. I did not think we were going into a recession. When risk managers at banks make decisions to mismatch their assets and liabilities, they're making a view on the economy. They're making a view on what will happen to the yield curve, what will happen to the long end. When you extend your maturities and you're making a bet, you must be making a bet that the prices are going to go up. The duration would likely be shorter, like the mortgages they took. And they were making a bet on a recession. I took the other side. You look at my portfolio, I was rolling treasuries 3, 6 months, 1 year, 2 years, and just every time they came due rolling, because I actually said very clearly, I thought Fed funds rates should be towards 6%. So every risk manager makes a different decision on what they do to offset their liabilities. SVB made a mismatch. Okay, I was around probably longer than most people on this call. I started Wall Street in the 80s at Salomon Brothers. They made a decision. They made a decision to extend their maturities because their stock got smoked. It went from 40 billion to 13 billion. Their assets doubled up from 100 billion to 200 billion, and they needed to make money. So they did a mismatch. That is a risk decision, and they were wrong. Not every bank does that. So I would just tell you that every bank that makes these decisions to, decide to lend to real estate because it's a higher yield, those are risk decisions. Not every bank made those decisions.
But all the banks have the same issue, that they haven't passed along the higher Fed rates to their depositors. All of them. They all have that issue.
Yeah, and I think they made a mistake, and that's why people flew to treasuries quickly.
And they're still doing it. And they.
Evan, I know you've got a.
Yeah, there's a lot of stuff.
What's up, guys?
Yeah, KP, you can go for it.
Just wanted to hop in on what Robert said. About he thinks if we raise 25, if we don't do 25, that will send a more fearful signal to the market. I remember 2018. I was working at Oppenheimer MetLife building. We squeezed in that last hike, and there was literally bankers coming down that escalator, going to the doctor to get checked out. The volatility around Christmas Eve, and just was not. I think the Fed learned their lesson from then. They had a reverse course shortly, so why not wait? Be patient. A few, at least keep it open ended, and I think the sending a fear signal by going from 50 to 0 would be true. If we hadn't, been doing this, so aggressively over a short period of time, and the reason we had fear recently was obviously the event that happened, but right before that, the market was starting to sense maybe 50 basis points is more likely, and that caused a little uncertainty. So I don't know. I think to do it just for credibility might I don't think the market. I think the market will applaud that. So I don't know.
I don't know. Evan, look. Evan just shared the above in the nest. BlackRock. So Larry Fink just said he thinks the Fed will have to continue to raise rates, and that inflation is more likely to stay closer to 3 to 4% for the next year. But he also says that more bank seizures could occur following the collapse of Silicon Valley Bank. It just puts it in a really tough position where either inflation is going to get out of control, or a contagion could kick in if things continue the way they are. It seems, Robert, you're more concerned about inflation rather than a bank contagion. You're pretty comfortable that Silicon Valley Bank is a one-off. Credit Suisse, they've been sick for a really long time since the GFC, and we shouldn't see too many more banks. Regional banks could take a small hit, but that's about it. And there will be no contagion. Is that a fair statement, Robert?
No, I mean, I think you're making it. I would say I'm probably a little more in the middle. I think what I said is the Fed has to balance monetary policy and inflation with financial stability. And that's why I think they'll go from 50 to 25 because of the concerns they have with financial stability. I actually believe we have, yes, we have some regional banks that are going to be in trouble because I think we've said the other day, all risk managers are waking up and saying, should I have my cash at a regional bank? That being said, what happened at SVB and Signature Bank is not the same what's happening today. What's happening today is there is a nervousness in the system, and there's going to be a flight to quality, which means there's going to be a move to treasuries. And so, yes, I think for the foreseeable future, we're going to see a lot of volatility in treasuries. We will probably see continued deposit outflow. That being said, I have bigger concerns with inflation than I do with financial stability at the banks. I said the other day, I did not think SVB was systemic from a global perspective. I still don't think it's systemic. I don't think Credit Suisse today is systemic. I think that those are two one-offs. But there continues to be this, reverberations in the marketplace that are going to make risk managers make decisions so they don't look dumb. And one of those is putting their working capital needs in safe places.
What do you think
Robert,
what do you think of S&P's downgrade today of First Republic's credit rating? They downgraded to
they're friggin' behind the curve. I think it's ridiculous. All these rating agencies are so far behind the curve. It's irrelevant.
Do you think it was kind of unnecessary of them to kind of call out an individual bank this week, and maybe they should have waited?
No. It's not about calling out individual banks. The S&P is trying to, what credit agencies should be doing is front running these concerns, and instead they're just retroactively changing their ratings. If you look at, Moody's has number one, no credibility at all after 2008. But if you look at Moody's had an A rating on Silicon Valley 2 days before it collapsed. So, these rating agencies are just, they're just sheep. I wouldn't take what they say seriously, personally.
They have to do something, right? You just had two regionals go kaput, so they got to do something with the other regionals. So they're just going to keep going next in line, next in line, next in line. It's just saving their ass. But it has
They just don't want to see another bank fail that they have an A rating on. That's it. Yeah. They just want to make sure that if any of these banks fail, they're like, hey, we downgraded the credit.
So we're kind of talking about it there. Credit Suisse is kind of the one that's really in focus here. That feels like a name that I would classify too big to fail. Stock Talk, I don't know if you agree or anyone else does as well, but that one feels like
look, there's a handful of banks that are labeled as GSIBs, right? Globally, systemically important bank. Those Credit Suisse is in that list of banks, as are Wells Fargo, Schwab, a bunch of other names that have come under pressure. They are considered globally.
How many are on that list?
I can get you the exact number. It gets updated every year, but I can pull up the 2022 list right now.
But yeah, so Credit Suisse is a top 50 bank in terms of global banks in terms of size. So
right, globally systemic important banks aren't purely due to size. they also, it matters about, what kind of diversification of deposit and loan profiles they have. There's a lot of factors. But just to give you a list here, Agricultural Bank of China, Bank of America, Bank of China, Bank of New York Mellon, Barclays, BBVA.
Yeah, hold on, Vishal.
Sorry.
Go ahead, Robert. Robert's jumping in.
Listen, what happened at UBS is the Swiss National Bank came in. We had to separate ourselves as a good bank and a bad bank. We put all our shitty assets in the bad bank. Swiss National Bank helped fund that. I forget what the number was, but I'm going to say, billions of dollars of support for us to fund that. So then we could be business as usual. I put that in quotes, business as usual at that time, with our good bank. And over time, we sold the bad assets off and paid Swiss National Bank back. And our stock went from, I forget, it's something like 65. And, I think we all stepped in with a rights offering somewhere around in the mid-teens. And it went down to 12 and really, for the most part, stayed at 12 for a decade, less plus. Maybe it moved up to, up and down over that period. I think it moved in the last couple of years to a high of 20s, and maybe now it's back in the mid-teens. But it had an everlasting impact. When you borrow from the government, $10 billion. I think with Credit Suisse, like I said earlier, there will be some sort of scenario. My guess is there's not only what the gentleman said that Saudi was at 9.8%, and if they go above 10%, something happens. I mean, you can do that in a loan. There's a lot of ways where you don't go over 10% and support a bank. My gut tells me that most people think that they're going to be some sort of bailout by the Swiss National Bank, or a takeover where the equity's wiped out, and that's the decision that's going to be made. That's I don't know if that happens, but I'm sure those are the conversations today. If you don't have someone coming in to stabilize Credit Suisse, if you are a private client, why would you keep your money there? Why would you take that risk? So I think that I think there's going to be some sort of government intervention, but I don't think that means there's a government intervention at the other European banks.
Robert, as the stock has mentioned, Credit Suisse is one of the major banks in Europe, and you have a scenario where as you just said now, they're going to need some form of government intervention. Shouldn't other banks in Europe first of all, should they have severe concerns? And is this the start of something much bigger?
I don't think it is, because I think Credit Suisse, if you look at what happened to them over the last 2 years, from their regulatory infractions to their mismanagement to their stock action, they aren't anything like the other banks.
I mean, I guess a lot of people are thinking, we're hearing these words over and over again: mismanagement, regulatory action, lack of diversity in terms of the way they're managing the portfolio. And so is it not the case then that because of the financial situation that the world is in, these banks, and it seems like there's a number of them, who are basically now going to fall into problems? And so therefore, not just Credit Suisse, but there'll be other banks which are considered reputable who may also have the same issues for that reason. What do you think about that, Robert?
I mean, listen, I'm not under the hood at these banks. I can tell you that when we walked into the Lehman crisis and I had oversight at UBS, we were 2.3 trillion in assets. We were the biggest Titanic going. I think we had the most assets out of any bank. We were 35 times levered. These banks today are not levered anywhere near that. Their balance sheets are much different. Their liability streams much different. As I said, I haven't had oversight of a bank for a decade, but my view tells me, based on the quarterly reporting I read of banks, that Credit Suisse is very different. And the other banks that are systemically important institutions have different capital adequacy, different reporting, and I think they're very different. That's just my view. I mean, for example,
But Robert,
2 days ago, yep, go ahead, sorry.
So just to follow up, Robert, I mean, look, I agree with you. There are, specific concerns that existed at Silicon Valley, and there are specific concerns that existed at Credit Suisse that separated those banks in terms of risk from the other banks. That's a fair point. But do you not agree that there is a risk here of a self-fulfilling prophecy behind this short selling campaign? I mean, if you're somebody who is invested in these banks, or even if you're a consumer who is deposited at these banks, and I made this point several spaces ago, but I think this is really the core narrative point here, is that the stocks of these banks are a proxy for the health of the banks, whether or not that's true, right? They're viewed as a proxy for the health of the banks. Like, if Deutsche Bank today, trading down 10%, Deutsche Bank may have no problems at all. But the short selling campaign on these banking stocks, I think there's a risk here of a self-fulfilling prophecy where these stocks get shorted to death, maybe not purely off of contagion risk alone, right? Another one of the risks for shareholders, besides not being protected in the case of failure, is the fact that these banks are likely to raise capital. We saw last night Wells Fargo raised $10 billion in capital with a mixed shelf offering, right? So if these banks are likely to dilute stock further, if the risk to shareholders in the regional banks has dramatically increased, and if on top of that, there's a short selling campaign that is creating the perception of, poor health in these banks, don't you see that those three factors together, or wouldn't you agree that those three factors together can produce an unforeseen risk to the entire sector?
I mean, the answer is yes, absolutely. I would. I'm like I said, I don't get involved in the stock market on an individual basis. If I buy it, I only buy indexes. I'm 100% in agreement with you that banks could absolutely become under pressure. That's one. I think number two, yes. Today, would I go buy, if Credit Suisse has troubles, would I go buy Deutsche stock? No, because a lot of people think that they haven't been the best managed company over the last decade either. I said earlier on Mario's call a few days ago, UBS, we were the first company that took $1 billion loss because we used IFRS reporting and had to mark to market our derivatives. We also took the first $10 billion loss. We always wondered why no one else was taking losses. And they didn't have to mark to market. They used different accounting. And I think still even today, people use interesting accounting. I'll leave it at that. I think that, as Buffett used to say, level 3 assets, I think, have a lot of phonyism to it. I would say, secondly, yes, I think there's absolutely going to be a rethinking of what is, what's the value of a bank stock at one times book. Does that make sense or not make sense? And there's going to be those that I think have a brand value that should be higher, and those that have a brand value that should be lower. The one thing that's very different than today, and I think I said the other day, I liked what First Republic did. They got a $70 billion facility from JP Chase. I think it made a difference. I like what Wells Fargo did. I said the other day, if I was a regional bank, I would take that Fed facility and do it overnight, just as an insurance policy. So there's a lot of different tools that I would be doing if I was in the risk management business today that would try to separate me from the other banks. The one thing I can tell you, and I think it's a great question, is, back in 2008, 2009, recall Goldman Sachs, became, got their commercial banking license. Merrill Lynch was bought by B of A. Morgan Stanley got their banking license so they could start getting a liability stream. Things change quickly. The issue with today, which is why I think the stock market is in a unique situation, is social media and digital finance is working much faster than where the regulators can work, right? I think someone said the other day, 40 billion withdrawn in 24 hours because of digital finance and what happened with the social media,
Robert, I think you got a call. You dropped out. But I think the point he's making,
and you wouldn't get anywhere near 40 billion.
You dropped out for about 10 seconds, Robert. So what were you saying? You dropped out at social media.
I said social media and digital finance changed everything. They're working faster than the regulators can work. So yeah, I would be nervous of the stock market because there's so many other things that the regulators can't work fast enough. I think that's one of the reasons, why we're seeing what we're seeing today. So no, I do not think stocks are necessarily, bank stocks are a good buy here, but I think some could be. But my gut, the end.
Well, what would you think? I'm going to ask that question to Jeremy, and then we'll go to Tiger. Jeremy, what do you think we need to see for the Fed to completely reverse course? So we saw the bank, Silicon Valley Bank. Now we've got the issues again with Credit Suisse, deja vu. Deutsche Bank, we wouldn't be surprised if Deutsche Bank starts to show signs of weakness. But when do you think is a level is like, all right, now we have a problem and now we need to act fast and decisive?
Well, it's they put all their now new metrics on this core services ex shelter, and it all comes back to wage growth and the employment situation. So you haven't really seen the material. Well, the unemployment rates are basically at all-time lows. I mean, it ticked up a small amount with some labor force participation in the last report, but we haven't really seen jobless claims spike. And so, in one narrative, the Fed could keep hiking because they don't see it in the data yet. It's our view that they're going to start seeing it pretty soon. And so, the question is, do they have confidence that the situation is deteriorating? And if they can go to forward-looking stuff versus just what's in the backwards trailing 12-month data. But it's going to be all about wages and the employment situation. Again, we don't think Powell should be trying to cut workers from catching up with inflation. They're still falling behind, real wage growth being negative. They're not keeping up with inflation. He shouldn't be trying to compress wages at this point in time. But at least the narrative for the Fed is that, hey, we still have wage pressures. We still have this core services ex shelter. That's an issue. And so I think it's got to see a little bit more meaningful increase in unemployment for them to stop.
Jeremy, can I ask you another question really quickly, if that's cool?
Please.
Kind of on top of it feels like so long ago, but last week, after Powell had spoken in front of the Senate and the House, we were at kind of the markets were pricing in 50 basis points, at least that FedWatch tool. I want to kind of know, taking us back to that point, is that kind of what you were looking? Maybe were you still thinking 25? How are you kind of feeling about what Powell was going to do at that point?
Well, we
before all this banking stuff. It feels like so long ago.
Well, it was going to be all about the latest employment reports and the latest inflation data. Even though, again, we thought that the current dynamics are much weaker than is in their official statistics, and we think they should pause. But in terms of what he was actually going to do, I think if absent this banking crisis, you could say, hey, at a minimum 25 and potentially 50 with the actual strength in the data. You can understand why he'd go 25 to 50 based on the data that he says he's looking at. But it is just a matter of, should he be looking at that data, or should he be looking at some other real-time indicators that seem that things are compressing rather quickly.
Ty, jump in.
Hey, everybody. Yeah, I just wanted to kind of build off what Robert was saying, because I think it's important, and then how social media has kind of lit the match in some form, because it's interesting. Most banks collapse or fail because of over leverage or bad loans, and in this case, it's just been an outflow of deposits, which leads to me believing that
because I want to, Tiger, I want to mention this. Like, the banks that are failing now, correct me if I'm wrong, they've been reckless, but not as reckless as what we've seen before.
No,
it was, and many have talked about the impact of social media on the run on Silicon Valley Bank.
Yeah, it's a loss of confidence crisis, and I don't particularly think that you can ignore that they were irresponsible. So I think people claiming that this is I'm so sick and tired of hearing people saying this is the Fed's fault. Like, you run a bank, like, you're supposed to manage your balance sheet according to the duration risk that you're exposed to. They should have reduced duration risk. It's not that complicated, right? And like, a lot of these banks are buying 10-year bonds at the top of the goddamn market. Are you really blaming the Fed on that? I'm sorry, I just don't buy that shit. And I also don't think that this will lead to QE anytime soon. I still think that the Fed is going to raise rates.
But Tiger, beyond just to follow up on what you're saying, beyond this, look, I agree with you. I think you're right. Blaming the Fed in a vacuum is probably silly, but doesn't this highlight conceptually the issue with U.S. banks being heavily exposed to long duration treasuries? And like the reason it never mattered before was because we had low rates for the last 15 years, right?
Absolutely.
So when you had near zero rates for 15 years, then no one was concerned about the hold to maturity problem, right? And now that rates have gone up at such an escalated pace, now it's an issue. So we've kind of highlighted this core structural problem with the way U.S. banks operate, because now we know, hey, if rate volatility comes, we're going to put all of these banks back in the same spot next time, right? As long as nothing changes with regard to their long duration treasury exposure. So I guess my question to you is, and we've touched on this before, there's a handful of solutions here, right? You either raise the return on deposits to meet or come close to the return on yields. You either add additional regulations with banks' exposure to yields and the way they hedge those treasuries, or you find a way to drive deposits. And the only other way I can see is this sentiment impact where people say, I don't want my money in a small bank, so I'm going to move it to a larger bank. And as a result, the larger banks get massive deposit inflows and kind of curtail the solvency issue, which, we've seen this in Bank of America in the last few days. We've seen this with Citibank in the last few days. We've seen this with JP Morgan in the last few days. So, they might have better footing to manage this. But when you take the big four out of the equation, how do you solve this problem for the rest of banks? Is it about treasury hedging? Is it about, increasing the return on deposits? What do you think is the solution?
I think it's all the above. And, just as the big banks had to, be subject to more stringent scrutiny after 2008, I think that smaller banks will as well, whether that means they have to go through stress tests of some sort similar to large banks, or maybe a more modified stress test that's applicable to a smaller bank.
It's interesting. It's funny. Elizabeth Warren just told CNBC need to put tougher constraints on mid-sized banks in place. So literally talking what you're saying is
really? I don't know how I feel about that. She's not my favorite person in the world, but anyway, I'm not going to get into that.
But I want to go, Ran, let me ask you a quick question to Ran. Just before you jump in, I think it was you, Simon or Jason. Ran, aren't we in a position now, remember the narrative, we've done a lot of spaces on this, and there's been a narrative where the Fed will keep increasing interest rates until something breaks. I know we had this discussion a few times, but with Silicon Valley Bank, and now we're seeing the weakness in Credit Suisse and potentially other European banks. Has something broken, or is it too early to make that statement?
Like when the wall at your house cracks, and then what you do is you just fill it in with we call it in South Africa, it's called polyfiller, but I'm sure that every country's got their own version of polyfiller. And then you paint a coat of paint over the filler, and then you think that the wall isn't actually cracked. That's what happened now with these banking collapses. So you have the banking collapse. What the Fed has done is they've said, look, we're going to backstop all depositors. That's like the filling it up with filler. And now they just painted a nice white coat of paint, so it looks the same. But underneath, it's broken. And any day now, it's just going to keep breaking and breaking again. So, of course, something's breaking. When you've got one of the biggest banks in Europe breaking, when you've got one of the 16th biggest bank in the US breaking, things are breaking. Again, we are at a over 50% probability of no interest rate hike next week after the PPI data that came out today. I don't know if you've discussed it because I've just jumped on your show now, but the PPI data was fantastic. It was the largest decrease month on month in PPI that we've seen since the beginning of the cycle. So it is another motivator for potentially not increasing rates next week.
I don't know if I would call that fantastic, because at some point, bad news is bad news, right? And I think we're entering that stage. It's because I think for the last, at least from like a market's perspective, the last 12 to 18 months, it's the narrative has been good news, bad news, bad news is no, sorry. Good news is bad news is good news, right? So I think that we're shifting to an environment where just bad news is bad news. And, you know, if you, like, inflation is coming down, but it's coming down for the wrong reasons, right? It's coming down because people are spending less. There's an economic contraction underway, and the fucking banking falling apart.
But
I don't know.
But can I challenge you there? Can I just challenge you there on 2 points? One is that there was a massive difference between the decline in CPI and the difference in the decline in PPI. Now, why? Because the CPI is directly related to spending. The PPI is also related to the supply disruptions that we had. And what the PPI is saying to you is that the supply disruptions are actually loosening now, they're becoming better now. So I think in this case, good news is good news.
Well, I mean, have you seen the inventory buildups? I mean, yeah, like if no one is like, if people are buying less shit and there's less demand for shit, then there's not going to be as much supply bottleneck, right? Like, so
look, we want to go in,
that's another thing.
We want to go into a normal cycle. We had an abnormal cycle because the government printed so much money in the COVID era, right? And that got the economy. You had like this crazy mix of the government printing and giving everybody money, and then everyone sitting at home and spending that money either online or whatever. Like, you saw crazy things like home renovations up and car sales up when people were actually sitting at home, because all of a sudden everybody had all this disposable income. You've got to bring that back to normality. And I think what's happening now is we're moving back to normality. And we've had two great pieces of data this week. One is inflation is coming down. It's at 6%. If you follow Trueflation, which is actually where we follow our inflation, they say that inflation is actually closer to 4.8% or something along those lines, not 6%. And then you've got PPI with a massive decline, which shows that, you know what, actually the Fed may have inflation under control. What I think the big mistake that I think the Fed made is that they hiked too much too quickly, and that they didn't give the rate hikes enough time for us to feel the full effect of the rate hike. You know, if you hike rates on 1 month, you don't feel the effects of the rate hike the following month. It takes you a couple of months. And so a lot of the critics of the Fed said that the Fed should have raised rates and then just had a pause period. And I think that is what they may do next week. I said it since Friday, since the bank started to collapse, where I said,
yeah, I would agree with you. I would agree with you on a pause next week if we didn't secure all the deposits. I would agree with you.
Yeah.
But the fact that we're securing everyone's deposits tells me that actually gives them room to keep hiking. So
you know what it's like?
I don't know.
It's like
That's just my opinion.
It's like filling the wall. Instead of filling the wall with filler, it's like filling the wall with bubble gum. So it's like you're chewing a piece of bubble gum and you put it in the wall, and you're like, okay, it's going to hold for like a couple more days. We can do maybe one more rate hike. But I really think that Jerome Powell comes out next week with no interest rate hike, and I think there's a good couple of reasons for it. One of them, I think, is just the perception of the Fed, and I think he's going to come out and say, we realize that, you know, the banks are collapsing. We realize that we've been raising rates, and we know that there's a big job to do with inflation, but the inflation numbers are coming down. We saw this in the PPI and the CPI, and we've decided to maybe, again, I think that what they'll do is they'll just take a pause for a month. Interesting that the market...
Ran, just a question on that.
One second.
Sorry, Ran, just a question on what you...
One second. Interesting that the market is pricing 4 rate cuts this year now. 4, which I think is crazy. I think it's absurd. I'd be surprised if we got 2. The market is pricing 4.
You know, it's interesting. The market actually right now, it does change super quickly on this Fed watch tool, but it's pricing in 2 50 basis point rate cuts this year. So not 425s. I'm seeing 250s, which is kind of crazy. But that's after this 25 basis point rate hike at this next meeting. But I cut you off, Sulman. Sorry.
Ron, I wanted to ask a quick question. Oh, sorry. Could I say something real quick just because I'm going to have to drop off? I'm Jason Bright. I did regulation. I was at the FDIC in Washington, D.C. during the 2008 crisis. And I just wanted to ask you one thing, Ran, and then just one thing about what Stock and Robert were talking about. So about the short selling of bank stocks that might lead just in and of itself to a crisis. Just remember, it was September 19th, like 5 days after Lehman Brothers failed. I think that's right, when the SEC came out and the SEC banned short selling of financial stocks across the board. So I think people need to remember it. If people just start short selling bank stocks, I mean, I was in the room in 08. There's a Treasury war room in 08. There's a Treasury war room now, probably with 100 Bloomberg machines all watching bank stocks. And as it gets hairy, there's other things besides Fed interest rates they have at their disposal to stave that off. And then, Ren, I wondered, do you think it's possible, though, that Powell might go for a 0.25 basis point increase just to keep his credibility? Because when I heard you say what you said, I feel like that people could then blame him, saying, well, look, you're raising these rates and now you're admitting you made a mistake.
Yeah, I mean, it's between 0 and 25 basis points. Like I'm looking at it now, it was 54% towards 0 and 46 towards 25, and now it's the other way around. Now it's 46 towards 0 and 54. So it's pretty much there. I think the one thing that the market's getting very wrong.
Here's what I'm at 325s in a row.
Yeah, I think what the market is not what the market. I think where the market is very, very, very wrong, and I think time will tell, is that you don't increase interest rates in 1 month to reduce them the next month, and that's what the market's starting to price in. The market's saying we'll raise and then we'll drop. That's not what you do. You don't raise interest rates.
Right, but I think. But guys, to the gentleman's point that just talked like about different tools, right? He talked about, banning short sales. I brought this up the other day. People were nervous about deposits for payroll. Well, the FDIC increased north of 250 for payroll. It was called the transactions. I forget the exact name, but it was the transactions insurance approval process, where actually they gave insurance for all payroll. So it was only transaction based. That calmed the markets dramatically because everyone knew that, okay, all payroll deposits were insured. Now that was deemed at that time, and the gentleman from the FDIC can vouch for this, that went well, but then that was deemed to be a little over their jurisdiction without congressional approval. So now you need congressional approval. But there are an incredible number of tools for banks.
Robert, just on the same point, we know when it comes to the financial sector, or any sector, things are about optics. The fact that JP Morgan said that the hike would be about 0.5, do you think that the reason for that was they were preparing people for a 0.5 or a 0.25 hike as opposed to a 0?
I think that there was different data. I think every day we're getting more data.
Yeah, I mean,
the data.
I think anyone who wasn't at a half a point after last month's labor numbers were just praying.
Yeah, I think there's new data coming in. I think that there's new data. Like when you get the PPI data, which is so strong, like we had today, you got to change your view at some point. Look again. Yeah. I've been saying since Friday, no interest rate hike. I think I'm going to be right, but let's see.
And what happens to risk assets over the next few months?
Yeah, not great. I mean, I think that they're starting to. So there's two risk. When we talk about risk assets, on the one hand you got equities, on the other hand you got growth stocks. We are seeing a inflow into growth stocks. There was a massive inflow into Cathie Wood's ARK fund, which is for us a good indicator of appetite for risk. We're seeing Bitcoin starting to run, although it is Bitcoin, not altcoins. We're seeing a much bigger run in Bitcoin than we're seeing for altcoins. We're seeing Bitcoin dominance up at nearly 45.5%, 46. Haven't looked at it in the last 5 minutes because it is moving really quickly. But let me just quickly check BTC.D.
Just want to close about Cathie Wood's fund because I think that's a little bit misleading. So I think there's a lot of there's actually a lot of demand to short Cathie Wood's arc. So what that might be is that certain brokerage houses and even market makers need to have this on inventory so they can lend it out for short sellers. So I think
but
that
the fact is, though, that the fund that I posted up top last Friday had $397 million of inflows, most since April 2021. And it could be either side, but it doesn't necessarily mean that's all wrong.
That's not real inflows.
I think it is. Right, I think it is. I mean, I may be wrong, but I think it is. I mean, we're also seeing it in Bitcoin, and you know, call it what you like, but I think you still have the Nasdaq at above 12,000 on the futures. You know, so it's not. There is some kind of money that's flowing into risk assets. I think that the financial sector is about to get whacked. I think the financial sector is about to get really whacked, to be honest.
Yeah, you know what's interesting?
What do you mean by wipe, though, Ram? You think that, I mean, there's going to be other failures? Don't you think that a failure of a bank like Credit Suisse was going to stop all the noise?
I think we're just beginning to see a failure of maybe. I mean, Credit Suisse claim that there's no failure, right? They claim it's business.
Right. I'm not assuming that they're going to fail, but I'm saying if they did, seeing as they're a globally systemically important bank, you don't think that would stop the noise?
Stock talk. Oh.
You address that for a second.
Talking,
yeah. Sorry, I missed that question.
Oh, okay. So he dropped out.
Seeing as Credit Suisse is a globally systemically important bank, right, at GSIB, you don't think that the failure, if it happens, and I'm not saying that it will, but if it does happen, you don't think that would stop all this noise?
Well, it depends how they bail it out. Who's bailing it out? What does the bailout look like?
I mean, they would have to bail it out. They would have to.
Who's bailing it
Credit
out?
Suisse is too big. Credit Suisse is 5 times the size of Silicon Valley Bank by assets.
Yeah, so who's bailing it out? And what does the bailout look like?
I mean, the Europeans would have to bail it out. They would have to. There's no choice. Right?
The Swiss National Bank.
This isn't a specialized bank like Silicon Valley. This is a massive bank.
What would you say? But stock talk. What would you say is the likelihood, in your opinion? What's the likelihood of Credit Suisse failing? Because they've been quote unquote failing for over a decade.
I was about to say close to zero.
I can't put a percent on it, but I will say the activity in the credit default swaps does not look good. But what I will say is that if it does fail, the Europeans don't have a choice. They just do not have a choice. This won't be a debate like it was for the FDIC with Silicon Valley Bank, where it's like, do we go over the insurance limit? There is no debate here. Credit Suisse must be bailed out if it fails. The European economy will collapse. It has to be.
But Stock, I would say I think there is a little bit of a debate that happened over the weekend with the FDIC. And to Robert's point, the FDIC did launch this transaction account guarantee program. That's what it was actually called, Robert, the TAGP. But they did that in conjunction with the Treasury that did the TARP, which was the true bailout, right? Because Treasury had to go to Congress to get them to pass a law to be able to inject money in the banking system. So what I guess I would just say to you or suggest is think about the Fed, the Treasury, and the FDIC right now. They're all like firefighters. The FDIC could do a transaction account guarantee program that basically made unlimited deposit insurance, which is essentially what they decided to do over the weekend, right? The Treasury, they're using this exchange stabilization fund or whatever it is, but if that runs out of money, they're going to have to go to Congress, and then they can just inject money in the banking system. And then the Fed, that's why I'm really interested in Ram, this discussion about the interest rates, because I got to be honest, never in my life did I ever think there'd be a discussion about whether we're going to raise or lower interest rates to potentially protect the bank. I mean, I'm a former regulator, and I mean, I'm almost a little bit ashamed, right? Because this is 15 years later after one of the biggest financial crises in the world. We've had 15 years of low rates. How is it possible that we're at a point where banks aren't managing that duration risk? But that is where we are today. But I would just say and that's my question too, Stock, from before, is just when you're saying that people are going to be short selling, I'm hearing you saying Credit Suisse, I'm thinking, well, that's probably now a short selling candidate. I still remember in 2008, Citigroup was at $1. And it wasn't like the bailout was a combination of things, including the SEC coming in and freezing out all short positions on all financial. So I just think there's a lot of different firefighters here and a lot of different combinations. And I think the Fed rate next week to me is going to be one of the most interesting calls ever.
I agree. It's gonna be interesting, and I'm not pretending to have a crystal ball here. I'm not saying what will or won't happen. But from a trader's perspective, I've been a trader for a long time, and I know many traders both on the street and other places, and every at the top of everyone's mind when the Silicon Valley noise started was short sell the bank stocks. And that's what I did, that's what all these guys did, and we made a killing doing it. Now, do I feel bad about that? Not particularly. And as a trader, you're looking for opportunity, but the reality is that it's not just me who was thinking that, right? I mean, clearly not. I mean, there's a lot of sentiment on that side of the ball, and I think is there value here? Sure, but I think it's different when we're talking about a bank like Credit Suisse, which, by the way, Credit Suisse oversees almost $900 billion in assets. Silicon Valley oversaw $212 billion. So you're talking about something that's 4 to 5 times the size. And when you look at it in terms of relative importance, if you look at Silicon Valley and you put it in context of the United States financial ecosystem, it's just a peg in the wheel. If you look at Credit Suisse and you put it in context of the European financial system, it's a much bigger peg. And I think, that's my point here is, I think the debate, a lot of the narrative around here is centered around the debate of whether or not we should bail out these banks, as opposed to what is likely to happen, practically speaking.
How likely is it that Credit Suisse will require a bailout?
I don't have a number. I don't have a number on that. But what I will say is, if they do fail, I would bet my bottom dollar that the Europeans will bail them out with fervor. There's no choice. I don't see there being an alternative.
In stock, one thing you should just be aware of is, just like they're traders like you, it's not to feel bad or not about, but I was there in 2008. This is exactly what's happening at the regulators, which is we're trying to simulate what guys like you would be doing. So when we saw people deciding to make that choice, right, deciding to short Citi, that's when there's an intervention even before this massive bailout that you're talking about would happen, which is maybe we need to do something at the SEC, which is really like an unprecedented thing you never want to do, which is impact the private sector, but to essentially stop all the shorts.
Yeah, you're right. That could happen. I hope it doesn't happen anytime soon. But yeah, you're right. That could happen as a way of preventing this. But to me, I really see the danger here. I think the risk to depositors has been abated. I mean, I think, depositors around the country probably have a sigh of relief after the actions of the FDIC over the weekend. I think where the concern is now, and I've maintained this view for the last few days, and I still feel this, is from the side of the risk reward and the equity in these banks. And I just can't come up with a thesis for why I would want to be long any of these names. I think the binary risk is too high. There's much better names to own, market wide. Redacted, what's up? You've had your hand up for a while.
Oh man, where to start here? Okay, so let's see. Credit Suisse. This is not the first rodeo here for Credit Suisse. They've been in and out with issues over the past year. Anyone paying attention or that monitors the market closely has known this. The only difference, I think, today or the latest thing, which I assume you guys talked about, was I guess they put out a filing with the SEC, and the SEC delayed it because they cited some material weakness in the filing. So that sort of, caused issues starting yesterday. Now the market opened today, it's down, but the stock is down from its highs, like 90% already. So this is not a new problem to the markets. They've already been aware of this. What does the Swiss National Bank do as far as a bailout? If it collapses, I have no idea there. But now here's the second issue with Silicon Valley Bank collapsing. The two have nothing to do with each other. First off, I think everyone agrees on that. The problems at Credit Suisse have already been around. However, again, with the collapse of Silicon Valley Bank, Signature Bank, and now we're starting to see some issues in the U.S. banking system. Any headlines right now, and I said this, Mario, yesterday, I believe, any headlines the markets see on any sort of stress anywhere, the market is going to react aggressively to that right now. And that's why you're seeing this today. Like 6 months ago, when there were sort of, headlines around Credit Suisse having problems, we did not see reactions as severe as we are today, with the dollar, spiking 1.3 and, huge rally in treasuries again today with the 2-year yield down 40 bips. It's just, again, another big move. And honestly, these moves in treasuries is sort of like a gift to all these banks that are sitting on these mark-to-market losses on all their longer duration securities that they hold, because they should be, selling into these type of moves like we saw since, last Thursday. And then the last point, I think Robert touched on this. Look, the Fed has always been behind the curve. They are using, lagging indicators when it comes to like especially CEI. You can look at the owner's equivalent rent component of that is lagging by like at least the numbers I read is like 6 months. So the data they are using is lagging. That's the bottom line. Now, what are they going to do next week? Well, first off, we have the ECB rate decision tomorrow, which I believe the market had expected a 50 basis point hike. I think there's some feedback. I don't think that's going to happen. I think the market's pricing in a pause there, but we'll see what the ECB does tomorrow. And then as far as the Fed goes, there was a meeting, and Robert, maybe or Douglas remember, or even Stock Talk. It was one of their last few meetings. One of the questions posed to Powell was like, well, are you afraid of something in the system like breaking? I forget the exact wording. And Powell's response was that, the Fed is more concerned about inflation getting out of control, because that is sort of like a monster that they can't really contain, but that they would rather focus on some sort of issue happens in the financial markets, because they have the risk management tools to sort of clean up a sort of a break in the system. And that's sort of the Fed's logic of this is.
I would agree with that. That's kind of one of the points I was trying to make, that inflation and monetary policy is right now going to be greater than financial stability because of the tools they have for financial stability. Yes, deposits are safe, but people aren't giving credit to the 1-year facility they put in, which they can always grow. That's literally a 1-year discount window that you have to that you get no discount. I mean, it's a 1-for-1. That's incredible.
Exactly.
That is a 1-year loan, okay, at no discount. When you go to the discount window, I remember during the Lehman crisis, the one thing we all said, the first thing we did was when we went into that room at the New York Fed, that brutal weekend, was we said, let's make sure everyone goes to the discount window. So there wasn't this exposure that some went and some didn't. So we all went. UBS would have gone anyway. But we all went to the discount window. Today, to make sure there is no winners and losers, everyone should be using this facility and they can grow the facility.
Yeah, there is a stigma with
sorry to interrupt. It's just a headline here. European Union officials say the European bloc of banks is limitedly affected by the failure of Silicon Valley Bank.
That's kind of what I've been saying all along.
That's correct.
But they'll say that either way, no? Even if there is.
Yeah, but
of course.
It's true though.
No,
whether it's true or not, they would say that.
But guys, not everything is Credit Suisse. Look what they did with Glenfill. I mean, it's just very different. And I think they're in talks, I guarantee, with the Swiss National Bank. There can be certain loans that's given. It's not like the U.S. is the only one that makes sure they can shore up their banks.
You know what's funny is when we see these equity fall-offs, right, in names like Credit Suisse, it's funny because this goes back to the self-fulfilling prophecy I was talking about. What's the first thing we see happen when we see these equity drop-offs? We see every other banking name come out and say, we have no association. We have no affiliation. We're not, we're not tied to them. So it's like you actually are encouraging more outflows from the bank by pushing these narratives, So again, I'm not saying Credit Suisse is on the verge of collapse.
Right, I could take the other side of that. Okay, you don't think UBS is getting new private clients just like JP Morgan did? I mean, I would tell you some of the banks are going to be stronger over the next 30 days.
No, I agree with that. Look, yesterday when we were shorting a bunch of regional banks, we took Schwab long, and Schwab's up 3% today. Right? I mean, the CEO bought $5.5 million in stock yesterday. That was good enough signal for me and confidence in the bank, right? So we went long on Schwab yesterday. So look, I'm not bearish on the whole sector. I do think there are winners. I absolutely agree with you, Robert. There are winners here. But the question becomes, how much is the sentiment going to weigh in the short term? Who emerges out of the dust, right?
Yeah,
I mean,
like I said, I wouldn't buy the bank index.
You
Right,
would
yeah,
or you wouldn't, Robert? What did you say? You would or you wouldn't?
I wouldn't, because there's just too much unknown, and you could have one bank take down so much of it, right? I mean, just because of the weighting. But,
yeah, and just to add to that, there's way too, after the Silicon Valley bank collapse, that was obviously not expected. Like, we've had headlines over Credit Suisse for months now, but with the market is way too sensitive right now to headline risk of even a Moody's or S&P downgrade, which is absurd because these guys are so behind the curve. These rating agencies are terrible.
Also,
Mario,
exactly
I
to
got
that point
off
you
in
said
a few minutes and get back to work, but I wasn't sure if there was any questions for me before I
Yeah,
hop
I'll
off.
ask you a pretty broad question to kind of wrap it up with. You know, what would you say in the next couple of weeks if your narrative
Hello?
would be very, very concerned? Is there anything specific? Oh, you
I
can't
didn't
hear me.
hear. Say it again.
Mari, you cut out.
Stock talk. Oh, I cut out. Okay, you can hear me now?
Yeah, we can hear you. Just repeat your question.
Yeah, so Robert, what would be something you'd be on the lookout for over the next couple of weeks, an indicator that would change the narrative for you, that would get you more concerned? What is something that could, if it happens, your concern level will go up?
Well, if ECB did nothing and the Fed did nothing, I would say that would be real trouble for me, because then they're under the hoods that we're not, and that would mean that they think that this is more, this short-term systemic risk is more than, you know, they're concerned with short-term inflation right now. I would be on the other side of that, but that would be very concerning. If the Fed did nothing, that would concern me. If ECB did nothing, that would concern me. So that would be,
and that would surprise. That'll be surprising as well. Be very.
Yeah, we have the
surprising to
ECB
me,
tomorrow, so.
And they're much more under the hood than any of us.
Robert, really appreciate you giving us the time. You're welcome back any other time.
To it. Much appreciated.
Thanks, Robert. Stock talk. How's the market looking? How's Credit Suisse looking?
the broader market, I mean, indexes are still pretty red here. S&P 500 down 1.5%. The Qs are down about 80 bips, but they're actually rallying back here, a little bit of recovery. You're seeing outperformance in the Qs and some of the speculative metrics like RK. But SPY's down 1.5%. Dow Jones down 1.7%. IWM down 2.5%. The gold stocks kind of tapered off their early move in the session. They opened the session up pretty hot. Most of them are fading now. Not a lot of relative strength. I mean, I'm just flipping through my scanners here, and not a lot of relative strength in really anything. Give me 2 or 3 seconds here to flip through and see if there's anything.
Credit Suisse was down 30%.
Microsoft is the only thing.
16.
Only thing I
we have a few big tech names
Microsoft.
holding up. Yeah, a few big tech names. That's about it.
Why do you think stock is holding up well? Tech is holding up well.
I mean, I just think there's a little bit more appetite for risk on sentiment in light of I pinned the tweet at the top, but Fed swaps pricing in 100 bips of cuts this year. I don't agree with that notion, but it is what it is, and it does drive equities. So yeah, I mean, people are I guess being willing here to put on a little bit more risk on, thinking that we might get cuts at the end of the year. Again, I don't personally agree with that, but the data is what it is, and the swaps are what they are, and they're pricing that in. And so maybe that could be the contributor to a little bit of favor for risk on sentiment today. But I mean, broadly speaking, the market's down.
He did bring it up though. Microsoft has that relative outperformance. Do we think this is from the release of ChatGPT yesterday?
Yeah. ChatGPT 4 is insane.
GPT-4, yeah. And Evan, I think you shared a tweet about that, but about GPT-3 performed in the bottom 10% when I took the bar, and GPT-4 got in the top 10% when I took the bar. So clearly an improvement in comprehension. Somebody actually put one of my tweets into GPT-4 this morning and then commented on my post, and it explained the tweet and broke down all of the things. It's pretty cool. But anyways, MG, you've had your hand up for a while, buddy. What's up?
Yeah, and right after MG, I want to go to Tom Nash is with us as well. So maybe we'll get after MG, we'll go to Tom Nash and get his thoughts on the markets and on the Fed decisions. MG, go ahead.
Hey guys, good to be here. I just wanted to push back a little bit about, I think Robert, the previous speaker, saying, I think that historically the Fed was created to prevent deflationary shocks. And so making sure that the credit markets are functioning has always, in my opinion, been their number one objective, even though they've always come out and said full employment and price stability are always our dual mandates. And the perfect example of this for me was both the response in the GFC, the response in COVID, the response even in December of 18. When the credit market sees, when people start lending to each other, when people can't make payroll. So in the case of an explicit banking crisis, like what we saw with Silicon Valley Bank or what happened in GFC, where literally people are sitting there going like, is the money in my deposit good? Can I write a check? When it's that extreme, the Fed has to intervene, and that's their top priority. Similarly, back in December of 18, when the credit market seized up and no one was able to issue sort of high yield credit, that also meant that they had to reverse course. This was the same Jerome Powell, the guy who was hawkish then, albeit he wasn't dealing with runaway inflation. He did reverse both on rate hikes. He did reverse both on QT, going back to QE. So there is some precedent for that kind of reversal or pivot behavior. Secondly, in this situation, I think most of us who kind of analyze banks, who aren't professional bank analysts, but we'd look at kind of banks and say, okay, they have to raise deposit rates. Chances are they're going to be much tighter with their lending standards. That is already an extreme sort of tightening that the Fed doesn't have to do on its own. So for me, the increases of a pause and potentially a cut have to go up, all things being equal, because yes, they want to fight inflation, but at the same time, they're kind of in between a rock and a hard place. They're constantly talking about, the soft landing where there's a little bit of growth and disinflation. But in reality, I think what they're dealing with is either you accept inflation or you allow for a deflationary shock. And if you have to choose between the two, I think that they would accept a little bit of inflation or, less than 10% inflation. It's a lot, I know, for a lot of people, versus a deflationary shock. So that's the pushback that I give them.
I think as far as the Fed goes, I think they're going to keep, I've always said over the weekend, Mario, in the spaces, that my guess was I just cannot see them hiking rates in the next meeting after two bank collapses. I don't think what's going on with Credit Suisse is going to even really matter unless something accelerates ahead of the meeting in the next week with Credit Suisse. Then that's not really going to figure in their decision. The CPI number came out yesterday. The core number, I think ex housing, was still high, half of 50 bips raised month over month. So that's not good. They still have an inflation problem. But as far as the Fed doing a full pivot, and again, I said on the spaces over the weekend, my expectation was they were just going to pause. But as far as a full pivot into cutting rates is only going to be in response to an emergency, or what they absolutely will not accept is any sort of freezing of credit, like lending, any sort of issue of a credit freeze. They will not accept that, and they will step in, in a minute's notice. They'll, if anything surprise happens, like another bank collapses, that's sort of has more of a systemic risk, they will do like an emergency type cut over the weekend before even a meeting. But we haven't seen anything like that. Obviously, Silicon Valley Bank is not that situation. So they're not going to overreact or do anything like that. They are going to focus on fighting inflation, and they will only pivot to easing of monetary policy in the event something bigger happens that has more of a systemic effect that could actually freeze the lending markets, because that is their biggest fear.
Hey, named redacted, what about the next 3 months? Forget this particular meeting. What about the next 3 months?
What Can you be more specific?
Do you think that the increase? Do you think that there's a significant probability of a cut, even if they pause, or whatever, or if they even increase 25 bips? What do you think for the next 3 to 6 months? Do you think that the probability of cuts have increased substantially as the market sort of indicated?
Absolutely. Last Thursday, the rate curve of interest rate projections, the WERP screen on Bloomberg, had 4 hikes still baked in to the end of the year. Now that is completely reversed as of this morning. The market's projecting 4 cuts by the end of the year, right? Is that, I'm looking at it correctly? So
2 big
my
cuts, I think it is 2 50 bip cuts.
Yeah, so total of 100 basis points. But what do I think? I mean, yeah, I think it's possible that they start cutting. Again, I don't know. That's what the market's pricing in, but things can change. It's only going to be in response to deteriorating conditions in the economy, and it's not really going to be unemployment. It's going to be some sort of other failure somewhere else that we don't know about. I don't think that it's going to be because inflation has gotten under control. It'll be more, like I said, again, they're focused on fighting inflation. However, they will pivot if there is a big enough sort of collapse of some other institution that we're not even talking about right now, that is a surprise that can have a broader impact on the economy when it comes to, lending, okay? Because they do not want a credit freeze. So the market's pricing in cuts now, but I don't know what needs to happen to get there.
Just to interrupt just briefly, what about the businesses that are essentially kind of very, very much dependent on debt? So banking, for example, commercial real estate, there's a whole bunch of businesses that are very, very credit sensitive. They haven't experienced the slowdown that these guys was probably anticipating. Do you think that these businesses can be profitable or to be sustainable at current interest rates? Because that's what the Silicon Valley Bank fiasco showed us, is that given where people were locked in previously, if you jack up interest rates by 400 basis points, these businesses are simply not viable at those level of interest rates.
Yeah, I mean, of course, they hiked rates so quickly and so high that something was going to break. I mean, anyone that pays attention or is, works on Wall Street or trades every day, we all know that it's pretty obvious. But yeah, no, I mean, it's money is more expensive to borrow, so it's more expensive to do business. That's going to have a lot of damaging effects. I think we feel it first in housing, of course, because mortgage rates are so sensitive, and then it just flows into the system, over time. But what happened at Silicon Valley Bank is their asset portfolio was at it's pretty amazing, but their asset portfolio average weighted yield was 1.6%, with a average duration of 6 years. So, and they didn't have the proper interest rate hedges, in the event there was a sudden rate spike. So but then again, the bank collapsed because of a banking run. So I don't think anyone factored that in. But no, this higher rates, when the Fed hikes rates, it takes time to make its way through for the effects to be felt through the economy. So that's why Powell has always maintained that their goal and their focus is going to be fighting inflation, and they keep using the term, they're going to keep rates higher for longer, even if they pause at the next meeting. I don't know the answer, MG, when they're going to cut, but in my opinion, a cut will only happen until they start seeing actual damage in the economy, or there's another institution that blows up that could have more systemic risk to the rest of the system. I mean, I'm going to tell you this, the S&P 500's at about 3850, 3900. They ain't going to be doing any cuts when the S&P 500's up here, by the way. And I know they say they don't care much about the stock market, but they're not going to switch into easy money policy until there's some pain felt. I think we can all agree on that.
Tom, I'd love your thoughts on Tom. I'd love your thoughts on this particular point, and maybe your thoughts on everything that we've seen over the last 2 days and what we expect, especially with the developers with Credit Suisse. Do you think this could get worse? Do you think there's more unknowns on banks' balance sheets that could get exposed in the next few days and weeks, even months?
Talking to me
Tom?
here. Oh, Tom, sorry.
I was going to Tom Nash. Not sure if he can hear me. Let me DM him. Tiger, the mic is yours.
Mario, let me answer one real quick question about that.
Go ahead, man.
Just the move in interest rates, or sorry, in the treasury yields we've seen, the 2-year last week was at 5%. Okay, so today it's at 3.8%. That's a major move in less than a week. So the number, even the tweet you sent around where the banks have this like $600 billion in mark-to-market losses on their balance sheet, they don't have to recognize those losses unless they sell securities. But this move in rates that we've seen just in the last several days, that has been sort of a gift to these banks, and I would assume that a lot of these
I
banks
got a
are
phone call
selling
right
into
when you were
this.
talking, which is the perfect timing as always.
No.
Okay,
Good, Tom. Sorry. Yeah, Tom. I was just sure. Did you? I'll repeat the question. Just want to get your thoughts on developments over the last few days and what we've seen with Credit Suisse today. Tom, you're dropping out again, man.
I got a phone call when literally.
No, Ogo, did you hear?
called my name.
No, Ogo. I just asked the question again now. Did you hear it?
No, nothing.
Oh, cool. I'll say it again. Your thoughts on the interest rate on the developments with Silicon Valley Bank, the developments with Credit Suisse, and what you expect with the interest rates over the next meeting. I don't know. Tom can't hear me, obviously.
I can hear you.
I thought you had him that time.
He just dropped out.
Yeah, I'll swing in, guys. On flows. I know that Stock Talk was mentioning some strength and some Nasdaq names, which kind of makes sense if you think about it, right? I mean, a lot of these names are almost like bond equivalents, right? And if I'm being honest with you, I'd rather bet on Microsoft and Apple than our government. So, I see how that makes sense. And I think
what is interesting? On Monday, it was actually the highest options and futures volume trading day ever. That was from the New York Stock Exchange, at least. So if you don't know, New York Stock Exchange doesn't really have tech, has a lot of those bank stocks in there and everything like that. So I don't know if anyone has noticed the market going crazy, just kind of as far as volatility.
Did you say volume or buying? I'm sorry.
Options and futures trading volume.
Yeah, we talked about that.
I mean, that makes sense.
Zero DTE, like volume being like the highest ever, but that's sort of a new thing where they made every day on SPX options as zero DTE recently. So Mario, Tom's back.
The jump was a little bit more significant than that. The previous high from CME Group for contracts traded was 56 million contracts. Monday was 66 million. It's a pretty big jump from second place. So again, I'm not sure what the relevance is there. It might have been something to do with this collapse in banking stocks, but broadly speaking, that's a big jump in total contracts traded. 66 million contracts in one day.
By the way, I'm sorry to interrupt. Yeah, I'm here. I hope you can hear me. It seems like
Mike is iffy, but we can. Yeah, Mike is iffy, but we can hear you.
Okay, so just to answer short and quick, since my reception isn't optimal. So you're asking what would be the Fed next move, so to speak, based on everything that went on over the past week or so.
Yeah, and more importantly, like what more could we see? Because it just like it surprises me with Silicon Valley Bank that none of the regulators saw this coming, and it's just a bunch of guys 3 months ago that spotted this and there's a piece on Seeking Alpha about it. So I'm just wondering, like, for could there be more surprises over the next few weeks that even the Fed is not expecting?
Well, the regulators are notoriously late to the party by definition. I think Stock Talk was mentioned earlier, the credit agencies being absolutely a total joke. I don't expect the regulators to be on time. It's not the first time we are seeing this. It's very similar to to how things played out in 2008. I'm trying to improve my position so you can hear me better, which I hope to do in a second. So I'll answer twofold. So the first part of my answer, hopefully you can hear me, is a little bit more about what this means for the market going forward. And I think, look, if we would have had this conversation about a week ago, then the conversation would have been around the fact that the data from the inflation data is a little bit problematic. PPI numbers were hot, right? Job numbers are hot, et cetera, et cetera, et cetera. Now the complete tone of conversation has changed, since now we're dealing with not only the collapse of SVB, Signature Bank, Silvergate, the potential de facto collapse of a few more banks that got backstopped by the regulators. Now we're talking about a European banks pretty much on the verge of collapse. And we got really nice inflation data today from the PPI, which was actually negative, the purchase price index. With these circumstances, I think the Fed will be inherently more dovish, at least for the near future. Now, as far as, is there more surprises ahead? Certainly there is a chance of that happening, but I think that, I know it sounds a little bit, everything is idiosyncratic, right? Two idiosyncratic instances in a row, but it kind of is, because if you look at the banking sector in general, it's very isolated cases. We talked about it in our last space, Mario. Remember, I pulled up the chart showing how SVB was so inherently different than banks like JP Morgan in where their deposits were originating, right? It was originating from the loans and credit lines they were extending to their own clients, et cetera, et cetera. So with Credit Suisse, look, you have to understand the special circumstances of what happened with Credit Suisse. And a lot of it is kind of psychosomatic, because Credit Suisse was dealing with outflows for the past 3 months of 2022, but then Harris, which was the biggest shareholder, sold out completely. So the biggest shareholder basically bailed and went to zero. The second biggest shareholder, that now is the biggest shareholder, which is the Saudis, pretty much the Saudi fund, is now saying we're not going to help them out at all because of regulatory difficulties. And let me tell you something: in my 15 years in this industry, I have never, ever, ever seen any management decision, any business decision being delayed or not done based on regulatory difficulties. There's always a way around this. So, in my opinion, this sends a really it's a very tough situation for Credit Suisse, because if you're a client of Credit Suisse at this point, I mean, there's no chance you're keeping your money in Credit Suisse. I mean, this is just too dangerous. So
why did the first investor bail again? Sorry, I missed that.
So Harris, Harris, were the biggest investor of Credit Suisse. They sold out.
And when did they sell out?
Well, over the last few months. As outflows was increasing. So imagine this: outflows, biggest investor gone. The Saudis, which is now just down below 10%, are saying we're not going to help, and everybody knows it's cap, right? This regulatory difficulties is complete cap. If Warren Buffett wants to own BYD and deal with the regulatory problems, he owns 25% of BYD. Or Warren Buffett wants to own more than 10% of Oxy.
Sorry to interrupt. There's a little bit of a headline going on right now. Credit Suisse appeals to Swiss Central Bank for show of support as share slide sparks wider rout. And that's from the Financial Times. I'll get the article up there in a second, but yeah.
Well, that's exactly what I just said right now. Think about it right now. If you're a client with money in Credit Suisse, what's your incentive to keep your money in Credit Suisse right now, based on everything we just talked about? It's literally, there's no incentives. So in this situation, it's very similar to SVB. It's just a complete bank run. And we said it multiple times, there's not a single bank in the entire world, not a single bank that could withstand a proper bank run. If we all right now run to our ATMs and withdraw everything we have, not figuratively, right? But if that happens, there's no bank that can withstand it. So once a trust is lost, the bank is done, no matter if it's Credit Suisse or any other bank in the world. And at this point, I think with Credit Suisse, the outflows, the headlines, Harris selling out, the Saudis selling, we're not giving you a single dollar anymore. The Saudis basically wrote it off. The only chance right now for Credit Suisse at this point, they're in a spiral. Their way out is getting backstopped by the government.
Jesus, hold on. So can you, Evan or someone, can you explain that headline a bit more? Credit Suisse appeals to Swiss Central Bank for show of support as share slide. So When you reach out to a central bank for show of support, what does that mean exactly?
I think that means they want them to basically say, we're going to backstop this bank. Someone else can come in and say that. I'm about to link the article right as well. I think Stock Talk has thoughts.
I mean, that's how I would interpret that. It's not a good sign, and I think it's just screaming help, right? How is it not that?
No, but it's a self-fulfilling prophecy. If the central bank says we're going to backstop, then the backstop would not be needed because people will relax. Ideally, that's what they're hoping for.
Yeah,
I think it's a huge mistake for them to come out publicly and say this and not say this in back channels with the bank directly. I'm not sure if someone leaked it.
We don't know if it's leaked. Yeah, exactly. I don't know if it's leaked.
This is leak. It says according to 3 people familiar. So this is another thing.
So it's hearsay. It's hearsay. It's rumors.
Yeah, you gotta be
we got a lot of these.
Got to be very careful with that.
This is very,
but this
typical.
is a leak. But this is a leak going to Financial Times. Is that they would do more due diligence than a random leak on some random Twitter account.
But it's just these are typical type of headlines we saw even back in 2008, where people are saying or like Charlie Gasparino will put stuff out and he's very plugged in about what's going on behind the scenes. So we have to be careful, but we're going to see a lot of type of headlines like this for the months to come.
I want to double down on that.
It's just typical.
We live in a world where it's picks or didn't happen now, and even more so than ever, unless it's official communication. To name Redacted's point, tread extremely lightly, and then some joke about Credit Suisse dying for the last 15 years, and is this the straw that breaks the camel's back, so to speak? That's always food for thought.
Mario, I got to jump in a meeting, but I'll be back in about a half hour. Okay.
Yeah, man, you can just jump. You don't need to tell me if you need to jump off. Everyone, it's okay. Just jump out. I'm just having a look now at the article.
It does also say Credit Suisse also asked for similar response from FINMA, the Swiss regulator. 2 people said. Financial Times generally puts their articles behind the paywall. This one isn't. I don't know if you're noticing that.
Say that again. Sorry, Evan. Say that the second part what you said. Can you repeat that, please?
So they did also ask FINMA, FINMA, the Swiss regulator, to do a similar response as the national bank. So Credit Suisse reaching out to everyone.
Hi guys. Is everyone aware that there's a lot of depositors at SVB that just have not gotten their funds and can't access it?
Where? Credit Suisse?
Oh no, I'm sorry. I'm going to SVB. I mean, look, Credit Suisse.
Okay.
I mean, look, Credit Suisse is a dumpster fire, and it has been for a long time. It's really not a surprise that they're in this position, and it all kind of spiraled out of control when it came out that they were very exposed to Archegos in 2021. They had obviously given out leverage to Billy Wong and I think they took what was the loss, 2 billion or 1 billion? It was a huge loss. But yeah, things just sort of spiraled out of control ever since then for them. So I mean, the fact that they're in this position is really, I don't know why it shouldn't be a shock for anyone. But no, I find it interesting that I'm reading a Bloomberg article now, but a lot of startups are not able to access their funds, and they keep refreshing the page, hoping a wire goes out. So I think to say that this is all good and sweet right now is a little misguided. I mean, there are startups with 10-20 $1 million account balances.
Yeah, but I think this is but I think maybe it could take another day or two. I think just give them a bit of time. I want to quickly go back to the Credit Suisse story, if you don't mind, guys. Stock Talk, you said Credit Suisse is a too big to fail bank. What was that list you were referring to? If anyone knows the answer.
Globally systemically important banks. So I can, for those that aren't familiar, I can just read off the list really quickly. It's not too long, but this might give people some context on which banks those are. So I'll just read through them one by one. Agricultural Bank of China, Bank of America, that's in the United States, Bank of China, Bank of New York Mellon, Barclays, BBVA, BNP Paribas, China Construction Bank, Citigroup, Credit Suisse, Deutsche Bank, Goldman Sachs, Group BPCE, Group Credit, HSBC, Industrial and Commerce Bank of China, ING, JP Morgan Chase, Mitsubishi, Mizuho, Morgan Stanley, Nordea, Royal Bank of Canada, Royal Bank of Scotland, Societe Generale, Standard Chartered, State Street, Sumitomo, that's a Japanese bank, Toronto Dominion, TD, UBS, Unicredit, and Wells Fargo. Those are
how many is that on that list?
1, 2, 3, 4, 5, 6, 7, 8, 9. $33 banks, and 7 of those are Chinese state-owned banks. Did you catch that?
Yeah, thanks, man.
Sorry, you cut out. Yeah.
So that makes does that change your concern level knowing that they've reached out to the Swiss National Bank and to FINMA?
I mean, no, you'd expect them to do
potentially.
That. Yeah, I mean, look, it might show that they, are fearing this attack on the stock combined with any potential issues they might be having. Obviously, the credit default swaps are concerning there as well. Do I think it changes the scenario that they ask for help? No, not particularly, but I would expect them to. But again, my view on this is Credit Suisse is too big to fail. That remains my view. And if Credit Suisse does become insolvent for any variety of reasons, I think that it will be fully. Not only do I think depositors will be backstopped, but I think it will be fully bailed out.
By the way, I did print out that list of stocks or banks that are considered to be globally systemically important. There's also some tiers in there. Stock Talk. What are the different? I know it has how much extra cash they need, but
there are
JP Morgan most systemically important.
And the list does change pretty actively. Some banks get pulled from that list and added to that list every year, but that's generally speaking the list. And some people. Depending on who you talk to, some people will exclude all the Chinese state-owned banks from the GSIBs because those are all just kind of like one bank, really, essentially. The list does change, and there are technically tiers to that list. But generally speaking, that's your list of 33 names.
So is it safe to say JP Morgan, just based on it being the only one in tier 4, is the most systemically important bank around the world?
JP Morgan is I would say the world's most important bank.
I would say that.
In my view.
Stock Talk, just to push back a little bit, or at least just to kind of add to what you're saying. I think back in 2011, 2012, when the Greek crisis was happening, the concern about the European banks, and Credit Suisse was included among them, was the fact that, yes, they're definitely too big to fail, but the problem is that they're actually too big to save. In the sense that, the Fed and the U.S. economy is still much bigger than JP Morgan and much bigger than, Bank of America or Citibank or whatnot. But the Swiss National Bank is not that much bigger than, at that time than UBS and Credit Suisse. And so unless I haven't followed it that carefully, but unless Credit Suisse has significantly lowered its balance sheet, the size of its balance sheet and the size of its exposures to derivative land, which I believe they have on the derivative side. They're a very different bank. The concern was that not only are they too big to fail, but they're too big to save, because the only entity that could save them is the Swiss National Bank. I mean, the Fed can't intervene.
Yep, that's a fair point. That's a fair point. I mean, the Swiss National Bank, I believe, and somebody can correct me if this is wrong, but has a little bit over $1 trillion in total assets. And Credit Suisse is about 850 billion. So yeah, they're basically on par in terms of size. But does that make them too big to save, though? I don't know. Jay's up here. Jay, what do you think? Do you think, A, is Credit Suisse too big to fail? B, do you think they can be saved by the Swiss National Bank if something were to happen?
A, yes, they are too big to fail. And B, absolutely. They don't need $800 billion. They need like 10, right? This is not like a a situation where you're going to, to see the entire balance sheet fall to zero, but they are going to need to raise significant capital in the short term. The market cap is different than the actual book equity and the tier one that they have, or the capital that they have. The market cap is trading at a big discount to that. So they actually have a little bit of capital buffer, and maybe they need to raise 10, maybe they need to raise 20 to be comfortable. But I don't think that there's any question that the Swiss National Bank, they're waiting for the Swiss National Bank to say something.
Today, the market cap of Credit Suisse is only what, 10 billion? The total market cap?
But it trades at like a massive discount to book equity.
Yeah, exactly, because of this banking panic, right? Another thing, and we kind of talked about this previously, but feel free to expound on it. I think there is a little bit of risk from this massive short selling campaign in bank stocks, and we talked about earlier, how in 2008 the FCC stepped in certain occasions to prevent short selling. Do you think there's a self-fulfilling prophecy effect here with some of these banks? I'm not talking about the big four, but with some of these banks, potentially the regional names, where aggressive short selling campaigns create this perception that the drops in the stocks are a proxy for the health of the bank, and then you get a self-fulfilling prophecy. Do you think there's risk of that with some of these regional names still?
Yeah, on the margin, but I think CS is a much bigger deal, to be frank. I think with some of the community banks, I was talking to a few of my friends who've retired, and some of them have gotten some cushy jobs on boards, and just they can't say anything specific. But what I've been seeing is that you aren't really seeing outflows as much from the small regionals. They don't have securities on their books. So I think CS kind of just surprised the market a little bit. The media also took it out of proportion, right? Saudi just can't invest more than 10% because of regulatory reasons.
What are the regulatory reasons specifically, Jay? I mean, I know that obviously as a 10% plus owner, there are a variety of different regulatory obligations, but what is it specifically that's preventing them in absolute terms from injecting more capital outside of, I understand the 10% threshold, there are additional regulatory issues, but what specifically are those regulatory concerns?
I mean, that's it. I mean, you're not allowed to. Well, I don't know if you're not allowed, and I'm not as familiar with European regulations as I am with the U.S., but something that we can ask the audience.
Yeah, because I didn't know either. So I'm assuming. But what would you say? Go for it.
I do believe it was much more of a, we don't want to deal with all the increased regulatory work and everything we have to deal with, as opposed to we can't do it. So maybe that's even a cop-out of, hey, we don't want to give more money to this company to begin with, and this is our excuse. But it felt like the more, we don't want to have to deal with all that. But there was a clip. It was a live interview.
Yeah, Evan's, I think, probably onto something, Jay. The PIF, or the Saudi Sovereign Wealth Fund, has limits on, private ownership, specifically in, kind of banks, and, having to deal and navigate with foreign kind of governments, because once you cross that 10% threshold, there's all kinds of transparency, there's all kinds of disclosure stuff that they might not be willing to do, and so for those reasons they might be restricted.
Yeah, the Saudis certainly like their privacy.
I want to ask that same question again, just to better understand it. So how common is it for a bank to reach out to the Swiss National, in this case, the Swiss National Bank, and to FINMA for help? And is that an indicator of what exactly they're going to have? Wouldn't that lead to a bank run? And wouldn't that lead to a...
It's very common, Mario, for them to do it privately.
It's very common, and it wouldn't result in a bank run, because if they actually did get support, there'd be no reason for a bank run.
Okay, and
Jay, I think the question
MG, yeah. How common is it, MG?
I agree with Jay. It's very common. I think what's different is that it was initially kind of reported as if they were doing it publicly. Jay, wouldn't you think that that's really uncommon for them to publicly kind of announce their
the public reaching out, I think, raises an alarm. But I mean, just keep in mind, this bank was in a very difficult situation for all of last year. They were trying to sell their securitization business to Apollo. the CEO openly lied to the public about AUM outflows. He said AUM outflows from our asset management crown jewel business are slowing, and then the next month you see like tens of billions of outflows. So I think this is again poor management, miscommunication, and that's why they need to make it public, because he royally effed this up.
But Jay, mismanagement could be used for almost all banks. At some stage, there'll be some sort of mismanagement.
Not like this. Not like when you know that there are tens of billions of dollars leaving your firm, that you're lying to the public. That is next level.
Hi there. In my opinion, there'll be combined support. So support Credit Suisse from the Swiss National Bank, but also the ECB, according to Reuters, is speaking to the large EU banks to see what exposure they have. So obviously the ECB is concerned about contagion. So there'll be combined support here. So we'll just have to wait and see what that looks like.
In addition, I suspect that they will also be asking via the Swiss National Bank for support from the Fed via dollar swap lines.
Everyone's going to be relying on the Fed for liquidity if this gets worse. It's funny. People on on this were saying, no one's keen on investing in the U.S. anymore. But you look at the market and we're at 38.60, and because of foreigners putting capital in the U.S. And you look at like every single bank in the world in every single country in the world, and if things go wrong, they're going to rely on the Fed for swap lines and liquidity.
I have a question, Jay. I don't think anyone's asked this for the last few days. First, I want to say, I think whenever you speak on the space, the markets recover a bit. I don't know what it is about your voice, but everyone just eases down. It's like, everything's going to be okay. Listen to Jay.
Well, this is the thing. I'm actually surprised that it's held up this much, because just relative to the risk-free rate, even before this started, equities are probably trading, 3 or 4 turns higher, even when you adjust for the big cap tech. And I think it was because of the last 15 years, people used large cap U.S. equities as almost like bond proxies because rates were zero. I don't know if that behavior will change. But going back to your question.
I was just complimenting your voice, not talking about the markets. But let's continue with the question. Chinese, how's the Chinese financial system? Because there's been people calling it out for months. How solid is it?
It's not solid at all. But the problem is that the reason why SIVB collapsed, right, is that they have public financials. You knew what they bought, right? You knew what the hole was, and you knew that they were raising capital. Now, what is the catalyst for shorting something that you can't trust the data for, or where there is no real data? So, you go to last night and Chinese retail sales were up 3%. Now that's very positive, but it's hard to kind of believe the numbers until you see the feed through into, ticket prices, Capri earnings, luxury goods. You almost need to wait, right? Like, why are commodity prices down so much if China's recovering so much, so quickly? You almost need to wait to see, how, like, where's the data in Australia, about iron ore imports? Where's the data from the luxury goods retailers? You almost can't trust the Chinese data, but since 2006, people have been talking about secondary and tertiary cities and buildings that are completely empty. In China,
that narrative has been ongoing, but I haven't seen anything materialize.
Well, the thing is, China has 70% of the Chinese own real estate, and it's an investment. It's bigger than the stock market over there. So,
what's the percentage in the U.S.?
In the U.S., it is about 60% of individuals in the U.S. is pretty high. Have nuclear families that own property, which means like their mom, dad, brother, sister own a property. But the market cap of equities, relative to real estate is much higher in the U.S. than in China. In China, the real estate market versus the value of Chinese A shares is much, much higher, like multiples. And there's an entire shadow making system where people lend against these properties, and it is not in the official banking numbers. So the government has had no choice last year but to prop up real estate. They had like 3 or 4 different, government efforts to prop up the largest builders in the country. And originally the market was assuming, oh, China's not going to bail out, real estate. But they have no choice, right? They have these demographic issues. Some of these buildings will never have a single person set foot in the entire building. Like they're buildings that are just like 100% empty. And I think that it's one of the biggest Ponzi's. Like if you think SIVB was bad, right? This is like zero income properties. Like there were points in time last year where the builders weren't getting paid because people were striking on making their mortgage payments. And I think this situation in China is only going to get worse. And I think that's why Xi wants to get more and more control over the financial system and wants to get more and more control over Chinese tech, because he wants to use whatever wealth there is in the country to paper over the problem. And we don't know how big the real problem is, but it's massive.
But then if you don't have transparency, it seems like a blessing in disguise. It's gotten him. Arguably, it's gotten him through so many years of very weak, very weak financials, very weak system. So I'm just wondering, like, what would be, as you said earlier, what would be the catalyst?
It's not an open system. So it's not an open system, right? Like if you have $100 million account, right? There's some examples of institutional investors that like you can't pull your money out. Right. So like your only choice is to invest in other Chinese assets. And, that's one of the issues where, the US doesn't have capital controls. It's a freer economy. Right. In Europe, you have similar. Japan's similar. So with China, not only can you not trust the numbers, but when you have an economy with capital controls, it is very difficult to know what price discovery really is. But right now, obviously, as we're entering a reopening, and this is the last point, as we're entering a reopening cycle, obviously you're going to see GDP growth a little bit higher, right? As people drive, as people do, just like in the US, when people visit restaurants, et cetera, et cetera. So it's not like everything's a complete farce. I just think that the numbers are not accurate. The direction's right, but the numbers are not accurate, and they're papering over problems.
Yeah, I just want to say, Evan, I see your hand up. You and Stock Talk don't need to put your hand up, guys. All of us 3 are hosts, so you can just jump in anytime. So jump in, man, before I ask.
I actually want to say something about the Chinese real estate market to piggyback on what Jay said. So Jay and I find it since our live stream that we have a lot of shared opinions about a lot of.
I know you guys become love bros.
We had an amazing stream. Yeah, we had an amazing stream, and I couldn't agree more with what he said. I just want to elaborate that a little bit. I've done multiple videos on the Ponzi scheme that is the Chinese property market. Make no mistake about it; it's a 100% Ponzi scheme. So what's going on in China? It started as something as cultural. In China, if you build an apartment building and you want to sell an apartment, if it's already fully built, as if like you have everything is built, floors, etc., the person who's going to buy it off you is going to rip everything apart and build it from scratch because it's bad karma or whatever. I don't fully understand it. But what started off as the cultural thing where they were just building apartments that were not like fully finished because whoever's going to buy it is going to put his own stuff in anyways. It spun to this whole Ponzi scheme. So what's going on right now in China, you have to understand the Chinese property market is literally 1/3 of the Chinese GDP. 1/3. That's an insane number. And if you take into account of how insanely fake that is, it will blow your mind. We're not even talking about the fact that the GDP numbers out of China are completely bogus, but that's a whole different discussion. So basically,
sorry to interrupt. I'm seeing a headline or two. U.S. Treasury just said we're monitoring the Credit Suisse situation, tongue twister there. And then the FDIC just said it's tapping Piper Sandler companies to relaunch the sale of Silicon Valley Bank.
Thanks, Evan. Just Tom. By the way, we always jump in whenever there's breaking news.
Yeah, no worries.
But go ahead about the. No, all good. Don't be sorry. I love how we jump in with breaking news. Keeps it spicy. But Tom, continue about the Chinese Ponzi scheme.
Yeah. So
yeah, but continue about that Ponzi scheme, because
Okay,
and then
this is how it
if you can maybe add on to it at the end, Tom, like explain it, but also what's the what is the catalyst? Like when could it all come down crumbling? Tom? No, don't drop out again.
No, I'm here. Don't worry about it. I'm stronger than the glitch.
Okay,
I'm stronger than the glitch. Anyways, ask yourself this question: what does bring every single Ponzi scheme down? Lack of new customers. That's every Ponzi scheme's death, right? Same thing is going on with China. So China is suffering from a crazy demographic crisis. Even the current Chinese numbers, which are really bad, are overstated. So the Chinese regional reporting of school attendance is all fake. It's for subsidies money from the main government. You can listen to Peter Zeihan explain it way better than me. So even the current bad numbers are overstated. So China has a major demographic crisis. So what's going on right now is basically people in China have been buying apartments solely for one reason, for the expectation of a price going up. It's not like you say, well, that's like any investment. No. This investment it leads to zero.
What period? When did that start, and is it ongoing?
It's been going
that's
for
always been the
years.
case.
It's been like for decades. Now look, here's the crazy
It's not like cap rates in the U.S. where people invest for income, right?
No, but here's
there
the
are places
thing,
in
like,
the Midwest in 2012, I was investing it for 12% unlevered, 25% equity returns on apartment buildings I was bidding on in the Midwest.
But these apartments don't get rented out.
The cap rate, they don't get rented out. So it's a zero cap rate.
So these whole neighborhoods, look, Mario, Jay will tell you, these whole neighborhoods, they have not a single soul in them. Buildings upon buildings upon buildings with not a single soul, roads leading to nowhere, etc., etc. And a lot of these contractors started building with very low standards because they know nobody will ever live in these apartments. And like it's like crazy shit that's going on over there. So basically, you buy this apartment with the sole expectations of reselling it later, basically on the greater fool theory, with 0% money making of this apartment, of rent, of nothing. And the price will always go up, right? That's how they see it, because historically the price has always gone up. But what started with the Evergrande crisis, if you remember that name, it's old news now. Evergrande was just the canary in the coal mine. What started going on right now is basically these contractors always needed new money to come in to fund the construction of the old money's apartment that we were supposed to deliver these apartments, et cetera, et cetera. But eventually, like Evergrande was the first time where this thing started to crack and to come apart at the seams like a cheap cushion. At this point, the only thing that's holding up this thing together is the government, like Jay said. The government, the Chinese government is holding this Ponzi scheme together right now. If they let go, this Evergrande was the first time when this whole thing started. Think about it this way. I'm just going to finish with this, sir, guys. I've been ranting too long. If you're a Chinese person and you've been paying mortgage for a long time, you spent a lot of money on an apartment, and at some point you just say, fuck it, I'm just going to stop paying mortgage. What does it mean about the value of the underlying asset that you're just willing to give it up? Is it conceivable to just stop paying mortgage on the property like that? You wouldn't do it unless you know that you're underwater on the property, which they all know. So this is just, sorry, I'm done, but just want to elaborate on Jay's position.
Continue, man.
No, this is just really, really bad. I mean, that whole Chinese...
To support what you're saying, and this is why I think the whole banking system is bankrupt over there, is that as of last quarter, according to Citigroup, 29.1%, a third of all Chinese property loans are now classified as bad debts. But because the Chinese banks are backed by the central bank, the central bank just keeps issuing them loans to paper over these losses. 29.1%. Imagine if there was a stat that came out and said that 29.1% of single family homes in the US, those mortgages were bad debts, right? The S&P would fall 50%.
And okay, and you're saying those are numbers in the US, in China?
These are numbers put together by Citigroup for estimated bad debts in China, and it's based on communication with Chinese banks.
How is their financial system functioning with all this?
The bank is just issuing issuing regional banks loans to paper over losses. The numbers are not real. They're just all the marks haven't marked the loans to market.
So Jay, I mean, with China specifically, right? I mean, I by the way, I agree with you and Tom Nash on everything about the Chinese commercial real estate Ponzi scheme. But, back in 2019, and I'm sure you remember this, Jay, remember Baosheng Bank? The Chinese government seized control of them back in 2019. And I think that was the first seizure in decades that the Chinese government had made of a bank. But when you look at the biggest, banking parties in China, they're on the list of those globally systemically important banks. God, I always mess that up. The GSIBs, but Industrial Commercial Bank of China, China Construction Bank, Agricultural Bank of China, and then the Bank of China itself, right?
Right. Those are systemically important. The thing with Baosheng was it was very small. It was about 22 billion US.
Broader point, I guess the point of my question is that, do you believe that because China's biggest banks are state-owned, that there is, less, I don't want to say less risk, but a much higher probability that the government will fully backstop any solvency issues they have?
They will 100% backstop anything that happens, then they'll paper it over. There is no way they're going to let China Construction Bank go down. It's like if the U.S. were to let J.P. Morgan go down.
Yeah, I agree. I just wanted to hear you agree to that point. But yeah, that's a big distinction here, right? Is that
that's why you can short this stuff, right? Like It's been a short for 15 years.
Yeah, no, I agree. Yeah, if I could short these with the knowledge that the Chinese government would step out of the way, then I would. But you're absolutely right; they won't. They can't afford to. And I think that adds a little bit of a differential element of risk compared to European banks, and even more importantly, American banks, where you may believe that the United States is just as willing to backstop or bail out these banks. But I think the dynamics of that are much, much different in the United States than they are in China, especially considering that China has zero intention of allowing any of those big four banks to have any kind of solvency issue. And even if they do, like you said, they'll paper it over.
But I don't understand, can they artificially sustain their system
Mario,
in
can I just
perpetuity?
give you another piece of information real quick? Mario,
please do. Yeah.
The Chinese government instructed all Chinese state-owned companies to phase out the big four auditors over the next few years, just for that reason.
Yeah, and that was a couple weeks ago. If you don't think that makes China an even bigger risk, I don't know what else.
Hold on.
Right?
So what do you mean? Sorry. Sorry for my ignorance. But what do you mean phase out?
I'll explain. You know how what's the big four, right? PwC, KPMG, Deloitte. I used to work for Deloitte. Shout out to Deloitte. Basically, they audit all they audit all the companies. So the Chinese government said, "Hey, when your contract with Deloitte, PwC, KPMG expires,
no, this is so fucked up. This is so dirty. I don't know.
They said you have to go with the Chinese auditor from now going forward.
So Jay's answer to how they can sustain this is by printing. Okay, how long? So how long can they sustain that for then, Jay?
Well, if they don't release real data, they can sustain it for a very long time.
So no,
they have sustained it. They've kept this Ponzi scheme afloat for at least 2 decades now.
Yeah, and people were talking about this in 2005, 2006.
Yeah, I remember.
Is this any different from back in 2008? So the situation that we had with mortgage-backed securities and in the US and Europe, all the central banks intervened then to prop up and to lend money to all the banks that were basically insolvent for similar reasons. Maybe the scale of it is less, but this is just a parallel of that situation. So
it's a lot different in the US, right? Because we just stopped building. In China, they never stopped building. In the US, we were underbuilding by 600,000 homes per year for a period of almost 16 years. Whereas in China, they just kept building because real estate's so important to the economy. So that's the major difference. And the population was still growing in the US, at least at that time. And in China, the population basically peaked, the working age population, in 2018.
So
the fundamentals are just...
Does the building continue? Because that's not what I've heard. The building
only in the last 1 year.
Pre-pandemic.
But it was continuing for the last 16, whereas in the US, building was much lower since 2008.
Agreed, but they can still follow the same policy that the US and the European central banks did.
They have such an oversupply. I think it would take multiple decades to fill up those buildings.
There were some crazy statistics that in a few years, like 2010, China used more concrete than than the United States did in all of the 20th century. So there's an outrageous amount of investment that went on in China. It's an investment-led economy, and I think trying to transition that from investment back to consumption a little bit has been the essential task of the Chinese government, and it's a very tricky thing. There's massive imbalances that have been there in China, and so they have to manage things very closely. And to Jay's point, if a bank is essentially underwater by government fiat, they can just literally force people to say you're not going to take your money out, and they can literally bring your military in and say there's no runs, disperse, everybody disperse. That's oftentimes what happens.
This is crazy. This is it's like it's interesting that it's working. Like we always thought nothing other than capitalism could work. Yet the Chinese.
Well, I mean, would you say it's working? You can't take your money out of the country, right? Like, why do you have all these Chinese in Vancouver and Canada? They're all trying to leave with all their wealth.
How? Go ahead.
And even then, you have to be politically connected. I mean, if you are, there's been sort of an internal purge that's occurred within China where, many people who were, politically connected had found out that, okay, my assets are going to be kind of taken. So,
sorry, guys,
one of the reasons.
Can I ask you a question? MG, I want to ask you a question. Sorry to interrupt, but I'm just researching this as we speak. I never thought this was going to become a China discussion, but holy shit. The source is asia.nikkei.com. Foreign direct investment into China totaled $42.5 billion in July and December 2022, according to an official balance of payments. That constituted a 73% decline on the year, the sharpest drop dating back to data in 1999.
See, this is why when we had someone on here saying that, there's this other currency, Iran, China, and Russia, that's going to overtake the US dollar. Like, I almost spit up my vegetable omelet. Like I was trying not to choke.
Vegetable omelet.
I was trying not to choke. That's how stupid it was.
So I don't disagree with Jay.
That will not happen.
Yeah, who disagrees with who disagrees? Yeah, Jonathan, please do. Go ahead.
No,
I don't. Mario, do you remember when I had this Kim.com backlash as well? When I was saying the same thing.
Yeah, I've got nothing but love and respect for every speaker, including Kim. But
remember when I went back and forth for like an hour and like absolutely.
Yeah, it was a really good.
I didn't even name him, right? Everyone has the right to say whatever they want.
Tom named him. But yeah, so Tom, you're referring to the first space I ever did, which was like getting close to a year ago now. Tom and Kim were there debating. It was a pretty viral segment that went on for an hour, and I think that was the topic, wasn't it? It was about brick economies versus the US and the Chinese yen as a reserve currency, which is it's a good debate. I think there's arguments to be made for both sides. But so just back to the numbers. Sorry to interrupt you, Tom, but the numbers again. Hold on, but that's a 73% decline. I'll send you through I'll DM it to you now, Jay, and I'll DM it to Evan and Stock Talk.
See you guys.
But
thanks for having me up this morning.
So can I just say, Jay, I don't disagree with you, but we've seen in literally the last week an alliance between Saudi Arabia and Iran for the first time. So that's a Sunni Shia sort of melting of the ice that exists there, which is aligned with Russia and obviously China, which now gives them a sort of influence in regards to oil and gas, critical minerals and materials, which are essential for the energy transition, essential for the new economy, the new clean tech economy that's coming. So that it's more than just finance here. There's sort of
that's absolutely right.
Which are critical, and that's the new battleground.
Energy is definitely the new battleground, but keep in mind they're coming from a place of weakness, right? They're coming from a place where oil prices halved, right, since March of last year, and Iran is in one of the worst economic situations. In Pakistan and Iran are just in a very, very dire straits. And you're looking at Russia as like negative GDP, right? So they're coming from a point of weakness. That's why they're grouping up. If they're coming from a place of strength and doing it, that would be something different.
Well, so
How?
the US is in a unique position, like Canada, because of the energy security that they have. They have their own oil and gas supplies. But Europe is in a very weak position because we don't yet have enough renewables or nuclear, so green alternative energies to oil and gas, to basically power our economies till that point where we do. So that they will become stronger by having this alliance, this energy
Yes,
alliance.
Europe is
And
at the mercy of this
China
alliance.
controls 60 to 80% of the processing capability for all of these raw materials. So between them, they'll control not just the mining element, so the extraction, which will be anywhere from 50 to 60%, but they'll control 60 to 80% of the processing capability, which means that it's catch up, which obviously is driving foreign policy in the US and in Europe. But, don't think this is just going to be, China and Saudi Arabia and Iran and Russia and, all of these other countries that typically have always been allied against the developed world, the Western
Europe's
world.
not going to join them. They're at the
away.
mercy. They're at the mercy of them, but they're not going to join them.
Would you,
No, they won't
Robert?
join them,
Robert,
but we will be weakened. We will be substantially weakened.
Weakened by, so just Jonathan, weakened by what exactly?
Well, we don't have energy security in Europe. If we look at the UK, we have storage capability for fossil fuels, so principally gas. Europe has substantial storage facilities, but
so on that point, so John, on that point, and Allsource with us. Allsource is an expert in geopolitics, but I don't want to shift too much into geopolitics. But taking all these things into consideration, the what's happening in the US and Europe, the foreign direct investment drop of 70-something% in China. And guys, if this is not as serious as I'm making it out to be, please do correct me. But for a 73% decline, the sharpest since 1999, foreign direct investment into China, that seems pretty severe to me. And then the whole real estate Ponzi scheme in China, and then the geopolitical tensions due to Taiwan, which we've covered extensively in this space, and of course the Ukraine war. It just seems there's a lot of moving pieces. There always is, but there's a lot more than usual. I'm just wondering, like, where we see the world economy still doing well, still humming along. I'm just worried that something serious will break, and then obviously we could see I don't want to call it an economic collapse, but a significantly worse situation. I see Robert is back with us. Robert, we kind of shifted towards China and what's happening there, and then I'm trying to bring it back to the world economy. Doesn't that, like the small simplified summary I just gave, doesn't that concern you, Robert?
Well, Mario, I missed the beginning. I mean, a few points on China. I mean, one is they've been able to buy energy incredibly cheap. So we have to take that in consideration that, listen, with China, you never really know, right? The numbers are never really the numbers. So anyone who's collecting data may be unsure. I mean, when we were running UBS, we were the first bank to go into China and do a joint venture and have the first Chinese bank, but we only could own 49%, even though we were running it. It was called Beijing Securities. And UBS, I think, was the largest bank at the time. So we spent a lot of time in China, as you can imagine. Like I said, you never know what the economy is really doing. I would say, because they're such an importer of commodities, that has been a huge benefit to them that I don't think people are taking into consideration. On the flip side, some of the other things they've done, of their investments have certainly, kind of gone off the deep end. The one thing I would say just on the energy markets, the way I view it, and Mario, you and I and your group been talking for a couple of days now of why I'm nervous of inflation. And I don't want to go into geopolitical risk because you guys have already mentioned you don't want to go into geopolitical risk. But my concerns is geopolitical. The way I look, when I was at Salomon Brothers, they had Fibro. When I was at UBS, we bought Enron. So I have some insights to the energy markets. And to me, this is still part of the perfect storm. We have a bit of the embargo from the 70s and 80s that have changed supply. We have a bit of the Persian Gulf War where energy rallied dramatically during the war. And then we have a bit of what I would call the post-Lehman, post-Lehman, post-recession, where energy went up big as well. We have all three of those things going on. The production capacity that someone just mentioned, certainly the impact on Russia. Number two, the war. And number three, the post-COVID environment. We're having all three of those at one time. So when I speak to this group about my concerns of inflation, it always starts right now with a lot of the post-COVID world where demand is different. The services sector, which is much bigger than the durable goods sector that caused earlier inflation, and the geopolitical risk, which I think we just don't think about as much as we should. And so, yes, I think China is an interesting discussion because, whatever they do has the second most important impact to the U.S.
And Robert, wasn't the geopolitical risk a major factor in the decision making to basically stopgap the deposits? Because the argument that was made was that SVB was an innovative bank which allowed for innovation, technology, and that fear was that people would fall behind China. So wasn't that like a significant factor in the decision-making process?
Like I said, I haven't been that close to SVB other than for the last 1 week. But certainly they became, I think your comments on FDI was quite interesting, which actually from an economic perspective is considered an export, which I also think is interesting when we look at data. But I would say that, it's if you're the only show in town like they were, because of geopolitical risk, you're going to grow incredibly fast. And like I said, we saw what that happened for them in 1 year. Even though their market cap got smoked, their balance sheet doubled.
Jonathan, jump in. You were speaking.
No, I was just going to say that there's a fourth element, which is the transition. We're transitioning away from fossil fuels to clean technologies, green energy. And China is exceptionally strong from a processing perspective. We in the West have allowed them to develop their industry and to focus on that. And now they account for between 60 and 80% of processing capabilities for particular, minerals and metals. So this is a fourth element that we have to consider. And this is why you see, with the Invest in America, Inflation Reduction Act, the Green New Industrial Deal, the Critical Minerals Act that von der Leyen came out with and announced today. This is the West now suddenly seeing, wow, we've got it wrong. We've been focused on, financial firepower, but actually the new battleground is the energy transition. Look at the Chinese manufacturers of solar panels. 90% of solar wafers are manufactured in China. You look at cost of goods. The Chinese manufacturers of industrial solar and wind turbine technology are 30% cheaper. Chinese nuclear reactors are now 30% cheaper from a construction per megawatt basis than anything that the West has, from GE to EDF to others. So, now with a combination in the fossil fuel sector of Russia, Saudi Arabia, obviously OPEC plus influence there, and Iran, you've got energy. If you've got the ability to control not just old fossil fuel energy capabilities and generation, so the supply of those products, but also the supply for a period of time, because the West will catch up. We will invest in it. We will gain access to these minerals and materials. But you're seeing a control in the immediate term and the medium term as we transition away.
Also, you don't have to wait, man. You know the drill.
Hey, thanks, Brian. I just wanted to kind of jump in quickly and make the comment on because I think there's a misunderstanding of the Iran-Saudi Arabia agreement that was reached in Beijing. I wouldn't use the term alliance. This was just a restoration of diplomatic relations. And I think there's fundamental that you cannot extrapolate that to say that somehow now Saudi Arabia is going to be in line with Iran, China, or Russia. This is just a restoration of diplomatic relations. Both countries have not had diplomatic relations, I think, since 2016. And there's underlying tensions in the Middle East between both countries that do not, just simply go into Sunni versus Shia. I mean, these are geopolitical tensions that are hard to overcome. And we cannot also ignore the fact that even at this time, Israel in that region, as well as trying to expand its influence and even conversations with Saudi Arabia to restore diplomatic relations. So again, this kind of ties into the BRICS conversation and seeing if Saudi Arabia, we're not even remotely close there. And then on the China economic piece, I'm glad all these speakers are saying this because, I mean, it's clear as day that Chinese economic numbers are just made up. That you can't trust them at face value. And there's so much reporting out there that shows that in entirety, I mean, this is a huge Ponzi scheme, and you just have to look at the real estate. The Chinese, how they structure their finance from the government standpoint, the local governments have to finance the higher government, right? The central government. And so what incentivizes how the local governments, the reason why we're seeing a huge push for building is because of land sales. But ironically, what we're seeing lately is that Chinese local governments are selling land to Chinese local financial corporations that are tied to local government. It's kind of this circle where they'll sell it, the local government, the local finance department will buy it, and then they hope to get builders to build it. And then that's why we're seeing this constant Ponzi scheme in the building sector. So, I think everybody looks at the West and the U.S. with concerns, and I think everybody here is in agreement. I think the biggest concern really is China, and with Xi Jinping's centralization of power and economic policies, it's just going to get worse.
To nuclear power, I mean, I don't know if anyone wants to see made in China on their nuclear power plant, right? Or at least I wouldn't. But I do think that those points are valid. Since 2012, the government has been subsidizing solar to the detriment of U.S. solar companies. And it's because of currencies that those manufacturing prices are actually lower than you see outside of China.
But Jay, just to let you know that the Chinese nuclear reactor technology is based around EDF designs, so they're actually quite safe. And I mean, that not to underestimate maybe how many corners China might cut, but I think it's a little unfair to judge the quality of their nuclear capability before we've sort of had time to see it.
Two from now, but I honestly, I still wouldn't trust, just my gut, I just wouldn't trust anything of that importance being built there.
And on the Saudi-Iran,
relationship, on the price action for banks. So Credit Suisse now is headed back. The stock recovered up to close. Pac West, FRC, both still on the decline, down 20% a pop. Deutsche Bank is getting hit with massive put flow. I mean, people are piling into short Deutsche here, multi-million-dollar flow. And again, flow, take it with a grain of salt.
That's what we talked about this morning, right?
I'm not going to say that. Yeah. I said that was early on next in line.
So out of the names, out of the group,
it's recorded, Robert. It's recorded.
Yeah, the biggest targeters right now, or the biggest stocks being targeted right now, are actually Morgan Stanley and Deutsche Bank. Morgan Stanley's down 6%. Put flow is ramping on that name. And then Deutsche Bank as well, down 10%.
Why Morgan Stanley?
I don't know. I don't know if anyone here has insight on that or why particularly that would be getting targeted. But Morgan Stanley's seeing a ton of sell pressure here and put flow. So, those are just some notes from the price action. But you guys can continue. Sorry to interrupt.
No, man, I'm glad you did. But I'm just really Morgan Stanley surprised me because you'd expect the big banks to do well with the regional banks taking a hit and the money flowing into the big guys.
Yeah, I mean, I think as far as beneficiaries go, you're really looking at the big four. You're looking at Bank of America, Wells Fargo, JP Morgan, and Citigroup. Now, that's purely from a.
And how are they doing? How are they doing? Stock talk.
The stocks are all down. The only big bank stock trading really green today is Schwab, and that's more so behind the CEO's buy yesterday and about the confidence. Yeah, he bought $5.5 million worth of stock yesterday. Might have been a little bit more. But
how when and during 08, in the early stages of 08, how big were the drops in the banking stocks?
Big, but I mean, this is probably the biggest sell-off in banking since 08. I think that's probably accurate, right, Jay?
That's correct.
Yeah.
Plus, Morgan Stanley is a retail. It's not a retail commercial bank. It's more
exactly. I think there probably is maybe some concerns about Morgan Stanley. I know there was a report a few days ago. I didn't read it. I just read the headline, but it was detailing some of Morgan Stanley's exposures to Silicon Valley Bank, and I don't know the extent of those exposures, so I don't want to comment in detail on it, but that could be potentially the reason. But as far as relative weakness candidates go, outside of obviously Credit Suisse today and the two regionals that are getting targeted, PacWest and First Republic, Morgan Stanley is getting a ton of put flow. So somebody's seeing something. I don't know who it is and what they're seeing. But they're seeing something.
One question I have for the crew here is, I was speaking with an investor friend of mine over the weekend, and we're talking about flight to safety generally, right? And we had been in crypto positions as well as fiat positions, and of course, we think a lot in the U.S. about treasuries, which I think looking at the movements in treasuries is really interesting. But his reaction was, actually Switzerland 3-month bond yield, or Swiss 3-month basically is one of the safest places to be. And actually looking at it's down 27%. It looks like on the day. But given what's happening with Credit Suisse, and given that the Swiss don't hold a reserve currency, they're of course one of the most important financial centers in the world. Do we think? Is that the safe place to be? Credit Suisse is so large, and they have to appeal to, the Swiss central bank effectively for help. How do we feel about Swiss 3 months versus 3 month treasuries?
Yeah, if you're in Europe, even outside Europe, that would have been a great place to have been, right? My biggest position was long duration treasuries prior to last week's malaise, and it worked extremely well. You could say, the Swiss bond. Thanks. A lot of people benefited from that. But I think that, the Swiss bond is fine, but just one word of caution, when you see something like this happen, don't just run into something that's already up so much where yields have collapsed. Wait. Because if you just pile drive into something like that with really long duration, and it pulls back 2 months later, you could actually lose. You could have a capital loss. So short-term T-bills at 5% look really great there because they have no duration. So just something to think about.
The way, a little empirical.
MG, you've been here for a while, so go for it, Evan.
I live across the street from a Morgan Stanley office, about 6 floors of it in the city, and nothing out of the ordinary going on there, if you guys are wondering.
I don't know if you'd see it in the office, even if there was something going on. But yeah,
one thing I wanted to add actually on that exact point, someone mentioned earlier that there was difficulties getting money out of SVB, but just to kind of dispel that FUD. So we've been SVB clients since for almost a decade. We had issues with it. Monday was terrible. We couldn't get into things, but it was mostly I think their servers were hit. We got a lot of HTTP 503 errors, but we were able to access it. It looks like it's clear. And for the direct record, we've been able to talk with all of our normal SVB bankers, both on the personal side as well as on the corporate side. So they all seem to be pretty much up for business. Pretty much everyone we need there is there. They seem in good spirits. They're excited about the new CEO. Who knows what all this means, but just simply, there wasn't any difficulty getting our money from SVB to our JP Morgan account. We did eventually get there on Monday. It did take a long time, but that's probably just, servers getting hit, if that's helpful.
How many other people?
There was a headline for SVB. There was a headline that they're opening new accounts and issuing new loans. What the hell does that mean with SVB?
Well,
is that?
They're still operating as a bank, right? They're in FDIC receivership, but they're still operational. The current employees are being paid 1.5 times salary. to continue to work there. I mean, the bank is still doing business. It's just under FDIC receivership while it's doing that business. But EY, one question I have for you before we go to MG, how many other people do you know, at least personally, that were exposed to Silicon Valley that have transferred their accounts to JP Morgan specifically? I'm just curious about that anecdotally.
Well, I don't know about JP Morgan specifically, but, as a founder, I'm in a lot of founder groups, and, they kind of, blew up. I'm talking about like WhatsApp groups, Telegram groups. And, we've been on these groups for quite a while. And these are groups with a lot of founders on them. Several people just didn't have SVB exposure at all, but a significant chunk of us, of course, did have SVB exposure. Where are we sending it? I think I don't know the answer to that, to be frank. I mean, we're lucky we've had a JP Morgan account for years, at least one entity as sort of different accounts. But I think JP Morgan has been a destination, a big destination, of course, because what looks safer than fiat and JP Morgan right now? I mean, there are probably other places, but just it looks pretty darn safe for us. Tech plebs out here who. So I mean, the problem is, though, we're even trying to open a JP Morgan account, even though we are JP Morgan clients and we have access to some of their big bankers on the tech side. They're just deluged, right? So we're trying to open a different account for another entity to transfer cash, and it's just, I mean, they're deluged. They are being responsive on email, of course, but like if you didn't have a JP Morgan account before last Thursday, you ain't putting it in, even now, right?
That's awesome.
Yeah.
So 15 billion of inflows into Bank of America, probably 50 billion plus of inflows into JP Morgan in this.
I was about to say that, Jay. Yeah, I mean, if Bank of America came out and said they had 15 billion inflows, I imagine it was bigger at JP Morgan. But the reason I wanted to know that anecdotally is, even today, and I try not to, base my whole narrative off of the price action, but as a trader, this is what I'm looking at every day. And, today is just interesting to me. I mean, JP Morgan is trading out 5% today. So clearly, at least in the short term, the market's perception here is that there is an element of systemic risk. I mean, the only banking stock that's been able to get any kind of green momentum today is Schwab. And I think that's almost purely behind the confidence that the CEO reinstilled with his buy. And I'm not even sure that this move will last. I mean, the stock's barely green. It was up 3.5% at the peak. I mean, it's still having trouble holding that move. But the rest of these are just crumbling. I mean,
JP Morgan preferreds are just an amazing buy today. If you can buy JP Morgan preferreds at a discount, I mean, it was something I added today. It's a no-brainer. In 5 months, right? That's a pretty good yield.
Yeah, I think you're absolutely right on the preferreds, Jay. But I mean, on the equity, you might have to exercise some patience here, right? It depends on how much the market wants to take, or how seriously the market wants to take the systemic risk, right? I mean, would I be surprised if all of these names are ripped tomorrow? No. Would I be equally surprised if all these names are down another 5% tomorrow? No, right? I mean,
but if the big guys, if the big guys are down, does that show concerns that it is systemic?
No, I think
does that narrative gain more legs?
No, I don't think it necessarily speaks to the idea that it is systemic, but I think it speaks to the idea that the market believes there is systemic risk. I mean, at least in the short term. And this can all be quickly abated, right? I mean, a few strokes of a pen. A few strokes of a pen. I mean, if the international government collective shows tremendous support for the international banking system,
it's
I
over.
think these stocks rebound.
Yeah. If the Swiss come out tomorrow and say, hey, we're bound, we're giving these guys, this guaranteed line, and Germany does the same with Deutsche Bank, right? It's just going to be like the rally you saw yesterday.
So I have a question before you go name. Sorry, just a quick question for Jane Stock Talk. You both expect that to be the case. You both expect governments to support. But you don't expect it.
Well, I think Europe is going to wait a little bit longer than the U.S. So they don't move as quickly. So I think it may happen if things get worse, but they're not going to let CS go down, and they're not going to let DB go down.
Why
so I think
the reason I asked though is, why isn't it priced in though?
Well, is anything priced in? Nothing. Do you believe in efficient market theory?
I try to.
The market pricing.
I don't believe in it.
But
listen. As everyone, people knew about this. JP Morgan, in its own research, acknowledged this HTM hole in SIVB's research, in their own public research, and we're still bullish on the stock 6 months ago. Was that priced in?
We're definitely in a show me economy, and until people actually make explicit claims to back these guys up, people are going to be skeptical. But today's price movement in the bond market, to me, tells me that the bond market has snuffed out that the Fed has to effectively pivot, or at least there's got to be, broad-based sort of easing kind of monetary conditions. Any kind of credit line or any kind of backstop or any kind of guarantee by the European authorities, by the National Bank, by the Fed continuing to do that, those, to me, are a form of monetary easing. And I think that what everybody in the bond market has been saying is, and calling essentially the bluff of the Fed, is that raising interest rates this fast is going to break a whole bunch of stuff, and things are not sustainable. And I think that
and
the
it's
bond
also
market
flow
is
driven, right? So it's
Let's
not. So when you're talking about are things priced in, like if you see a whole, large amount of capital leave, the European fins and the U.S. fins, right? Even if JP Morgan is actually doing better in this environment, right? The major risk to JP Morgan is they just buy somebody, right? And it dilutes their earnings because they're buying something with losses, right? Outside of that, JP Morgan is actually going to do much better in this environment. They will gain market share. So, but as money's leaving the financial indices, right? As people rebalance, you could have days where the stock could be, or weeks when it's down 10%. Right, and those can create buying opportunities at some point. Not now, but some point.
Robert, quickly,
what do you
throw
think?
A question over to Robert.
Yeah, please do.
So Goldman Sachs, they just came out with a quote saying that the small bank stress would have the same impact on growth as roughly 25 to 50 basis points of rate hikes. I would love to hear what you think about that. If this kind of last couple of days has done about 25 to 50 bips worth of the Fed's raising that needed to happen.
Yeah. So thank you. I commented on this a little earlier, and I put it on Twitter, I think, earlier. But two things. One, I think the SNB will absolutely step into Credit Suisse if it has to. I knew the SNB quite well. They stepped in when I was running UBS. And then at that point, my guess is either someone will quickly take them over, or they would sell off different pieces, but, there's going to be a protection. You have one of the systemically important banks in the world, although I do think it's been managed horrifically. With respect to the Fed, I've been very clear. I think the Fed's going to do 25 basis points. A week ago, I was at 50 basis points, and I think this moved them a little. But, inflation hits the world on a daily basis. I've been very clear. I think we're in an inflationary environment. I think the tail's going to be much longer. Whether we're at 6% inflation or 4.5% inflation, we're still, somewhere around 2 times on where the Fed wants to be. I think they should move their level to 3.5% to 4%, but they're not going to out of the blue. And so, yeah, I think will be 25 basis points. I think the ECB will probably do 25 basis points. And I said earlier, the biggest risk we have, if they both do 0, then we should really look under the hood. And I would definitely feel like there are more financial bank problems than meets the eye.
Robert,
I agree with you. I also think the ECB will step in. So the ECB will step in. I mean, you've seen, I think it was Societe Generale, a number of the weaker Italian banks, their share trading was halted.
Yeah.
Hey, Robert, are there any nuances we kind of have to look at here? Oh, sorry, you can go if you want to answer that. I'll come in with another question. I was just going to ask.
So now it's Fitch, Moody's, and S&P all downgrading FRC today.
Those guys are all.
How fortunate are we?
They're just
making new lows now on that, and the regional bank ETFs are falling off a cliff too.
By the way,
go ahead.
How fortunate are we to have Robert in this space? I mean, you guys should actually look up who Robert is and try to understand the magnitude of how beneficial this is for the tens of thousands of people who are listening.
Thank you.
In general, also, when someone says something really smart on Spaces, I think that's a good way to know that person actually knows what they're talking about, and a good account generally to follow. But Robert, I want to ask you a question. If there are kind of any nuances here that we have to look at with Switzerland, it's obviously not a part of the EU directly, but it's very heavily weighted in Europe and will have some big impacts on that. Are there any kind of nuances we have to look at, just kind of based on politically Switzerland not being a part of the EU?
Yes, Switzerland, you could argue, is at times of stress geopolitically, is the most important country there is. They are always at the table being the agent of trying to bring things together, whether it's their relationship with Russia or China or the US. You know, you don't have to have a title to be at the table. And so I would say whether you believe it's called Swiss neutrality or not, I would obviously, based on my background, sometimes I would agree with that. Sometimes I would challenge that. But they're always at the table, and they're so important to financial and geopolitical risk. They just are. And I think we kid ourselves when we think of, you know, there's the G5, there's the G7, but when it comes to, you know, conversations that happen around the globe, they're always at the table.
So, Robert, I mean, I think you can speak to this probably more intimately than anyone as the former CEO of UBS Americas. But what do you think of UBS's statement this morning? We're focused on ourselves with regard to a potential acquisition of Credit Suisse.
So we're talking about, the earlier question was on Switzerland. This is now just on UBS. And I used this comment the other day. I'm an old Salomon Brothers guy. We called this time fixed bayonets time. It's only about protecting your own castle. And during the Lehman crisis, you know, yes, we were all together. There were 10 executives in a room, and we're all call it frenemies. And at first you try to work together to figure out if there was an option to save Lehman. And we knew there wasn't an option to save Lehman. You start then protecting your own castle. And you're doing everything you can to shore up your own balance sheet, your own liability stream. So, of course, UBS, from a management perspective, have to care about themselves 1, 2, and 3. That doesn't mean they're not part of every conversation to make sure that there's not a contagious environment, whether in Switzerland or the broader economy. So just to differentiate the two. I mean, UBS, my guess is UBS is, you know, of course, JP Morgan and others is one of the, by far the biggest beneficiaries because of their private client base and people moving stuff from Credit Suisse to UBS or from Deutsche to UBS. If you're pan-Europe, I guarantee is happening. And it's also one of the reasons, you know, why, you know, in some ways I'm not at UBS. They went on defense instead of offense, and maybe I'm an ugly American. And post the Lehman crisis, I wanted to go on offense and hard charging. And they really wanted to be more of a private client bank, and that worked for them. So I think that they're making sure they're holding hands with their key customers around the globe, and it works for them. And so that doesn't surprise me. I would not be surprised if they're opportunistically looking at Credit Suisse's private bank. I wouldn't be surprised if the S&P is looking at, you know, what is the best way, you know, to not cause a panic with CS. But someone made a comment the other day, recently, I mean, not the other day. I mean, CS is down 80%. They announced that they have problems with their reporting. FINMA's been all over them. They've had turmoil at management. This is not new news. This is just not new news that CS is in trouble. I mean, they announced they were going to spin off their investment bank. People don't make wholesale changes like that because it's business as usual.
Name, jump in.
So, Robert, I know you can comment on this, but yes, correct. This Credit Suisse distress situation has been going on for quite a while now. It's just that today their CDS is at record highs. The spreads are blowing out incredibly, and it's getting more attention. Like, we wouldn't have held a space on this, but
I made the comment only. It's because of Saudi. It's because listen,
exactly.
when I spoke earlier, Mario was allowed me to start early at 9:30 and delayed this for me today. But, you know, listen, during that time of the last crisis, UBS did a rights issue. And I said earlier, GIC and the other sovereign wealth funds out of the Middle East, they came in and they supported. They thought UBS was a great institution, even though the stock went from 65 to God knows what. I think it went down to 15. Their view was long term, this is an attractive opportunity to buy back into it at these distress levels, and we're going to take up our rights, meaning their pro rata rights. All the sovereign wealth funds went in. Saudi National Bank's response today, and I think someone on Mario's call said they own 9.8%, and that at 10% it changes what they have to do from a regulatory shift. Believe me, there could have been convertible loans, there could have been straight debt, there could have been stuff with warrants. There's a lot of ways to skin a cat out there if you want to support a bank.
Yeah, the
They
actual
decided
quote
that
was the answer is absolutely not, for many reasons outside the simplest reason, which is regulatory and statutory. But
and so my view is that enough's enough, and you know, money's fungible. A lot of you guys day trade. Every day you look and choose where you want to put your money to work, and I think they said there's better opportunity. And Credit Suisse is not one of them. And I think the market's telling you that when a stock goes from 8.5 down to 2 and no one wants to buy it at 2, there's a reason.
So, Robert, one other thing I wanted you to comment on because of your experience, and I was around in the financial crisis too on the front line, so I witnessed it firsthand. But back then when the Fed and Treasury were sort of, you know, like Geithner and Paulson were sort of marrying these banks, they were doing it by giving these banks like JP Morgan some backstop or guarantees to the losses. So back to Silicon Valley Bank, there was no buyer. So given what happened during the financial crisis, it's expected we're not going to see banks like JP Morgan or, you know, Wells Fargo or whatever rush in to go buy a bank without those same sort of terms in that they got in the financial crisis, correct?
Yeah, no, great comment. And I commented about this the other day. Everything has changed, right? What happened 15 years ago is not going to happen. Bank bailout where the stockholders live another day and the debt holders are able to negotiate. It's just very different. They're making sure deposits are safe. Away from that, I don't see any money center bank taking on, you know, litigation liability and other liability. And I don't see the government coming in and saying, I'm going to protect you on downside risk on the liabilities you take. So no one's going to, you know, literally step in the unknown territory without a diligence done today that didn't have to be done 15 years ago, right? You got different protections. Those protections are toast. There's just no way that the government in this polarizing environment, my guess, and even that may be around the world, can actually allow, you know, for the most part, you know, banks win and Main Street loses. So I just don't see this similar to 2008 where there were backstops done. I mean, remember, that's why Lehman went under, right? I mean, you know, as one of the 10 executives there that day, the first thing Paulson said when he came in at 4:30, there will be no government bailout. We had 72 hours around the clock to come to a decision. The UK didn't approve. I think it was Barclays at the time on the takeover. And then all the governments, you know, ring-fenced capital. And the contagion hit because capital was not able to, you know, move around the world. Like that's the, you know, UBS, when I was running the investment bank, we were in 27 countries. If you can't move capital, you know, around the globe and there's going to be ring fence, then you're a different company overnight. So I do think, maybe I'm being a little long-winded, everything's changed and you're 100% right. There is no backstop here on the risk, at least in my opinion. that's not on the table.
Not
That's
to
why I
mention,
don't think.
after all the marrying
Sorry.
of these firms back in '08, they didn't have
I think
to.
someone was jumping in or is cutting out.
Can you hear me?
No, I think it's
Yeah,
cutting out.
I can hear you.
Yeah, cool, guys. Yeah. Stock talk. Just a quick update from you, if you don't mind, and how the markets are looking. Anything new?
No, nothing really new. Same place we were at earlier. I mean, your S&P 500 now is peeling back down about 1.8%. And then Credit Suisse continues to make new intra-session lows, now down over 25%. FRC down 25%. PacWest down 20%. Deutsche Bank down 11%. UBS down 10%. Barclays down 10%, Morgan Stanley down 7%, Citigroup down 6%, Goldman Sachs down 6%. So just broad-based selling here. JP Morgan as well down over 5%.
Yeah, I want to add to that too.
By the way,
Mario, there's one thing you're
go ahead, Naim. Yeah, I think I couldn't hear you. Sorry. Go ahead.
People are, there's going to be a rotation out of banks just for hedge funds mainly, and pensions or mutual funds, just to de-risk. But where you're seeing the money going, you got to look at where's the money going, and you're seeing a bid in tech pretty much, or at least not as much of a sell-off. Like Microsoft is up on the day. It's not up, it's not up as much as it was earlier, but Google's higher, Amazon's flat. So they're just, a lot of it is rotating risk. They're moving out of financials into tech and into treasuries, heavily into treasuries today.
Yeah, I agree with that broadly. I mean, I think one note to take out of the price action, if you're one of these banks, is that, again, the only real big bank trading green today is Schwab. And that likely is behind the catalyst of the CEO buying stock. So the market is telling these executives what it wants, at least in the short term. And the statements that have come out of some of these banks, hey, we don't have a solvency crisis. Hey, our liquidity is fine. Hey, our treasuries are hedged. Whatever any of them are saying, the market has given it very little credence. The market isn't trading off of words here. They're trading off of action. And so, one small thing I think some of these banks can do to stop the bleeding in the stocks itself, and this isn't necessarily a solution to any of the core issues we've discussed, but if these banks want to stop the bleeding in the stocks itself, I think the CEOs coming out and outright buying millions of dollars in stock like the Schwab CEO did, the market is saying that's what it wants. The market is prioritizing that as a sign of confidence. So that's just a little note on the price action itself.
I think that's.
I mean,
I think
can I
that's
just one thing I think we should look at on price action, if we just, we're not looking at it day to day. I tend to look at trends. I'm not a day trader. But if I said to you that over the past year, JP Morgan's high low is down 15% off the high and up 25% or 30% off the low, then what happens on a day-to-day basis? You would say in a raising rate environment, and this type of environment where the yield curve, was inverted, JP Morgan, kind of being in a mid-range of the high-low of the year seems to make sense. We're coming off the lowest rate environments. This is the first time over a 1-year period that we had this type of blunt instrument, jammed into us. I could argue.
On that note, Robert, I just wanted to ask you, if the inverted yield curve has been happening for a long time, and proverbially, historically, banks have a really hard time making money, wasn't the bond market essentially telegraphing that financials and big money center banks are going to have a really, really hard time? And then to StockPoint's point, if you're running a big money center firm like UBS or a Credit Suisse, Credit Suisse is maybe a little different, but like a JP Morgan, Bank of America, any of these, do you know enough about your business to confidently go in there and personally put in 10, 20, whatever $1 million in order to give, the market a sign of confidence?
I mean, listen, all I can tell you is I'd like to be able to answer that yes. But, when I bought the UBS rights issue in, I don't know what it was, 2010 or something, and we put all our bonuses into the stock at 21 something. It was a dead cat bounce. It went right down to 12. And I think I probably sold it out even at lower than that. So, yes, I think it's important for management to make, real opinions on their belief. And I think some of these managers, like what Schwab did, I think it's important whether, they say they'll take their bonus in stock or whatever it may be, or, do some things that show the market that they're believers is important. That being said, they don't know what they don't know, right? No one predicted SVP could lose 40 billion deposits in 24 hours because, of how fintech moves now. So we're in a new environment that I haven't been part of. And so it's hard to assess whether management knows what's on the left and right side away from them that impacts them equally.
Can I one follow-up question? Do you think that some of these banks aren't doing that in the sense they're not basically showing kind of explicit support for another failing bank and saying, hey, look, we'll inject, such and such billion equity capital or convertible preferred or whatever.
Absolutely.
Do you think they're not doing it because they're waiting for a bankruptcy to maybe buy them on the cheap? Or is there some gamesmanship involved?
Because it's the first thing I said. We're frenemies. When I went into the Lehman crisis, and I'm going back in history, Lehman Brothers was one of the few firms that didn't kind of all hold hands together when long-term capital was going under. And everyone joined hands to help long-term capital, and Lehman didn't. And, people have long memories. And so, like I said, we're frenemies when you run Wall Street firms. You work together when you have to, but you always look at taking advantage when you can, because at the end of the day, it's about, your company first. But that was a little different back then. There's not real contagion. I mean, most of these bank stocks are at their midpoint over their last year. We were talking about stocks going from 65 to 15. I mean, I'm just making a comment that when we talk global contagion and global risk, don't compare this to 2008. It's just not comparable. What happened in SVB is, I don't want to say a one-off, but it's a one-off. I just don't think we're in a comparable situation. And yes, most people don't want to bail them out until it's at the most distressed point possible, unless it's going to harm them.
So just quickly, so hold on, let me read this out. I'm gonna actually, let me ask you a question. I want to kind of comment on this point, but while you're asking a question, I'm going to tweet something out with a graph just to really compare this to 08. I've kind of hesitated to compare this to 08 because this is a very different situation to what we had back then, and in my opinion, not even close to as bad. But there's a chart I would like to share and get some commentary on. So I'll tweet this out in the next minute or two, and then I'll jump in, Slayman.
Yeah, Robert, I just had a question, just based on some information that I got. So it says, so the information is that a 2-year Treasury yield is now under 4%, but a week ago it was above 5%.
5%. Yeah.
Yeah. So this is the largest 5-day decline in yield since the October 1987 crash.
Yeah.
So is the market calling the Fed's bluff on further tightening after next week's FOMC meeting?
So I think that's a great question. I think a couple things were happening, and I was there in 87 too. So yes, I'm over 60, but I started Wall Street young. Listen, I think that anyone who's in a deposit, my guess is 2-year notes at 4% or 1-year CDs at 4% looks a little attractive over the last few days. I bought treasuries, 2-year treasuries when they were at 5%. I'm probably going to move a lot of my deposits to a 1-year bank CD that you can still get 420 or something, just until I'm, watching different things. I'll put a ladder out. That's what I'll do. So every 3 months I have the ability, to look at where the environment is. No, a few things about the Treasury, because someone talked about the inverted yield curve earlier. I mean, once again,
I disagreed with kind of how the yield curve was performing, partly because I don't see a recession on the horizon. But when you have 50% of the market believing there's a recession, that's going to cause yield curve changes, right? I mean, just by supply demand. And so we are in this environment where you have half the economists thinking the Fed should do nothing or actually even ease. And then you have half of us that think, okay, they should have gone to 50. Today, they should be at 25. I mean, we have never had these type of paradigm shifts where literally half the market thinks we should ease and half the market thinks we should continue to tighten. It doesn't surprise to me that people are moving into a flight to quality environment, but I don't think that's forcing the Fed's hand. In my opinion, their monetary policy and their move on inflation has to be their number one priority. Inflation impacts every person every day around the globe. I hate to say SVB doesn't.
Robert, I really appreciated those insights. One question I have based on that is, you mentioned SVB as a one-off, right? 42 billion coming out, in a day last Thursday, but it feels like from a one-off perspective, right? And we're talking about global banks, in addition to U.S. banks. And, those 42 billion were just, normal people. Tech entrepreneurs, but really just normal people who were scared. And, if you look back at, Washington Mutual, of course, WAMU's collapse, they sustained a fraction of those outflows across something like 10 days. And it really feels like the difference isn't necessarily that, of course, SVB was in a category of its own if you look at its, a balance sheet and things like that. But the difference between now versus 10 years ago is that we can now wire things, right? It's not.
Yeah, no, listen, I've said all along, the speed of social media and digital finance is night and day, and it's moving faster than regulation and faster than asset sales, and people can't keep up. I don't mean to cut you off, but I will say that there's a ton of tools, okay, to make the safety net feel real. And I think that on Sunday night, the FDC and the Fed and the Treasury threaded that needle. And there are more tools to do. That's my only point. They have a lot of tools that they can calm people down. We didn't have those tools in 2008. We didn't. We walked in, and I was one of the largest proponents of Dodd-Frank because we were using tools from the 1930s. We have different tools today, and I mentioned it earlier. There was the transaction payments tool where the FDIC insured all payroll deposits. That was a tool put into place at that time. I think the facility they did the other day that allows, for the most part, the discount window to be extended 1 year at no 10% margin for treasuries is another great tool, and we can make that much bigger. My only point is I'm not saying that there's not issues with regional banks. I'm just saying there's a lot more tools today than we had 15 years ago.
So that was what I said earlier.
Guys, name. Before you jump in, sorry to interrupt. I think it was your name. Robert, can you have a look at the pinned tweet above? So if you scroll up to the top, you'll see it on screen, and everyone else could check it out as well. I've just pinned it. And
what do I look at?
So if you go on your screen now on this space, can you see if you scroll up to the top, there's like tweets pinned at the top, like showing a few tweets that we share.
Okay, I'm not breaking. Is that what you said?
Yeah, there it is. Yeah. So if you look at the chart there, the failures, excluding Silvergate, because officially it hasn't failed yet, Silicon Valley and Signature Bank total, those two failures, even though it's only two banks, at $319 billion in total assets. Now, if you go to 2008, we've got, I know that the 2008 was a lot more systemic and could have been a lot more worse if the government didn't step in, but you're looking at Washington Mutual at 307, IndyMac at 32, and a few other smaller ones. The total is at 374. So if you add Silvergate to this year's numbers, the total assets under management this year so far are larger than 08. I don't know. Again, I understand it's not as systemic as 08, and we don't have the same toxic assets on the balance sheets. But I just have the feeling that we haven't digested how bad things are. I would love your thoughts on it, because I know you've already commented on it, but I'd love you to give us a bit more oversight on those numbers and why they matter or don't matter as much as I think they do.
I mean, we were talking in 08 about Merrill Lynch, Morgan Stanley, UBS. I mean, the largest financial institutions in the world. Lehman was not one of those. And we weren't even allowed to talk about AIG and insurance companies. The shadow banking system and the leverage in the system was monstrous. This would have put the global economy into the deepest recession we would have seen since the 1930s. You would have literally put the banking system on the brink. The banking system is not on the brink. It's just,
but it's not on the brink. It's not until it is. That's why I'm just wondering with how fast information spreads today and how edgy everyone is after 08. Like, we keep making those comparisons, even sometimes unfairly or illogically.
If we said, you know, we're guaranteeing all deposits, okay, which kind of we've said without saying, there's a different safety net right now. Okay, JP Morgan is not stopping work today. I just think that there is, I mean, we're making a very different comparison. Companies were 35 to 40 times levered. It's just very different today. Yes, assets have gone much bigger at these companies. Okay, I mean, if you were a bank north of 50 billion, you were a systemically important institution. I don't know if they would have allowed Silverbank to go to 200 billion or not if they were SIFI. Who knows what would have come down on them? I just will tell you, we have different. I'm not saying that this is not a critical moment. What I'm telling you is we have different tools today. Credit Suisse has a living will. They will be able to go in and understand how to break up the pieces if needed. There are things today that we have that we didn't have before. That's my only point. It's apples and oranges.
Apples and oranges, 100%.
No,
you have a banking system.
It's just not the same.
Yeah, just to add
Lehman
to that,
was using repo 105
in 2008.
Right? And they were levered over 40 times.
There was.
Yeah, I think the key thing.
Just quickly,
the key thing is actually the leverage ratios.
Sorry, guys, just 2 seconds. I missed what Jay said, and then we'll go to the leverage point with Robert and UIC.
In 2005, right, Lehman was levered over 40 times, right? JP Morgan and the big banks in the U.S. have 12% plus tier 1 capital ratios, right? They're levered less than 10 times. And Lehman was hiding its balance sheet using repo 105s, which is a repurchase agreement that a company essentially used to gain funds via short-term loans that are backed by collateral. But
the other thing, just to add to that, is level 3 assets, which means you cannot price them. They were 15 to 20% of everyone's balance sheet. Today, you can't get away with that. Okay, I know Silvergate.
Not even close.
I know Silicon Valley Bank, had a mismatch, but those are assets that 90% you can. I mean, I thought depositors were going to get 100 cents on the dollar anyways, but 90% of those you can monetize in a day, in an hour.
So why do we, Robert? So why do we have Credit Suisse dropping? So guys, why do we have credit? Sorry to keep pressing on this point, and I apologize if those questions don't help the audience. But I'm genuinely curious. Why did the Credit Suisse drop more than they did in 08? It's a single, so they closed at 31% down. But they've been broken for a long time. They've been broken for a long time.
Because you're at a point where they're not generating any profitability. They have a very slim capital buffer, and the market's just going to target the weakest financial institution.
Yeah, well, I understand if it was a 15% drop, but it's a 31%
No, those are
drop
just
in one
arbitrary
day.
numbers. If it was 50, I wouldn't be surprised. If it was 10, I wouldn't be surprised. I mean, with this, how small the market cap is, it's just arbitrary numbers.
Hey, sorry, Robert, I
I think
interrupted you in EYC. Go ahead, guys.
Yeah, I think going back to the leverage ratios is really interesting. Is really the key points, right? Going 40x levered. I think it's really instructive to look at not only past banking crises in the in the 1930s, but actually going back a century earlier. The banking crisis of the 1830s is actually really, really interesting, right? And actually, for the record, the leverage ratios there, the banks were levered about 1.5 to 2x, right? I mean, it's amazing to see how the leverage ratios have grown, right? We think 40x is outlandish relative to 10 or 12x, but it's interesting. But I mean, a lot of similar things were happening in the 1830s, right? From 1830 to 1836, you had if we're talking about safety fund banks in New York, you had about 29 banks that grew to 90 banks, and you had employed capital grow from 6.3 million to 32.5 million, right? Nominal. So I mean, these are just aggregate across the banks. And of course, in 1836, 37, when the banks collapsed, I mean, you had a lot of similar things that have happened in terms of regulatory things coming in and people changing things related to that. But again, going back to it, I think it's just really about the leverage. I mean, back then, 1.5 leverage was enough to be a systemic banking crisis. Of course, tools have changed and things have changed, but a lot of the policy
Right. I mean, the
responses
economy is completely different. You can't even compare, right? I mean, their banks today, they can sell tens of billions of securities in a moment. I don't think you can even compare.
Yeah.
I don't even know how to
I
conceptualize.
think the comparison is more about what do people do in a banking crisis, right? And it's really interesting. I mean, I think that's the thing that's eternal.
So the one thing I want to just comment, I think I don't even know, but I think it was maybe 2004, 2000. I forget what year I became president of Investment Bank globally, which was obviously where most of the risk was at UBS. And at that point, we didn't even have a real asset liability committee, right? All of these banks were like S&Ls. They had overnight deposits, and then they decided where they wanted to buy their assets. All of the big banks today, and like I said, I don't know SVB, but all the big banks have asset liability committees that look at capital adequacy and risk-adjusted capital night and day where it was 15 years ago. Night and day. And the strength, and I think someone made the smart comment, I mean, the leverage in the system is like 10 times today. It's just night and day versus 15 years ago. We didn't know what we didn't know. I joked the other day I was still on a Quotron, but not that far off. But I do think that, listen, regional banks are going to come under pressure, because that's where a lot of people who didn't use big banks, like real estate companies, got loans. And so there's going to be undue pressure because of what assets they have on their balance sheet and what loans they were making. But there's a lot of those regional banks that probably acted incredibly smart, and it's probably a huge buying opportunity. And I think all of these banks have to start communicating. I watched Schwab's interview. I don't know him, but the more CEOs get out, I will tell you one thing that's clear. People are going to be betting on management. When Jamie Dimon walked into the room that 4:30 on that Friday during the Lehman crisis, he was like the freaking consigliere. Okay? There was no question they were fine. Didn't blink. I could tell you some of the heroes of Wall Street that I looked up to. They had red in their eyes and their knees were buckling. Okay, so people are going to make bets on management. Today, people are nervous about CS because their management has been under incredible pressure and people aren't confident in it.
On to your next topic.
So,
you're unmuted.
One thing I wanted to add is, as far as the comparison to 08, it can't, this is not even close to that. I mean, in 08, credit literally froze. Banks, there was major counterparty risk. The banks would not lend to each other. Commercial paper market was buckling. I mean, there was just that was the situation we were in back then, and it's much different. Even though, Mario, I get the tweet you put out of the size of Silicon Valley Bank, it's just still not comparable to the crisis we had.
It wasn't as systemic. Like, my question was more is what could make it more systemic? Because again, 08 wasn't systemic until it was. There was just the amount of leverage and toxicity in the system.
Yeah, and
but I'm just wondering, like, but sorry, that name just I'll give you back the mic. But like my question is, even in 08, like, we didn't know until we knew afterwards. I'm just wondering, and obviously I'm not in a position, you guys are in a better position to kind of comment on those things. But if there's something we just don't know within the system that could break on a much larger scale, I just can't point a finger on it.
It's possible. I mean, that's a good point. And then we we saw this similar type selling in financials in 08. I mean, we sort of knew who was holding what, but you just didn't know. Like, I don't think anyone knew when, and Robert, I'm sure you remember this, when AIG showed up at the door in the midst of the Fed trying to merge these other banks. They're like, what are you guys doing here?
I mean, I brought this up, I don't know, Mario, when I was on my first Twitter Spaces 2 days ago, but I said to everyone that when we left Sunday night, the New York Fed, we did not speak at all in that room about the biggest elephant there was, which was AIG, because the insurance regulator was not in the room. And the Fed, who was in the room, the SEC, and the Treasury, the three of them who were all in the room with us, with the 10 of us that weekend, because they were not the regulator. And that's one of the reasons why systemically important financial institutions include the largest money managers, because of, back then it was because of, if money markets, went under the buck, and the largest insurance companies because of the shadow banking system. So things changed dramatically from that day because they didn't have the tools. But you're 100% right. AIG wasn't even a comment, and they were the biggest elephant. I would tell you, people knew what was going on a little more than met the eye. Just to be clear, but we didn't have great tools to do something about it, right? I mean, Lehman Brothers commercial paper wasn't trading, and their debt wasn't trading anything like, UBS.
The money market funds froze. Today we're talking about, hey, put your money in money market accounts. Right. At that time, they completely froze.
Yeah. So I'm listen, I've said all along, and I've gotten hit on this on Twitter. I said comparing this versus 08 is effing insane. It's ridiculous. And I ran a bank. The people who were saying it didn't run a bank, they didn't understand what tools we had, didn't have, and they didn't understand the leverage in the system. I mean, forget about just the leverage at the banks. There was leverage at the household, right? Credit card debt was 105% of household of household income. We had the consumer was leveraged. Okay, that was the time of subprime, right? The household was leveraged, and the banks were leveraged. I mean, it's insanity to make this comparison.
Not to mention, Robert, there was no.
So Robert, I think we've kind of illustrated, and I agree with you. There are a dramatic amount of differences between today and 2008. But one thing we touched on before you were here, in some of the previous spaces, which I would love to give your thoughts on. Do you feel like banking executives internationally are potentially fearing the fact that one huge difference today from 2008 is that practically all of the world's deposit liquidity is on a hair trigger. I mean, if you look at the digitization, the advance in the digitization of banking, even since 2008, it's dramatic, right? And so do you think there's some concern of the notion that, look, a bank run isn't orchestrated the way that we traditionally think about it anymore? Bank run isn't orchestrated by millions of people, lining up and pounding on the glass and screaming at tellers. It's just orchestrated by a bunch of people on their computers clicking a few buttons. So do you think if this, at least the fear, and I pinned a tweet at the top about short sellers today, 15.7 billion in short positions held as of yesterday. And that just speaks more to the sentiment. But if this sentiment spreads, and isn't it terrifying for bank executives to know that, look, we are just a few clicks away from, trillions of dollars in liquidity. And I'm not saying it would all happen at once, but trillions of dollars in liquidity being demanded by depositors within the few clicks of a button. Is that concept itself scary to you?
Yes, and I'm going to answer that two ways. I'm going to go back in old school. When I became the head of UBS and then we got into trouble, I went to the board and recommended we buy $1 billion of 30-year treasuries. And I said, I hope it's the worst trade we ever did, but it may be the greatest insurance policy we have. And they laughed it off. But it would have made more money than God. Today, if I was a risk manager, listen, it's easy to, after the fact, to say, but today, if I was a risk manager, the first thing you have to do is you have to make sure that deposits are priced right. You just have to. You have to make sure if the market should be at 4%, you're not given 1.5%. You have to pay the market price. And if you don't, that's your first mistake. So it's clear to me that a lot of these players, thought that they were getting away with things that maybe is going to come back and bite them in the ass. Number two, you're now able to, compete with, rolling 3-month treasuries and get a very attractive thing. So yes, the deposit base is a bit fragile. And then the third thing, which I can't even communicate because, I'm not a real social media guy other than Twitter. I'm not on anything else, but I can't believe how fast it moved. I mean, it's unconscionable that 40 billion of deposits could move out because of digital finance in 24 hours. I made this comment the other day. We weren't like It's a Wonderful Life, but 15 years ago, months, never mind 24 hours. So yeah, you're right. The system.
Question for
Joe, hold on one second. So Robert, do you think if banks simply increase their return on deposits, do you think that would solve part of the problem? And obviously the flip side to that is profitability, right?
Yeah, I think it solves part of the problem, one. I also think, listen, if I was, yes, I speak to Washington a lot, but I'm not a decision maker at all. If I was the FDIC or the Fed, I would have announced on Saturday or Friday night immediately that, and I said this on TV, that all depositors would get 75 cents on the dollar Monday morning. And likely within the week, they'd get 100 cents on the dollar. That's one. Number two, I would have tried to call an emergency meeting and get Congress to approve the transactions facility, which increases FDI insurance immediately to cover payroll. There were a couple tools that you could have done that I think would have subsided some of the impact that came about on Monday or Tuesday. That being said, once again, we've never seen digital finance move faster than regulation before. They're way ahead of it, light years. So, what's going on in Twitter is faster than anyone can really manage something.
Robert, to the point you're making on regulators, that we have pace the structure of the banking system adequately to the advance of fintech. What specifically do you think banks can do? And I mean, I think there's no one better than you to speak on this, but what specifically do you think bank executives can do to try to reduce the risk of these hair trigger deposits and to reduce the risk of digital banking?
I think a few things they can do, and I said this earlier, back when we were, during the, I don't know, do you guys hear me or did I get off? No, I just keep getting beeped in. Listen, communication's critically important. Unfortunately, all media is saturated, so it's hard to ever get your voice out. So the ones you have to really concentrate on, you can't worry about,
the stock market as much. You have to worry about your customers. So the first thing you can do is, in my opinion, is tell all the customers, I think, is that you're using the depository facility. I think that there used to be an incredible negative connotation if we use the discount window. And I know to some of you, I'm repeating myself, but when we were at the Fed during that brutal time, we all agreed the banks would use the discount window. So they wouldn't have the haves and have nots. So there wouldn't be a run on us. So that's where we were friends more than enemies. And everyone did that. And the FDIC and the Fed, your Fed regulator, ours was Federal Bank in New York, made sure that we were using it. So that's one. So one, I would make sure if I was a depository institution, not everyone, may get a bank line and facility like First Republic did, but I would say I'm using the depository, and I would actually tell all the regional banks to go in it together. I don't know if it's, a couple billion each, but the 20 people are talking about, maybe they do 1 billion each. Number two, I think it's important that you say, during this time, we're going to make sure we pay the right level. And if that means that your profit, I think one of the reasons the market's down is, and I said this, in response to Bill Ackman's tweet the other day, and, some people saw it, some didn't. I don't have that many followers. But what I did say was, if you want to guarantee all deposits, then banks are going to become a utility. And therefore, we have to look at profit and risk. So I do think part of the reason bank stocks are going down is, I'm not saying they're going to be a utility, but certainly if you're going to think about making sure all deposits are safe, they're going to change risk appetite at many of the banks. They're just not going to say, here's a gift and you guys keep making what you want. So I do think there could be some changes in the year on profitability. And so who knows what one-time book will mean or not mean. But I think it's all about the CEO making sure that all their customers realize where they stand and what they're doing. And if that means it reduces profitability and their stock gets hit a bit, so be it.
Hey, Robert, I have a question for you. I see it more compared to the 20s. Money supply is negative. Only way to get that back up, though, so we don't become deflationary, is to print more money. We can't print more money because our interest rate is high. This is very much the scenario we saw in the 20s, and that 2008 was more of a leverage collapse. 2008 wasn't as much of a leverage collapse, although there was some leverage. Have you been looking at the M2, and what are your thoughts on that?
I haven't, but I would probably look at monetary policy a little different. If I was being honest, we just put, $6 trillion into the system over the last 2 years. So if you ask me, the amount of money we've put in the system, we flooded it. Yes, if banks get hurt, that feels deflationary to me. Once again, I think this is much more short-lived than the Lehman crisis, so I view it very differently. And I would also say I think the economy is incredibly strong. I just think I look at the economics with the half glass fill, as opposed to where half the people look at it the other way. And listen, this was no question, I'm fortunate to have a lot of smart people that I get to talk to, whether it's Austin Goolsbee and others. But, we used to have this debate of, durable inflation versus services inflation. COVID was durable inflation, right? And I said this the other day, people buying Pelotons and furniture and computers and nice chairs to sit on and whatever, and making sure their house is great because they're going to be living there for the next 2 years. Today, we have services inflation, and I think that's real. And I think that, I think wages have been going up higher than inflation. Someone made a comment that they think real inflation is about 4.5%. And I think wages have been going up north of 5%. So I actually think purchasing power is increased, not decreased. Most of you will probably argue with me on that, but I see the economy much more buoyant than meets the eye.
If you have wage inflation global, we're doing a lot of hiring. So, and I see what's happened over the past couple of years after COVID, and a lot of remote workers won't accept anything but a U.S. salary. But I'm not educated enough to know what effect that has globally when there's such huge increase in wages around the world because they're trying to get paid in a U.S. salary, basically.
Yeah, I mean, you're preaching to the choir. I think that we have real wage inflation. I thought what was interesting, and not a lot of people are speaking to about it, because wages was muted in the last labor report, but labor participation was at a 3-year high. We used to say, oh my God, labor participation is getting hit every year. People are leaving the workforce. Actually, it was at a 3-year high and no one even brought it up.
Yeah, what does that do globally? Like, I understand what it does in the US, but does that affect, I mean, is that why we're seeing such high numbers in Europe, basically? Could it be?
I think I would probably just say that coming out of COVID, the inflationary tale is so real. You know, and I mentioned this earlier, you had huge demand during the war. I mean, so we had energy inflation and we had demand inflation. I'm surprised that people think that it can reverse its trend that quickly. I mean, I've been on this case now for a long time. I just see it very differently. I'm more, I'm not saying I said it before him at all because he's a brilliant man, but I'm more of what Larry Fink said this morning, that inflation is going to be at 3.5% to 4% for years. I'm more in that camp.
Yeah, he called it a slow rolling crisis today.
Yeah.
Nim, you got your hand up. You got a question?
Yeah, so I want to make a couple points. First off, and Robert, I know you remember this, and Michael, I'm glad you're back up. First point is the comparison to 2008. You got to remember, this is to the audience, the assets, these subprime assets, mortgage-backed securities, these broker dealers or banks were over levered with, there was no bid in that market for them. So they couldn't, it was very difficult to raise capital by selling those. There was just no bid because all the banks were already, just loaded with them. Second point, as far as why we didn't see any bank come to rush and buy out Silicon Valley Bank. And the point I made earlier was, there was no sort of, government backstop like there was in 2008. And that's why JP Morgan, took Bear Stearns and took, I believe, Washington Mutual, and then, Wells Fargo took Wachovia and, the other mergers and B of A and Merrill. There were a lot of government protections with those. But secondly, the point that everyone's got to remember, Robert, I know you know this, is after the crisis and the dust had settled, the banks were demonized. JP Morgan, they had all these CEOs in front of Congress. They were demonized, even though they sort of helped with, the Fed by, merging with these other banks and taking them under control and sort of assisted with this rescue. They were demonized for years and fined billions of dollars for their efforts. So there's no rush for a JP Morgan, and Jamie Dimon is pretty savvy person. He's not going to be the first one at the table to bid for Silicon Valley Bank after his 2008 experience.
Believe me, I've lived that, all too much. I mean, I think some people commented about my background, but I was running UBS, president of UBS, and at the same time I was advising President Obama. And so, I like to say that Obama fans hated me because I was on Wall Street, and, Main Street hated me because I was on Wall Street too. So, I didn't have either side. But, Yes, there's no question. I said this before. Reputational risk is huge. People are not going to make a decision on their brand, which is the most important thing they can do, without doing different due diligence today, especially when there's no government backstop. I think you're spot on. It's just under no scenario is someone going to make a play without understanding their risks. And they just don't today. The litigation that could take place, who knows where it ends up.
Yeah, just to comment on 08, from my experience, and I don't know if it's anyone else's, but like 50% of the people I knew owned a mortgage lender. It was all over New York. It was like getting into AI and crypto today. It was the mortgage industry then. And it wasn't the smartest people in the room that were doing it either. I feel like the writing was on the wall 2008, and here, I don't think there was any writing on the wall. I don't know if someone feels differently, but I didn't see the signs of it.
So this is Mike Green, and I'm just going to make a couple of quick comments. First of all, Jay, Special Situations, had mentioned this earlier. I can't tell you guys how incredible it is to have a forum in which you have direct access to somebody like Robert Wolf. So I just want to emphasize that before I say the next thing, which is, unfortunately, I really strongly disagree with Robert's assertion that the economy is really strong, and would point out that metrics around real wages, particularly on an aggregate earnings basis, which incorporates things like declining bonuses and incorporates things like falling hours, which we've seen have been sharply negative in a manner that we really haven't seen before, and are very indicative of a loss of purchasing power, which is certainly what everybody's reacting to. If there's really strengthening purchasing power, we would see consumer sentiment rising, and it's simply not doing that. Now, the risk is, of course, that those people who are marginal to the economy start losing their jobs, which is something we're already beginning to see. And at that point, it doesn't fall on an average basis. It rises on an average basis because most people are worse off. So, I think there's a very different statement here in terms of things are going very well. Yes, things are great if you want to work at Chipotle. They are not great anywhere else.
I mean, listen, all I will say, I have a lot of respect for Michael. I think this is where everything is today. 50% thinks the economy is doing okay, and 50% it's not doing okay. And for every piece of data he may add, I may have a different piece of data. I think it's an incredibly tough decision here. And I, I'm going to stick with my view. I hope I'm right. But certainly, the last 72 hours, it feels a little less right.
By the way, just some updates. The 2-year bond has gone back up above 3.9. At least it did for a little bit. So, Robert, I hate to say it, seeing it go back up so quickly is kind of making me feel like you might be right about the 25 basis points. But I'm not going to take defeat yet.
Listen, I will tell you, I think if, like I said, I'm telling you, if ECB does nothing and the Fed does nothing, your conversations are going to be a lot crazier what that means than the ones today. Because then we know what we actually then have answers that says, okay, they're seeing something. And what did they see? And they're now nervous about the global economy. It could be that there's deflationary things they're saying. I don't see any of that. But obviously, if the ECB and the Fed does nothing, then I'll have to look at the new data differently. But once again, that would surprise the hell out of me.
Jay, do you think that
there was what's your perspective if they do raise?
Hey guys, the EYC can go first.
Do raise
Joe, if that's okay. Go ahead, EYC.
I was just going to say there was such a discrepancy between what the ECB did versus the Fed, obviously, in 08. I mean, do we think that, ECB was kind of asleep at the wheel and was hiking into a recession? I mean, how do we feel about, and the ECB structurally is in such a different position, right? Because, at least we're federated states here in the US, but they're more like a loose confederacy over in Europe. I mean, what do we think? How do we think that the ECB may or may not have learned from its issues in 08.
Robert, what do you think? Do you think ECB's learned from 08?
You know, I'm not close enough to it. You know, they also were my regulator, but listen, it's really interesting, right? Because they're seeing what's happening in Italy, which, you know, I mean, it's very difficult versus the U.S. to say whether. I just have this one premise: inflation hits everyone every day. And if you're a politician, something that hits everyone every day that we haven't had for decades has to be top of mind. That's my overall premise, which is why I stay with my view that the Fed is going to stay course, because inflation is something that, you know, and I said this the other day before we had a situation with Credit Suisse, that yeah, if unemployment goes up a little, okay, that hits 1 million people and they'll figure that out. Inflation hits 350 million people. That's still my overwhelming premise.
But don't you think sentiment also hits the people, Robert? Like consumer sentiment, consumer feeling secure?
Yeah, I don't think as many people are being hit as you think. I think a disproportionate amount of people don't have more than 250,000 in deposit, and they feel fine. I think we're kidding ourselves. That I think there's something like 94% of deposits are less than 250, and I may be low.
Now it's interesting because Jay, you had a different point of view on this. You're the point of view that I've adopted now. Thanks for convincing me. But Jay, you know, do you agree that all of this bank failure that we're seeing, or all of this instability in the financial system, Jay, is affecting inflation?
Yes, it's very deflationary if it lasts. And, you know, like I said this earlier, the only thing more deflationary than an atomic bomb hitting a city is a banking crisis. And, you know, there's just no other way to frame it. You have a money multiplier effect. You know, you have even with SIVB, for example, you know, who's going to be lending to those companies? Who's going to be giving them credit lines? You know, who's going to be giving them venture debt? It's not just the deposit issue, right? Even if Oaktree buys some of these lines at 40 to 60 cents on the dollar, they're not going to re-up the lines, right? They just want to buy something at a discount, right? They're not the same type of customer focused lender. So if you do have something that's a little bit more spread out, it will be very, very deflationary.
So Robert, one question is, how does the Fed prevent overshooting here? Like if you were Jerome Powell, God forbid, for your own mental health sake, but if you were him, how would you prevent overshooting?
Yeah, I did raise my hand for one Fed roll at one time, but go ahead.
but really, you know, how would you, because the risk of overshooting here is just as real as the risk of not doing enough, right? I mean, do you not agree?
Yeah. No, of course I agree. And by the way, I think I've been clear for anyone who sees me on TV for a year that they were, or 2 years, or 3 years actually, that I wasn't supportive of QE3 or 4. I wasn't supportive of them calling it transitory. I mean, you know, I think they're smart people at the Fed. That doesn't mean I agree with everything they do. I actually have had probably more disagreements on what they've been doing over the last 3 years. Listen, I believe Powell and them were going to do 50 basis points. So I think 25 is trying to make sure they don't overshoot and put fuel on the fire of what's happening in the banking system. And I agree with the gentleman before that if this situation is longer about the bank problems, then yes, that's deflationary because there's absolutely not money, you know, being handed out to consumers and credit being handed out and loans being available. I'm not disagreeing. I just don't see it as long lived as he sees it, and it's too early to tell who's right. You know, I think everyone's going to be listening to. First of all, they're going to see what happens over the next few days. Yesterday felt a little better than today, right? I mean, if we're being honest, and if Credit Suisse, if there is some sort of announcement, that's a new piece of piece of the puzzle that everyone's going to have to understand what that means. But let's just say I'm making it up. If you had UBS saying I'm buying Credit Suisse, which I'm not saying they are, versus Swiss National Bank, bailing out credits, giving a line to Credit Suisse, those are very different, conversations, right? So we don't know what we don't know. And that's why I said next week, after we know what ECB and Fed does, then we'll really have interesting discussions.
Hey, name redacted. You just
because
posted
those will be the most telling.
Robert, sorry to interrupt. Name redacted. You just posted Zero Hedge's newest tweet. Can you share this with the rest of the group?
Yeah, I mean, it's just this is typical. It's a lot of I guess we used to call it rumorage or whatever. It's just like there's a lot of rumors and sources say and whatnot. But the thing that Zero Hedge and other accounts that Walter Bloomberg put out was these are by the way coming across the Bloomberg terminal. These headlines is that BNP is stopped. Basically, they're reducing their risk, counterparty risk to Credit Suisse by. So that it just adding to just compounding what the headlines we've been seeing all day, and that's
a little scary for Credit Suisse right now.
Yeah, not surprising.
Robert, what are your thoughts on the fact that others are pulling back their counterparty exposure?
You wouldn't be a risk manager if you didn't.
Exactly.
I mean, this isn't even a question. You get paid to risk manage. And if you're not looking at Credit Suisse differently today than yesterday, something's wrong.
But Robert, isn't this scary? Because if Credit Suisse, I mean, isn't this essentially, I don't want to say contagion because it's not a contagion, but a self-fulfilling prophecy?
See, I think of Credit Suisse, it's once again, yes. If one of the systemically important financial institutions goes down, that definitely reverberates. That being said, I think no one should be that surprised that Credit Suisse is in trouble. I mean, you're talking about a bank that stock went down 80% in a year. I mentioned earlier that JP Chase is at the midpoint, actually better than the midpoint over the last year. So we're talking about strong banks versus weak banks are apples and oranges. If you look at the strong banks, they're all performing okay. CS is an outlier. Then add the FINMA reporting issue, and then add today's news on Saudi National Bank. The idea that we're comparing anything to Credit Suisse, that doesn't mean it doesn't have reverberations, makes no academic sense.
Yeah, I mean, that makes complete sense. Joa, did you have a question for Robert?
Yeah, I mean, just because rarely do you get someone who might be as knowledgeable about this, but since UBS is a Swiss bank or started in Switzerland, Switzerland has inflation under control, even during this COVID period, because of the way their central bank set up, and it's not that old. Their new system is not that old. I think it's 20 years, I guess, somewhere around there.
Yeah, it was a former UBS guy who set it up.
Right. So why doesn't the U.S. do something like that? Because then we take inflation out of the picture in all reality. Even their energy prices remain stable while the rest of Europe skyrocketed. We have enough resources to do it.
I mean, all I will say, it's a lot different when you have, I mean, the size of Switzerland and the way they looked at risk, which was mainly a private client. It's just hard to, you can't put the United States in that type of sandbox.
Yeah, it's like saying Sweden has such a great economy and everyone's so happy. I mean, look at the population.
I mean, it just doesn't, it's just not the same. It's
we're just too big.
You're talking about an ocean versus sandbox.
And we're talking about different approaches towards capitalism, right? Like we're looking for higher yield, higher profit, and I think they're thinking about client risk. So it's a little bit different. EYC, did you have a question for Robert? saw you on mute. So, Robert, looking now, let's say in the next 24 hours, what are you looking at to make that final, I know you've been asked this question a couple of times, but as Credit Suisse continues to unravel, which is going to, like you said, any good risk manager, BNP is not the last one, right? So any good manager, a risk manager is going to say, okay, we're gonna stop, reduce our exposure to Credit Suisse. As it continues to unravel, what is the one thing where you're like, oh shit, now it's actually hit the fan in the next 24 hours?
I mean, I don't think we're going to hear anything out of the U.S., right? I don't think they're going to say we're extending a facility. I don't think they're watching the stock market. Yesterday it went up, today it went down. I don't think they're going to make a decision when there's really no news on that.
If you were advising Biden,
I think the only, one, we have to obviously think about the ECB, but to me right now, it's all hands on Credit Suisse. And if they can get some sort of capital infusion, right? Or is it going to be a lifeline from the Swiss National Bank? My gut tells me, we'll know sooner than later on that. You don't have Saudi make an announcement the way they made and Credit Suisse sit on their hands and do nothing. They see what's happening. And when you start losing your counterparty lines, my guess is they're losing deposits. My guess is private clients are saying, you know what, not feeling too good. They have to make some really quick decisions and announcements. And, I don't know what the timetable is, but, it's short.
Well, that's ominous. So if you, I'm sorry, go ahead.
Yeah, no, I hate to say the market's usually efficient. Right?
Exactly. So in terms of if you were an advisor to Obama, so let's say you were advising Biden right now, we can all agree that Biden coming out, may or may not have helped. It was sort of neutral. Some, depending on where your politics are, you might say it wasn't good enough, or if you're pro Biden, it's very, very good. So, but in reality, it was more neutral for the markets. What can the administration do to actually shore up consumer confidence? And then also, in terms of actual policy, could they do in the next 24 hours to prevent some issue going on? Something this getting bigger.
Yeah. So, I'm not part of the administration. Obviously, I'm close to most of the people there. I don't think there's anything they have to do in the next 24 hours. I actually think what they did Sunday night, I think they threaded the needle. A couple things. They're not going to come out with an announcement, we guarantee all deposits. One, I don't even think they can. They'll need congressional approval. Number two, there's not enough money. That's $17 trillion. I think they made the best statement they could, that deposits are safe. Not they made, but I think some of the people have made deposits are safe. I think number two, I think we're underestimating the facility they did, which I'm repeating myself again. That is a 1-year discount window at no haircut. They can obviously try to make that bigger. My guess, if need be, I'm sure they could find money from that at Treasury. So that's one thing they could do if there's a nervousness. And then the third thing, I think they could have emergency congressional vote. I'm not sure that the FDIC is asking for it or not, because my guess is they probably don't think it's needed yet. But they could do the transactional, facility for payroll that, puts FDIC insurance much greater than $250,000. What it does, it puts it at the payroll. And I mentioned this, I know I'm repeating myself. The FDIC did that, during the Lehman crisis. It definitely helped dramatically, but I think that that was not considered
they did not have that jurisdictional approval. So I think now it needs to be Congress. Those are the few things that I think, I don't think they have to do anything in the next 24 hours, personally speaking. I mean, but that would be my view.
Yeah.
Robert,
I mean,
I agree with you. I think the ball's in the EU's court, so it's really up to SNB, the Swiss National Bank, and the ECB to step in here. But I don't think they need to do it quickly. Need to do it sooner rather than later, because you're seeing trading being halted in BNP Paribas, Societe Generale, Italian banks. It's not going to be too long before you see that happen in German banks. So they just need to get ahead of it.
Well, trading halting is unfortunate, right? That's a volatility measure. And, I think BNP, if I looked at them year on year, I don't know. I mean, let's see, BNPP. I've been pretty right on this. They're 2770, right? The U.S. equivalent, and they were as low as 20 and as high as 35. So they're dead center middle. Like I said, I think the big banks, are nothing like what happened at Credit Suisse. Remember Silicon Valley Bank before they went down. Remember, they were down from 40 billion to 13 billion year on year. So the market is pretty intelligent.
Yeah, remember, Robert, though, that capital ratios are lower in Europe than they are for similar sized banks in the US.
Yes, but BNP is a systemically important financial institution, and oversight by the Fed.
So
as well.
So Robert, one of the other things is
they're great. By the way, BNP is a great firm.
Yeah, absolutely. I was going to say, outside of, so now that we've kind of talked about what's going to happen in the next 24 hours, what you're going to be looking at, is there any other, there's been a lot of talks around used auto loan. There's other sectors that are connected, and this contention that this could be a death by 1,000 cuts, where now suddenly you're getting you're seeing some of your higher concern areas where like Jay was saying, sentiment changes, people start dropping auto loans, the value of the auto loan drops. How does that affect these smaller regional banks that are probably overweight on riskier assets?
Yeah, well, it definitely impacts them, right? I think, there are going to be some regional banks that have serious trouble because of where they are with their lending, and whether it's commercial or auto or whatever it may be. Michael may have a different view. I still think the consumer's strong. And that's where we differentiate a bit. I thought this morning, yes, it's backwards looking, but Lennar had great profits based on home prices being up. So I think it will be interesting to see. Recall what I said the other day. The housing market and the auto market, still look pretty strong versus, pre-COVID times.
Michael, what do you think? Is Michael still there?
I'd like to jump in.
Yeah, go ahead, UIC.
Yeah, I'd love to provide some commentary about and actually get the people's feedback. This has been a fascinating discussion. But SVB is back in business, right? Under obviously a new entity, but they're still originating. So word is, I'm one of these founder groups as a tech founder, and a lot of people are reporting that they're continuing to originate loans. Venture debt may be a question, but things like mortgages, et cetera. And if you think about the months and time before leading up to the collapse of SVB, they were desperately trying to replace some of their long duration assets with, other types of things like venture debt, for example, maybe more risky, as well as mortgages. A lot of times to, for example, tech founders. And that's actually still happening. So that's something I found fascinating. So I would have assumed that those loan originations would have been halted, but not only is SVB back for business, but they're going to continue to try to do that. I'd love to get people's commentary on that overall.
The mortgage business is a very small percentage of the overall business. And, the FDIC gave 45-day employment letters to 8,500 employees. I don't know how many were accepted. I'm assuming a lot were. But this is a bridge, right? They can't just let the business just run off to zero. It was a bridge to sell, and they're still trying to sell the business or parts of the business. So I don't think you're going to see any of that venture lending until there's a new acquirer. And that's the biggest part of it.
Or is venture lending kind of off? I mean, that's a big question, right?
It could be off the table, right? Depends on who buys it, right? If it's like a distressed lender that buys it, it's completely off the table.
Yeah, I mean, if we think about fundamentally what venture lending is, right? I mean, at the end of the day, it is basically a loan to a startup it's basically a loan to a startup.
It's a Ponzi loan, right? It's a loan to the next capital round.
To the next capital round, right? Well, is it a Ponzi round? I don't know. That's kind of a philosophical, bigger question. And for a good company, it's not, right? Yeah. For a good company, it's great. I mean, if
for a good company, it's not. But then it wouldn't be a venture loan, right?
I mean, like for example, OpenAI, right?
No, I'm not sure that's. I'm not sure that's a theoretical distinction. But by definition, it's money losing enterprise that must raise money from the next group of investors. That is to pay out the existing investors. That's a Ponzi. It could eventually become a real business, and they're gambling on that, they're betting on that, et cetera. But at this stage, it is a form of Ponzi finance.
Well, let's give. There's interesting discussion on that. I mean, for example, given all the chat GPT, it's interesting. All the VCs have gone from being a Ukraine war expert to being a banking expert over the weekend, and now being an AI chat GPT 4 expert. If you look at LinkedIn yesterday, as things were calming down, which is a whole commentary on that whole sector in general. But and for example, if people could invest in OpenAI today or yesterday, and it goes company by company on this, right? I mean, I think who knows whether fundamentally where it is, but certainly from a sentiment perspective, people are so excited about ChatGPT 4 that, that would be an interesting thing if it were a public company, right? So, I mean, I think the question about venture lending in general is about company by company. Systemically is an open question, as people here have pointed out. And I'd be curious to get people's thoughts on all of those things.
How many of these companies, very large percentage of these companies go away, right? Some of them are bought for their talent, right? Acqui-hires. Some of them just go out of business, and a few are sold, and very, very few make it to IPO. But it's very hard, to make that type of bet when you're not in this SIVB business, or you're not a Comerica, and I don't think Comerica has the power or the size to buy them. And PacWest certainly doesn't, unless you have that culture and you have those relationships with VCs and you're willing to put your money behind the VCs, which now I don't think, why would you, right? If I was a new bank buying SIVB, why would I trust the VCs after what they did, right? It's all based on faith and all based on capital raising. So the next buyer of SIVB is going to be much more critical of the business model. It's going to be much more
Jay,
critical.
Not to interject, I mean, I agree with you. You and me, I think we're in full agreement about how silly it was for Peter Thiel and the Founders Fund and the NY Combinator to unleash this, sentiment, if you will, and that's at least partially what contributed to the $42 billion in withdrawal requests intraday. But we touched on this a few spaces ago, and now that we have Robert here, Robert, I'm curious to get your input on this. But we talked about how over the course of the last 15 years, the risk perception landscape for small companies in the growth and technology space, that high cash burn companies that haven't earned a profit in a long time, that don't plan or aren't projected to earn a profit in a long time, the risk for providing those types of companies credit facilities in the last 15 years, I mean, broadly speaking, has been much lower than it is today, right? I mean, the last 6 months of rate hikes have dramatically changed the perception of value for these long duration growth and technology companies that, you know, again, are just not the most ideal candidates for loans or credit facilities. So I'm curious, Robert, do you think that changing landscape, and Jay, we'll go to you right after, do you think that changing landscape has affected the perceived value of a bank like Silicon Valley Bank's loan book? And, you know, what are your just general thoughts on that, on the changing landscape and the changing perception of risk for, you know, providing loans and credit facilities to these high cash burn smaller companies?
That's a great question. And I'm kind of, you know, in the midst of some of that type of discussion now. I became chairman of Community over the summer, which is the hyper-personalized text messaging company that was founded by Ashton Kutcher and Guy Oseary. So, you know, one of the things that changed, right? This was a, you know, 2019, you know, type vintage, you know, entrepreneurial startup. And I came in at 2022 and obviously, you know, restructured the valuation of the company and the cap table, because it's clear that, you know, what was vintage 2019, 2020, and 2021, I don't have to tell all of you, is different in 2022. And yes, EBITDA is more important and valuation have to be more in sync because, you know, you only have two options of capital, right? You either take a loan or you take more equity. And things are definitely tougher out there unless you have, you know, in my opinion, strict governance on how capital is used, or a platform, a technology platform that has the ability to be quite successful. I mean, we at our company have the ability to take facilities on against our receivables because we have good receivables. But I think, yes, the environment, the value of a Silicon Valley bank, although still there, you know, those type of loans are, you know, fewer and far between, right? People, you know, are nervous about, you know, just taking a loan because of liquidation preference on an early stage company.
Right. Jay, any thoughts on that?
That's 100% right. I mean, if you look at the Russell, right, 60% of the Russell is not GAAP profitable. Now think about, you know, those are public stocks. They have equity as a currency. They can do ATMs. When you look at private companies, you know, outside of the VC and outside of an acquirer, right, and given where rates are and the cost of capital, right, it's going to be tough to make those acquisitions where they're dilutive to EPS or free cash flow. Outside of those scenarios, it is 100% Ponzi finance. And if you guys recall what happened and this is not 2008, but if you recall what happened at that time, there are companies that, same thing in 2000, 2001, that, you know, their stock prices fell 95% and they didn't move for years, right? Because there's just no concept. There's no bridge to profitability. So I think that the venture landscape is very fortunate that they raised $500 billion of dry powder. I would not be surprised if a lot of these venture firms are marking down entire vintages of funds 80, 90%. And outside of like the top companies, right, you're going to have a number of businesses that, you know, you would be worried to even lend to them, even at like the best terms, right? You're seeing new rounds and new valuations just get cut overnight by like 50, 60%. And founders are just bewildered, right? Because they're basing their cash burn assumptions on, okay, this is how much capital I can raise at this price. This is my Series B. I can raise $500,000 or $5 million, and I have 10 people or I have 100 people that I need to employ for the next 6 to 18 months. You can't make those decisions anymore. So it ends up just shrinking the entire ecosystem.
Jay, do you think the general, you know, likelihood of hyper specialized $200 billion plus banks, you know, existing?
Joe, sorry, it's Stock Talk. I just wanted to interrupt because Robert has to jump off in a couple of minutes. So just thought I'd give him a final word and another thanks for jumping on twice today, and then we'll get back to your question, Stock Talk. Robert, thank you again for jumping in. We'd love your final words for the audience.
Yeah, listen, I love being on these calls, and I appreciate that some people want to hear my views and share other views. I mean, this is a free education for all of us, and this is we're in a very volatile environment. And I think the more we can listen to smart people and hear and share ideas, maybe you leave the phone and it helps you make one decision a little differently than you would have beforehand. I think we're going to have a lot of interesting discussions over the next week. And so, Mario, I appreciate you and the rest of your hosts giving me that time. So, I look forward to our next one.
I appreciate it, Robert.
Go for it. Anyone's in the audience, I was just going to say, drop Robert a follow. Obviously, he has tremendous amounts of industry experience.
The ability, the ability to jump in and I feel like we're a fly on, even myself as a host, just a fly on the wall listening to these conversations. It's kind of behind the scenes conversations that you don't get on most media platforms.
Even as somebody who's exposed to myself, it's been an honor.
I've listened to a lot of your conversations, but I only chimed in because I was listening to Ackman and Cuban, and I kind of felt like, okay, maybe I'll give a different perspective.
No, I appreciate you jumping on, Robert.
Thank you. And if you guys, if you have questions, I mean, Twitter, DM, Mario has my information, but I appreciate you guys. And I look forward to our next one soon.
Thanks a lot, Robert. Thank you. I want to go back to first Ophir. Welcome to the stage. We've been trying to get you up for a while, Mr. Gottlieb. But while getting Gottlieb up, Stock Talk, I'll give you the mic back. Sorry to interrupt.
It looks like Ophir disconnected again. We were trying to connect him yesterday to his space. He was having some issues. It looks like he disconnected again. So
yeah, I'll figure it out.
Sure how we can resolve that. But yeah, I'm sure you'll figure it out. But yeah, Jay, I guess my broader question, and this goes to Michael as well, but do you think the likelihood of, hyper specialized banks of the size of Silicon Valley, $200 billion plus banks, do you think the likelihood of those types of banks existing has, maybe slightly decreased?
No, they will exist. This bank was just a complete, I don't even want to use bad language on here because I can't, but it was just, the CEO was just completely, despite being on the board of the San Francisco Fed, had just no idea about in interest rate risk, top ticking a $90 billion purchase of 10-year duration MBS. And secondly, the entire culture of the bank is just not appropriate in this type of environment. You can't compare it to other 200. I'm not even going to name the other $200 billion banks because I don't want them to scare anyone. It's not the purpose of this. It's education. And listen, there are going to be several $200 billion banks, and they're going to be, that are going to exist. They're going to be most 95% of these banks or more are going to be around a year from now, 5 years from now. So maybe some of them will be acquired, but this is not like 2008. I was very deeply involved. I was one of the biggest holders of LBHI, of Lehman Holdco paper, throughout the crisis. So this is nothing like it.
So I would echo some of what Jay said. It is certainly not yet like 2008. We have not seen the game play out entirely. We don't know the policy responses. We don't know whether Jay Powell is going to reverse. We don't know whether he's going to accelerate based on a perception of inflation, et cetera. So I'm withholding judgment until that point. It does, and I would also echo, and I wrote about this in my Substack, and I encourage people to take a look at my profile and read that article, because I think it does a pretty reasonable job of laying out a balanced perspective of what happened with Silicon Valley Bank. And I totally agree. Management made terrible choices. The culture of the bank was troublesome. In general, I would argue that Silicon Valley has, I was very surprised moving out from New York back to San Francisco to see the culture of Silicon Valley and to see the level of business decisions that were being made. It very much has characteristics of Ponzi finance, as we were discussing earlier. So I do think that there are unique components here. I've put out plenty of tweets that highlight this. Like, this was truly an unprecedented change in interest rate policy that I struggle to fully lay at the feet of any one management team for not properly understanding that. And I do think it is actually really important that we emphasize that everyone that was super anti the Fed when they were cutting rates and bailing things out and doing all that sort of stuff were super enthusiastic about the Fed hiking in an unprecedented manner because, hey, they had to behave responsibly. It was irresponsible in both directions.
I know it's really popular.
I don't think you can blame the Fed. I don't think you can blame the Fed for this. I think 95% of this was in the CEO's hands. Now, is the Fed right? Have they gone too far? We might see in 6 months that is the case. Something was going to break no matter what. But in this case, in the case of SBNY, which was going to be investigated by the DOJ and the SEC for anti-money laundering, and Silvergate would shut down before this even started, the 3 banks that have actually closed were probably going to have major problems already. And you could say the same thing for CS.
I know it's really popular to be anti-tech technology.
I totally agree.
But as somebody who's been in technology for years, and I love this industry, and there are things that in the last few years things really got out of whack. With high valuations, on cash flow negative companies. But if we're to step back, and if we think productivity gains are really the major drivers of ongoing forward of our economy, as they always have been. Population growth and productivity gains. What are we excited about? I'm talking about long term as Americans, right? The tech industry, for all its faults and now being unpopular and VCs being unpopular, like if we think about global competitiveness, against China and other countries, the EU, et cetera, in an emerging Africa, is there a brighter spot in our economy than tech companies? For all the failures, in the last generation, you had Google and Facebook and Microsoft. This generation, you're going to have things like OpenAI. You're going to have hopefully some crypto companies if we don't get regulated out and squeezed. Of course, there's things in the real economy. I'm not trying to say that there are other parts of the economy, but back when I was a VC a long time ago, we used to say that our companies eventually generated, like as an industry, something like 20% plus of US GDP. So, just kind of throwing out the baby with the bathwater. I don't find, still I go back, I don't find I'm more excited about anything else in this country than tech, right? And if we have this,
but there's a lot to be excited about, and it doesn't mean tech is a bad thing. Tech is great, but there's a lot to do when it comes to infrastructure. There's a lot to do when it comes to streamlining the healthcare sector, which is an unbelievable opportunity. There's a lot to be excited about when it comes to reforming education. When it comes to making money, and productivity gains, right? Tech is still the place to be, but you have to bifurcate the companies that, were invested in at reasonable valuations, where they have a viable business model, where they're not like scooter, the 20th scooter company or food delivery company. There's a lot of excess in the system. And just like 2000, 2001, you'll have some of the best companies come out of this. But that doesn't mean that there isn't a lot of excess in this space. So I think that tech is a wonderful sector, and a lot of innovation actually happens in free cash flow positive tech companies as well. It's not just venture. I've done some deals with Venrock, and I've done some stuff personally over the years. And when I found that these guys were just offering money, to kids, with no thesis, right? And they were telling them, hey, I don't care about gross profit. I don't care about unit economics, just revenue. It really became, Ponzi economics to an extent where you could never become public for some of these companies. So you just need to dampen the enthusiasm a bit, but tech will continue to grow for the next 20 years in this country.
So, Jay, I actually agree with a lot of what you're saying, and I appreciate it. I do think that there is access. As somebody who's on the ground and worked as a founder in the tech space, I think there is absolutely excess that needs to, we need a little bit of Joseph Schumpeter in here to give us some creative destruction in the space and clear out some companies. So I think I'm pretty aligned with what you're saying, but I think, having lived a long time in San Francisco, the Bay Area, and before that, living a long time in New York and in the East Coast, and growing up in the East Coast, there's kind of this kind of philosophical question that's interesting. It's that, the Bay Area, for all its faults, is extremely open-minded, right? In a way that maybe doesn't exist to the same degree anywhere else in the country. And so one could argue, and I think is right, that, hey, there's excess in the tech system and you're lending to people with PowerPoint slides that don't seem to have a clue what they're doing. But on the flip side, you could argue that open-mindedness and the culture of that is what is able to create these outsized innovations, right? Because if you look at Facebook or any other major innovation, it's like, you laugh at it at first, right? Facebook was a joke at first, and then it didn't become a joke. And that's true of everything. Like, if you think of all the major companies, they would never have been able to get their start without the culture of open-mindedness.
So that no one's arguing that. No one's arguing that, right? But venture has existed, right? It existed in Boston, and that's kind of when I got my first taste of venture. And you didn't need this amount of debt, right? You don't need debt. VCs are trying to accelerate their returns, and the only reason you needed so much debt is valuations got so out of proportion. Most of these companies don't need debt. It's completely unnecessary. You should have all equity deals. And open-mindedness is wonderful, and I think people will continue to be open-minded. I just think it makes sense to be a little bit more critical, of a business model, asking them, instead of selling your unprofitable company, what's your 5-10 year plan? Even if it doesn't work out that way, which we know nothing ever works out the way you plan, people need to put more time into understanding, could this be a real business? Could it actually generate positive economic returns? And you had a lot of rich, ex-Facebook guys and Amazon guys and Google guys who don't have anything to do. So they've started their own VCs, right? So I would argue that there are too many VCs, right? Just like there are too many hedge funds. And I had the same types of conversations, during 2001 with a lot of the SaaS bros and tech bros. And I was reading some of these prospectuses and S1s. They're like 164 tech IPOs. And I almost went blind reading through all this stuff. And every single company would say, oh, we are a monopoly. I'm like, all right, so you're a monopoly in this part of software, and this other company is a monopoly in that part of software. Eventually, your TAMs are going to overlap, and you're not going to be a monopoly anymore. So there's just a lot of nonsense that, just using common sense, you don't even need to go to school, to have some of these common sense discussions, where I'm surprised with the level of education in the Valley that they don't have these types of common sense conversations.
Yeah, and actually to flip and completely support a part of what you're saying. No, the venture debt thing, I'm completely I for one have never either raised venture debt nor would I invest in that as an asset class as somebody who's kind of been on the ground. So venture debt, totally agree with you. But the interesting kind of flip side, right, is, and also kind of the interesting thing about SVB in particular is you could argue that if SVB went down, that you have these people flush with money, right? At least the venture capitalists that didn't have their money at SVB, right? Let's talk about rewind to a few days ago, right? Quaint old Friday, Saturday, Sunday, which seems like forever ago. You could argue that people with capital there knew the most about the companies, and you could let the bank go down, let the depositors lose their money. And I'm speaking against my own industry here, right? Just presenting a thought experiment. And then the venture capitalists who know the most about their companies would be the ones to invest more capital in the ones that failed only because they happen to have their bank deposited at SVB, not because they were a bad company, right? I think that's one line of argument I've heard, and I don't think it's necessarily totally wrong to think about. But I think the big thing is systemically SVB, and we'll see where it goes, right, is been such an important institution for 40 years, and the culture, right? I mean, we're talking about the culture of SVB. Clearly they did a lot wrong, and I don't disagree that they did a lot wrong. But at the end of the day, if you go back and rewind the clock, right, the biggest problem was their long duration, was basically a duration mismatch, right? And if you go all the way back, it's SVB having so many deposits from all the capital raised as a company. And you're managing this bank. What do? You're going to buy the safest thing possible, which is treasuries, right? And that's long dated treasuries.
They bought mortgage bonds with 10-year duration. They didn't buy T-bills, right? Like Silvergate did. Even though that was a worse business model, the CEO is actually smarter when it came to that.
Jay, I just want to make sure that people are aware. So first of all, I agree with a lot of the things that you're saying, but when they bought those mortgage bonds, the expectation was the duration was closer to 3 to 5 years for the portfolio. It's the rise in interest rates that blew out that duration.
Yep, yeah, and at the time, the Fed is saying, hey, inflation is transitory. I mean, we got to think back to when they were buying these assets.
They didn't buy
but it's
them
transitory.
in early 2001 when the Fed was saying it was transitory. They bought it well into expectations of the Fed rising rates, and they got so big that they couldn't unwind it. And you can actually look at when the CEO's 10b1 filing was actually put together. He knew months before that he had a big problem. And I think this is going to be looked into. And it's not just that. It's not just the securities. It had to be another thing, which is that the entire business was a Ponzi, in that because these companies burn 10 to 30% of their money per month. The only way to replace those deposits quickly was to raise more money from venture capital. And guess what happened? Venture capital funding started to dry up. In the second and third quarter, people stopped raising new money. And as a result, this company was losing 20 billion of deposits in the third quarter of last year. It would have blown up anyway, but it would have been several months, if not a couple of years from now. And maybe they would have been able to raise capital. Who knows?
So how much, it's really interesting to hear the details, and actually I'd love to kind of look into it a little more, but do you think therefore
look at the third quarter 10Q on SEC, Edgar, and then the fourth quarter 10Q.
I'm going to be looking up the details after this, but I guess the question then is, what blame, if any, do you place on JP's feet, or the Fed's feet, given this, right? I mean, given the narrative, SVB is.
I think it's very easy to blame the Fed. I think it's very, very easy to blame the Fed, and the Fed makes mistakes. But we had an exogenous shock, right, of epic proportions since the Spanish flu. And nobody knew what was going on, and nobody knew we were going to have a vaccine or whether it was going to work. And we have half our country that still doesn't believe it works. So who knows, right? So we are at a point where there's a lot of uncertainty around the world. 500,000 people died in the U.S. Several of my family died in India, my extended family, even though I'm a U.S. citizen. A lot of my family lives over there. And nobody knew there was a lot of fear in the market. Powell, undoubtedly kept the policy easing for a lot longer, and people took advantage of the system, right? There was, hundreds of billions of PPP grift. I can go on and on and on, which I won't do right now. And, that money just never left the system. And it's easy to go back and blame the Fed, but, you could also blame the Treasury. You could blame our tax system. You could blame the fact that why isn't it digitized? Why don't we have records of these people? Why haven't people been persecuted for taking PPP loans? Like, there are a lot of people you can blame. It's easy to blame the Fed because they're the biggest person in the room, but the decisions that this CEO made, he could have actually raised capital a lot sooner, right? Maybe he was waiting 2 months to raise capital, so it wouldn't look obvious that he sold his stock at that time. Who knows, right? But for me, it's just very, very fishy, and I put most of the blame with management, because if you look at all the other banks, none of the banks, right, have a balance sheet that looks like this, right? None of the banks in the United States have a balance sheet that looks like this.
Jay, would you also say
zero?
I definitely agree with that.
out of the 40, I think
that's indubitable.
Jay, would you
actually out of the over 4,000 banks in the United States, none of the banks in the United States, zero, have a balance sheet that looks like this, with venture debt and MBS at the size that they were.
So I agree, Jay, with you in part. I also think this is a fascinating conversation, because of a throwaway line was, well, I'm going to have to dig in more to really understand the situation after commenting on it. Like, I just think that's such an interesting insight in terms of the way the world seems to operate these days.
Generally, Jay, you made a comment about sort of infrastructure investment, which is quite interesting. Would you say, because of government policy, that actually the focus of capital investment at the moment is now somewhat more towards manufacturing and infrastructure development, especially given the fact that sort of globalization's gone into full reverse?
I think that's true. I think, obviously when there's free money from the government, that encourages, right, spending in certain parts of the economy. I also think it's long overdue. Do I agree with the infrastructure bill? I don't agree with the infrastructure bill in the timing of it. Given that it was after trillions of stimulus and it was a political agenda, that it could have been a lot more targeted. But I do think that, there's been a lack of infrastructure spending in this country. I think that, the power grid needs support. I think that, if you look at what happened in ERCOT, with people dying because they didn't, in the richest country in the world, with people dying because they couldn't heat their homes, like that is absolutely absurd. So I think that there is some catch-up spending in some areas in the U.S. where, entrepreneurs can actually do very, very well for the next few years.
Someone's got a question. I've got a question for Michael. Michael, and I missed the discussion a bit earlier. I was on a call, but I wanted to get your thoughts on Credit Suisse, and considering that this is the biggest one-day drop in the stock price ever, bigger than 2008. Does that concern you in any way, and do you think this is getting closer to being considered a contagion? I know that Credit Suisse has been a quote-unquote sick bank for a while, but every contagion starts with the sick.
Yeah, I mean, I put out a tweet on this that makes fun of that concern, right? I mean, it's fallen from $2.25 to $1.40. Yeah, yes, biggest fall in history, right? The equity value of Credit Suisse is not what you should be paying attention to. Other people have correctly pointed out the surge in the CDS, which is equivalent to a fall in the debt on the basis of credit dynamics. That's the much bigger issue, and what it really boils down to, and I'm sure Jay is more familiar with this term than I am even, what you really have now is basically asset price uncertainty. We don't know what some of the stuff in Credit Suisse's books is worth. And that makes it very difficult and ultimately requires a backstop. Nobody is going to step in and bail out Credit Suisse except for a government. You just can't do it.
Yeah, there's no question. This is a systemically important bank from my limited experience dealing with, in 2012, I flew to Europe and I was dealing with Cajas. For those of you who don't know what Cajas are, they're the Spanish lenders, and they lend to carnivals, right? If you know anything about carnivals, they move around. You can't find them. It was really funny. There's community-oriented banks. And then I was looking at Piraeus and Alpha Bank in Greece. And it was a pretty fun time in my life. But one thing I learned is that there's a lot of just opacity in banks, and they're black boxes, and they don't have to tell you, line item by line item, what they own. And with someone like Credit Suisse, even though it's a publicly traded institution, nobody knows what the heck they own, right? And what the loans they made, and especially when it came to structured finance, like loans based on, for yachts and Russian oligarchs.
To that point, and not to interrupt you, I want you to finish your point, but to that point, I mean, like, you kind of mentioned that earlier about these banks being a black box. I have some friends that they're analysts that I'm good friends with, and I've talked to them about the same thing, and they just say, no matter how much work or due diligence you're putting into some of these banks, it is so hard to decipher where their allocations are. So I would love if you could just speak more directly to that.
Yeah, absolutely. So when you invest go ahead.
Yeah. Sorry, name redacted. I'd let you just jump in with the news that you sent me. Just quickly share it with the group before Jay.
He's not up here yet.
Okay, I'll read it out until he's up. So he just sent me through. So the U.S. government will likely only sell Silicon Valley Bank to another bank. That's according to the information. The U.S. government only wants another bank to buy Silicon Valley Bank, likely ruling out PE firms and VCs who are looking at putting together a bid. I'd love your thoughts on this, Jay, before responding to Stock Talk's question.
So that first point makes sense. If they're going to sell the bank and not piecemeal, right? You need a banking charter, right? And private equity firms, have a restriction. They don't as necessarily want to own an entire bank and be regulated in that way. So I think that was inevitable. And then two, when you buy another financial security, right? If you buy a REIT, even some of the REITs can be sketchy, but if you buy a closed-end fund or you buy a 40 Act vehicle, or when you buy a fund, you have a schedule of investments, right? And you have updates, and you can estimate what net asset value is. With banks, the banks tell you what their book value is, right? The banks tell you what they own. The banks tell you how they're funded. You could be Einstein level IQ and have read every single piece of every single public filing from a bank. You will never understand how the bank works or operates because you don't know exactly what it owns. You know the biggest categories, but without actually opening up the books, That's how Lehman Brothers got away with the repo 105s for so long, and how these banks own like toxic assets and CDOs, and like the Fed had no clue, right, what was going on, because they don't have to make it public.
Okay, go ahead, Stock Talk.
Well, no, I mean, yeah, I just wanted to speak to the black box thing that Jay was talking about. So yeah, I guess specifically, Jay, what is it? Why is it so hard? Compared to other public companies, to really decipher, the asset allocations that these banks have, and to decipher, the overall risk, in general on these names. What is it specifically that makes it so hard to navigate?
So the regulations just don't require it. You're just not required to disclose, exactly what your loan book is. And, some will say, do people want to read a 30,000 page document with, line by line, the loans that people made and the LTVs at which they were made and the geographies at which they were made? And maybe that's why banks summarize things. But when you have a crisis in confidence, some of that stuff matters. And maybe you don't want to know some of that stuff, because if you really knew what some of these banks were doing, right, you wouldn't want to touch them.
Just to add a little bit of color to that, like the really simple example is actually exactly on something like an interest rate swap, right? So post 2008, you effectively want to close out your directional exposure as the bank. So you do a fixed pay, a fixed pay receive floating to J. You do a fixed receive pay floating, receive floating from me. Technically, you have no exposure, but you now have credit exposure to both J and I. And if either of us fail, and by the way, that shows up as perfectly balanced on your books and it's settled up on a regular basis, et cetera. But if either one of us goes bankrupt, right, then the bank is suddenly on the hook for the other side of that trade. So it literally is almost impossible to figure out what a bank looks like until you're actually inside looking at the books, evaluating the large exposures on each individual line item, et cetera. And that's also part of the reason why the US government doesn't want to sell off this in piecemeal, because that actually allows entities to take only one side of that equation, right? I feel comfortable lending to Jay, but not to Mike. I want all of this type of exposure in the portfolio, but not all of that. Well, of course, that has positive value over and above the institution itself. But what you're left with is a terrible black pit that you have no idea how much you're going to recover from it. And yet you have huge liabilities.
Did anybody?
That's 100% right. And the concept that Mike talked about is called counterparty credit risk, right? You may not even know what the off-balance sheet risks are. And that's why, the Fed kind of stepped in 2008, because everything was so tied together, right? And Warren Buffett called, these bank derivatives weapons of mass destruction. Like, everything was tied together. It wasn't regulated properly, and it resulted in something much bigger than it should have been. But if you guys are trying to analyze these companies, you have to be very careful and honest with yourself, and to tell yourself, that you really don't know what's in them, and to be very measured in the type of risk that you take.
Hey, Mario, I don't know if there's more news. Oh, okay, looks like here. This is probably it. I just see a headline: Switzerland holds talks on options to stabilize Credit Suisse. So you're seeing a massive bid coming into the financials. XLF is at highs of the day, and tech is ripping. Nasdaq's up about 30 basis points now, and the VIX has come off from a high of about 30 down to about 26.50. So Switzerland holds talks on options to stabilize Credit Suisse is the headline. So that's breaking right now, and the whole market overall is ripping. And XLF, the financial sector, is at highs of the day.
Can you DM me the headline, please, name?
Yeah, I'll put it up on top.
Yeah, please.
Yeah, he'll pin it at the top, but it's just that the Swiss bank is considering intervention here. Credit Suisse is recovering rapidly off that news. I mean, I want to say a lot, but I mean, it's up 7% from the lows, down only 16% now. But the whole banking sector is moving off of this. KRE, regional banking ETF, is making a potential red to green move here. It's down only 1% now, after being down significantly more than that at the bottom. But all these names are picking up pace. On the index side, the Qs just went green. Arcade just went green. S&P 500 is pushing 390 here. and is likely
More
about to go
headlines
green
from
if
it,
this
though.
momentum stays up.
Swiss regulator FINMA likely to make a statement very soon. And
Yeah,
Credit
here's
Suisse
some other.
options also include Swiss spinoff or UBS tie-up. So a little mention of UBS on here as well.
Yeah,
Sure.
so this is just
Can you
remember
send
everyone.
that to Evan? Can you sorry to interrupt you guys? Evan, if you can send that through or pin it at the nest as well for the audience, that'll be great. Please.
Yeah, this is always a fluid situation, and the market in times of stress like this is going to be very sensitive to, you know, headline type moves, just like you see now the S&P.
But isn't that this typical speed in responding? Is that I didn't expect him to come out with a statement so early. Is that common?
Yeah, pretty much. I mean, when you're seeing stress like this in the system, it's expected that there's going to be, you know, something come out, but we still need the official statement from, you know, the Swiss National Bank, of course. But these are just like headlines right now coming up. But I expect an official announcement soon.
Yeah, appreciate it. Let me check the.
It says FINMA is expected to make a statement supporting Credit Suisse today or tomorrow, and that's the headline going around right now.
Yeah, having a look through the headlines just for the audience, you can see both everything pinned above. If you have a look at it, but I'll go to Sliman.
Stepping in here on the index is pretty heavy. I mean, the flow into SPY right now is pretty heavy. And the Qs are holding on the green. So, yeah, that's something to watch. I'll let you guys know if they make a ripper.
I appreciate it, man. I'm just having a look through the article. Sliman, I know you've got some audience questions. If you want to go through them now, probably a good time.
Yes, I do. Let me get them in front of me. Just 1 second. There was a few good questions. Right, so this one is policy per se, which is to say it was, but neither was the irritant. The irritant was COVID, and as irritants go, that was a pretty bad one. There was no clear end point when it started, even in name. So therefore, isn't the main irritant COVID as opposed to these other factors that you're referring to? What do we think, guys? Stock?
Sorry, could you repeat that?
So basically, I'll just summarize it. So basically saying that isn't the main irritant COVID as opposed to these other factors that you're referring to?
Well, I mean, COVID was the original cause, but that's in the back mirror. We shouldn't even be talking about it.
So I guess the question is this: that at that time it caused a significant impact on the market because of a variety of reasons, and then it's put us in a situation where other things, such as, for example, when it comes to SVB situation, where they've done terrible management, where they've not basically done the necessary regulatory things that they meant to do. And then you've got the same thing with the Swiss bank now as well. So what is happening is that what's happening to these banks is almost a result, although it was long ago, of for example, the issues that occurred due to COVID.
It's all tied together. I'm trying to figure out, what the goal is of his question.
Yeah, I have a question. I mean, one sector that I think everybody's watching is commercial mortgages and real estate in general and office landlords. I mean, that's what I thought we would see cracks with first. And I'm just curious what people's long-term prognosis is, because in a lot of these cities, the office occupancy rate for people who have leases is still about 50%. Office vacancy is at near record highs, and they may point to the newer office spaces that have all the bells and whistles as the future, but you have vast swaths in major cities with major budget deficits, and you have XRX and Brookfield literally just handing over keys to these offices, and a lot of this is on regional banks and other banks' balance sheets, and the fair market value compared to it is not what it should be. And I'm just curious, when are we going to start seeing this? Because this is even if you want to bid on it with the reduced value that
it's already happening.
Yeah.
So we did something on this a few weeks ago. actually posted something to the top here that goes into detail about the number of bankruptcies that we've already seen in this space. But, there are a lot of individuals who kind of predicted this would happen with, shorting the CMBX 6 triple B tranche, which was Carl Icahn, on the retail side. And then you have, Marathon, who's short the CMBX triple B tranche, which is shorting office space. It's very hard to short these things, as you guys probably know, because you have to short carry, right? If you're shorting a REIT, you have to pay that dividend out. And if you're shorting CMBX, you have to pay, right, to do that periodically. So the interesting thing is that, like you said, or like the gentleman said here, is that, Blackstone has even defaulted on, multifamily property that went into special servicing. It was small, 11 properties, but you don't see that with multifamily. They defaulted on 47 office buildings in Finland. Brookfield just walked away from 2 office towers, the gas company tower in downtown LA and the 777 tower. These are not small things to overlook. And we have $21 trillion of commercial real estate, of which 40% is office and malls. And think about it as one trade. Like office and malls might have low occupancy and they may not be able to cover interest because these are floating rate loans that are coming due over the next couple years. And with LIBOR at 5%, a lot of the loans are based off LIBOR or SOFR. Your interest costs have tripled or quadrupled, right? But the problem is that when these property prices fall, they might drag down property prices in commercial overall because it's the same players, right? It's the same private equity funds, the same private debt firms, the same lenders that are lending against all CRE. So, there's some parts of the commercial property market that will do better than others, but this is going to be like a 2 to 3 year slog, like death by 1,000 cuts. I thought this was going to be the main focus, right, of volatility when it came to REITs and the banks. But, I didn't think about tech lenders.
But if I could steer you, because I agree with what you're saying, to more practical real world aspects for people around or living in these cities, is there going to be a private actor who's going to step in and repurpose this office space, right? The cities are not going to have the budgets to do this, right? Just looking at the deficits they have in mass transit from, reduced ridership, and the landlords are going to start appealing their property taxes. Anybody with a brain is going to be doing that. So these budget deficits are going to be blown. So how are we actually going to repurpose large swaths of American cities that are empty now while dealing with whoever these debt holders are? I'm just trying to think of, what can actually be
that's
done.
like a 3-hour conversation we could do over the weekend, but it is not an easy question, and it's location by location, right? When you're talking about mass transit, right, you're talking about New York and places like that. It has much different problems, right, than other parts of the country. So it's region by region.
Well, New York, Chicago, San Fran. I understand that some other states are seeing it, but those are just
guys. I'm seeing. Sorry to interrupt. I'm just seeing a lot of concerns. Actually, Wahid just jumped in. Perfect timing, Wahid. I'm going through the comments, and anyone in the audience that's new to Spaces, bottom right corner, that purple circles where you can comment. And I'm seeing a lot of people in the comment. I'll read one of them that sums up most of them. Are we able to get the discussion going around the Credit Suisse collapse contagion risk? I know we've discussed it a few times over the last few hours, but there's some people that just joined. Maybe Wahid, you just joined us today. You've been covering the developments in Silicon Valley's collapse since day one. So would love your thoughts on what we're seeing with Credit Suisse. Did it catch you by surprise? Is there contagion risk? Because the narrative so far, the consensus across most of our panelists is that we probably won't see contagion, especially with Switzerland stepping in.
So I'm sorry I missed the space today, guys. I'm tranquil. I'm feeling comfortable because of the statements I've been making in the last week, which is that we all know how this is going to end, right? We're going to have the contagion. We're going to play Ring Around the Roses, right? We're going to have more and more banks be challenged. I thought that the package laid out on Sunday and Monday were excellent, but that markets were going to test it and test it and test it until and only until central banks completely capitulate. Because the elephant in the room, and I'm going to keep saying this because there's always new listeners, is you cannot take a 700 trillion levered global economy, okay, and just raise rates willy-nilly 500 basis points in a record amount of time, a span of 12 months, and think that that's not going to absolutely neuter the global markets. And so everyone was waiting for the first thing to crack. And then once the glass cracks, the entire window starts to shatter. It's the identical thing. And so there's only one way to end this, is for them to just basically capitulate. I hate it. I'm a hard asset guy. I don't like the interventions, but this is the way of mankind that they've chosen for the last 40 years. Okay. And unfortunately, that's where we are today. They have to choose structural inflation of 3 to 4% because the global system just cannot handle, forcing it to 2%.
The comparison. So Wahid, the comparison is being made to 2008. We all agree that this is very different.
No, I disagree.
But it's
I disagree. So this is a lot worse. This is a lot worse, guys. This is a lot worse. Yes, the banks are much less leveraged, but the shadow banking system is huge. Let me repeat the numbers: 330 trillion global sovereign debt, 180 trillion consumer and corporate debt, 220 trillion and change in unfunded pension
That's not
liabilities.
fair because you need to compare
Those
it with
are big
global
numbers.
GDP. But you need to compare it with
I have
the
compared
change in
it
GDP.
since
And not
08,
only that,
GDP.
hold on, not only that, the government debt, you know what they're going to do with the government debt, right? They're just going to print. So you can't compare government debt to corporate debt or consumer debt. I know it all
I
becomes
actually
one
agree.
thing.
I agree with you. I never said I'm bearish. I'm actually quite bullish.
Your tone was kind of like
No.
calling into the
I
world.
think I said it very succinctly. I hope maybe I'm not a good speaker. I said that we know how this is all going to end. They're going to have to capitulate. They're going to have to resort to 3 to 4%, and we're going to have an explosive. As in,
but I want to go back. I want to go back to the
because that's.
But wait,
but let me make this.
Sorry,
clear.
go ahead. Yeah, go ahead.
So
go ahead.
GDP has underperformed growth of leverage since 08. I mean, I think that is a fact.
That's correct. We're at 130%, excluding Social Security, et cetera.
So
And
I
we
don't
were at
think we're going to go to the
80%.
cave. I don't think
We
we're
were
going to go to
80% back then.
I think we're going to
Okay.
have structural inflation. So I'm positive. That's why I've always said you want to own risk assets. You want to own risk assets because the way this ends is they will capitulate. So I hope that's clear. Sorry, I apologize.
Yeah, that part I agree with. I do think that they would capitulate. And I think, we are at 130% that's GDP because of COVID and what happened versus 80% then. But, compare that to the rest of the world. I know people don't want to hear it, but we're still the best of the worst. And, when it comes to this funny money, government debt situation that we have in Japan and all over the world, you kind of can't compare that to what's, corporate debt or individual debt, when you have these central banks doing what they're doing. So I actually think that having 3% inflation is a positive structural inflation because it means that every 3 years you're wiping out, in real terms, 10% of your debt, right? So that could actually be one way we can get debt lower, versus GDP over a long period of time.
So I want to go back to that comparison, if you don't mind, Jay and Wahid. Just a comparison to 2008, the amount of leverage in the system. Why is there different arguments on this point? Like, are we more levered or less than 2008?
We have more government debt. We're levered in different ways. That's correct.
Okay,
but
perfect.
in terms of housing debt, we have less leverage than we had back then. So you kind of need to make some distinctions. And in terms of cash versus debt, which is known as higher at the most leveraged companies that went bankrupt, the junk companies, they have more liquidity than they had back then, by multiples.
So the concern that Wahid has is government debt, but what you're saying, Jay, is this is not as concerning, especially when you compare it to GDP.
Yeah,
Correct?
I mean, obviously it's gone up, but if you're talking about immediate trade implications, then I don't think that that's something we should be spending our time on when we have so much else going on.
Here's where I disagree with Special. I think we're fine if we have structural inflation of 3 to 4%, i.e. the money printing and everything.
I think That's what I
we'll
said.
get-
I think
yeah.
I said if we had 3% inflation, it's good in that it's in every 3 years, we have 9% lower debt in real terms, right?
No, absolutely. I agree with that 100%. And I actually think, not many people stick their neck out. I will make this that politically central banks will be forced there. I really, really do.
I don't think it's even a novel idea. I mean, I was talking to William Danoff about this back in 2008. Like, this is a 15-year-old idea that, the easiest way to reduce your debt is to have structurally higher inflation.
No, I don't think it's a new idea, but it's a new idea to be uttered by politicians and central bankers. I mean, no one's ever done that, right?
Okay, and Wahid, in terms of being bullish, I've asked this question to a few panelists. What could happen that that changes your sentiment?
Well, I'm bullish with a huge footnote, which is I'm bullish in an artificial way, right? So the point I'm trying to make is, I said this in the last space, I guess yesterday, maybe. I was in the airport when I said, no crisis has ended, okay, without a huge credit event. The question is it one credit event or several? So SVB was one. Credit Suisse would be a much bigger one, and then hopefully it's
If they allow it to default, right?
Right. No, when I say credit event, so Mario, to answer your question, how does it's bullish if they basically resolve all this, right? Because then we're just going back to the old guard of money printing, stabilization, et cetera, focusing on employment, not just inflation, all those things, right? Where I could be wrong is if suddenly they go hard, right? They go Austrian economics, and they don't save the system, and they allow the system to naturally solve itself. Then it's obviously the opposite,
right? Which is not going to happen given how bonded.
Yeah,
less than 24 hours.
So I agree. If you're short, I said that several times. I think that's a wrong thing. You got to bet with the policymakers and moral hazard. Unfortunately.
Well, I don't think we can guide anyone that way.
I think you can have switch and go long until there's a shift in Fed policy, which we haven't seen yet, and there hasn't been a big enough blow up or credit event for them to actually switch to easing monetary policy. We're not even close to that.
How can we say we're not even close to that? When I go back to the numbers, that the two banks that failed, excluding Silvergate, Silicon Valley at 209 billion, Signature Bank at 110 billion. If you add Silvergate, the total will be above more than the $374 billion that we saw in 2008. So I just don't understand how Silicon Valley.
Mario, that asset exposure was very different than it was at Washington Mutual. So
I'll give you a short answer, and then Jay can articulate this much better than me. Okay, but the short answer is I get what you're saying, Mario, as far as the size of the bank collapse. But in 2008, you're talking about a massive contagion where credit froze. Okay, the commercial paper markets were freezing. Banks were not lending to each other.
So what you're saying, the counterparty, what makes it really different is the counterparty risk we saw in 2008 versus now, and the size of that exposure.
Banks were not lending to each other.
Washington Mutual was
You couldn't pull more than $200 out of an ATM.
Yeah, I know, but JJ, I know, but this is at the peak of the crisis. What I'm saying is that it started boiling at the beginning. If you compare the early stages of 2008, before everything kind of spiraled out of control, that's the comparison I'm trying to make. Like the early stages of 2008 versus now, not the peak of 2008.
I get what you're saying on size. I get that it looks that way, but it was different.
But that's misleading. But that's
there was just the size I get, but it
makes sense.
08, credit froze. Like they needed to step in with a massive bailout, because you got to understand, if there's no credit, if there's no lending in the system, that means you drill it all the way down to like truckers that that can't get their gasoline to order, to deliver goods to your grocery store. I mean, that's how deep that crisis went. That didn't necessarily happen, but that was how bad the problem was. Okay,
would you agree? So Naeem and Wahid, would you agree with the point that was mentioned earlier, is that if the Fed does not raise rates by 25 basis points, at the next meeting, does that indicate there's something worse that we don't know about? There's something, you know, that we should be concerned about?
It could indicate something like that, but the market might give them a waiver if they say, hey, we'll revisit this in May.
I also
I like what Michael
never
said yesterday. I would be more concerned if they actually cut rates, because then market would view that as a panic. So
you know, a lot of people are saying that, you know, this isn't like '08, and I agree in a lot of respects and disagree in some. But I guess, you know, I've been talking about the banking crisis of 1837, which I think is really interesting and maybe out of recent memory, so in some cases more interesting. But I would love to query the group here. What what crises are interesting to look at in this context? I mean, savings and loans, of course, crisis come to mind. Volcker in the 70s come to mind. I mean, what historical examples are interesting to sort of compare this to here, since people are saying, oh, this is not like '08?
Well,
I don't think you can compare it to.
You can't really compare it to one single event. You can take, history doesn't repeat itself; it rhymes. I don't think looking as far as 1837 is going to be super helpful. But I do think that, looking at a combination of the savings and loan crisis and what happened with tech in 2000, 2001, and what happened with deleveraging in the system and uncertainty in capital markets flows in 2008, and, make your own decisions. But you're not going to learn about this from a book. You're not going to learn about this from looking at what happened in these prior cycles. You're going to learn about it from being in it. And this situation is very unique in the way that it set itself up, and it's been created by the Fed. To some extent.
Just quickly, Michael, I know I muted Michael because there's a bit of feedback sound, but Michael, I saw you unmute. I'd love your thoughts on this question. You gotta unmute on the bottom left corner if you don't mind.
I think Jay did a very good job of articulating that it's never quite the same this time. The really critical thing to understand about 1837, right, was that was an outgrowth of what was called the Species Circular, which was an action by Andrew Jackson that removed the usability of state bonds to pay for federal lands, right? So the United States, prior to basically the beginning of the 20th century, was basically one giant real estate speculation, not dissimilar from what China had. In that situation, the U.S. government basically said the only money that is good for buying real estate from the United States government is silver and gold. And that collapsed the money supply, leading to something very, very different than what we're looking at right now. There are echoes of prior crises in this, of course. But unfortunately, the one that this looks the most like is probably something along the lines of the Great Depression at various stages of it. Again, I'm not arguing that.
Michael, one question I have for you, Michael, specifically on that is, first part of the question, what was your general perception of the likelihood of a recession headed into this year, and how much has that perception changed following this event? And then you can continue your commentary on that, but I was just curious.
So the frustrating part for me is that I actually think that we were very clearly headed to a recession for exactly these reasons. The financial conditions, indices, and things that people track, none of them consider the level of interest rates, and the level of interest rates has a very predictable, slow, and then suddenly impact on the market. You were beginning to see all the signs of credit stress beginning to emerge, primarily in the dynamic of reduced issuance, which unfortunately all the systems we have say, oh, that's a great sign, there's no speculation, right? But the reality is that people are basically speculating, trying to hold off borrowing. Maturities that's sitting in front of us. And that's really kind of where we are. We have a ton of entities, whether they're, as Jay pointed out, the 60% of the Russell that is not profitable and needs access to financing, whether it is the U.S. consumption economy that's built around financing houses, cars, et cetera, that we're all, basically coming to a standstill of what's called the interest rate sensitive component of the economy, which is the vast majority of it. Right? I mean, we can talk about services being a big deal, but remember, those services are you applying for a car loan, you applying for a mortgage, you paying your credit card and it going through a servicer, et cetera. It's all credit sensitive. And that was very clearly going to grind to a stop. And now we've just accelerated it. And yes, the Fed can step in, the Fed can print, and the Fed makes sure the counterparty risk doesn't exist as a challenge. And I'm hopeful that they do that, because in some ways it smooths the process and it prevents people from being unfortunately, severely adversely affected by sudden events that they really can't plan for. But the simple answer is that it's here now, right? And you're not going to see an increase in lending activity. You're going to see a deterioration of that. People talk about the dry powder on the sidelines for the VCs. Remember, they don't actually have committed funds. They have, commitments for other people to give them cash. Those people are not sitting. The pensions that are allocated to private equity and venture, they're not sitting on cash, right? They're going to have to sell equities, sell CREs, sell debt securities, et cetera, to obtain access to those funds. And that in turn is going to place even further pressure on the system. So, how quickly this reverses itself, I think is going to be very hard to predict. It does depend upon the policy responses. But I'm going to kind of take the other side of Jay and say that the reactions that we've had so far have actually been certainly adequate to address the immediate issues, but in no way address the systemic risks.
And what action is needed
Yes,
to address those systemic risks, Michael?
Oh,
Sorry, Jay.
we'll find out as the commercial real estate market unfolds.
Again, I agree with Jay. Like that's the fun part, right? You're basically saying, tell me the way I'm going to die. I don't have to do that, man. You're just going to die, right? Doesn't really matter. It's an interesting theoretical discussion. And candidly, that's the great hubris on all of this stuff is just people trying to say, this is why it's going to happen. No, like when you hike interest rates in this fashion, after an extended period of them being very low, things will break. What is going to break? I don't know. And guess what? I don't have to, right? Like that's a degree of specificity that you can sit back and you can watch elements of it, but you just want to be prepared for it.
Protocol.
Yeah, I agree with everything that the last two speakers said. I mean, people want to bring up Volcker, but we didn't have this type of debt levels at that time, right? We don't know if the same model will work the second time around. I mean, this is, eliminating, as the prior speaker said, geopolitical risks. I mean, Volcker didn't have to worry about if Europe is going to have a cold winter next summer and its LNG reserves will be able to meet its needs. Like there are a lot of risks that people can see and that people can't see coming, and that can come at any time. And I think that this right now, just the system is it's overloaded. I mean, there was a study that the Fed put out, I believe it was in July, and it basically, these are the cliff notes. They said that, they're mirroring a policy the Fed took prior to the Great Depression and raising interest rates, and their fear was that the lag time in cuts in employment would cause a collapse. And this is eliminating everything else we've seen, SVB, commercial mortgage issues, et cetera. I mean, this is a very tenuous time. And then I'll end with that.
So I want to revisit actually the question I asked Michael, and I want to get Jay your thoughts on this as well. What were your thoughts on the likelihood of a recession headed in this year? Have those changed materially after this event?
Yeah, could you repeat the last part?
Could you? So can you repeat it again as well? I missed it.
So coming into this year, what was your perception of the likelihood of a recession this year, and has that changed after Silicon Valley Bank, the pressure on Credit Suisse, the failure of Signature? Has your view changed at all, specifically on that, on the likelihood of a recession?
At the margin, going into the year, we were already kind of predicting a soft landing. It was in January when the market started ramping up that people changed their minds. There's no reason why my biggest position in my portfolio would have been tied to, 25 and 30-year bonds. And my second biggest position would have been short-term treasuries. I've never had that positioning in my life. If I didn't think we were going to go into recession, I wouldn't have had that positioning. So, and I think a lot of people, who are on my website, who have discussions with our 1,200 traders in our Discord community can agree to that. But it's the timing and the speed of the recession that I think might change here. I think you might actually see the recession become, more real because of a lack of lending. And this is the multiplier effect that banks have, right? In an economy like this, where banks are lending and you see the real money pulse go down, and you could see M2 collapse, and you could see, all of a sudden banks are willing to lend to everyone, to buy cars, to buy homes, to fund unprofitable businesses. And you just assume that amount of lending falls by only 1/5, right? Let's say 2/5, 3/5. It completely takes away the the growth prospects of a lot of these businesses, and the asset purchases that drive a lot of the U.S. economy, right? How many people are employed in the real estate sector? How many people are employed at auto companies? So I think it's very meaningful. I think we need to see how it plays out, and how big of a role government takes. But if it were to continue to play out, then it would have a deflationary impact, and deflation coincides with the recession. And maybe this whole no landing talk that a lot of arrogant people were having in January and February, becomes a soft or a moderate landing. So I think it's kind of the speed and the severity that changed, but I had a pretty strong view we were going to enter a recession no matter what. It was whether it was going to be at the end of this year or in the first quarter of 2024 was, I think, what people are familiar with me saying. I think maybe it'll be in 2023, not in 2024. Who knows?
What are your thoughts, Wahid? Wahid, are you there? No, it's not. Let me DM him.
If I can, I
sorry,
wanted
I was
to
in
ask
another call,
one
someone
question.
called me.
Go ahead, Mario.
I'll ask a question again. Actually, as you said, Stock Talks question. Stock Talks, do you want to ask a question, Wahid?
You said ask a question to Wahid?
Yeah, the same question. Do you want to repeat it, or I'll repeat it for you?
I
Wahid,
heard
what are your thoughts?
Did we expect the recession?
The risk of a recession, yeah. Because I know I've asked you that
I'm just
question
curious,
multiple times over the last few months, Wahid.
Wahid, I'll kind of give you an idea of what I'm trying to gauge with that question. And the reason I asked it to both Jay and Michael is, me and Jay are good friends, and we're on Space all the time. And so, I always respect his opinion and just I'm trying to get a gauge here of really, what is the fallout of this? Because for me, I'm more concerned about the fallout and its impact on sentiment. I really don't think this is going to destroy the American economy, right? I mean, I think that's hyperbolic, right? But what is going to be the fallout in sentiment? Because as a trader, that's what I think about, right? Like, where's the price?
So I'm not in America.
But
I'm
so I'm curious on that. Your sentiment-wise, how has your sentiment changed and your perception of, personally, how likely you think a recession is?
Okay, so I'm going to answer a global answer because I'm based in Europe. Obviously, I follow the U.S. economy like a hawk. I'm going to tell you that I was shocked that we didn't slow down a lot more materially late last year, both in Europe and the U.S. I thought with the geopolitics, etc., rates could not possibly go more than 3.5%, 4% on the front end. Okay. I really did. So I was wrong. I just didn't think we could withstand this. So I've been predicting recession for 6 months. And if anything, I'm positively impressed at the resilience of especially the U.S. consumer. Now, when you look at the debt levels, so you look at credit card and savings going down, etc., I get a sense that we borrowed a lot from the future in order to sustain consumer spending, but markets are shocking me. Economies are shocking me at how resilient they are. In Europe, I'm very shocked at how resilient Germany's economy is. Really, and there we have inflation of 9 to 10%. The UK, the slowdown I predicted a lot more. So what I think happened, honestly, was the Fed was shocked. The central bankers were shocked. They were shocked at how sustained inflation was and how employment remains resilient. And so what they did was they kept pressing and pressing and pressing and pressing until it broke. And so now I think it's payback time. And unless the central banks react quickly, I think we'll start to spiral downwards quite a bit.
Look, so I think one thing, Wahid, and I want to get your opinion on. And you're that even in the face of higher rates, lending standards not only had tightened in some places, but demand for loans obviously goes down as rates go up. And now you would imagine that to some extent, let's call it X percent, lending standards or even just volume of lending, I think would be a better way to phrase it here, is going to tighten somewhat. And I think that's a reasonable conclusion. Is that, Jay, in your view, one of the main, I guess, objective things to watch in this fallout? Is the degree
100%
to which
is to track the amount of lending that happens.
Do you want to expound a bit on, maybe again, I don't want to fearmonger, but potentially what you view as, worst case scenario there and the potential fallout that could have to other industries?
Well, it's a very nuanced conversation, but what I will say is
I understand I'm asking you to speculate, so I don't want anybody to assume that you have a crystal ball, of course, but yeah, I'm asking you to speculate.
As the smartest boss I had in my career was my boss, that was around 2008. And, the best thing that he told me that I kept was that you have a lot of dogmatic people in the world, and they get stuck with these narratives and these dogmas, like, I only love gold, I only love crypto, I only love growth stocks, I only love this, I only love that. And they eventually blow themselves up, right? As the data changes, you have to change. And you could be more conservative, less conservative, but when you're thinking about your portfolio, 70% of your portfolio comes from asset allocation. So if you're just doing the same thing over and over and over and over and over again, you will eventually blow up, even if it's a good thing. So that's the first thing. The second thing is that when you're thinking about the banking system, right, we have a banking system. We've all appreciated that it's 10 times levered, right? It's based on confidence, right? Even the best small regional bank, if it were to have a bank run, it would have an asset liability mismatch, and it wouldn't exist afterwards. It would have to get bailed out. So that's the type of system we're in today. Now, that doesn't mean that our banking system is in a very strong spot versus 2008, but in response to having to raise capital, banks are going to be more particular about the risks they take. What does that mean? They're going to they're not going to stretch to give you a loan at a lower rate. They're going to look at your credit. They're actually going to look at your FICO score now, and they're going to say, is this person credit worthy through a recession? If they are, then instead of charging them 6%, maybe I'll try to charge them 7 or 8% because deposit betas are higher, and I need to pay more money, to people who are depositing with me in checking and savings. So even if it's a good credit, I might charge them 6-7% instead of 5%, or 8-9% more realistic than 7%, or 10 to 13% with a bad credit score versus 9%. And guess what? The person that wasn't creditworthy at all, like the 600 FICO score person, they're not going to get credit at all. So that person, right, is going to be completely removed, and their purchasing power, their spending, their ability, to buy big ticket items, TVs, cars, homes, is going to go away in a recession. And, on the margin, you might be able to find, expensive financing here or there. And the same thing happens with, other forms of financing, corporate loans. You already saw that the junk bond market was shut down in October, and the leveraged loan market was shut down. Private equity firms had to do all equity deals. Never seen that, right? Private equity is essentially, the entire concept of private equity was to take advantage of tax shields and was to generate a levered return. And private equity is no longer private equity. It's just they're buying companies in all cash, and then they're waiting for rates to come down to buy them.
Yeah. So Jay,
go ahead.
So kind of refocusing us on the main point, but I mean, to the extent that they do tighten more than we expect them to the extent that net volume of loans nationally decreases to a certain degree by this. And I think that has nothing to do, which I'm sure you agree with the idea that there's systemic risk or contagion risk. It's probably just a good management.
It's just going to happen. Right? It's going to happen no matter what now.
Yeah,
right?
Exactly. And I think we agree there. And so, is that the element that you think is the accelerant for a recession here, if it was already going to happen? Is that specifically, you think, I guess, the biggest?
You can't look at one thing, right? No, you can't just look at one thing. It becomes circular. So it's consumer confidence, right?
I'm saying if you had to rank the catalyst.
No.
What would be then in your view then? And I imagine maybe you'll say commercial real estate.
So I think it's circular. And what ends up happening is the lack of bank lending forces people to mark mismarked assets. And when you have mismarked assets, you have a loss in confidence. And then the biggest driver, right, of this consumer spending, which been keeping everything up, is confidence levels, right? You'll see confidence levels fall. Confidence levels at banks, confidence levels at corporations, confidence levels at individuals. And that's what has been driving the economy. You read earnings calls, even in the most recent, like I have a graph that shows the number of recession mentions, but then you have a CEO saying, well, yeah, we expect a recession, but we still expect 3% revenue growth and yada, yada, yada. And we still expect EPS growth. And you're like, dude, what are you smoking? You just said that you expect a recession. You must not really think we're going to enter a recession because you seem to think that you can continue. And the banking system is key to confidence. And the shrinking M2 and the shrinking lending is only going to compound that. And it's going to force people to mark assets and to spend less for people who have less income. Now, one thing that's been supporting the economy and why confidence has been so high is that unemployment is at 3.4%. It's the lowest unemployment, I think Powell said, in 40 years. Now, the actual number, so the number of people working is actually lower than 2019, which most people don't understand. It's that the labor force has shrunk by 2.9 million people. 2 million plus people left the labor force and 500,000 people died, right? That's what it is. We have an immigration. I'm not going to comment on that, but the labor force is just super, super tight. So we have like this very, very weird recession where you have high confidence and high spending because everyone has a job. And, when lending comes down, I think you're going to see by next year, unemployment trickle back up above, 4.5%. And that's likely what's going to get the Fed to cut. But in the meantime, the economy is just going to slow, right? So it's confidence, employment, mismarking of assets, and lending all kind of working together in a loop.
Okay, so I want to get back to commercial real estate because I think, that's something that you and I have been on the same page about for a few months now. And it's been a great trade to the short side, but I think maybe perceptively we both feel like there could be more meat on the bone in certain areas. But before we get back to commercial real estate, let's touch on the 2-year briefly, because I think we talked about this yesterday, but massive drop off in the 2-year, right? When we were trading, a week ago at above 5, right? Around 5.06. And, today we're trading, 3.88. Thoughts on that in general? I mean, thoughts on, the public's perception of it. And for people in the audience, Jay, that obviously we have 10,000 people in here, I imagine there are some that may not be as financially literate as some of the people on the panel. Can you explain to the audience, I guess, just the general significance and market perception of the 2-year as well? But I want to hear your commentary on the drop.
I want to give a quick comment on that before Jay goes, because I know he's going to articulate more. But I will just say again, not to downplay the Silicon Valley bank collapse, okay? Not at all. But the silver lining on that is you see the flight to safety into treasuries. And as you noted, Stock Talk, the 2 years dropped from 5% to under 4% now. And across all, the yields have dropped massively, which in retrospect that bids up all the bonds where all these banks are sitting on hundreds of billions of losses. They sort of got a semi bailout that end, so they're not sitting as much of losses, and hopefully these banks are de-risking some of their portfolio into this massive bid in treasuries. Or Jay, you can expand on that. But
this, multitasking here and trying to guide some people, but the yield curve, let's talk about the yield curve. The front end of the yield curve tends to be very highly correlated with what the Fed does, right? So the Fed essentially sets overnight interest rates, right? The Fed essentially trying to simplify this. And the front end of the bond curve is very, very closely mimicking what the Fed does when the capital markets are open and there's no fear of bank contagion, et cetera, et cetera. And the Fed had essentially, in the last Fed speech, and I think I've shared the transcript. You can just Google the transcript if you would like. Powell was a little bit more hawkish, and market expectations were that he would raise 50 basis points in March. Now, the lower bound of the Fed funds rate is 4.5%. The upper bound is 4.75% ahead of this March meeting. It will go up likely. The bond curve actually does is it tries to estimate, right, to the best of the investor's ability, outside of like a fear contagion type scenario like we're in now, where rates are going to go. The short end of the curve tends to be very closely correlated to what the Fed says. Once you get to the 2-year, the 2-year tends to lead what the Fed says. So the 2-year bond is, essentially is estimating what the Fed is going to do later on. And the reason why the 2-year, for example, had rallied so much is that first the market was assuming we would cut rates in 2023. And then after seeing inflation, PCE quarterly and monthly data and the tight labor market and what Powell had said, the market was then assuming that we were not going to cut rates at all this year. That had been priced out of the market. Now, with this banking volatility and 3 banks going under and some European bank volatility, the market has priced that back into the market. So the 2-year has come down very, very sharply. It's the fastest move since 1987, fastest 5-day move at the tights of the day. And some people will say don't use tights, but you can say the yield was lowered to that amount in the fastest speed since 1987. Now, the longer end of the yield curve is more correlated to long-term nominal growth and inflation expectations. So when you're looking at like the 10-year, be as sensitive, right, to what the Fed is doing or what they're saying, because in the longer term, right, rates are likely going to normalize. 5 to 6% rates are just not sustainable given the amount of debt that Faith Tribe. I agree on that point. The government debt we have, every 1% change in rates is $400 billion of additional interest we have to pay, either through taxes or by cutting government spending, which we're likely not going to do, right? Defense, Social Security, healthcare, et cetera. So it's likely that the Treasury is going to be forced to cut rates. That's why I think the Fed hiked rates so quickly in the first place, because they realized they can't keep them too high for too long, because the entire economy would be completely offsides. They would have to raise taxes so much, it would just become a doom loop and the economy would just shrink like for many years. So I think the market is now, those expectations are just becoming realized faster, in that the Fed might have to cut a little bit sooner, even if we have structurally higher inflation by an extra percent. In the long term, right, that will likely help our debt in real terms, as in nominal terms, our debt might be doing one thing, but with inflation, the actual amount of debt versus GDP our government's going to have to pay back is actually going to be less. So hopefully that makes some sense to people. Rates are not, you can't just look at rates as like one rate. You're looking at a rate curve, and that curve can be inverted, it can be upward sloping, it can be bent. And right now, the yield curve might have moved too much in one direction, because there's also a lot of money that's leaving bank deposits and going into treasuries. That's why Treasury Direct was just down. And there's a lot of money that's moving in from investors, and a lot of money that I think moved into U.S. Treasuries from Europe early this morning. So again, a lot of what we say is speculation. People try to make narratives about what happened after it happened, but that can provide some perspective. This move in short-term treasuries, the 1-year treasury and the 1-month treasury, the 30-day T-bill being less than the Fed funds rate, is a sign that the market was not even acting rationally and was assuming. There's so much fear in the market that and I posted this on my timeline, you can see the graphs in the morning, that the market was so fearful that the market was actually pricing in cuts. But you can say, well, was the market really pricing in cuts, or was it just flow of funds? There's just so much money chasing.
Roger, thanks for joining us. And
yeah, I was going to introduce Roger. Go ahead there, Simon.
Sorry, I just wanted to ground the conversation back to what the main issue was at hand. And there's a lot of new listeners now, because it's in the UK at 7 p.m. It's getting more later in the day. And so we've seen what happened with in Switzerland with the Credit Suisse. And so I know that there are concerns in Italy, possibility of a bank run in Europe. Roger, you just need to unmute your mic.
Hey, how's it going?
Yeah, good, thanks. How about yourself?
Yeah, good.
Good to have you back. Yeah, just Roger, just first welcome back, because I know you were on a plane yesterday and it didn't work out well, so I appreciate you making the time again.
Yeah, I was flying from Europe, actually. I'm in New York now, but we're just in conversations with Swiss School of Business and Management, with actually in a joint venture with them at the moment, and in Switzerland at the moment. Obviously, there's a huge amount of concern of what's happening with Credit Suisse. So, what's really interesting in terms of like kind of the battles that we've been part of is seeing just what is happening in terms of, frankly, not just what the public does in situations where, panic creates things like bank runs. Because obviously when that happens, you could say, well, how much of that could be prevented? Obviously we saw what happened with, Silicon Valley Bank and how, VCs and startups collectively together almost made it a self-fulfilling prophecy. But what for me is one of the biggest parts of this, which I'm sure you guys have covered already, is just the amount of this which is manufactured. I mean, like the fact that the short sellers in the markets made over $2 billion, right, in the last couple of days is mind-blowing. And so when you see these banks just like crash on their share price, and that a lot of it isn't, actually legitimate investors that are trying to get out. It's just short sellers coming in and creating their own panic, right? And the combination of that, which is obviously what's happened with Credit Suisse, where, if they're losing shareholders and at the same time, you get, very predatory trading take place, then they do need to be propped up in one form or another. So I think it's inevitable. Something there is going to have to happen. Obviously, today the Swiss government's now stepping in as well. But that would just be my view, is that this really is the very, very beginning of what is going to be an even bigger domino effect. And that's just coming from the point of view of being in Europe, seeing what's happening in Europe, as well as seeing the way that the markets are treating this entire banking crisis right now.
I mean, to be fair, Credit Suisse did report its biggest annual loss last year since the great financial crisis. I mean, you act like there isn't a reason why, 110 billion worth of francs were withdrawn from their, from their bank. I mean, there's a reason why they don't have this type of confidence.
No, I agree with that as well. I mean, but here's what happens if it is just through mismanagement. You could definitely say the same with with SBP, right? You could say, okay, well, they just did a bad job of how they were allocating their assets. But when you layer that over this like lack of trust in the system itself, right, and also what's happening at macroeconomic level as far as interest rates are shifting, all of the dynamics within every bank's portfolio, then we wouldn't be so concerned about the fact that one bank goes down. But when you've got second and third biggest in the US ever happen over the weekend, and now you've got the weakest bank at the moment, Credit Suisse, which is also one of the biggest banks in Europe, that goes down. Well, then this isn't going to be the last of it. Is really the point I'm making.
And which banks in the US in your view, have the greatest exposure when it comes to Swiss Bank?
I don't know enough about the banks. I mean, obviously, the whole regional banking system is where the biggest challenges are, and become part of it. And one of the things I was looking at was the number of different banks that were actually stepping up when they were taking in the bids for SVP. So it'll be interesting to see who ends up winning. But the fact that there are a whole series of Middle Eastern banks, for example, like in Saudi, etc., that were already talking about putting bids in. And then at the same time, if Credit Suisse does end up having to be bailed out or ends up having to be acquired, which are going to be the banks that are going to come in and take them over. And I think that is one of the biggest challenges to all of this, is that the end point to all of this is that the biggest banks, which are the best capitalized, end up creating even more of a monopoly over the system as the weaker or the smaller banks are actually being taken over. And in the case of something like Credit Suisse, that would, to what extent it actually creates more of a domino effect back over this side of the Atlantic, and to what extent it actually then creates the same kind of issues of regional banks in Europe, that's kind of remaining to be seen.
I mean, with the Swiss bank is such a large bank, is there many banks that have the capacity and the ability based on their own financial situation to even have the ability to take them over?
Yeah, that's one of the biggest challenges, right? Is that if you look at what happened with HSBC, taking over SVP in the UK, is obviously much, much, much smaller, and so much easier for them to do it. Could be a combination of the banks and even coming on board, and then at the same time, the government underwriting some of the assets, which is obviously what happened in SVP's case. So seeing what happens there in terms of when they do announce who's acquiring it and what that's going to look like, I think that it's going to be a combination of government together with the acquirers.
And if there is a bank run in Europe, which there is a possibility that may happen based on some of the information I'm hearing, not to scare anyone, it may not happen either. But if there is, how will that impact the United States?
What's really interesting, I think, is that I travel between Europe and US all the time, and having seen what's been happening in the US, seeing what's been happening in Europe, I think the reality is that the two sides have, to some extent, been going their separate ways. I mean, the kind of crises that we've been seeing in terms of what the government's had to deal with in the UK is at a whole different level, frankly, to what's been happening even here in the US. And so a lot of the CEOs that I know in the UK have been struggling a lot in terms of being able to even, access financing, in terms of how they're dealing with their property, given that the property market itself is collapsing.
So, Roger, sorry to interrupt you, but this is just a headline just coming in now. Swiss National Bank has issued a statement on Credit Suisse. They said, authority FINMA asserts that the problem of certain banks in the USA do not pose a direct risk to contagion for the Swiss financial markets. The strict capital and liquidity requirements applicable to Swiss financial institutions ensure their stability. Credit Suisse meets the capital and liquidity requirements imposed on systemically important banks. If necessary, the Swiss National Bank will provide Credit Suisse with liquidity. So that statement was literally just issued about 20 seconds ago by the Swiss National Bank, and so I pinned it above.
I put it up to the top there, you guys, the whole statement and the press release. Or what?
So that goes pretty much to exactly what I was about to say. That there feels like there's a decoupling, even though there's things that are related between Europe and the US. And while on the one hand we could say, wait, hang on, we're talking a couple of days ago all about US banks, now we're talking about European banks. The reality is that they, came from different, they have totally different reasons that they're actually, having the challenges they have. But the governments are still having to deal with things the way they're dealing with it right now as well, right? So, at the end of the day, when we look at, the questions about the US going to recession, et cetera, well, most of Europe's already in recession, right? So, Europe definitely are ahead of the charge in terms of things collapsing. And I think we're going to see more and more of that as time goes on. And it's always great when a government says, don't worry about anything, because that's probably about the time that everyone should be worrying about things.
And just want to give a shout out to Kim. He's also joined us on stage. He's wrote an interesting thread in terms of the perils of the current financial system in the United States. Do you think that basically this is just the beginning of the end of the financial structure in the United States, or is this just are these just examples of events that have occurred that have no basis about what's going to happen in the future?
Well,
go ahead, Tim, if you want to say something. If you want to reframe it.
Yeah, well, what we're witnessing now is the beginning of a major economic and market collapse. And I've been saying this for over a year. I've just printed the tweet on top about some of the tweets that I've made over the last year about, predicting exactly what's happening right now. And just
everyone who was here a couple of days ago when I said this is a much bigger problem. And I said that I'm going to short the banking sector and that I think, this is going to be a much bigger deal than people here made it out to be. I was proven right. And what we're seeing now is really just the beginning.
And so, that was the question, Roger, and I'm glad Kim framed it in a more succinct manner. Is this the beginning of the end when it comes to the United States and their financial structure?
Why are you so positive today?
I'll be honest with you. This question, you got to bring a bit of fear mongering, don't you, so you can get the stream going. But anyway, jokes aside, that is one of the concerns people have.
You know what? I'll just share that. I don't think the fear mongering is something new to this week. I mean, obviously any of us that have been following the people that we've been following, whether it's a Ray Dalio, right, whether it's a Kim.com, every one of us basically have been not necessarily watching the mainstream media, but actually following those that are.
Roger, just quickly, I thought I'd let you know breaking news. Swiss National Bank will provide liquidity to Credit Suisse. That was just tweeted by our co-host, Watcher Guru.
We just went over that.
Sorry, guys. Sorry, Roger. My bad.
Yeah.
Mike is yours. Sorry, Roger.
So exactly as Kim says, we are at the beginning of a domino effect. Where that ends up, what that is going to look like, how much this is going to mean that, the Fed has to reverse what it's been doing for interest rates, etc. That's all up in the air right now, right? But there's no question that if we would look at ourselves being at an inflection point, the last time we were at a point like this was definitely 2008, right? So what this now looks like going forward over this year, I would definitely recommend that, everybody that here has any bank accounts in their companies or in where they're at starts thinking about how they diversify that effectively. We're kind of lucky in that we've got a Singapore-based company and we've got already multi-currency, multi-countries in terms of our cash. And I think that's the most important thing for everyone to do right now, so you don't end up getting caught up in something which we all could see coming. Right? And if we're all wrong, and it turns out that basically the governments all can prop up the banking system and everyone's happy, well then it's better to be safe than sorry, right?
And also,
does anyone have perspective on FX risk?
Sorry, just one second, Iwa. Just to link to the point what you made. We live in a fast-moving society. I think it's been mentioned on this space a number of times how quickly SVB fell and how it quickly, based on the age of information, Twitter, technology, how this may impact on bank runs a lot more quicker than it ever did before. And therefore, banks that are not solid in terms of their regulation, in terms of their diversity, do they have a greater burden and a greater onus to make sure that they have put these things in place? And if they can't, then they should just fail and allow other larger banks to take over.
Yeah, I think that's one of the biggest challenges here, right? The fact that we've seen it happen now, right? When was the last time we saw queues, outside of bank and we saw an actual bank run happen at the scale that we've seen over the weekend? So the fact that that's now happening means it becomes a self-fulfilling prophecy, right? There are almost no banks that actually can survive a bank run that just shows up, right? Because every bank has got its own liquidity issues based on how it's invested its assets. So because of that, right, this is definitely not going to be the last one we see. And what's kind of wild about this is it isn't like there haven't been bank runs and there haven't been bank collapses happening on a regular basis on different parts of the world. It's just that they happen to be in places like South America or in some Mediterranean countries like Turkey or Greece. We don't expect to see them in the more advanced European countries or in the US. So it just happens that now it's happening here, and it's going to change the way we start thinking about money. And frankly, it may start accelerating other alternative exchanges. We've got our investor meet in about half an hour from now, and that's where we're actually announcing our dual listing onto Upstream Exchange, which is a blockchain-based trading exchange. And so where we move towards new decentralized pathways which have more trust inherent in them, I think is going to be a very interesting thing to watch over the next year.
Yeah, and kind of to add to that, one of the questions, one of the things, really interesting question around, FX risk. So I'd love to query the group here about thoughts about FX. A prior speaker just talked about having things across a variety of banks across the world, and seeing how FX has moved over the last year, and also seeing how it's moved in the past financial crises is really interesting, like, USD yen, USD euro, et cetera. So that's interesting. And then actually really interesting, of course, on the decentralized exchange side, I did share a few days ago about, our experiences over the weekend trading on this global liquid market and using DEXs to do so. And just, and Ethereum 2.0 is just so, it's just so great. I mean, just when you need it, it's there, and it's so cheap to move large sums of capital around, and you don't need a counterpart. You don't need to worry about counterparty risk. Anyway, two different discussions, but yeah, FX risk, and then DEXs, of course, are a particular area of interest for mine.
I'll share my immediate thought on that, and I'll hand it over to Serena or anyone else who'd like to speak. Like when you've got an international business where a shift in the exchange rate, or even a shift in the relative value of currencies, can make a massive difference to what you're doing. Like, for example, like we've got our businesses in South Africa where we saw the rand drop like 70%. Like when you see that happen, and you're basically still paying some of your bills in US dollars, and you're basically bringing income in rand, it makes a huge difference. And it goes the other way around as well, right? But by far the biggest challenge with all that is it's almost impossible now to be able to predict exactly what's going to happen with currencies when they happen. I mean, like look at what happened to Brexit, for example, and what happened to the pound after that, and then how that's now impacting all the different assets in the UK as well. So again, come back to the same thing. Like the best way always, right? Unless you happen to be an expert FX trader who knows enough about it that this is how you make your living. Rest of us are going to get caught short by it, and that's all the more reason to be diversified across multiple banks, right, across multiple jurisdictions. Not everyone can do that, but highly recommend you're in at least 5 different currencies, and then at least that way, when something goes up, something else is going down, is the middleman, right? Like, as long as you've got a situation where everything has to go through with cost and with the amount of time it takes to do a withdrawal, we got to queue up to a bank to actually get cash out, right? Like, that's such an archaic system, which we all know is archaic when we look at the whole decentralized systems that are now being created, which is not only zero cost or at least much lower cost and much lower time frame to be able to transfer. It's just a matter of time, and whether it happens in 10 years, 5 years, or less is really the biggest question. But for sure, like, no one can say banks are safe anymore, right? And because of that, that's going to just accelerate pathways towards new.
Little update on the markets here. Credit Suisse is ripping off of that headline. We shared that headline about 10 minutes ago, but it's off the lows significantly here. It was down 25%. It's trading now down just 15%, which, I mean, I shouldn't say down 15% for one of the biggest banks in the world, but it is recovering big here. I don't know if it'll last, but it definitely rallied off of that Swiss National Bank news. So just wanted to update on that. But
Did the Swiss National Bank just take like $140 billion hit last year?
Yeah, they did. They did. That's a great thing to bring up. Yeah, they absolutely did. I think it was their biggest annual loss ever, I believe. Let me go back, and actually I tweeted about that when it happened a long time ago. Let me go find it, the exact amount, but I think it was, October 31st. Yeah, Swiss National Bank just reported an enormous $142.6 billion loss in the first 9 months of 2022, which is the largest loss in its 115-year history. Yeah, I'm glad you brought that up, Prodigal. Interesting. Yeah, I remember that.
Well, a lot of central banks are bleeding right now. Bank of England, Canada, the U.S. I mean, they're losing billions right now.
Yeah. I mean, MG, what's up?
Hey guys, good discussion. I just wanted to kind of chime in a little bit. I think that the gentleman was saying people want diversification in foreign exchange. I think that the opposite is actually true. If you look at sort of the cross-currency basis swaps, both against the Swiss franc and the euro, what you'll see is that today the demand for the US it went negative, and what that is a sign of is that people ultimately are demanding dollars versus euros and dollars versus Swiss franc. So there is currently a massive run to the US dollar. And, you're seeing a bit of stabilization in gold. I'm not sure what's going on in Bitcoin, but if anything, in a world where there's credit issues, what we've seen in the past is that people want to flee to the dollar. And the simple reason for that is that, about 80% of world trade occurs in dollars. And so if you're worried about people paying you, you want to make sure that your balance sheet is bolstered with dollars so that you have dollars to pay for things that you need. Otherwise, you're shit out of luck. So the demand for dollars, all things being equal, during a credit crisis tends to explode. And that's what we're seeing.
Maybe if I could,
yeah, go
thanks. Yeah, if I could just chime in on the FX front, I think what was notable today. I mean, I agree with what MG was saying about the cross currency, basis swaps showing some dollar funding pressure. But we do see a really notable move in the yen today, and in particular in the yen versus the Swiss franc, which are both considered safe haven currencies. But I think the nature of this crisis is kind of Switzerland specific to some extent, and the Swiss has the Swiss National Bank have engaged in rate hikes recently, certainly far more than the Bank of Japan, which hasn't. Actually, is the only G10 central bank that hasn't raised rates yet, and so somewhat in line with JP Morgan's note from I think the end of last week about how SVB is not the only kind of carry trade that's out there. There are a lot of different carry trades that have been out there that are gonna probably have to get unwound, and certainly I would say a number of those are versus the yen. And Japan having the biggest net international investment position is probably the biggest kind of safe haven and a big risk off move in terms of G10 foreign exchange. I mean, the dollar certainly world reserve currency clearly in that in that group, but I would just point out the move in the yen today, particularly Swiss franc versus the yen, as standing out to me.
Nick, I think that's so interesting. And the question I have following to that is, a lot of people compare JPY to CHF, but I guess because of the similarities, as you noted, but of course today we have this kind of idiosyncratic, well, hopefully not systemic, but idiosyncratic development with Credit Suisse. What are the thoughts kind of going forward? Of course, when there's panic, you want USD, but kind of going forward, it's interesting because, if you look at treasuries, you're thinking that it's pricing in a, potentially lower rates over longer term, but at the same time, you're seeing these moves in these quote safe currencies, JPY and CHF. What's kind of the thought process? I mean, JPY makes sense that it's, a relatively stable because the Japanese central bank is a little bit, I guess, predictable, if you want to say, just given where they are. Yeah. But how are these two currencies different? I mean, so many people think of JPY and CHF as so similar. Yeah. How would you say that they're structurally different over time?
Yeah. So one thing I also want to point out is that a big part of it, I think a big part of the move here is that the terms of trade are such that in Switzerland, where they get a lot of nuclear and hydro power, they don't rely so much on fossil fuels. And so when you had the invasion of Ukraine, the yen declined in value versus the Swiss franc because of the spike in fossil fuels. The spike in natural gas, the spike in global oil prices is to the detriment of the trade balance of Japan because they have to import so much of that, all of it basically. So that's a big factor here in terms of the differences, I would say, as terms of trade as it relates to energy prices. So the decline in oil today, that's consistent with outperformance of the yen. The other one is that they both have big net international investment positions, but Japan's is the biggest in the world, so it's a little bit bigger. Serves as kind of the ultimate, when Japanese want to pull yen home, rather, they're converting that back into yen. And then the third thing is the interest rate differential. I mean, it's a common framework for thinking about moves in FX rates is moves in interest rate differentials. And because the S&B had rates a bit higher, kind of more along the lines of the ECB, it just gives it more room to fall in a risk-off environment. And as you said, the Japanese rates, they fell as well, but they're just like a lower beta to global rates. So it just fell less, and therefore those interest rate differentials declined.
It's fascinating.
Hey guys, could I just touch on something just for one sec? And I've been thinking about this for the past couple days, but would you agree that the regional banking crisis, and now seems like a broader banking crisis of some sorts, would benefit brokerage houses more? I mean, you're seeing that with Schwab, right? And they offer a diversified set of products with more attractive yield, right? And now that you're going to see deposit rates squeeze banks? Wouldn't you say that the brokerage houses are going to be big net beneficiaries as a result? Does anyone have any thoughts on that?
I think I'll take a stab at that one. Obviously this isn't investment advice, but one of the aspects of Charles Schwab is they do have money market funds. So they have a suite of offerings that are available that are separate from the banking entity, but are products that are sold to their retail base and also their advisor base as well. And so those money market yields are competitive while, the deposits are significantly less. So even if they do have, some short-term funding pressure on the deposits, their money market funds ideally would be able to attract that capital, which is probably why you're seeing the price action now compared to other banks that don't have that brokerage relationship and money market funds that are essentially under the same parent umbrella.
Right. No, it was just a thought. I don't have much to add on the FX side, so I was just making a short pivot on the conversation.
Yeah, I think, for me, somebody's bluffing, and so we just have to figure out who it is. If you look at 2-year Treasury yields right now, they've fallen below the Fed funds rate. And, this level of vol on 2-year Treasuries we haven't seen since, Black Monday in 19.
I mean, Darren, that is markets, right? Somebody's always bluffing. I mean, one side's bluffing, right?
Right. So I think, either it's NASDAQ and QQQ that is basically saying like, hey, things are fine. This is going to be contained to, just a couple of these regional banks, maybe one more bank that's on the list. And that's going to be it. But if you look at 2-year Treasury yields, now that they're, significantly below effective Fed funds rate of a spread of around, 50 basis points, as I'm talking right here, it's 0.542. That's a significant spread, right? And so the 2-year is basically saying no more rate hikes. And you can see that in the Fed Watch tool that has just been all over the place in terms of tracking the historical probabilities of no rate hike leading up to the March meeting. I think, I don't know who's bluffing right now, but a lot of correlations and a lot of, hard, fast rules between how asset classes are supposed to perform given certain environments has been breaking down so far. So I think, beyond the Fed meeting that's coming up, we're going to get a lot more clarity on, who has actually been bluffing right now in terms of whether this is systematic or not, because rates are saying it is systematic. Stocks generally, especially the tech sector, is saying that it's not. So.
Name, got your hand up. What do you want to say?
I think MG was first if he wants to go. But
I'll just go real quick, Name. I'll just go real quick. I think that to Darren's question, I think that there is a game of chicken being played between the bond markets and the stock market. And you're right, someone is wrong. So the bond markets are anticipating an inverted yield curve and some sort of slowdown happening, some sort of recession, and ultimately a cut. I think it's hard to interpret the 2-year at 390 without assuming that some sort of cut is coming within the next 6 months or so. Just because the 2-year is largely an expectation of like taking the overnight rate and rolling it over 2 years, and that's roughly what you should get, roughly. Now, if that's the case, then the way you square that circle and resolve that contradiction is that the Fed has to sort of respond to this and say, okay, look, it appears that the banking system alone has done a significant job of tightening. And if people move their deposits to money markets, as Darren suggested, or even if the banks have to significantly raise the deposit rates in order to be competitive, to prevent that from happening, at the very least, they have to tighten their lending standards considerably in order to increase their profitability, because they're locked into a whole bunch of loans that they made, in the last 3 years, where at higher deposit rates, they're going to lose money. So all things being equal, that tightening that the Fed was hoping for is ultimately going to happen. And so if they actually sort of begin to reduce rates and the 10-year goes down, then you can see risk assets on the equity side that are long duration in nature go up in price. All things being equal, with a lower discount rate, those prices are going to go up.
Naim, you want to say something?
Yeah, just a couple things. First thing I want to comment on of when we compare, 08 or to now, certain things that I look at, and I'm trying to find this article on Twitter, but I can't. But basically, just as an example of credit markets, tightening to some extent, not fully freezing, but apparently this is a Bloomberg article. I just can't find it again on Twitter. But Santander, the U.S. unit, was part of a 1.3 billion asset-backed securities deal for subprime auto loans, and they were doing that through Citi. But on Wednesday, today they delayed the sale of those bonds because of all the risk and the issue with Credit Suisse. So there clearly wasn't an attractive enough bid for those bonds, and those are sort of the things that I look for when you start to see credit conditionings, tighten, where you have banks pulling deals because they can't find, buyers for like these asset-backed securities at attractive enough rates to make it, worthwhile. Or the bidders are just demanding a higher rate, right? Where the seller is just not going to make that sale. So I just wanted to point that out. I wish there was a tweet on it with the actual story, but it did come out on Bloomberg.
Hey, Naim.
Yeah.
Just a real quick question. So I just want to reiterate. So you said that it was for an ABS auto deal, right? Or an auto ABS deal?
Yeah.
Okay. Was that all subprime, or was it sort of a mix?
Yeah, it was part of it, or it was a subprime auto loan ABS deal.
Really?
Yeah.
Okay. That's all I needed to know. Okay.
Who was that talking?
It was me. That was me.
Tiger?
Yeah. Yeah.
Yeah. I'll DM you the screenshot.
I would appreciate that. Yeah, because we do have a short position that is pretty sensitive to that. So
yeah. So see, you understand the
great.
magnitude of like when sales like that come to the market and they basically either fail or they just pull them. I mean,
oh
it's
yeah.
a big deal.
I mean, I'm short a subprime auto lender, so that'll be very useful information. Yeah, thank you.
Give me a second, I'll DM you. So then, Darren, I want to ask you a question, just to look at the history of the 2 and 10, the 2-year, 10-year Treasury like inversion, just to give people an idea. So on the .com bubble, that yield inversion was at negative 50 bips. The financial crisis, it hit a low of negative 20 bips. At Silicon Valley Bank's collapse Friday, that inversion got as steep as negative a full 109 basis points. It's come back today. It's only negative 44 bips. But what are your thoughts on seeing that inversion, tighten so much more so than past recessions or ahead of past recessions?
Well, obviously, it's not good, right? So this goes back to the narrative that the bond market is saying, "Hey, we're headed into a recession. We need to cut rates," right? And the speed at which these rates are changing is very significant, and hasn't happened for the last 5-10 years. So when you have an inverted yield curve that has predated a recession every time, when this starts to unwind, when you start to see these inverted spreads start to unwind, is when you start seeing a dramatic rush into cash, right? And if you're just looking at the flow of funds into ETFs like Bill, which is short-term treasuries, It's in magnitudes of 33 times what you would typically see on any given day. And so the unwinding of this, right, is putting a lot of downward pressure on short-term cash. It's where everybody, I think, is reevaluating how much cash they have on hand, and it's in, I think, direct contrast to what we're seeing with other parts of the market. I think if you look at the tech sector, right, if you're looking at year to date, some of those sector specific ETFs are still up 11, 12% for the year. That doesn't really coincide with not just the inversion, right? Because the inversion happens, and then usually, on average, it's like 9 months until a recession. But once you start to see an inversion actually start to unwind, those timeframes between 9 months of a recession start to shorten between 6 and 3 months. And so, we're still playing the game of averages. And like I said, the bond market is telling us a recession is imminent, while the stock market is essentially saying that everything's still fine, even though, we're still around 3869 on the S&P 500 right now. But I don't think equities have appreciated the unwinding that we're seeing in the bond market today.
Darren,
That's why they call
about
equity the dumb money. Just for anyone in finance knows that the bond market usually leads, what's going to happen in the economy, and then equities are usually the last to respond. But when they do respond, it's quick and it's painful.
Darren, I think, it's two of the biggest ones, right? That track TLT, that tracks like, the 10-year, IEF tracks, the 7 to 10 year. These things, if you look at like, a multi-decade price chart on this versus like, for example, 10-year treasuries, it's like, how do they calculate these? Do you have like insights into, how these, like, because for example, TLT and IEF perform very differently, despite the fact that in theory they track similar securities. I mean, they, slightly different duration. But yeah, I'd love to hear your insights on, kind of the inner workings of these ETFs as it relates to treasuries.
Yeah, so the bond math is a lot easier if it's just one single bond, right? Once you start dealing with a fund is pooling multiple bonds together. Instead of looking at single durations, you start to look at effective durations, which is the aggregate across all of the bond positionings, also their cash holdings. So there may be differences between these treasury ETFs and how much they can actually allocate to cash. And, wider bands would obviously perform different from those with lower bands. I think in terms of modeling, right, the effective duration can also be impacted on whether or not they can hedge their interest rate risk, right? This band of their duration parameters, whether it's 5 to 7 or 3 to 7, right now is a significant difference. And then, finally, in terms of modeling, I think right now, if you're saying, okay, is now the time to go out and buy bonds, and do you want to buy longer duration bonds that are more sensitive to interest rates? If you do think that there's, a rate hike, the last time I modeled this out was about 3 days ago. And, if you use like a Kim Wright or ACM term modeling technique, those still say that, the term premiums are not as advantageous, meaning that, even with a pause, the duration payoff for going, way out long on the curve isn't there yet to attract a lot of capital. People are still putting money in shorter term duration because just the uncertainty of rates and the expectation that there still will be a 25 basis point hike. So if you had a duration of 25 and you hike rates by a quarter of a basis point, that's 6.5%, 6.25% down on that duration bet. And so on the upside, if we did see a rate cut of 50 basis points in the next March meeting, that would be the time to load up on duration. So I'm not like I feel like I'm kind of just talking in circles, but I'm just kind of outlining some of the upside and downside that are associated with what we're seeing right now in the markets. I think peak rates may be higher than the market is currently pricing, but as of right now, they're looking at a more steady path of rate hikes going forward. So instead of seeing jumps of 50 basis points, we're looking at more like 25. And as you narrow that rates distribution, the expectation is that the volatility that we're seeing in interest rates today may come down.
I think that's really interesting. And perhaps a follow-on question to that is, are there like for direct, ETFs, that relate to treasuries? I imagine, they can, the manager can just buy the underlying security, but when it relates to multiple duration, it gets a little more difficult. So I guess, is there any risk? I mean, these things have the biggest ones have total assets of like 32 billion or 30 billion or, like high mid 20 billions, which by the way, just as a crypto note, is less still than the total value locked in USDC, which is about 40 billion, right? Which just is an interesting side point. But I guess, Darren, do you have any concerns around, let's say, the underlying existential quality? Like, are they just holding treasuries and therefore it's pretty much 1-to-1? Like the calculation of the modeling might be difficult, but you don't really worry about the existential risk of these ETFs. I'd just be curious because I know very little about the structure.
Yeah, so it depends on the ETF, right? Not all bond ETFs are created the same. So government bond treasury ETFs, I would have to corporate bond specifically goes back to what we already saw in March of 2020, when a lot of these bond ETFs were put to the test. And the test was, hey, is the market value of these going to fluctuate significantly to their net asset value? And you can calculate that on a daily basis or intraday basis based on their discount or premium to net asset value. What we saw in March of 2020, when we saw significant trading volume, a lot of disconnects that were happening in the market, a lot of these bond ETFs actually stayed relatively close to their net asset value during open market hours. And so these ETFs did hold up to the underlying securities. There was, not any fundamental breaks. I think, some of the widest spreads that we saw were about 1% to net asset value. And those were on, some of the junkier ETFs like JNK or HY. Market makers did perform their functions at that time.
That's great.
Guys, let me just jump in very briefly. Sorry to interrupt you, Darren. But guys, there is we do have a big crypto space that was scheduled for now, but just because of the developments we're seeing with Credit Suisse and the banking sector, this will be delayed. So anyone that's coming in for the crypto space, any speakers, you'll be DM'd now by the team just to delay that space. And for the sponsors of the space, we do have a fair, even sponsor of the crypto show, but it is a company called USPC. USPC.io, which is a decentralized so it's tokenizing real estate, which is an area I'm pretty interested in. It's a security token. So anyone that wants to check out decentralized real estate, check out USPC.io. But yeah, for the crypto space, for everyone, you'll be getting a message from the team regarding the new time. So we apologize for the inconvenience. Sorry to interrupt, guys.
No, I
think.
Rob,
yeah, go ahead.
No,
Darren.
I think that's kind of my cue. I'm going to jump out here. I got to hop onto an earnings call just after market close. But I do appreciate, the questions on here and the ability to share some of my thoughts. So thank you all.
I appreciate you coming on. Suleiman, the mic is yours, man.
Thanks for that, Darren. Robert, thanks for joining us again. Take this opportunity to ask you a few more questions now. I do apologize if some of these questions have been asked before.
Hey, is Robert, hold on, is Robert back on stage? I can't see him.
All right, I can see him unless.
Yeah.
Is it just me? Well,
I would respect his hustle. I don't know where he gets that energy.
right, because yeah, on mine he is, but I'm a speaker, you see, so it could be that it's showing incorrectly.
Yeah, I think it's
I
showing
do see
correctly.
Robert in the audience, but I don't see him on the panel. Robert, if you would love.
Yeah, no, he sent me a
Robert's
message that he's listening. No, he sent me a message that he's listening right now,
Okay,
so it must have glitched and
Yeah,
showed
yeah,
up on
sure
the
he's.
page.
Yeah, I'm sure he's busy. So.
No, hold on. He does say, hold on, he did DM me now saying I am on. So I think it's glitching. Robert, it would be great to have you back on. I'm going to send you a DM. So just jump out and then on my DM message, click on the link again. It'd be a pleasure to have you back. That's going to be exciting. Cool. Right. Stock talk. I'll sort out Robert. So I'll give you the mic back.
Mario, did we give everyone an introduction to Robert and who he is?
Yeah, I think it's worth a new introduction. Most people would know who Robert Wolf is, but I think an introduction is definitely worth it. Probably one of the most exciting speakers that we've had. So, Stock Talk, I'll give you the honors to introduce Robert.
Yeah, so Robert Wolf is anybody in the
I am back
community
on.
knows him, but there he is.
Hey, good to have you back.
Thank you.
Yeah, for those in the audience that aren't familiar, he's the former chairman and CEO of UBS Americas, and he was the chief operating officer at the investment bank as well. So, Robert, it's great to have you back. And, I'm sure that we touched on a lot of topics earlier, but I know that since you came back, we had the statement out of the Swiss National Bank.
I'm not going to say I predicted that, but because I don't get to take too many bows, but I was off. I said it would be.
Yeah, check anyone. Yeah, check my
20,
retweet.
I said it was.
I retweeted it. Yeah.
I said it was going to be 24 hours or less.
You were absolutely right on the nose about that. And so
my main role for you guys, I was president of the investment bank globally. For the most part, balance sheet. So it, like my tweet said, it brings back some harsh memories.
Do you think, now that the Swiss National Bank has come out and, as you expected, made the statement of full, basically, unadulterated support, that this is going to alleviate a lot of the fears of this contagion spreading to Europe?
Well, as I said earlier, and I'm sorry if we're repeating a bunch, there are things, the answer is yes. But for me, the next biggest signs is going to be what the ECB does and obviously what the Fed does. I've been clear all along. I think the ECB has to do minimum 25. I think they should do 50, but let's just say they'll do 25, and I think the Fed should do 25. Yes, whenever a central bank's providing liquidity, it's good and bad, right? It's a sign they need it, and it's a sign that they needed to announce it. That's a good thing. And my guess is we don't know what conversations are going on, what it means to provide liquidity. I know our days at UBS, when they provided us liquidity, we had to split our bank into a good bank, bad bank. We had to sell assets off of the bad bank, even if they rallied. There was no going back and forth. One thing UBS, and I mentioned before, we were different than others. We used IFRS accounting. So we had to price everything, unlike GAAP accounting, which, a lot of the banks use. I don't know where Credit Suisse and Deutsche is today, but back then they weren't. And yeah, I think it's a good sign that what we saw Sunday night and what we saw today was that the regulators are moving as fast as they can. And unfortunately, they can't move as fast as digital finance or social media, but they're moving probably faster than what we've ever seen in the past. It did not surprise me, as I said on Mario's call earlier. The SNB had to make a statement after Saudi National Bank made a statement, right? For the most part, as of this morning, they were flushing CS if something didn't get made, if a statement wasn't made. Especially after, you have BNP Paribas commenting about counterparty risk, kind of spiral.
We touched on, most of the angles around the European banking situation, thanks to you and thanks to your expertise there, especially. But I'm sure we'll touch on that more. But, I think one thing maybe we didn't get your full perspective on is obviously producer price index came in this morning as well. A lot cooler than expected. I'd say that's probably the best PPI print we've seen in at least 6 months. So, seeing that big beat on producer price index, and, as you know, it's CPI and PPI aren't, neither of them are leading indicators. They're both lagging indicators. To the extent any of them can give you insight, I'd say PPI is a little bit more leading. So do you think, that considering this banking crisis, if you will, I hesitate to even call it that, but, Silicon Valley Bank, Signature Bank, the worries about Credit Suisse today, the extent to which that phenomenon softened the path for rates, right? We saw Fed swaps pricing in 100 bips of cuts by December, which I think is ludicrous. But, we saw the market's reaction to it. Do you think that this, cooler print, I know it's just 1 month, but maybe edges us even more in the direction of a softer monetary policy path forward?
I don't, unless we think they're nervous about financial stability. And my gut tells me after this price action, they probably feel okay. And based on what they did Sunday night and the extension of kind of what I would call a 1-year discount window. My view's a little different. And I've been having a debate with all of you guys over the last couple of days. Half the smart people think we're going into a recession and the Fed shouldn't do anything or even eventually ease. I'm on the other side. I think we're absolutely not going into recession. I think the most important thing is inflation when it comes to the Fed, because I've said this multiple times, so sorry to repeat, that impacts 350 million people. I don't think we're anywhere close to coming down to 2.5. I agree with Larry Fink, although I was saying it publicly before him, that we're going to be 3.5 to 4% for years. And so, I'm more nervous of inflation. I'm more nervous of geopolitical risk being prolonged. I have a different perspective. I think the yield curve is more of a flight to quality. I also think it's deposits going into the short and what they should. There's a lot that went on the last few days that made people, in my opinion, smarter, right? All of a sudden there's people talking about options to deposits and, hey, is it fair that what they were paying people? I think a lot of people are saying, you know what, I'll take 3 months or 6 months or, 2 years at 4%. So I think that there's a lot of different variables taking place. So my view would be the Fed should first of all, I was at 50 basis points after the last employment number, not at 25. So I think I am moving by going to 25.
Yeah. No, I agree with that. And I mean, you made a point there, and I think we can, level that up and bring it to a second question. And I'm asking you to speculate here, but do you think that this aggressive move in rates that we've seen, combined with the fact that we know, most U.S. banks at least are heavily exposed to long duration treasuries and maybe didn't expect this or weren't prepared for this steep of a move in rates up? Do you think maybe structurally we've kind of itched the system, or, maybe the cat's out of the bag proverbially in terms of people expecting more from depositing their money in anywhere? If we think about the move of so many depositors to treasuries this year, and maybe even inflected higher after this move, do you think that could lead to maybe somewhat of a structural change in banking going forward?
I think it has to, because I think, like I said, I think people are smarter. And if you are going to keep your deposit at a bank, they better pay you for it. That being said, I also think some of the statements like deposits are safe, right? We've never had a deposit be in trouble, forever. So, the last thing anyone wants from a regulatory perspective is a guarantee of all deposits. Because if I'm a bank, I become a utility overnight. And then we're really going to change how risk and profitability gets pegged with banks. So I don't think that's going to happen. I think they're going to continue to use their tools, but I think that banks are going to your point, banks are going to have to step up and, can't pay 30 basis points if the 50 basis points are 1 point, if the 2 years at 4% or 5% a month ago. Just can't do it.
Yeah, they got to be competitive, especially.
They got to be competitive. It's funny. I called my bank yesterday just to see, and I mentioned this earlier. because I have some 3 months coming off where 1 year CDs were, they were 420. It's interesting, a bank CD at 420, certainly, better than I've seen. So maybe it was 430.
Yeah,
but
I know it's
people are
anecdotal, but
making different
I have
calls.
some.
People are making different calls to their bank, and their bank's going to have to do the right thing.
Yeah, I know this is anecdotal, but I have some, decent sized personal accounts at Bank of America, and they've been itching me on the phone to try to get me to put the money in higher return places, because it's clear that banks are concerned that depositors are wanting to move their money in droves to treasuries, and maybe it's not as much of a risk to depositors as it would be in a lower rate environment like we've been in for the last 15 years. But I completely am on the same page with you. Something has to give here, because with this rapid escalation in rates, banks are between a rock and a hard place to try to incentivize depositors.
Yeah, to actually back that up, it's kind of interesting. I've been a Merrill customer for a long time, and I've turned off all of the please don't contact me. And it's kind of really interesting that they reached out to me yesterday and today. Like, I'm just getting constant calls from them.
And they have to be nervous, right, of sweep accounts, right? They have to be nervous that so many customers are going to sign up for deposits and then have excess money going to the sweep accounts, which is, money market accounts that they normally sub-advise. They make bupkis on that.
Yeah, no, I think that's definitely a great point to consider going forward. MG, I saw you had your hand up. Do you have a question for Robert?
I do. I have a couple of questions for Robert. First of all, Robert, thank you for being on here. My first question is that given the issue with banks now, it's not about credit quality. Like, in the savings and loan crisis and in kind of the toxic loan crisis of the GFC, it was about bad loans and extending bad loans. Here it was essentially a duration mismatch. So on the one hand, what people have kind of posited back in 2008 was, let's increase the equity ratio. Do you think that the equity ratios need to be increased even more so that we don't have these type of interventions, like, maybe a 20-25% type of equity ratio for banks, saying, look, that takes a lot of these kind of questions essentially off the table? That's my first question. My second question is, by having deposit insurance at such a massive scale, does that create a horrible moral hazard? Because a lot of financial historians have posited that the problems in the savings and loan crisis in the 80s was due to the fact that we had FDIC, kind of guarantees. And as a result, a whole bunch of Texas banks and Southern banks made really, really bad real estate loans that ultimately resulted in a collapse of the savings and loans.
Well, I just want to say I was coming on actually to listen to Kim.com. I was going to be a listen only. So I just want to make that clear. Listen, there's two things. One, I don't think they need to change the what I would call the capital adequacy for the systemically important institutions, right? They have 12% capital against they have 12% capital against their assets. So I think, they're under 10. What are they? Under 10 times levered. So, when I was running yes, we were 35 times levered. So one, the systemically important financial institutions, not politics, but they, SVB and others were lobbying Congress, and they moved the systemically important financial institution asset level from 50 billion to 250 billion. So SVB and others, and I mentioned this earlier with Mario and his group 2 days ago, they were no more a SIFI, which means they didn't have things like living wills and a certain amount of capital adequacy. So if they're going to make changes, it's going to be to those that they are extending the facility and the liquidity to. Number two, I think what they're doing with the deposits was smart. what they did was not only did they kind of say deposits are safe, although they never used the term guarantee, but instead they also added the 1-year facility. And that's really a 1-year discount window. And what, for those who didn't hear me earlier, during the crisis, no one wants to go to the discount window. What you do is you give your treasuries and they give you 90 cents on the dollar back. And it's a quasi repo. And if you went to the discount window, the negative connotation you had as a bank was haphazard, and it caused unintended consequences. During the crisis, we made sure all the banks went to the discount window, so there wasn't a view of winners and losers, who's weak, who's not weak. I think everybody, all these regional banks, should go to this facility. It's literally being able to go to the discount window with no margin. It's a no-brainer. So one, I think that the Treasury and Fed and FDIC could make that bigger if needed. And then the second thing that I mentioned before that they could do, although they need congressional approval, and I think this would be better than saying we guarantee all deposits, which is 15 plus trillion, they could always go to the transactional facility that they did during the crisis 15 years ago, which was FDI insured at a higher cap, but only for payroll. And that would also remedy a lot of the, systemic discussions that we've been talking about. I hope that wasn't too long-winded and answered it.
Thanks for that, Robert.
Thank you.
I'm glad Robert mentioned Kim. Kim, I've been getting a lot of messages about your tweets, and the question is this an accurate reflection of what's happening, or is this Kim's personal dislike of the United States?
This allegation has been made a lot, right? Of course, when the US government destroyed my business in a novel case of copyright infringement, it was upsetting when they raided me with, 72 cops and 2 helicopters with machine guns and all this shit. Of course, that was very unpleasant, but that was 12 years ago, What I'm tweeting about, what I'm talking about is just my observation of where things are heading. It's not because I'm an angry person. I'm actually a quite happy person. I live a very good life. I have a great family. I'm
6 kids too. God bless you.
Yeah, thank you. And just the new one just arrived in November. So,
Congratulations.
Things couldn't be better, right? So I'm a happy guy. This is not a vendetta. But what I do like to do is, because I have this insight from my first-hand experience with the U.S. government and how they operate, and how dangerous some of the decisions that they're making actually are. I think it's because I have this knowledge, it's important for me to use my channel to share what I know with the world, and I'm just an observer of the data, of the facts, of what's happening, and I'm putting it all together in an easy to understand format for my followers. And, I just made a tweet earlier gloating a little bit because I've given people a couple of years, and if you compare them with current events, they've been spot on, and to say that all these tweets that I'm making are because I'm mad at the United States, that's just not the case. I'm worried about the world. I'm worried about the future of my children. I'm worried about, people around the world that have no idea what we are facing. This current financial crisis in the US may actually accelerate the problems that we see internationally with Ukraine, the conflict with Russia and China, because let's be real, is the US government the kind of government that is going to go down and take it on the chin and rebuild after a total crash? or is it going to be the government that is going to take the world down with it? And that is my big fear, that the arrogance of the people in power in the US is so beyond what anyone understands, that they are literally going to start World War III, and that the conflict with Russia escalates into a nuclear confrontation. Because what do these people have to lose? The US is going down in an accelerated pace, and it's so obvious to anyone who is observing what's happening in the world. It's just that Americans are being fed all this propaganda and all these lies by their deep state controlled media that they cannot see it. Americans don't have any clue about where the world is heading, because they're given this fake story by the US media about how things are actually going. And it's depressing to look at it. And I'm trying to do my best to keep people informed, and I have the wisdom and the understanding of where the US is heading, because I've been observing this stuff for the last decade. And, I'm sorry, but I'm just quite knowledgeable about what's happening.
And I just want to echo what Kim said. There's no doubt. You just have to look at Kim's history, and the way he's acted in terms of having many opportunities to make his life easier, and chose what the principal thing was. So I don't think he would be fear-mongering. But yeah, I just thought I'd ask you the question so that, we got the overview of everything. Douglas, thanks for joining us. There's a few more questions that people have been sending through, and I thought I'd ask you, as well as Robert and Kim and EYC and MG and the various other guests we have. So one of the questions is that when it comes to the FDIC insurance premium, based on these, some call bailouts, some say they're not bailouts, but based on this, are people expecting their premiums to increase?
Yeah, that came up a couple of times yesterday, and I forget who was particularly mentioning that as their concern. It'll pop back into my mind in a minute. How do the dynamics change if we're offering, I'm not going to call them bailouts, but these backstops provided by the FDIC? How do the increased costs of FDIC insurance ultimately trickle down to us, to depositors? And I think there is something to be said for that. And I'm not, I haven't played that out entirely. Does that show up as, a limitation in yield for depositors? I don't know, but, we're going to be surely thinking about what, the second, third, and beyond order effects of what these actions, these policy actions in banking over the last 5 days will have. And, I've kind of gone into this with the mentality that, there's going to be very little reason for me to believe that whether it's bailouts from taxpayer dollars or backstops from insurance like FDIC, and sure enough today, in the most least surprising news I think any of us could have expected, is that there is now liquidity provided to Credit Suisse if needed. And I won't be shocked if indeed it is needed, and I wouldn't have been shocked if they were, if they went under and got bailed out. We're just kind of in that's the name of the game right now, is we can't let the house of cards fall, no matter what. Stability above all else. And we'll create new tools if we run out of the tools that we currently have. Kim has every reason to be concerned about the future. At some point we have to, limit our concerns and live our lives, but they're valid. I'm not going to deny anyone their concern over that. My hope is, and focus is usually on, what green shoots or solutions can we think of, hopefully together in somewhat of a united way, to overcome the challenges that we have. What's bleak to me is the gentocracy that we face in the country, and the lack of fresh ideas, the lack of youth, the lack of collectiveness, and presence of, my generation, from Gen X on down through millennials and Gen Z. That's where I place my bets and hopes. So if anyone listening here, if you want to avoid being depressed and you want to start feeling good, take some stock, in the future of the country, and that lies in X on down. I'm a geriatric millennial. I have a great deal of confidence in my generation, if given the opportunity, if the baton actually gets passed, from the boomers, eventually and older on down to folks who have the intellect, the wherewithal, the energy and ability to create the change that's needed to move us forward in a direction that's sustainable. And we this is not a way. This is not an opportunity. I don't want this to go down the political road, but it inherently is, and it's not one side versus the other. It's just new versus old. And I'm not trying to do ageism here either. It's just it's just right in front of your face. It's always so in your face. Every single thing from policy to whichever administration is trying to gain power here. That's the part that bums me out the most. But on the other side of that coin is the part that encourages me the most. My generation was told to go educate themselves to the highest order and take out the loans to go do it. And, the 08, 09 kind of blowing up that whole situation. I don't think it's really taken the youth of this country back. I think it's maybe emboldened and empowered them, and that takes us down a lot of narratives.
Not to interrupt you, but just a little update on the price action side. So in the after hours session here, Credit Suisse is ripping after hours. It's up 10% in the after hours session, dragging Barclays with it a bit too. Barclays up 2%. But
yeah, that's.
I want to give you guys an update.
How are the US? How I'm back. How are the US stocks doing?
Are pretty flat. Bank of America up 30 bips. Schwab's up 25 bips. Citigroup's up 20 bips. JP Morgan up 11 bips, which is surprising. I mean, JP Morgan traded down 5% today. Bank of America traded down it didn't trade down at all, actually. It traded pretty flat, down about 1% for the day. Citigroup down 5%.
So would you say, Stock Talk, you're seeing, based on the swift response, the market is responding really positively? Is that a fair statement?
Yeah, I mean, as soon as that headline dropped, Credit Suisse started rebounding pretty hard. I mean, the lows off that news, the stock was trading around 185. Stock's trading now 240, so pretty massive move off of the local lows from that news. I mean, that wasn't the low of day. The low of day was in pre-market, actually, when the stock was down a little over 30% in pre-market session. But up a lot.
I want to ask you. So I've got a question for you again, Stock Talk, just on your strategy with banking stocks. But before doing that, let me just mention again, for anyone coming in for the crypto show, we did reschedule it just based on the developments we're seeing with Credit Suisse. So we consider this a pretty serious matter. So we're just focusing on that for now. And I want to give a shout out again to the main sponsor of the crypto show, considering we rescheduled it and it's relevant to this discussion. So I don't mind giving it a shout out in a non-crypto show, and that's USPC.io, which is tokenized real estate. They're a security token, and I'm a pretty big fan and pretty comfortable, backing a security token project. So USPC.io, if anyone wants to check it out, and they'll be a sponsor of the crypto show that we'll do later on. But back to the question I have for you, Stock Talk. What do you expect with banking stocks over the next few days and weeks?
I mean, I think, look, the easy part of this trade is out of the way, right? I mean, the easy part of this trade was going short the regional banks out of the Silicon Valley bank failure. That trade worked beautifully, but it's really hard to predict price action when from now on the action these bank stocks are really going to be governed by political action and policy action, right? And that's exactly what you're seeing here. The second the Swiss National Bank stepped in, I mean, Credit Suisse now made a complete reversal. So is this going to last? I don't know. Does this remove the any issues that Credit Suisse has internally? I don't know, but what we do know is that the Swiss National Bank is willing to fully backstop it, provide liquidity if necessary, and I imagine in an extreme case, bail out the bank. And so that was as expected, as Robert said earlier. That was what he expected. Myself and Jay said the same thing. There are certain banks that are just globally systemically too important, right? Those are the GSIB banks, 33 names we mentioned. The likelihood that any of those 33 banks goes out of business in a flash without policy intervention is very low. And so I really think the things to trade here are not necessarily the banks themselves anymore, but the fallout candidates, commercial real estate partners, small caps that depended on credit facilities. There's other angles from which to trade this theme, but I think the easy part of this trade is over, as it usually is at the outset of these things, right? I mean, you're either quick to the punch or you're chasing the trend, and the majority of the market chases the trend. I mean, even if you were one day late to this trade, you would have gotten killed by pretty had opportunity. So trading these is not easy. Navigating markets in general is not easy, but I'd say the easy part of the trade was post Silicon Valley being short the regional banks, and now it's a very indeterminate fate. Any one of these regional banks, you could see funds consider some of them a steal, right? You saw Ackman came out yesterday and said, I think there's tremendous value in regional banks after this collapse, and there probably is in some of them. But the question becomes, what's your risk reward profile? What's your perception of risk on these equities? Has it changed? I think materially it has changed, but that doesn't mean that there aren't bargains in the space, and there doesn't mean there aren't stocks that won't rebound. One of the names that we liked yesterday, which there are very few, if any, in the banking names that we liked, was Schwab off of the CEO buy. That stock outperformed the whole sector today. It's up 5%. It's up another 25 bips after hours. I think it'll probably, keep running, assuming there's no more. But, a lot of these have come down off of babies being thrown out with a bathwater effect that you see in markets all the time. And that's a lot of times where alpha is to be found, whether it's the upside or the downside. So, that's just some general thoughts. I mean, Credit Suisse, you're cooling off a little bit, up about 7% now, but still up big in the after hours.
Let me ask a question quickly to Eugene and any other speaker. And that, Eugene, you mentioned that comment a while ago. Actually, before you do, I've just pinned the tweet above for USPC. A lot of people commenting. So if you want to check it out, the sponsor, the securitized real estate tokens, check the pinned tweet above, so you can have a look at their website. Eugene, a lot of people were criticizing tech stocks, and someone mentioned the thinning of the herd. I don't agree with a lot of that criticism. I think being pre-revenue, even if you have high valuations, that's not necessarily a bad thing. I think to innovate, focusing on long-term potential rather than short-term revenue is not necessarily a bad thing. So if we do see more kind of a backlash against tech stocks after the collapse of Silicon Valley Bank and what some people perceive as a bailout, even though it isn't, doesn't that concern you on the health of the tech sector in the US, even if Silicon Valley, or even after the backstop for Silicon Valley Bank, could there be a slowdown or loss of competitiveness for the US tech sector? So I want to ask that question to Eugene, because you were talking about it earlier.
Yeah, definitely. Thanks for the question. I definitely think that that's the concern, and that's what I was harping on earlier. I mean, as an American, and as somebody in the tech industry, I firmly believe that technology is the sort of one of the main drivers of productivity gains going forward in this country, as it has in the past, right? And I talked about how San Francisco and the Bay Area in general has this kind of open-mindedness to new ideas that I think both led to the reasons for the collapse, but also are sort of the reasons of what makes the Bay Area so special, right? I mean, a random person with a PowerPoint on a cash flow negative company, those, a lot of those fail, but some of those become Google and Facebook, et cetera. I cited the thing earlier about, around 20% plus of all GDP in the US was started by, venture capital backed companies. And I think that's a really important stat. I think we should be concerned. Now, I mentioned Schumpeter before.
Before you continue, sorry, man, before you continue, I'm interrupting, just to let everyone know. So I do get a warning on the space that it could crash after a certain number of hours. We've been going on for over 7 hours. So if it does crash, you'll just have to go on my profile, click on the link again, you'll access it. If it does crash for anyone, that could happen. It's a 50-50 chance over the next 3 minutes. But sorry, go ahead, Eugene. Sorry to interrupt, man.
Yeah, absolutely. I mean, I think that there's a lot of glut in the space. I mean, there's a lot of companies, a lot of startups that have raised a lot of money and are probably not even deploying it efficiently. I mean, talk about moral hazard. The question is around, will tech startups, right, private tech startups that are burning cash, how much will the weekend change the psychology of how we choose to deploy our capital, right? And in some senses, perhaps a lot. In some senses, no. I think it's going to be company by company. It's going to be founder to founder. I think a lot of us founders and these founder groups that I was in were just relieved to be able to make payroll on on Monday, right? So I think we're just kind of, battling it second to second. But, like the fundamental question of like how much risk to take and how much like is funding risky ventures inherently like a systemically bad thing. And I think for the United States overall, like keeping the spirit of the Bay Area, maybe not around the rest of the world, but keeping the spirit of Silicon Valley, I think is extremely important. I mean, think about like, let's go all the way back in time, right? Marcus Crassus, funding a pretty much bankrupt Julius Caesar, right? I mean, regardless of what you think of what he did, I mean, that like people have been funding risky ventures for a long time, and some of those ventures turn into nothing, maybe 90% plus, but some of those ventures turn into very large things that add to the economy.
But isn't that the cost, you think, EYC, of
Can anyone hear me?
Stock talk?
Oh, sorry, did I cut out there? My bad. I said, but
Man, go ahead.
I hear this, and it's tricky for me, because I consider myself, a capitalist. I'm in favor of free markets, generally speaking, but I'm also a realist to the extent that I understand that we don't live in an ecosystem anywhere, whether it's the United States, China, anywhere, where we operate in purely free markets, right? I mean, we all know that we live in a central bank enforced global financial ecosystem, and so I think there's a lot of idealism that gets injected into these arguments, and I'm not saying that you're in that camp, but I guess my broader point is, isn't that just the cost of innovation, right? These zombie companies, these failures to innovate, these cash burning, unproductive companies, isn't that just the cost to innovate? Because if you make the argument that the United States is overfunded, small cap growth companies, or overfunded venture capital growth companies, you also have to underline that assumption or underline that statement with the objective fact that the United States has led the entire world in innovation for the last 100 years. I mean, most meaningful innovations in technology, in industry, have come from the United States. And you have to somewhat attribute that to the fact that we provide capital. This is a place where you can find capital as a startup business in a way unlike anywhere else in the world. So, don't you think that we kind of have to discount that cost of these zombie companies and these unproductive, tech companies?
Well, Stock Talk, I think that's a really interesting point. And, obviously we can look back the last 100 years and it, is really interesting history. And clearly we've been the innovation leaders as well as, the largest economy and, the world's major superpower. But the question is really, what does the next 100 years look like, right? And, I've kind of my small view, right? I know a lot less about energy and a lot of other things, but, if I look broadly, what's happening in technology still continues to get me excited. But when you look at what's happening in technology and you look down in the scenes, I mean, sure, OpenAI is getting a lot of attention about ChatGPT-4, and it is an amazing product, by the way. I'd recommend everyone to try it out. But let's think about some frontier tech, the AI war, right? Who's to say that we're going to win that, right? I mean, up until OpenAI put out ChatGPT, I think the consensus view is that China is going to win the AI war, right? Just because of the mass amounts of data, how big their population is, right? I mean, data is the problem, right? Or rather, data is the new oil. So, okay, AI, who knows? OpenAI is a great bright spot, fantastic. A lot of dark spots. Crypto, another potentially bright spot, right? I mean, look at what we did with Coinbase, and we grew some of the biggest companies in crypto, and they're still based in the United States, but based on regulatory actions and certainly based on what's happening over the last few days. Are we, like, as a crypto entrepreneur, you're looking at what's happening and things like Coinbase, who should be the darlings of our, our people who are running regulations, right? I mean, if you believe in the U.S. economy and you want us to keep our sort of forthrightness and looking at the innovations around crypto, you would say, let's embrace Coinbase, right? If you're a regulator, right? Like, sure, crypto's unpopular, whatever.
Well,
but
I think don't do that. Hold on. Now I think you're making an assumption that every type of technology is in favor by the government at the same time, which, isn't true, right? I think the broader point I'm trying to make is that to the extent that you can glean any political motivation behind the insurance of the depositors at Silicon Valley Bank, which in my view you can, that bigger political backdrop is the idea that this is no longer a global economy in which you can expect the entire economy to be viewed in a vacuum. We are so hyper competitive with China now technologically that the last two major pieces of legislation passed by the government are both directly in line with that narrative, right? The CHIPS bill and the Inflation Reduction Act. Both of those bills are injecting hundreds of billions of dollars, quite literally, into not only bringing technology to the United States in the form of batteries, battery metals, that entire industry of attempted clean energy, I'll say. And on top of that, the CHIPS bill, where we have the United States government doing its best to incentivize the chip industry to build here domestically. And so those kind of speak, I think, to the motivation of the United States government that this is no longer purely a matter of, hey, let the bullshit fail and let the great companies succeed, which is a concept I broadly agree with. But this is more so about the United States edge versus China in an international competition, which is what it's boiling down to. I mean, we have import controls, export controls between the two countries. We have increased domestication of industry to drive both of these technological trends in both countries. And so, how do we enforce the balance between our desire to protect capitalism, to protect free markets, with our desire to be internationally competitive with countries that are seeking to displace the United States role as the lead innovator?
But what's the solution that you're referring? So, for example, I mean, I think that's great information, and certainly I don't have a lot
it's
of
not a solution. The point I'm trying to make is that in my view, we have to view industry in context. I don't think at this stage of geopolitical tension, I mean, look what's happened in the world in the last 8 months, right? The last 10 months, the last year. I mean, look at tensions between, anywhere from Iran, India, Pakistan, China, Taiwan, obviously Russia, Ukraine, which has been the centerpiece of attention. Look at the dichotomy in policy. This thing is, geopolitical tensions have bled to every thing in the world. They've led to economic relationships. They've led to border disputes. And, we're boiling it down, I think, in a way where we want to view industries, bank failures, government interventions in a vacuum, and to make those assessments of like our broader beliefs on, hey, I'm idealistically a capitalist. But I think we're missing the context. We're missing the context that we're dealing, competitively with a country that is, for all intents and purposes, a dictatorship. It's a one-man ruled nation. Xi just got elected to his third term unanimously. I mean, whatever your criticism might be about the United States, we don't have people that are elected unanimously with zero opposition. Not one person in the party voted against Xi being reelected. So we're dealing with a country that has no red tape. They don't have a Congress to go through and a Supreme Court. It is dictation. It is economy by dictation. And so to be competitive there, what extent do the United States have to protect industry? What extent do the United States have to make political exceptions to step out of what might be idealistically right and make decisions that are in our geopolitical interests?
I mean, I think I love a lot of what you're saying, and of course support it. Just given the fact that I was born and raised in America and have just been a great beneficiary of being a citizen here. But I mean, basically, if we were to step back and just think about it, I mean, we're in a classic Thucydides trap, right? And this has occurred many times over, where the declining economic power in the world, we do have the strongest military, and China is on its way up, right? And there's some anxieties around, are we sure, dictatorship, et cetera, moral questions, but I mean, for hundreds of years, we've all assumed Western style democracy is basically the best way to live, right? The whole Churchill thing of, democracy is the worst form of government, except all the other ones that have been tried. But, that hasn't been consensus for many years, right? For the thousands of years, right? I mean, Plato thought enlightened dictatorship was a better form of government than democracy. In fact, he put democracy pretty low. I mean, I don't necessarily agree with him, but I think a lot of our assumptions are going to change, and a lot of us Americans feel so much anxiety around the Thucydides trap and where we're going to end up. And I think, of course, it's an open question, but I don't think we should say that simply because government's a dictatorship, et cetera, that's going to make it not the country that's going to succeed, right? Despite how much we don't want it to succeed. But I'd love to.
I'm not making the implication that it's not going to succeed because it's a dictatorship. I'm just saying, factually, China is a dictatorship. I mean, that argument is very, very
agreed on that.
Yeah,
Robert, let me. Sorry, stock talk. Robert, on that same point, I'd love your thoughts on the rivalry between the US and China, and the steps back we've taken with globalization.
Listen, they're our most important counterparty in so many different ways. We're the two 800-pound gorillas, and I think we continue to test each other, but we also continue to talk a lot more than the public knows and would think. And listen, no one wants nuclear proliferation. Everyone would like to see, a remedy for Ukraine and Russia. Certainly, people are nervous when
and a settlement for Taiwan.
Yeah, certainly people are nervous with when they see our relationship with China not on steady ground. Listen, I'm on the Defense Business Board for the United States, and there's no question that China is certainly on everyone's mind in Washington 24/7. I think it's best I leave it at that.
I'll try to get you not to leave it at that. I'll give it a try. Do you have any concern? By the way, I don't have to put you on the spot, Robert. You could just not answer. But do you have any concerns? And I don't want to divert the discussion. I want to go to MG and get his thoughts. But one thing we've covered a lot in this space, and I think something I just don't want it to be, I don't want the issue to kind of be forgotten by people, and that's the issue of Taiwan. At various generals on stage in the spaces we did, and you have, and that's just the only question I have about China, US, and then we'll move back to the current discussion. But you've got Biden's rhetoric that we will use military, we'll intervene militarily if Taiwan's invaded. You have China saying that they'll use military force if they have no other option, and that was directly from Xi Jinping. I'm paraphrasing, of course. So you don't seem that concerned. You think behind the scenes there's more dialogue and there's a high likelihood a middle ground will be found, but this is more. Well,
I mean, one, it's not. I don't think I intimated I'm not concerned. I mean, I said we're on fragile ground. So, listen, I think not having a public debate here with Kim, but no one's looking for World War III. And no one wants to edge anyone on to get into World War III. And, I think the faster, at least my perspective, where we can get Ukraine back to a democracy and we can, get this war behind us is we'll all be better off. And I think, based on what happens between Ukraine and Russia, obviously has impact in Taiwan, as does, North Korea and Iran, and a lot of the other, places around the globe that has authoritarian rule.
MG, I'd love to give you the mic. Thanks for being patient with us, man.
No problem. I wanted to go back to your earlier question about technology and potential malinvestment in that space. I did want to push back on some of the conversation. I think that there, from a traditional kind of investor's perspective, I look at what's been going on in technology and the valuations, and I frankly can't get my head around it. And that's not because, I've invested in technology, I've invested in software a lot, and I think that there's this notion that people have to give technology companies sort of leeway because they're innovative. And I'm just going to call bullshit on that because, I'm not seeing that much innovation for companies that have been, and I agree at the beginning, that's always the case. But these companies are asking for infinite rope to having to prove their innovation and their sustainability and whether or not their business models actually make sense. So if you look at a lot of these businesses, and I don't want to single out any names, but, just to throw out like DoorDash, Twilio, Okta, a lot of these sort of SaaS names, none of them, when I look at their, kind of income statements and balance sheets, none of them make sense. You have a company like, DoorDash, and, you can go down the list, Uber, Lyft, all these guys. You have a company like DoorDash, $6.6 billion in revenues. Their gross profit is about $3.1 billion. Their SG&A is $2.85 billion. And then on top of that, they have $830 million in R&D. If you're not making money, very readily apparent in your income statement that you're not profitable at $6.5 billion in revenue, that business model doesn't work. And that goes down the line for these guys. And so I'm actually frankly tired of the tech companies constantly saying, and the tech people in that industry saying, hey, look, we're doing these disruptive things, we should be given more leeway. And also the other thing that I want to frankly talk about, and this relates to what Robert said earlier about LTCM, when LTCM was in trouble, you had a meeting coordinated by the Fed, but all the banks got together to essentially bail them out. And the banks that didn't participate, Bear and Lehman, later on were ultimately punished because people didn't come to their help when they needed help. Now, here you have a situation where everybody apparently talked about how important systematically to the Valley's culture and to the ecosystem Silicon Valley Bank was. And the guy was very connected. If you went to the Rosewood Hotel, which is the center of deal making, this guy was all over the place. And even then, he probably expected that he could kind of clear an equity deal if, I think he was trying to raise $2.2 billion. He had $500 million committed by General Atlantic, which is a big and real private equity firm. And none of these tech billionaires, all of these VCs, none of them could kind of pony up and help the ecosystem kind of remain alive. Meanwhile, they went out of their way to go and backstab this, this bank and said, told all their, kind of investment companies to leave them. I mean, it's just a bad look. And then on top of that,
why did they do that in your opinion, man?
My sense is that, for all of the criticism that Wall Street has received, for being rapacious and greedy and this and that, Silicon Valley has, in this instance, in my eyes, it looks like a kind of a very dysfunctional sociopathic type of community. I mean, no one was willing to kind of talk to each other, say, hey, look, everybody pony up 50 million, everybody pony up 100 million. We're going to keep this bank afloat. These relationships are worth it. The service that these guys provide.
They did the opposite. They did the opposite, and they kind of sparked a run.
They did the opposite. So, it's just a bit, for me, I'm a bit cross with the tech industry in general. And also when we're talking about the tech industry, we're talking about info tech and websites and whatnot. It's not like there's material science, sort of capital intensive sort of tech that's going on. It's not the tech that's going on in the energy sector. It's not the tech that's going on in kind of the industrial sector. It's a very particular type of tech. And even when Stock was talking about the incredible government subsidies that are going to the semiconductor industry, those are government subsidies because private interests won't do it. So, there's a problem there.
So, MG, I actually agree with a lot of what you're saying about some of these systemic problems, but I guess I'd implore and just ask everybody, well, what's the solution, right? Some sort of practical solution. So I'll say, for example, ostensibly private equity investors and VC investors sort of look similar, right? They both invest in private companies, but just in very different ways. And if you look at the culture of each, type of investor, I mean, they're just so different, right? And I'll bring it to the broader global scale. So many countries around the world are trying to replicate the magic that we have in the Bay Area, but so far have not, been very successful. I mean, you can look at some examples like Tel Aviv, et cetera. But that's I guess the question that we have, right? Like this culture, everyone's complaining about the culture. And there are certainly problems, and there's systemic problems with companies that have raised too much money. But if you start, to bring in the culture of New York to the Bay Area or wherever else, that's just not going to work, right? It's not going to produce the kinds of innovation long term that we've been able to generate over decades in Silicon Valley. So I guess I acknowledge the problems. I actually agree with a lot of what you said, MG. But it's like, what do we do then? Do we say, okay, well, replace all the VCs with PE folks? I'm not sure that's the solution. I'm not sure it's going to generate the kind of value that we've come to expect from this ecosystem.
I'm not saying that, EYC. What I'm saying is that I think it, from a kind of if you were to kind of put a collective societal hat on, I think we do need investment in other areas of the economy besides tech. And I think that this idea that if we don't do it, we're going to lose the race in innovation and disruption and this and that, I don't know. I'm not buying it. I'm not buying that argument.
I think it's a good
How
point.
do the investments in the US tech industry relative to China? Does anyone have the numbers?
I would say that in general, broadly speaking, Mario, that the investments in Chinese tech are much more hardware centric and therefore far, far, far more capital intensive. And probably, because the investments are sort of, pushed by the government at some level, and to some extent, they're sort of motivated by making sure they maximize, employment and whatnot. So having very large, capital intensive sort of investments that have lower returns is probably the objective for the Chinese state versus what's going on here.
That's interesting.
And talking, Eugene, I'm going to ask you another question. Let me Google the numbers directly. I think this is something that that we discussed briefly, but it's just not being covered enough, in my opinion. I know we've asked you a lot about China today, you and MG, and this is another China question. And Robert, I'm not asking you questions because I feel bad. I don't know where you get your energy from, but you can also weigh in on this one. I'll read out the stats. Foreign direct investment into China totaled $42.5 billion between July and December 2022. That's according to an official balance of payments. That constituted a 73% decline on the year, the sharpest drop dating back to 1999. So we've talked about the concerns with the Chinese economy. We've talked about the Chinese real estate Ponzi scheme, as you guys called it. Would love more thoughts because we didn't discuss. I think we discussed it with Robert and Jay earlier, I think. But Eugene and MG, would love your thoughts on this. Robert as well, if you want to weigh in. In the meantime, I see a lot of great names in the audience. Make sure you check your phone because I am sending you an invite. If you're doing your push-ups or something, you won't know that we're sending you an invite to come up on stage. So check your phone quickly if you see an invite, DM me or come up. It'll be good to have you back on the panel. But Eugene, actually, do you want to kick this off on the if whether you have any concerns with the drop in foreign direct investments into China?
Yeah, I think it's fascinating. That balance of payments info is really interesting. Going off the numbers and more to kind of personal experience, as a tech looked at getting investments from like the Tencents, et cetera, of the world, right? The BATs, Baidu, Alibaba, and Tencent. And, what we didn't realize and what's kind of apparent now is that, there's just so much of, it's just replication, right? Like there are these companies wanted to park a lot of money in us because effectively they just wanted to replicate us, right? And you're seeing that, you saw that play out. But the problem now is you have some of these category leading companies, right? That are now just coming out of China. FDI flows is interesting. How does that affect things? I'm sure a lot, but I'll say as an entrepreneur, like I'm just very glad we didn't take Chinese money. It was one of those easy things to do back, let's call it 4 or 5 years ago, where we could have gotten a lot of flows. But yeah, it was just an interesting thing to live through.
MG, Robert, would love your thoughts on this.
No one can be surprised that foreign direct investment slowed in China. One of their biggest moves.
73%, Robert. 73%.
No, I know, but a couple things. One, they kind of shut down, maybe more than anyone. Number two, a big part of FDI in the past has been investment into real estate, which equally shut down. And number three, a lot of the growth in China over the last 2 years has been gambling, which isn't part of FDI. So, it's nothing to me that we may see a slight reversal as China reopens, but it doesn't surprise me. No different than exports changed dramatically in the U.S. during that time because travel and tourism for us is an export, which went down dramatically during COVID. So I think we have to kind of look at where the starting points were, so it doesn't surprise me.
MG, where do you stand on this?
Yeah, I'm not surprised that there's a decline for a couple of reasons. One, the COVID reasons that Robert spoke about, but also I think a lot of companies certainly going from Europe, certainly from the United States, maybe less so from Europe and Germany. But basically, along the lines of when you do foreign domestic investment, say in a subsidiary that you need to sort of set up internally in China, there's often, a requirement for technology transfer. So companies have, been onto that game and have been reluctant to do that. But broadly speaking, you have a $17.5 trillion economy in China, of which about 40% is investment led. So that's about 7 trillion. So in the grand scheme of things, it's not like China's at all dependent on foreign domestic investment in terms of promoting their own internal investment needs. So I'm not as concerned about it.
The stock talk, we talked earlier about the real estate Ponzi scheme in China. You could touch on it very briefly, but also give me your thoughts on this. And while I ask you a question, man, I also want to give you a massive shout out. You've been here for like 7 hours. So anyone that wants, I think most of you know what, the knowledge that Stock Talk has. He does have a group, I think, trading community group. So check him out, go on his profile. And he does give a lot for any traders out there. He does give a lot of research papers and tips in his group. I'm not a trader, but if you are, highly recommend you check him out. Stock Talk, I appreciate you being here, man, and giving us your time for so many hours.
Yeah, I appreciate that. Yeah, we put in a lot of work. We try to be different than some of those other communities. We put in a lot of research and I think some great ideas as well. But yeah, on the broader topic of the China conversation, me and MG, I know we've kind of butt heads on this before, but I'm all for the idealism of free markets. Okay, if I had it my way, it'd be great if we had free markets everywhere and internationally countries traded freely and there were no geopolitical restrictions or import-export controls as a result of that. That'd be great. But the reality is there aren't. The reality is that there is growing geopolitical tensions over the last 10 years. And when we talk about tech specifically, the issue in tech specifically is that new age technology, next generation technology, has one of the biggest innovation chokeholds we've seen in decades because chips, the cutting edge chips we have a huge choke in the supply of cutting edge chips by their very nature. That's point one. But point two on the choke in supply is that the race to clean energy has created a choke in supply in the materials necessary to produce batteries and enable clean energy technologies. So understanding that there are two major chokes in next generation technologies and combining that with the fact that geopolitical tensions have led to import-export controls, sanctions, countries outright refusing to trade with each other, we don't have an international free market. It's quite the opposite. And as a result of that, countries have to be incentivized to operate strategically to ensure their economic success, especially if you are a top 5 economy in the world and your economic prowess hinges on the idea that you remain competitive. So, for me, I hear you. I'm not saying the government should dip their fingers in everything and be throwing money around like candy. I think that there needs to be restraint in spending. I think that there needs to be better budget controls broadly. But I understand the United States position strategically when it comes to technology, more specifically when it comes to things like battery metals and high capacity cutting edge chips that we know there is an international supply choke for. It's become inherently competitive. It's 4 or 5 countries in a room that have not only the resources, but the GDP, the infrastructural sophistication to even participate in these next generation technologies. And so those 4 or 5 countries, maybe 7 countries, are inherently in competition to secure the resources necessary to do so. So, I just think there needs to be strategic context when we talk about the survival of industry in the United States versus China, and when we talk about the efforts that the governments are making to incentivize next generation technology and industries in America versus China. And I think there are fair arguments about the downside risks of that, and the zombie companies and all of these things I think are fair things to entertain. But broadly speaking, I think it is a bit naive to assume that we do not have to have strategic implication in our policymaking and decision making, both economically and militarily, in the United States. We just have to. The geopolitical landscape has changed in a way where that shift in the geopolitical landscape, combined with the surge in the need for next generation technologies, puts us at a dilemma where but in our hearts, we can be pure capitalists. But broadly speaking, if you expect to compete with China in this next stage, I don't think you can just forfeit all incentives to bring battery metals to the United States, to bring chips to the United States. I think it's a good thing.
Dr. Tuck, I think you highlight a really interesting point, especially because, I mean, look at NVIDIA, right? They reported they are sitting on a mountain of 30 series chips. So if there are any gamers in the audience, now's the time to buy your 3090 or 3080 Ti. But going to the broader point, I mean, we've since World War, I mean, for the latter half of the 20th century, we've lived in an increasingly globalized world, right? And of course, if you subscribe to the theory of economic comparative advantage, that means, wealth for everybody. What happens in a world that has been deglobalizing for years now, right? I mean, slowly but surely, we are in a deglobalizing world where that's another source of value that is going to be slowly unlocked. I mean, meaning, we're going to lose value as countries trade less and less, or at least that there are barriers to trade because of war and other exogenous factors. So I guess, how do we operate in that kind of environment? Big question.
Yeah, my retort to Stock Talk, just to clarify my position, is I don't disagree with you that this is probably necessary. My huge disagreement is that why is it necessary for the government to get involved? Because you have Intel, you have NVIDIA, you have other well-capitalized players that aren't willing to make those investments. And the reason why they're not willing to make the investments is because they know that the returns to capital won't be that good. And for whatever reason, we've gotten into a situation where a certain industry believes that they can only make investments where the ROIs are really high in order to keep up stock prices, where they're not willing to make investments that are capital intensive, that inherently would involve lower returns. And this is because of the predicament we've gotten ourselves into, that where there's a massive amount of malinvestment. You're allowed to
just to keep this conversation, because I hear you on your point, but I want to inject right there and hear your responses. But don't you believe that those advantages, let's say it's even a labor cost advantage, China can't sustain that labor cost advantage for the next 20 years. You would agree with that, right?
I think you're probably right. And I think AI probably helps us a little bit because that pushes them a little bit more to the brink. But the question a lot of other industries are going to have is like, well, we'd love to expand too. The energy industry would love to expand. The industrial sector in this country would love to expand. They're not getting that chance to expand.
But how is our support of cutting edge tech preventing those industries from expanding?
Well, I think that in general, for what I'm saying is that the capital markets themselves, for whatever reason, aren't functioning, right? If you go out there and you say, look, I have a plan for building, a couple of factories that are going to have 15-year lives, in the latest, greatest kind of semiconductor manufacturing space. Like, for example, if Global Foundries did that in the capital markets and said, look, we need $10 billion to get that. And people say, okay, what's your IRR on that? They'd say, about 12%. They'd be laughed at. 12% is actually a good return in a capital-intensive industry over a long horizon.
I hear you on that point, but I don't want to get too far away from the central point. Your initial comment, right, was that, hey, I don't disagree. You don't disagree with me that this might be necessary, but your quarrel is, why is it necessary? MG, the reason it's necessary is because we are competing with an autocracy on the other side of the map. And that autocracy has full dictation over the economy. If China wants to build industry, whatever industry that is, it's a matter of a few strokes of a pen. We can't do that in the United States. That is the competitive restriction here, is that we have to incentivize chips companies to come here. They would never come here. And as far as the labor advantage goes, you and me agree on AI. That's something we're wholeheartedly agree on. But I don't even think it's just AI that's going to drive that. This narrative that China's cost of labor has drawn companies there for decades. I mean, look at their per capita GDP. It's on the climb. I mean, the trend is nothing but up. In 10 years, China's per capita GDP will rise to the point where we won't get work for pennies on the dollar in China, right? That's inevitable. And so the labor advantage the cost of labor advantage that China enjoys today, they will not enjoy in the future. And so strategically speaking, I agree with you, right? Why is it necessary? It sucks as a free market. And I consider myself a capitalist, but as a person who's in favor of free markets, it sucks to come to the realization that, wow, the United States has to incentivize companies to build lithium mines here, to build batteries here, to build chips here. because we don't have the cost of labor advantage that other countries have, because we have one of the highest per capita GDPs for a country of our size in the world. And the United States capital ecosystem has, enabled that to happen. But knowing that our economy is where it is in terms of its growth versus China's economy being is where it is, it's created a dichotomy in the competition where we have to incentivize certain industries to participate and build in the United States for that reason alone. But once China's labor advantage expires, whether that's in 20 years from now, 25 years from now, the United States will be in a much stronger competitive position, and maybe we won't have to pour hundreds of billions of dollars into this. But I mean, I think you make good points, and I don't think we're too far away from the needle. It's more about intention here that we're debating. But look, I just strongly believe that this is strategically necessary to do. I don't think the United States can forfeit its support of cutting edge technology at this juncture. It's too risky. And the Chinese government doesn't have to worry about that. They don't have to incentivize companies to stay. They can force them to stay, like they've done for the last 20 years. The Chinese government is more known for firms than any government on earth by far, by a mile. They own everything. They have a percentage stake in every major company, the golden shares dilemma. They have basically directive control over the entire economy if they so choose to exercise it. And to the extent they've become more of a free capital, more of a free market economy over the last 10 years was solely for selfish motivation to grow their economy. And now, to the extent that they can pull and push on that narrative as much as they want because they're a unilaterally controlled nation. And we're competing with a unilaterally controlled nation, not just in China, but in Russia as well. The United States' biggest competitors globally are autocracies. They're ruled by one man. And whatever criticism you might lay on the table about the United States, we're not. And there's red tape, checks and balances, government controls in the way that prevent us from being efficient when it comes to competing in these industries. And I know what I'm saying sounds like so, counter-capitalist, but I just think that we've been put into a situation globally where this is not a global free market anymore. This is not an international free market, best company wins environment, because we're dealing with countries that can quite literally force the economy to operate as they so choose to. And to compete with them, incentives, I think, need to be provided at certain stages.
Robert, I want to try to squeeze you for some information. As a former member of the President's Expert Council, would love your thoughts on this discussion. I see also Kim and Gordon's hands up, so I'll go to them right after if they're able to. But Robert, would love your thoughts.
Well, we had an amazing opportunity to have things. A much more free and fair trade environment. In 2016, we had the ability at one time to approve the Trans-Pacific Partnership, which were, the 12 Pan-Asian countries alongside the United States and Mexico, including Venezuela, the Philippines, Malaysia. And if we pass that, and at the same time, we were working on the Transatlantic Partnership. If we pass those two, 80+% of all goods and products and services around the globe would have had a free and fair trade environment. And I was on the Export Council, was nonpartisan. And I recall I actually had dinner with President Erdogan of Turkey at the time. And he was scared shit that Turkey was not going to be included in the Transatlantic Partnership, which they were not at that time. Because, if you were more of an authoritarian leader, then people were nervous of having you part of this this collaboration. That didn't get approved. And then China went on to literally do their own Pan-Asia collaboration, of which the U.S. wasn't included. So a few things. We've lost some amazing opportunities to have fair and free trade. I agree with the gentleman who spoke before that many of the countries have become more nationalist. And, and I think it's incredibly disappointing that we cannot figure out how to, maybe get this going again. Because one of the best ways we can compete with China is by being friends with everyone around China. I recall Japan was in this. Like I said, Malaysia, Australia, New Zealand. We had an incredible opportunity. Most people think we should have approved it. So it's just food for thought. We whiffed, and this is what happened since then.
Kim, I'd love your thoughts on this. Good to have you back.
Yeah, so really quick, I mean, I've been listening to all this China rant for a while now, and I think it's time for some perspective. What happened is the US businesses have moved their manufacturing to China because they wanted the cheap labor. They wanted products to be made cheaply so that they can increase their profit margin selling their products around the world. That is why China has been growing, and the intention was that China will forever just be a provider of cheap labor. It was never the intention that China would be an innovator and create their own industries. But that's what happened. China wanted to be a competitor, create their own cars, create their own advanced technologies. And that's what they have done. And now everyone is looking at China as if they're some kind of evil country. No, they're just competing. They're doing what the US has done early in the game when they copied everything that came out of Europe, when they hired, all these Nazis to come over to the US to build their weapons programs and their space programs and all of this. So China has basically done the same thing. They've built a powerful manufacturing base with cheap labor, and they started becoming innovators in the beginning by copying technology and now creating technology that is in some cases more advanced than the US stuff, where, for example, now they have hypersonic missiles that the US is actually trying to copy. So this entire crisis that is taking place here is really just because China dared to assert their right to be an innovative country and compete in the global marketplace. And they are outpacing the US because not only are they great innovators now, they still have a cheap labor market, and their production facilities and capacity has become better and better over time. Their products are more reliable. It's really going well for China, and that is the real reason why the US is trying to sanction China and put disadvantages onto China in order to prevent them from being a peer competitor. And that to me is just it's just fishy. That's just not legitimate business practice. You don't try and kill your competition by sanctioning them and putting
Isn't the US put in a spot where they have no choice based on China doing the same for a lot of the, copying a lot of the US tech, not following IP laws and banning a lot of, not being capitalist. So if China's not playing by the rules, why should the US? US is kind of playing by China's rules now. Is that an unfair statement?
No, that's not correct. So, for example, one reason why China kept the US tech sector out of its country completely, you don't see Google there, you don't see any big tech companies there. It's all Chinese made. And of course, Chinese copied what the US has done. But for the reason that the US used their big tech advantage to spy on the world. And when you look at the decisions that China has made, actually there's so much wisdom in that, because they avoided to be part of this mass surveillance pool that the US has spun around the world. They can, happily innovate and create and do things in their country without worrying that every Chinese person and every Chinese business is subject to mass surveillance. It's
Instead, they
literally
just surveil them themselves, right?
it's a homegrown problem that the U.S. deep state is responsible for. If you spy on the world and you install backdoors into all your tech products, if every phone is bugged and turned into an open mic, if every U.S. product is infiltrated with software that is used for spying, of course the Chinese are not interested in that.
There are 540. Kim, hold on, Suleiman, hold on. Kim, there are 540 million CCTV cameras in China, operated by the CCP. Does the American government spy? Yeah, sure. I mean, you're not surprising anyone there with that statement. But the idea that the Chinese have saved their people from surveillance is hilarious. That might be the worst point that you've made.
No, I think maybe he means they saved it from US surveillance. Maybe he means US surveillance.
The Chinese government surveils their people with more intimacy than any government on earth by far, let alone through data.
Well, that statement is not
people through cameras.
Sorry to interrupt you there, but that statement is just completely wrong. If I may,
it's not wrong.
I tell you why.
Are there not 500 million CCTV cameras in China, Kim?
You want to hear why it's wrong, or you just want to talk over me? I can tell you exactly why this is wrong.
Tell me.
Because the U.S. has turned every single mobile phone into a surveillance tool. Every camera that people have in their phones can be activated to surveil them. Any microphone that people have in their iPhones can be activated to listen to them. That is nothing compared to what China does in terms of surveillance. And of course, China is trying to compete with the US in the mass surveillance stage of their own population. But all these innovations about mass spying came out of the US. The US is an absolute monolith when it comes to global spying.
There are Chinese cameras inside toilet cubicles, Kim. I mean, you're making a silly statement by saying that.
Bullshit. You're full of shit, man.
How about the level? How about the level of censorship? But in the US, the level of censorship in the US doesn't even compare to China. Would you agree at least with that statement, Kim? Not the surveillance, but more the censorship.
Both. Yeah, I totally agree with that. I mean, the Chinese firewall is well known. There are a lot of restrictions for people accessing information in China, but you also have to understand something, right? I mean, we're looking at this as such an evil method by the Chinese government to keep their citizens, shielded from certain information. But then in parallel, you have a global effort of U.S. organizations trying to stir regime change in other countries by funding people inside Russia, inside China, to cause protests, to cause all kinds of issues that could actually destabilize a country. So in a way, what China and Russia and many other countries are doing, they're really trying to defend themselves against this kind of influence from the US trying to topple their power structures. And that's, of course, understandable. I think anyone would do that if they were in a similar situation.
I want to quickly jump in, guys. Hold on, guys. Suleiman, I want to mention just some on news, if you don't mind. I will go back to the question. I'll go back to you in a bit. But I just want to mention this, and if someone can give me a bit of insight into this. The Federal Reserve said Wednesday it will launch its long-awaited instant payment service called FedNow in July. The instant payment network will settle payments in seconds with the capability to support consumer to consumer, consumer to merchant, and merchant to merchant, and bank to bank transactions. So they quote, with the FedNow service, the Federal Reserve is creating a leading edge payment system that is resilient, adaptive, and accessible. News to me, but I think a lot of you might know this already. Not sure what you think of this development. Maybe I'll go to Simon. Simon, we've talked a lot about similar topics before. Would love quick comments on this point and then go back to the discussion. I know that Gordon has been waiting for a while.
I was actually going to chime in on the China conversation. I don't know too much about that. It sounds like a micro payment network or a smaller payment network.
Talking about China, I think it looks like they're catching up to China, considering how far advanced they are with instant payments and digital payments.
Yeah, which is the WeChat Pay, but at the Fed level. So it sounds like that. I haven't studied it. So I do know there's been quite a few bills introduced for eCash, which actually was digital cash trying to do the Bitcoin thing with anonymous transactions. But I'm not too familiar with this one. Yeah, I haven't got too much to add there. But I was going to chime in on the China conversation if anyone else wants to go in that way.
Yeah, of course. And I see Michael trying to come up. Michael, it's dropping out. I'm going to send you an invite via DM. It would be great to have you. Michael is the Director of Economic Policy and Studies and Senior Fellow at the American Enterprise Institute. I'll send you through the invite now via DM. But I know that Gordon's been waiting for a while. Gordon, jump in.
Hey, thanks for the question. One thing I'll say on the China discussion, I don't want to get into argument with anybody, but when you think about I think it was $280 billion CHIPS Act, right? That's taxpayer money that's going to go to incentivize companies to build basically semiconductor manufacturing here. The problem is, I think it's like 90% of the world's polysilicon comes from China. So if we're taking all this taxpayer money to build the infrastructure to do chips here, but we have to buy the poly from China, we're still at risk. But more importantly, the question I have was for Rob Wolf. It seems like what's going on with Credit Suisse, going back to that, I think that's the title. And forgive me if you already answered this. I just came in, but it seems like they're going to get bailed out by UBS with the federal backstop. And it seems like, given how these things have worked out before, probably going to be a creation of a good bank, bad bank, with the Swiss domestic bank probably being spun off in a resale. So given that dynamic, the question I have is very specific, and you may know the answer, you may not, but I'm going to go ahead and try. One of the companies I cover has a warehouse with Credit Suisse. It's a warehouse facility. It's $1.8 billion. And they recently sold their ABS products division to Apollo. But I don't think that the warehouse went over to Apollo. So the way that I think about this is what UBS is buying is kind of what Apollo didn't want. Is it possible, in your view, Robert, that Apollo may say no?
Hello?
No, it's not you, Robert. It's Gordon just dropped out. I think someone just called him. He should be back any second now.
I didn't see. Was there news
Gordon.
that UBS is taking over the Good Bank?
No. Can anyone comment on this?
I'm not sure what he's referencing.
No,
I
there
only saw that.
wasn't news about that.
I only saw
Gordon,
that
are you
Swiss
back?
National Bank is giving liquidity.
Yeah, he's back. He's back, Robert. Yeah, go ahead, Gordon.
Yeah.
I'm sorry. Did you guys hear the question?
Yeah, no, it cut out. It cut out, Gordon. You want to repeat it? MG, go ahead, man. I'll fix Gordon's mic. Go ahead, MG, and then we'll wait for Gordon to be back.
Gordon, are you back?
Can you guys hear me?
Go for it.
Okay, sorry.
Yeah.
All right, Rob. So I'm going to ask it again. Sorry about that. Can you guys hear me? I'm just making sure.
We heard, but we were confused by the premise. Did you see something that with the Swiss National Bank giving liquidity that they're splitting themselves into good bank, bad bank like UBS did years ago? We didn't see that.
No. These are my assumptions. None of this has been confirmed.
Okay.
But just based on what we heard today, it seems like UBS is going to step in and buy them with a federal backstop. There's the good bank, bad bank, and then they're going to spin off the Swiss domestic bank. That's my assumption. And then the question was, Credit Suisse has a warehouse facility with a company that I cover, but Credit Suisse just sold its structured products group to Apollo, and it looks like Apollo did not take that warehouse facility. So that warehouse facility, I believe, still sits with Credit Suisse. So the question is it possible that UBS comes in, a new set of eyes see that facility, and they see that Apollo didn't take it, and they say, you know what, we're not going to do this business going forward? Is that a possibility?
Yeah, I would say it's absolutely a possibility, because anything they take on at this point, they'll have to put a certain capital against it. As I mentioned earlier, UBS uses IFRS accounting, so they mark to market everything. I have no idea, nor does anyone else know, where Credit Suisse may be marking this facility and taking the right haircut, or how much risk capital was against it. I don't know what's the underlying asset backs in this facility, but I know during
It's solar ABS. It's like a bunch of thousands of solar rooftop systems.
Yeah. All I can tell you is going backwards, that probably would not have been in the good bank.
The solar ABS, right? That would not have been in the good bank.
No.
Yeah, I'm just thinking that, like, if Apollo passed on it, right? Why would UBS go forward with it? That's what I'm thinking. I just wanted your thoughts there.
Yeah, I don't think it has anything to do with Apollo passing or not. UBS will make their own decision. But based on how they look at risk-weighted assets where Apollo doesn't, it's just a very different question. And my gut tells me UBS is not going to want to just balance sheet a facility that, unless they think there's even if there's an incredible amount of money, I'd be surprised they'd want to balance sheet that.
And one more question. So if they don't balance sheet it, is your view that they won't want to do that business going forward? Like, if they see that as not viable business, will they simply say, we don't want to continue accepting these type of warehouses, in your view?
Are we talking UBS?
Yeah, we're talking UBS. So Credit Suisse currently provides.
No, I understand. My guess is people aren't going to start new structured credit businesses right off off of this. There's a flight to liquidity going on. There's a flight to capital going on. The last thing I think people are going to look at is going to be illiquid asset-backed facilities. And I don't know this business, so I'm prefacing that. Unless this is just a going concern that UBS is part of anyway, which seems highly unlikely.
Extremely helpful. Thank you.
Mario, once again, thank you.
Yeah,
I got to hop to my next meeting, but look forward to chatting on ECB's decision tomorrow morning.
Yeah, I appreciate it, Robert. I'll make sure you have the invite. It'll be good to have you. We're going to be covering it live. It's going to be a big day.
Great.
Thanks as always, Robert.
Take care, everyone.
Thank you.
Bye.
Take care, Robert. MD, jump in. And
Yeah,
I want to mention, by the way, I just want to, Mr. Domalewski, Armand, thanks a lot for joining. Go ahead, MD.
Sure. I wanted to ask Kim.com a question with regards to his kind of views about the U.S. The one country that seems to be in a very precarious position, which you might know pretty well, is Germany, which ostensibly had a pretty kind of cushy relationship both with Russia for energy and for essentially one of the biggest sort of exporters to Germany, selling them industrial machinery for them to sort of essentially build all of their factories. So here's a country who has made a decision strategically to ally themselves with the United States. Why do you think that they've done it if what you're saying is true? Obviously, there's German strategic planners that are sitting there saying, okay, do we side with NATO? Do we not side with NATO? And thus far, they've completely sided with the United States and with NATO. So if things are as dire as you say, and if the American sort of project is as colonial and as mercantilist as you're suggesting, why have the Germans not risen up and said anything? I haven't heard anything in German public opinion even that says anything to the contrary.
Well, as you may know, I am German, so I do care a great deal about what's happening in Germany. And I've been following it, and it's the biggest political blunder in German history that we went along with this nonsensical U.S. proxy war in Ukraine. And just to explain, how much Germany benefited from Russian gas, Russia sold its gas to Germany at a 40% discount. And whatever Germany had above what they needed for their own industry, they sold to the rest of Europe. So it was a major profitable deal for Germany, and it kept its industrial base competitive with the rest of the world. That competitive advantage is gone. The cheap gas is now moving to Asia. China is going to benefit greatly from the shift of markets into China with the gas. And Germany has basically set itself up to be deindustrialized, to become a failure in the EU. It will no longer be the carrier of the EU because the strong economic performance of Germany made the European Union possible. So the EU is eventually going to collapse over this insane blunder. And when I look at our German chancellor, who has a full understanding that the pipeline of Nord Stream was manipulated, sabotaged in a terrorist act by the United States, flies to the US in a private meeting without any observers, without the media, without even giving a press conference, to meet with Joe Biden to discuss with him a cover-up strategy, what Scholz can tell his population about who actually did the attack. And then they're coming out with this fictitious story that some sailing yacht was used by a couple Ukrainians to dive down to the pipeline and blow it up. I mean, it's ridiculous. And Germans are just being lied to as much as Americans by their mainstream media. They're all aligned now. And it's just shocking for me to see as a German that my country is literally taken to the slaughterhouse because of either incompetent or completely corrupt leadership in our country.
Okay, but the German population has completely rejected that narrative. You agree with that, right? I mean,
the German population is subjected to non-stop propaganda similar to what's happening in the United States. There's no independent media in Germany. They're all repeating the same talking points from the Pentagon. And it's ridiculous. You know, the few independent journalists that are talking about what's really happening are being vilified. And there's even action by the German government to take them down and to persecute them. So the reality is Germans are blind to what's happening in the world because they're being lied to by their media.
Look, I'm no defender of the American media. I think there's a lot of problems. But what I will say is the assumption or the implication that you're making to make the U.S. media distinct from, let's say, the Chinese state-owned media or the Russian state-owned media. I mean, at least our government doesn't own our media enterprises. The United States is one of the only places, in spite of the criticisms. And by the way, I'm with you. I'm not defending the mainstream media. But what I am saying is the United States is one of the only major countries on earth where you'll actually see news organizations criticize the government.
Stock talk. We can have this conversation here on Twitter. I don't think we could have this on WeChat.
Exactly. And not only that,
until recently, you could not have had this conversation on Twitter unless Elon Musk bought it and turned it.
Elon, guys. Yeah, but then I'd make a counter argument there that there's no, and then I want to go to Simon. I know he's been waiting for, but then Kim, it's a fair argument, and we've covered censorship heavily in these spaces, of course, with the Twitter files. But I do another argument to make is that if Elon Musk did this in China, I'll make it for you, bro. I'll make it for you, bro.
Before we go to the next speaker, Mario, just one point I want to make is that the problem that happens here every time we have this debate about the United States versus China versus Russia is that every criticism that is levied against the United States is far worse in China and Russia. And that's what makes this argument ludicrous. The Chinese government surveils, censors, and controls its citizens and its economy magnitudes more than the United States. Magnitude.
Complete bullshit, because if you read the revelations from Edward Snowden that he had released about NSA global mass surveillance by the US government, if you would have even read any of that, you would understand that the US has been doing this for over a decade. And it doesn't help you if you shout over me, right? It doesn't help you if you shout over me. It's just not right what you're saying. China is...
Kim, what I wanted to say,
copying what the US is doing.
Yeah, so Kim, what I wanted to say is that you agreed that we can have this discussion on Twitter now, and the counter argument I'd make there, if an Elon-like person, let's say, I'm bad with names, the founder of Alibaba, Jack Ma, if Jack Ma did this in China, we know what happened with Jack Ma when he spoke against the the CCP. So the point that I'm making, if an Elon did try to do the same thing in China, I don't think he'd succeed as he did in the US. So I agree with a lot of your criticism. I disagree that China is worse, but obviously, you know, you're pretty knowledgeable, and I don't want to try to debate you. Do you mind, Kim, if we jump to Simon briefly, because I know he's been waiting for a while.
Yeah, we'd love to hear from
if that's okay with you.
Hi, Simon.
Thanks, Kim. Simon, good to have you, man. Appreciate you being patient. And actually, Simon, I was going through the audience and I see a lot of these nice, beautiful NFT pictures. So a lot of crypto people here. So maybe as you comment on or whatever point you want to make, I'd love a quick overview on the crypto space and you know, your thoughts on the hit that the space has taken with the on-ramp, off-ramps getting either targeted or just getting a streak of bad luck.
Yeah, no worries. I'll try and bridge the conversation a little bit and then take it back to Bitcoin because it ties in nicely. But as somebody that spent a lot of time in China and lived in Hong Kong for several years, I can tell you that both of you are right because there is just a different version of surveillance in both countries. So China openly surveys their people. You know, US has covert surveillance, as came out in the revelations, and so they're just two different cultures. You know, Mario, you talk about capitalism and IP. I mean, Kim knows he's been on the wrong side of, you know, IP within China, but within America. But IP is not really a free market concept. It's
how have I been on the wrong side, Simon? Explain that to me.
Well, you tell me. You tell me. I don't.
No, I think he means it positively, Kim. Like you've been the target.
Well,
yeah,
people need to understand, and I will be very, very brief with this. It's a novel copyright case that never happened before and never happened since, where the US government is trying to say that I'm legally responsible for the actions of my users. This has never happened before and has never happened since, because they shot themselves in the foot, because after they raided me, all the professors that are knowledgeable about IP law in the US said that this is an illegal act by the US to shut me down based on these allegations that I'm somehow legally, criminally responsible for the actions of users on my side.
Yeah, well, that's what I meant when you created technology that allows.
But just to add to that,
you created technology that was used against you for an infringement upon an industry that is very dear to America.
That's right, and just the same at Google, at YouTube, at any other major US site that allows user-generated content. So there was absolutely no difference. The only difference was that I'm not American, that my business was based in Hong Kong, and that I was a major donor to WikiLeaks, which the US government didn't like.
Yeah.
And Kim,
I'd like to insert.
1 second, Simon. Let me get my point because I've been trying to talk for like 20 minutes now. But so just to get to the point of what Kim was saying, I agree. The issue is when it comes, and I agree with what Simon said as well. So in reality, the only difference between the United States and China is one gives the mirage of free speech, whereas the other one openly lets you know that you don't have it in certain situations. And then the question becomes, what is your preference? But in terms of bringing that,
how do you? So I want to push back on a tiny bit this, Simon. How do you call what we're doing now a mirage? We could say anything we like right now, and nothing will happen.
Yeah, but that's because Twitter's owned by a billionaire in America.
And even then, they've basically been pressuring that billionaire to make sure that you don't have free speech, and and it depends how long he'll be able to hold off because he has banned certain people based on pressure, such as Kanye.
Look, no, but this is
the major difference.
This is This is okay. I want to chime in on this.
Bro,
because
you need to stop talking over people. It's just ridiculous.
I'm as big of an Elon fan as anyone here. Okay, I'm a huge supporter of Elon. But the idea that Elon owning this network is the only reason you can say whatever you want is absurd. You can say generally way more in the United States. Generally speaking, you have way more freedom of speech. Okay, again, we are not talking about
why are you giving an example of Twitter and then talking about the United States?
We're not talking about absolute.
You're giving an example of Twitter, but then you're talking about the United States.
Freedom of speech isn't something you either have or don't have. Okay, nowhere in the world do you have pure, unadulterated freedom of speech. Nowhere. Okay, but in the United States, the version of free speech that you have is far and above, leagues better than the version of free speech you have in Russia or China. There's no debating it. You know, that's undebatable because
No, well, you say it's undebatable, but then you've not provided any data or evidence. You've made a
Hold on, okay, guys,
breaking-
talk.
I have
Hold on,
some
hold on.
news.
Yeah, maybe a good time for the breaking news, Eugene. Go ahead.
Well, I don't know if it's breaking news, but all of us.
Yeah, I'll give you the mic. Then I'll give you the mic to Slayman because I know Slayman, you're dying to respond. So go ahead, Eugene. I think jump in with this point, and then Slayman, I'd love you to respond as well.
Yeah, just real brief. The we were supposed to be on a client call. All SVB clients got a client call that was supposed to be happening right now, but we literally just got this is with the new CEO Tim. But we just got an email saying that due to competing demands, they have to reschedule it. Probably doesn't mean anything. It just says that SVB Bridge is open for business, etc. But it was just kind of surprising that they made this kind of all SVB clients were supposed to get a call and be on the CEO. But
and there was a point made earlier as well about some people, some businesses not being able to withdraw their money from Silicon Valley Bank, but isn't everyone meant to be able to withdraw today?
Well, we were able to withdraw on Monday. It was just that, early Monday, a lot of us were not able to access just the SVB site. But many of us were able to do so kind of later Monday. So I don't think that
we did have a panelist come on here, a respected panelist that mentioned, I can't remember who it was, but I did tell him it just takes time. But worth mentioning, if anyone does have issues in the audience, do DM me. And if we can verify the DMs, I'll share.
I think we should go back to Simon now. I just interjected there.
Yeah, I think. I know. I will go.
So let's listen to what he wanted to say.
Before that, do you mind, Simon? I want Simon to jump in because I know he's been dying to jump in for a while as well. If that's okay, Simon, I'll give you the mic again. And I do want to, so Simon, I'd love you to jump in. Simon, give your thoughts, and I want to go back to the discussion of the current situation with the banking industry. But Simon, jump in. Thanks for being patient.
I appreciate it. So just to add to that, this is the reason why I rate Kim.com quite a bit, is because he was an example of somebody who held onto his morals based on the fact and principles, based on the fact that there was a clear, and as we know now through Julian Assange, through Edward Snowden, through various other journalists and media, there is a significant incestuous relationship between mainstream media, between the government, and between the entertainment industry. Now, separate to that, although I agree with that, but I was going to bring the point back to the original thing, that the reason why China is able to lead in a number of areas is, I agree, because they haven't got the same things that stop them from making their advancements. As an example, when it comes to certain ethical frameworks that we have in the West, whether it comes to genetic testing, whether it comes to testing, even to the point of designer, testing in terms of getting design, in terms of DNA, RNA, and these type of things. So those types of testings are occurring in China, and not being and the reason that's been allowed is because within the West we do have certain ethical frameworks that we adhere to, and hence why I was on that point I was gonna just disagree with him and say that there are certain things, maybe in terms of advancements in science, advancements in a number of areas where China is able to do so because they don't have certain red tape that other countries have, or they don't mind going beyond certain ethical frameworks or what we would deem ethical.
I would quickly to respond to that, if I may, because it's addressing me, right? I'll be very, very quick, right? Yes, there are U.S. laws that prohibit certain things, but what does the U.S. government do? They just do it through other jurisdictions. So, for example, in the U.S., there's a law that U.S. spy agencies cannot spy on Americans. What do? They give the British access to all their communication networks and let the British spy on all Americans, and then get access to the spy product in a spy cloud that they share. Another example, bioweapon research is illegal in the United States. What does the US do? They go to China, to the Wuhan lab, they open labs in Ukraine and in many countries around the world to do research on bioweapons that would never be allowed in the United States. And they're still funding it, they're still doing it, they're just doing it outside of their jurisdiction. So to come here and claim that you have laws in the US that make things better for Americans and safer for Americans, it's really bullshit, because whatever the US government wants to do, they will just do in other jurisdictions, and that is the reality.
A counterpoint there, and then I'll give it to Simon. I'll do the counterpoint because I know Stock Talk could get heated on this one. But the counterpoint again,
No,
We
no,
can
I'm
say
not going to
anything
get
we
you.
want.
I'm going to ask
No.
Kim a regular question. Maury, I'm going to ask Kim a regular question. Kim,
Yeah, but
who
I
makes
think it's time to go back to Simon. We're kind of drifting off, and we took his moment.
You're the one that just interjected.
Let him
If you want
talk. Yeah,
Simon
we
to
can.
talk,
Let's
then
go
let
back
Simon
to it
talk.
later, because this is a waste
What
of
the hell are you
time.
talking about?
I think
Go
it's,
for it.
it's Simon's
yeah.
turn now, and we should respect that.
You just went on a
But Simon-
monologue, and now you're telling me it's Simon's turn. Anyway, Simon, go for it.
You guys are hilarious. Brilliant. So when I was in China, my experience was on the ground, you have a significant level of freedom until you fuck with the government. And that's where China is absolutely outrageous. If you do something that is against, an industry that the government is trying to protect, then you could just disappear. And that's a reality. That's a fact. In the outrageous part of the United States is the international part, and obviously it does spy on its own people with all the Snowden revelations. But the outrageous part is that as somebody that has never lived in America, I still need to report all my transactions to America. I still end up having withholding taxes anytime I engage in anything to do with America. Anyone that tries to leave America still has to pay taxes to the US government forever and report everything forever. And the international side is where it is significantly more, egregious than what China does on the international scene. And so you experience that. But I would also say the version of what China is from watching US or European media or even search engines is significantly different than when you're actually in China, and vice versa as well. And so we do come from the lens, and it is different cultures. But one thing I can say is that having spent both a lot of time in Europe, America, and China, there are people within China that want to do anything to fight against their government, as there is in America. And they tend to have the same battles, that they want their freedom of speech, they want their freedom to transact. And, that's why I spent so much time in China, because the Chinese community trying to support the Bitcoin, ability to have that freedom to transact and freedom of speech. And I see the same thing in America as well. And so it's just a different flavor, with different levels of outrageousness, and that's my experience just from being. And definitely, the media gives you a completely different perception, that really does control our bias.
I think it's a great point, and
I can agree with most of that. Yeah,
I have a question. I have an earned question for Kim, and you described something very interesting, which is sort of the description of Germany siding with the U.S. effectively in the Ukraine war as a mistake. Going back, I mean, I'm curious as to what you would recommend as the actions or what Germany should do, right? But going back in a little bit of history, I mean, Germany has had, like several decades ago, the alignment with the globalized world order headed by the U.S. has been so amazingly advantageous for Germany for quite a long time, right? I mean, a good example is the Deutschmark effectively being extremely undervalued when it became combined with the euro, and of course allowed for many, many years of extreme German competitiveness relative to the rest of Europe, like the PIG countries, and certainly the rest of the world, right? So Germany has been a beneficiary, and I'm not saying that they should continue to subscribe to this, this world order, but I am earnestly asking the question: if you think it was a mistake, what is your prescription for what they should do going forward?
Well, of course, everything that happened after World War II, fortunately allowed Germany to recover and build a powerful industry and become a global leader in manufacturing, right? But that doesn't justify that the German government now is taking actions that are harming German industry and that are completely counterproductive. What the Germans should have done is say, look, your coup d'etat in Ukraine is not really something that we like in our neighborhood, because that could escalate into a civil war, which it has. And the EU should have had a stance against this kind of interference by the US government in other countries' affairs in their neighborhood. And this thing has now escalated to a war that may become World War III. If NATO troops get involved in Ukraine, there could even be a nuclear conflict. And, to take this kind of risk and put the European population on a path to complete destruction is just not wise. They should have acted differently and not just follow the US lead on this, especially after all the bad examples that the US has set in Iraq, in Syria, in the entire Middle East, where Germany took a brunt of immigration coming from those countries because they were fleeing war-torn regions that the US was responsible for. I don't understand why Europe is taking this path. It's actually puzzling to me to understand how a German leader could allow this to happen to their population. It's just I don't have the background information to understand this kind of decision making, but it's obviously flawed.
Kim, that's an interesting answer, and actually a follow up to that related. We've been talking a lot in this group about how do we hedge duration risk and things like that, right? I want to ask the question around what's your view on how to hedge personal risk, if this is the view, right? Like, wow, this is the world, and it's going. There's a lot of systemic issues. For example, talking to some friends are like, well, New Zealand has access to water and things like that. But of course, knowing your history, may not necessarily be this case. Some people say you should load up on bullets and Bitcoin, right? That was an early COVID narrative, certainly among the crypto community. But as you think of like hedging personal risk, right? Where do you think are safe places in the world?
Well, a little bit of background here. I moved to New Zealand after I saw what happened in 2008 and 2009. So we had the global financial crisis born out of bad U.S. regulation in the U.S. banking sector. And as a result of that, China, Russia, and a number of other countries have formed a new alliance called BRICS. And it became very clear early on that they are going to challenge US leadership in the financial system, because they did not want this kind of thing to happen again, where the US makes mistakes and then the entire world is suffering the consequences of a major financial crisis. So they said, we're going to challenge the US dollar as a reserve currency, and we're going to start something new that allows for a new financial system, a backup financial system, so we don't have to rely on the US anymore. When I saw that in 2009, I said, okay, I need to set my family up in a country that is as far south as possible and far away from the crisis that this is going to create. Back then, I knew it's going to lead to a global conflict between the US, Russia, and China, because the US cannot afford to lose its US dollar reserve currency status, because otherwise they can't print money anymore and they can't support these debt levels that the US already has. So this is actually an essential fight for the survival of US empire. If Russia and China succeed with dethroning the US dollar as a reserve currency, the US is finished. It's bankrupt. It cannot raise debt anymore by money printing. And that is why we have this global conflict where the US is challenging Russia through Ukraine and is planning to challenge China through Taiwan. This is what this is all about, the US hegemony and the US dollar as a reserve currency. If that falls away, the US is done.
So I just want to bring the topic back to the topic at hand, and we've got Robert joining us. So thanks for joining us, Robert.
Thank you. Yes,
Robert.
And while Robert, and also Armand jump in. before we, and Robert, we've got a few questions for you, but I know you've been waiting for a while.
Sorry.
Armand. Yeah, sorry to interrupt you, Simon.
We were too busy debating, so we didn't realize you'd come on, so apologies. So the question to either one of you then is, and it might be a bit of a repetition, but I'm pretty sure we've got a lot of new listeners now, and in addition to that, we've got new speakers on the panel. But the first question is, obviously, we've heard what's happening to Swiss Bank, and the concern is that and we know that there's been moves to make sure that this doesn't cause a problem, but people in Europe have told me that there are concerns in various European states, such as
Let me, Simon, let me read this out to you. Actually, to give you an exact quote relative to this question, Sulaiman, to show the concern, because we did have panelists before, and very smart panelists that I'm always humbled to have, kind of express that this is expected and they're not too concerned about this being a contagion. But let me read the following. Karen Petrou, who's a managing partner of the Federal Financial Analytics consulting firm in Washington, she said she expects Credit Suisse will be rescued by Switzerland. Okay, that's fine. If Credit Suisse were to fail, you would see significant problems. All sorts of exposures would come unglued. So that particular point, all sorts of exposures would come unglued. This is the systemic, the contagion risk that I think should be addressed a bit more. And I just have the feeling, I just don't have enough knowledge as all the panelists who have had over the last few days to kind of give specifics, but I just have the feeling, and Stock Talk will be back with us shortly, he's off on a call, that there's more risks and more leverage than we give than we think. I think we're just feeling a bit too complacent, but obviously I could be completely wrong. So maybe to get your perspectives, Robert, we haven't talked with you. We've been here talking about Silicon Valley Bank's failure, Armand as well, but we haven't gotten your thoughts, guys. Sorry to take your mic, Sulaiman. So I apologize, man. But actually, Sulaiman's question will be about the same, I think. Your thoughts on Credit Suisse and the response, the swift response by regulators, offering support.
No, it's brings up a great point about European versus U.S. regulation on the institutions, but also on the deposit levels. And it's been in a great space all day. I've been popping in and out. Robert Wolf was really excellent. Maybe he couldn't talk directly about a direct competitor, but if he were to tell you, UBS was far better run. I might not agree with all his policies, but that institution was far better run than Credit Suisse. So the real question is, how many Europe has an even more pronounced problem with continued QE, with rates that have gone up, where their portfolio there is probably underwater, about to take some hits. I don't believe they have a big relative U.S. portfolio, particularly in deposits, that would cause a deposit contagion concern. And I looked over the top 25 U.S. banks. You're talking about 11 trillion of total deposits. There's not much that are in insured deposits, probably 2.5 trillion of insured deposits. There's no way we should be doing whatever we just did with SVB was a mistake on going to help insured deposits. So resolve them quickly. They could have been resolved by working them out. Maybe they would have got 70, 80 cents on the dollar for uninsureds. We cannot do that for Credit Suisse U.S. deposits. We should not. There's only 100 billion left in the FDIC fund to do that. They just raided 25 billion out of it to get it down to under 100. So no, it's not. It is a problem with Credit Suisse. It's a European problem. Let Europe do it. Let them bail out the European side of it, not U.S. depositors paying for their mistakes. These are specialized mistakes. SVB was a super concentration of risk in a sector that is a Ponzi scheme. When you're raising money for startups, guess what? They don't have any profits. The only takeout is that next IPO, right? So when the IPO market seizes up, there's no takeout. They draw on their lines. They max out SVB. SVB has to go chase hot money deposits like they did last year. And guess what? They offered fat yields to get that. They get those deposits. I'll disagree with Robert Wolf on this. What caused SVB was them running for hot money, paying up deposits. Guess what? The hot money also goes out just as fast as it comes in, and it did last week with 42 billion going out. So this is kind of a mess. I don't think we should be creating new systemic problems by rating the FDIC thing. Let the market prevail. I have to I have to basically, congratulate the rest of the responsible banks out there. Of those 11 trillion in the top 25 deposits of the U.S. banks, they're managed really well. There's a couple maybe teeny ones, Bank of China that are playing games, but all of them are really well run and can withstand the financial malpractice that the Biden administration has brought on them and the Fed has brought on them. They can handle write-downs on their long-term book. And that's just one leg of the three-legged stool. They have capital, but SVP quickly ran out of capital. Credit Suisse might be quickly running out of capital too.
I mean, the argument from a number of speakers, and I think Robert made the argument, although don't quote me because I could be wrong, but they said that this, they're not calling it a bailout, so stopgap that's occurred is specifically for these two banks, and then they're not going to do it for other banks. So won't that alleviate the problem in terms of the FDIC not being able to back it up?
It depends on the stopgap. What's the stopgap they're proposing in Europe?
So in Europe, sorry, so I was talking about SVB there, but in terms of Europe, it's not, I mean, it's not actually United States who's come in to help support the Swiss bank, or correct me if I'm wrong, but it's actually Swiss National Bank, isn't it? So it doesn't really have that much to do with the US.
Yeah, let Europe come up with their backstop. They have some kind of facility, or they're doing extend and pretend really well. They've been doing it for years, doing that. Let them do it with Credit Suisse over there. We don't want it to impact our stable U.S. banking system.
Okay, so I mean, I'm not sure about this, so I'll ask you. But are you aware of any connections Swiss Bank has with American banks?
Well, they all have exposure to each other. Like that's
exposure.
Any bank anywhere in the world really has exposure to others. And Armand, you got a lot of background noise. I know you want to jump in. I'll give you the mic. Just a heads up. I've muted you a couple of times because you got a bit of background noise. But yeah, like there's something that for anyone, any bank failing within the system will have we're a globalized economy, so we'll have impact on other banks. So if the Swiss bank, Credit Suisse, is not bailed out, it's going to heavily impact the US banking system and vice versa.
Sure.
Again, if I get it wrong, please do correct me. But Armand, I'd love to get your thoughts on this.
Sure. Can you guys hear me okay? No
yeah, man. Yeah.
Now?
Yeah.
Okay, cool. So there's a couple things. One, U.S. Treasury currently is reviewing this bank's exposure to Credit Suisse, but from what they've seen so far, it's not huge. It's more of the concern that, if it destabilizes across Europe, of course, it's going to hit the United States. But I want to respond to a couple of things Robert said. I don't think it's an accurate characterization of how Silicon Valley Bank went under. What happened actually is that they had a ton of big IPOs and the deposit rate went up really, really fast. But most banks, when they have a lot of deposits, they make money in the short to medium term by doing loans. The role of startups as a business for a bank is that they don't really do debt finance equity. They do primarily startup, they don't do debt financing. They probably do equity financing. And so they didn't have a big book of loans. And so they put way too much money in these long-term mortgage-backed securities and T-bills. But it's not an issue that they were actually, the vast majority of the deposits that were uninsured didn't even have interest bearing. They're not chasing yield. They're just depositing the money there because for a lot of different reasons why it worked for the Silicon Valley ecosystem. But their fundamental issue wasn't something about chasing yield. Their fundamental issue was it's not like a bank that is set up in a lot of traditional ways because the industry they support is one that doesn't need a lot of loans. And so they made a bad bet on long-term interest rates. The second thing I wanted to mention on...
Sorry, on the bad bet for long-term interest rates. Yeah. In hindsight, the CEO is getting a lot of criticism. Again, the background noise, Armand. But in hindsight, the CEO is getting a lot of criticism, and rightly so. But the risk, compared to the risks that banks took in 2008, it's incomparable. I think it's a stupid risk. It's irresponsible, fair, but it's not a risk that depositors will take into consideration when considering to deposit their money in FDIC. In Silicon Valley Bank. So I don't see the argument, and I don't want to get back to that discussion because we've discussed it a lot. The argument of Again, I would never call it a bailout because you're supporting depositors, not shareholders. I think it's a weak argument.
So
no, 100%.
So-
And part of the issue is that if they didn't stop them, this would cause more bank runs, and eventually the FDIC would have to pay out more for that. And so this is actually like the cheapest thing for the FDIC. And if a sale happens, which I still expect it to in the next few weeks, the FDIC is not going to pay anything. So, like, 100% agree with you.
Robert, do you disagree?
Yeah, I totally disagree. So, we have an insured deposit system here. The banking institution assets there's all many that are, we only have 2.9 trillion of insured deposits. The top 25 banks have like 11.5 trillion of deposits. So there's a lot of uninsured deposits in the system. And FDIC cannot, they don't have enough capital. They didn't even have enough capital. Their net assets now are 100 billion. So they're already weakened. We couldn't even handle another, 100 billion before the thing is wiped out. And guess what? The taxpayers then have to bail it out. Right now, the depositors are bailing it out because the Fed said, or the FDIC said, we're going to sock everybody with new deposit insurance premiums. It's not going to be like generously donated by bankers. Bankers are going to pass through to depositors. So, and back to the loan portfolio. I think Armand, interesting point about what you're thinking, but I think the proof will be in the bidding. I guess the contention is that the loan portfolio wasn't that bad, and it was a debt maturity thing with the long-term bonds. Yes, they did have a $1.8 billion hit from trying to time out and sell off their debt investments. Those are the most liquid. They had to go to the first liquid investments to sell in order to meet the $42 billion of deposit outflows. They're not going to get any liquidity out of the $75 billion of loans they made. My contention is those things were not cash flowing. If you want to look at the bidding that goes for the whole bank of SVB, and that's actually a smart move to sell it off in whole. I guarantee you they're going to have some dirty hits in that loan portfolio because those things are not cash flowing because the IPO market did seize up. There's no takeout there.
No, I agree on that, but the bigger issue was just that it's a small percentage of the portfolio in general. That's why they had all these treasuries and mortgage-backed securities.
Right. That was
didn't actually have that much debt that they could issue because startups.
It's not the debt issuance. Their asset side was loans and investment securities. They tried to issue debt and equity and failed in that. So there was some kind of a little effort to try to fix up the problem that we actually don't really know about. There's nothing public about it, but that failed. And they couldn't issue debt. They couldn't issue equity. So the only other option left to the FDIC is to try to shut it down. Their first move was protect the insured depositors, 75 billion of them. And then when that news came out, the local street out there freaked out and said, oh my gosh, my uninsured depositors aren't going to be protected. We need to be protected. Well, guess what? It just pushes the pain to everybody else. And it's private gain and social losses. And that's not the fundamental premise of the FDIC.
That's fundamentally not how the FDIC works. Like since 2008, post-Indy Mac, the informal policy of the FDIC is to recover 100% deposits, which they've done 91% of cases for 95% of assets. Because after Indy Mac, they saw that there were a bunch of cascading potential bank failures when they didn't make depositors whole. And under least cost provisions in the FDIC's charter, they argue that would cost them less on balance. If we already saw that Signature Bank went under this weekend, the Fed and Treasury really worried about bank runs. If you had a bunch of bank runs and you said, I'm only covering FDIC insured, that would still, but you have 10 bank runs, that's going to bankrupt the FDIC faster than saying, we'll backstop you now, prevent a bunch of bank runs, not spend any money.
And that's it's a fair point, Robert. Go ahead. I'll let you respond. Then maybe Jason, as a former FDIC capital markets regulator, it'd be good to get his thoughts on this. But go ahead, Robert.
No, so that's mostly right. Thank you. That the FDIC has worked out everything except IndyMac, Now, but that shouldn't be the implied policy going in. They first have an obligation to the insured depositors, and then thankfully they try to work out and resolve the rest of the assets. And if you have a properly structured bank with 15% capital, assets should be, 117% of the liabilities, right? So you got that first buffer. The first buffer is there for a reason, is the skin in the game that should cover the risk activities of the bank. And then thankfully, if you lose 15% of your assets, then you still can pay all the depositors and the liabilities back. But for some reason, FDIC said that's not going to work out. We were thinking their first initial thought was give them a 50% coupon on Monday, and then they work out the rest, and maybe they get most of it back. But the key thing here is they would have to work it out over time. I did several big FDIC workouts, right? And it's a time element of earn your way out. They could have done that here, but for political reasons, there was such a hissy fit about it. They said, let's not let SVB work itself out over time. Everybody's so concerned. Let's accelerate the workout, and let's give up all the uninsured depositors 100% coverage right now. And that is irresponsible the other way.
I want to, Robert, just quickly, I want to go back to the Credit Suisse discussion. With reading out 2 minutes ago that came out. Not too surprising, but large US banks view Credit Suisse exposure as, quote, manageable. Obviously not surprising to see such statements, but maybe Trevor or Robert, Armand or Jason, anyone could give our thoughts on the impact of the Credit Suisse turmoil on the US banking system.
Yeah, I think one of the things that it hasn't been necessarily talked about is the absorption capability of these loan portfolios. I mean, Robert and I were on a panel with Grant last night, and I think one of the things that we haven't focused on is when you look at risk exposure, that's one thing. When you look at duration risk, that's another. But the asset repricing is happening because we're raising rates, right? Like we're sucking liquidity back out of the market. So inevitably, what's happening is confidence in banking systems, because you're not earning what you could on other asset classes, is starting to become an issue for several banks that bought loans or were anticipating assets or loans that they thought were going to be held to maturity to rotate back into AFS or available for sale, because of the fact that the majority of these the Fed hikes over the years are cuts in our quantitative easing system has basically proven out that we do not have the type of infrastructure from a financial banking system to handle these types of swings from an interest rate policy perspective, right? Like it's kind of baffling to me that we're not talking more about how real estate has seen the gains that it has, how certain startups and valuations have seen the gains that they have, and to kind of not assess really the fact that interest rate hikes and the cost of capital going up is not going to impact asset classes and the value decay of those assets that we've seen for the last 10 years is kind of interesting. So I think with Credit Suisse, obviously, the more that you saturate the market with these loan portfolios that have to be sold at a fast rate, right? We haven't seen anything like this before. I mean, like 2008 was its own dilemma, but I think the speed and the velocity of how Contagion is spread, especially in the financial, fear, fear sells, obviously, but I think in this case, so many people are so much more in tune to the risk on, risk off process on like an hourly basis. And I hesitate to kind of speculate where being naive to the fact where it's like, oh, okay, like it's manageable risk. Everybody's at risk, right? All the banks are always at risk because they have to loan in order to make any money. So the fact of the matter is that I think a lot of the banks are trying to kind of curtail the media narrative or the impact by saying, all right, look, like we've got this under control. Sure, but if you had a run on your banks and everybody wanted to hide their cash under pillows, which doesn't make any sense, not saying you should do that, but if that were the case, no bank would be able to survive a quarter of their deposits being pulled. So I think it's kind of this false narrative of saying, oh yeah, like SVB was kind of one in their own. If you had a quarter of your deposits as a bank pulled in 2 days, you would have some significant issues, regardless of if you were JP Morgan or SVB or a regional bank, right? So I think these are the specific items that the velocity of fear, I think, is going to drive more of a narrative. And when people start seeing volatility like we've seen in the markets the last couple of days, and see headline news of banks collapsing, whether they know what the intended purpose was or not, I think consumer sentiment is not like, oh, yeah, we're going to go out and buy a Mercedes tomorrow because a bank imploded, right? It definitely has an impact to the way that consumers have confidence in the marketplace, which also drives the underpinning for the confidence for those loans to be, economically sound, if you would. So,
Trevor, can I ask you a question there? I feel like I've asked this question multiple times over the last few days. It's not with the fractional reserve banking system, we're no longer discussing leverage. We're discussing leverage is still important, but we're discussing it's a game of confidence.
Yep,
that's the priority. I think what the FDIC's number one priority should be consumer confidence or depositor confidence, followed by how healthy or toxic the balance sheet of a bank is. And we saw that in 2008 as well. I just don't think, you can't look at what happened in 2008 and the balance sheets we saw in 2008 and compare them to what we saw with Silicon Valley Bank. Again, correct me if I'm wrong, but we can't compare them with Silicon Valley Bank. But what is similar is that the run on the bank we had in Silicon Valley Bank is insane. And it's very weird as well, the way that VCs kind of either triggered it or did not, kind of calm the fear. And that's what this is what concerns me the most. This is
Not to interrupt, but
go ahead, Robert.
Brand new Wall Street Journal headline that just dropped here. United States threatens to ban TikTok if Chinese founder does not sell ownership stake. So that just hit.
There we go. I've been calling it for a long time. We did spaces on this.
About time.
Who would have thought?
Sorry, guys. One second. You've also seen that the Pentagon said that aliens might be sending probes to the Earth this evening as well, because they
want to change it. They want to change the subject.
Where's all our money gone? And they're saying, "Look, aliens!"
But I think to your point, Mario, this is absolutely a.
Can you send me? Sorry, Trevor. I would love you to answer the question because this is like my main question over the last few days. But I don't want to be rude. The stock talk. Can you pin it above or send me the? Oh, there it is. You've pinned it above. So I'm gonna check it out. That's. I mean, do you think it'll be banned or they'll? Sorry, Trevor. We'll get back to it. But do you guys think the founder will sell? I think he's forced to sell the stake rather than face a ban. That's just fascinating.
Hold on, just quick question, guys. The aliens, how good are their banks? I'm looking to put some money in.
I heard they're pretty insolvent. Yeah.
In Trump administration, we had them. They had some deals to line up a new owner, so maybe that the TikTok ByteDance would get out of it and find a different owner. So those discussions were ongoing. They'll just fire those up again.
Yeah, but now they're threatening. Did they threaten a ban or no?
I think they've been ratcheting up the pressure.
I haven't read.
No, not now. I'm saying whether that happens. If you can include the article in the headline, Stock Talk, I'd love to have a look.
Yeah,
at
I'm trying to get the article right now.
But back to your point, Mario, and so the fractional reserve system is great, but the key part of that is the real first line of defense in the banking system is the equity layer of the bank's capital, regulatory capital, and that's been really strong. The banks are doing really well. They still, they've got 15-16% equity capital. And that's enough to withstand the mark to markets that we've seen because of rapid interest rate rises and the adverse effects on the investment portfolios. The banks can all handle that. The SVB had other double and triple whammies on their book that are unique. Credit Suisse has different unique characteristics there. So, but what the two tools are, if the bank regulators wanted to manage the tools and capital and the fractional reserve system, they could change the reserve requirements and say, hey, dudes, you need more backstop, frontline backstop by changing reserve requirements. That's one. Or they could actually get the banks to raise more capital, either indirectly, like we did in 06, 07, 08, where the banks were saying no dividends, no stock buybacks. That can support capital. And just one other kind of salacious political thing I want to throw in here. Why was SVB giving away $73 million to BLM last year? That could have supported $1 billion of deposits. Just stupid stuff that SVB was doing. It was part of the problem. It's unique to that bank.
Mario, I think you hit upon it with saying, is this just a confidence game? And I think to, Robert's point, there's this idea of how they try to work out these deals. And it was, very, very odd for the FDIC to ever say, hey, we're going to protect the insured depositors on like a Friday, transfer all the money to that, deposit insured bank, and then transfer it to the Silicon Valley Bank NA, this new bank on Monday that's now open, and they're going to protect all the depositors. I mean, the core FDIC mission is to protect, the insured depositors. That's always at least the way I understood it when I worked there. But what is interesting when you say, it is a confidence scheme is the FDIC is really trying to figure out what's going to just make people calm down and not put money in their mattresses. And I don't know if you already talked about it in this room, but it was released, I think, a couple hours ago on Politico that they've hired Piper Sandler as their investment bank to sell SVP as a whole unit. And I think that's a very interesting point because that's really what the FDIC is trying to do now. They want to sell it. Now, interestingly, this came from some lawmakers who said they had 4 deals from 4 different banks that did an auction process on Sunday to buy the whole amount of SVP, and all of them were rejected by the FDIC. So I don't know what Chair Marty Gruenberg's reasoning was in rejecting all 4 of those deals. I would imagine one of them would have been good enough to let SVP be acquired. But acquisition, and I'll just say this: acquisition is the answer to the question about what's the backstop. We did the same thing in 2008 with like Wells Fargo and Washington Mutual. And Wachovia, we thought like, what would happen if Wachovia failed? What would happen if Washington Mutual failed? But failed outright, wasn't bought by another bank. Then it does deplete the deposit insurance fund, and then there's nothing left for the FDIC to do as far as a backstop without, talking to Congress. And Robert, that part of it where we have to like get money in and all that stuff.
Yes.
So we're at an interesting inflection point, and I think it is of note if it wasn't discussed yet. I mean, they hired an investment bank, Piper Sandler, to put SVP out on the market for someone to acquire as a whole unit. That's a big deal.
It's a good move, thankfully, and the efforts they try to do to sell off the bank early were probably just some half-assed efforts where they didn't know what they're doing. The regulators are probably worried about diversity and gender studies rather than real bank regulation. So let a professional who knows that sector. Piper and Sandler O'Neill's been doing this a long time. They know the space, and they can get a much better price for the FDIC, which will help the depositors and prevent taxpayer backstop. And we'll actually see. I think the real tell will be what is the buy price on that loan portfolio? Is it 60 cents on a dollar, 80 cents on a dollar, 50 cents on a dollar? FDIC had a problem with that book. It was not liquid enough to do anything with it. It needed time to work itself out. And we'll see what a buyer will do. And the buyer is going to get the franchise value. They can set it. They'll get. This happened last time in 06, 07, 8, 9. It worked. It'll work again. And I think it's a specialized thing, not to worry about contagion. Even on the Credit Suisse U.S. deposits, it's not a big deal. I think Europe should take care of that.
But you said Credit Suisse is not a big deal, or not a big deal for the US?
The US part is not a big deal. If you look at the top, yeah.
But I want to go back to I want to remind everyone, I'm not sure who I interrupted, but I apologize in advance. I want to go back to one point about Credit Suisse because I really want to focus on that one. Where is the tweet I have? All right. So Credit Suisse, I'm not sure if anyone remembers that list of the too big to fail banks. And there's like 33 banks on that list. 7 of them being Chinese national banks. So it's the biggest called the GSIB list, GSIB, I think Stockdale calls it. So global systematically important banks list, and Credit Suisse is on there. So considering the fact that Silicon Valley Bank is the second biggest bank failure in the US, based on total assets, and then if you count Signature Bank, Silicon Valley Bank, and Silvergate, the total assets of the banks that failed this time around is larger than 2008. I know the exposure is different, so it's not a fair comparison, but a comparison still worth making. Considering this fact, considering Credit Suisse is as big as we just said, and top 50 in terms of size, going back to the question I had earlier, it's a game of confidence. When do we get it to a stage where obviously intervention helps confidence, but with the speed of how fear spreads with social media, is anyone concerned of confidence taking a hit despite the banking system being significantly healthier than it was in 2008?
Yes, definitely. Like the leverage ratios are different around the world. US is always the best in that area. So we've got pretty good capital standards. We have really much better accounting standards. Who the heck knows what's going on in Chinese accounting standards? The leverage is a disaster there. So and we do not have a global FDIC. So it depends on what you're looking at. If you're looking at US deposit rules, global deposit rules could be different. Our leverage ratio and our capital stronger, our leverage is lower, our accounting rules are better.
I think
go ahead.
Go ahead.
And then the accounting standard problem is actually going to be exacerbated after China's forcing out the big four. So I just want to make that point.
And what FDIC equivalents do we have in Europe? I'm just curious.
I would assume UBS is on that list.
On which fail list?
Yeah.
Yeah, it is. Yeah, from memory. Stock token, correct me if I'm wrong. What's the situation with UBS? Can anyone offer more clarity on that? How concerning is the situation there? Because the stock took a hit in the last 24 hours, according to Stock Talk.
I mean, all of the banking stocks took a hit today. I don't think it's going to take UBS.
I think this is the issue, right? Is we're trying to correlate Contagion with like regional or like FRC and other banks that are regionally impacted or that are failing. Like what's the contagion? Like the banking sector is going to be impacted throughout, right? Because the second that we start seeing credit default swaps at Credit Suisse see the levels that they are. Right, you've got a ton of loans that are being rotated into the open market for bidding. And to Robert's point, if there's no bidder, right, then price falls. So we're looking back at an asset reflection of reality where we've spent quantitative easing over the last 10 or 12 years, pumping money into the market, and the Fed is essentially sucking that liquidity out of the market and impacting asset prices. And banks are the ones who are having to rotate these losses off their balance sheet. So I think this is where you get into a very sensitive, and I do believe this is an inflection point. I don't know who mentioned that, but we're at a point where we could supersede the speed that the FDIC or any other backing mechanism could facilitate saving or backstopping serious financial turmoil. But again, at the level of communication speed that we have, and I think psychology is playing a big role in this, is we're forgetting that there's not a lot of basically variation. Once people start this herd mentality, we're probably 10 times the velocity that we might have been in 08. Right? People are a lot more conscientious about what happened in 08. People are a lot more fearful than they were because they know that they've had a great bull run, so to speak. But most people, the average person knows, cost of capital has been cheap, and it's not cheap anymore, right? If you have a fixed variable, or if you have a fixed loan versus a variable loan, you know that you're paying way more on that variable loan, regardless if you're an average Joe person. So I think getting back to basics of the psychology of the vast majority of people have far more recognition of, okay, if I want to get out at a time where there's kind of exuberance, right, is now the time, right? I'm still at, the Dow's at 31,000, what have you. Is this the time where I get out? And I think the margin of error where historically, perhaps, large institutions could quietly move money out on a 6 to 10 month period, we're not in that same era anymore, right? We have far more information that moves way more quickly, and large institutions and individuals cannot move money as quickly as they used to without it being noticed. And I think banks in particular pose a large risk because Wells Fargo, Bank of America, JP Morgan is probably the best position. But out of the 4 to 5 top, US banks, there is a ton of fragility that, yes, acquisition and perhaps this is a consolidation phase of the US banking system, perhaps. But I do think that there's some nuance to how the deal is represented to consumers and retail traders, because if it's presented as something that like, oh, hey, this was incited to essentially force the hand of consolidation in the banking system, consumers are going to be, and retail traders may be a little bit more weary of, all right, what does this mean for the foundation of fiscal policy in the United States? And I think there's a lot of people who recognize risk differently now than they did in 2008, 2009, 2010, right? We don't have strippers taking out third mortgages on properties. And I think, again, we're not focusing on the fact that this is not a credit problem. It's an asset repricing problem. We spent 10 years inflating assets, and now we are in the position where the Fed needs to pull out liquidity and move back into a realistic spectrum of pricing of those assets. And in doing so, banks that were exposed on loans with 80% LTV, right, which is value, right, what their perceived value of a real estate development or the cost of doing business for whatever they would loan out for in their portfolio, is that value and the LTV applicable to them retaining that 15 or 20% equity that they thought that that borrower had in that deal? And I think this is the discrepancy that a lot of banks are struggling with, is that in order to comb through the details, and as somebody mentioned on here, Credit Suisse probably has, a few percentages, and as did SVB, where their loan portfolio was, as they dig through it, they're like, oh man, we lent to these guys. Yikes, that probably wasn't a good move. And once you start really digging in when you're under pressure and you have to fire sale, the market will dictate what a fair value price is at that time. And when you have hold to maturity securities moving back to available for sale, that's where you have the conundrum of the repricing. And if all these assets are being repriced at the same time, you're flooding the market with inventory of securities, which is the primary problem why SVB is not just a singular event. You will have contagion. The problem is, will fear exacerbate that contagion into a deeper line of problems?
And in terms of the repricing, which banks would be hit hardest
Before
in
you
Europe and the US?
Trevor, with a question where I just wanted to update on the TikTok thing. So, it looks like this was a statement by the Biden administration on essentially trying to get the founder to sell his stake. The response that TikTok had was, I just finally read the article. By the way, I linked the article in the pinned tweet if anyone in the audience just wants to read it themselves. But I guess the biggest takeaway is that TikTok proposed a $1.5 billion internal investment in a security plan that would wall off its U.S. operations from Chinese government access to the data. Now, how legitimate would that wall be? I don't know. I don't think I would personally trust it, but that is their proposed solution. And the White House isn't content. But on the actual topic of attempting to do this, in 2020, the Trump administration actually tried to do the same thing. They sought to force the sale of TikTok to a U.S. majority ownership company. I don't know if you guys remember, but at that time, Oracle was a name that was being floated to acquire the U.S. TikTok U.S. side. There was a bunch of headlines about it at the time, but again, that's besides the point. But when they tried to do that in 2020, the Trump administration, what ended up happening was ByteDance went to a federal court and blocked the ban through the Berman amendments, which is referenced in the article. So if anyone wants to read more about that, you can check it out in the pinned tweet. But yeah, I just wanted to update on that. But go for it, Trevor. You can answer Mario's question.
No, I was pretty much wrapped up. I was hoping for some feedback.
One thing I
agree with everything you said. I mean, it's I share the same sentiment. Sorry for it. Go for it, Jason.
No, I agree. I think the one thing, I'm less of a numbers guy and more from the FDIC, sort of how we tried to instill confidence with what happened, the wrong things that happened with IndyMac Bank. And I appreciate you making the distinction between 08 and now, because it is different. But the big difference that I worry about is that, in 08, we struggled with IndyMac because we had all these YouTube videos going around, and it created what you're talking about, this fear starting a run. And one of the things I always wondered about back then, Trevor, that I'm still trying to reconcile in my head is, as we get to like mass communication, this is like we've gone from the YouTube bank run where at least at the FDIC, you had a fighting chance on a Monday and Tuesday to get out in front of these depositors and say, you don't have to take your money. Don't go put it in the mattress. It's all FDIC insured. And we're beyond that now. We saw this happen so fast. And I know people always, knock the regulators, but I don't know how you have regulators try to, do any pushback on this at the rapid clip that it happens. And when I say pushback, I mean just try to provide the education, which is what the FDIC's playbook is.
Which goes back, Jesse, which goes
everyone
back
be educated
just,
on like what FDIC deposit insurance means. So
that
Mario, to your point about like this being sort of a confidence game, and this being, with the fractional reserve banking system, we have that, and the fragility of it is really being tested because there's not an opportunity to explain anything to anybody. Twitter just goes on quickly with all the information. And I don't know how you stop that kind of bank run. It's totally uncharted territories, which is why, depending on whether there are real problems within the banking system or not, you might see several banks go under and us go into a more crisis purely because of the way, no banks can hold any information back anymore. Everything's immediately known, and even if it's not a warning sign, it may be seen as such, and before you know it, Twitter's ready to blow up another bank. I just don't know the solution to that. It's very scary right now.
Yeah, exactly. I like what you just said. Twitter blowing up another bank. First, thanks for the credit. I don't think we can blow up another bank, but we'll do our part. We'll try to not to do our part. But to answer to kind of comment on your point, Jason, it kind of goes back to a point a senator when he said that they asked whether they can censor anything that could lead to bank runs. So that was a concern. And again, we've talked a lot, we've fought a lot here against censorship, but it's just an interesting. It just kind of shows the concern that they have. It'll be fascinating to see how regulators react to the speed in which fear could spread. But I'd love more thoughts on this, because for me, I find that to be the biggest concern that we have right now, and something that probably the biggest lesson learned from the Silicon Valley failure. Dennis, what do you think?
Well, it's an awfully interesting point, Mario, and thanks for letting me speak. It's really impressive what I'm hearing. It's just that a couple things. Let's remember that there's only 40 million people on Twitter in the US out of 330 million. Let's also remember, let's make up a figure. Someone else must know this figure. What percentage of all individual Americans have more than $250,000 in cash at their bank? I'll bet you it's less than 5%. This is not a problem that all of America has to worry about. What cratered Silicon Valley Bank, though, it was the most loyal, huge customers taking out their money. If they hadn't done it, this wouldn't have been a problem. How do you stop that? It was those multi-billion-dollar accounts and hundreds of millions of dollars accounts, not Americans. Sorry, go ahead.
No, on that, fascinated. I wish I can bring Danish up. You'd be fascinated on how things spread. The things we said on the space, I think the episodes were about 400,000 listeners. Okay, that's still 400,000 people is a lot of people. Yet a lot of people would listen to it and then send a message to another person in their network, to another investor. So Danish, who moderated the room with me, a lot of you might remember him. He's like, Mario, I can't believe how quickly things spread. I jumped on your space, and while I was speaking, most of my investors were messaging me about the space and what's going on. The information spread like this. It was crazy. The amount of money withdrawn for Silicon Valley is crazy. I just, as many other panelists have said, no bank can survive this. No bank, no matter how healthy their balance sheet, can survive such a bank run.
Strategies, not under current strategies, but maybe a bank that is under the spotlight, instead of receding back into the shadow and being afraid. That's what Silicon Valley did. They stayed in denial. They did not take the hit as soon as they should have. Maybe instead a bank has to have a person on a chat like this, especially an influential one like what you guys run. A quick question about CS, since you do want us to address that. Doesn't Credit Suisse get any credit at all for coming out and taking the hit up front and saying, hey, man, we messed up here. We got to fix this. There's some internal controls. I mean, SVB took forever to say, hey, we fucked up.
Yeah, but CS has had several managerial issues over the years. I mean, they've had a lot of banking and managerial issues that far exceed them coming out. I think the reason that they're coming out in the manner that they are is because, I think it was last year they took, $4 billion or some odd $1 billion from a Saudi fund in order to like restructure their bank. And the reality is that everybody has this mindset of like this Swiss bank is some abstract, really unique, like everybody thinks of sovereign wealth funds, if you would, right? It's all in Switzerland or what have you. And the mindset is that the archaic nature of the banking dynamic, UBS has transitioned very well into the United States with their wealth advisory and management arm. Credit Suisse has not done that. They focused on the private sovereign wealth funds and managing the banking aspect and not delivered much value outside of that. And I think, to your point, Dennis, there are a lot of psychological differences between a lot of people that see if Credit Suisse, which is a pretty notable name, I wouldn't say it's probably like a B, C bank, right? If Credit Suisse fails, it's not an SVB, right? It is a premier bank that most people have a general notion of Credit Suisse. And if they see Credit Suisse failing or imploding, this is the next level of most people. I can't remember, somebody tweeted this earlier, but it was like, SVB, if somebody asks you, oh yeah, I heard something about a bank imploding, but I have no idea. It's a small bank, whatever. It's SVB. Oh, like, what do they do? Oh, great. Short the market because nobody knows what's going on, right? The problem with Credit Suisse is they're not indicative of other banks failing per se, but if they do fail, they have risk that they have to sell off, that regional and national banks in other areas of the market have to absorb at a premium of what they wouldn't have potentially bought at, right? So I think that's kind of a delineation, is that Credit Suisse has had managerial issues for a few years now. And it's not indicative of necessarily the optimal bank. But again, you're weeding out, this is capital efficiency, right? Like the second that we start to really get and nail down into, all right, let's get back to free market. Let's figure out how to remove the invisible hand, going back to Econ 101. The second that we do that, shit goes haywire. And in doing so, you start revealing toxicity within the banking system that it's not just the US, it's also the EU. And China, we don't have necessarily the purview to, right? But South America, like, we don't have the type of accounting principles and rules that we do in the United States for other markets. So our applicable valuation may not be the same. So again, going back to your point, Dennis, like I don't think that there's necessarily a direct correlation with Credit Suisse and, oh man, like, is this the next big bank that fails because of, or why did they come out because of? I think that there's a problem that was rooted deep in Credit Suisse that's just being, exacerbated because of existing liquidity issues in the United States.
Some of which would not.
And sorry, just to say on that.
Go ahead.
Sorry, I was just going to say, in addition to that, the timing was pretty awful in terms of, you had the Treasury and the Fed come out on Sunday. On Monday morning European time, so Monday afternoon. Monday morning your time, Monday afternoon, the CEO had to come out and say that they'd had huge banking irregularities. This is on top of an existing fraud issue. The CEO resigns. They've had liquidity before, so it's like a Hail Mary of the fact they had to be honest to the market very quickly because of previous issues, but the timing was horrendous.
So once again, they did wait too long. This happens with almost all companies in crisis. It's kind of like a slow creeping cancer. The crisis is coming, but you stay in denial, hoping it will go away, and then suddenly it kind of smacks you in the face.
I want to kind of ask. Go ahead, Rob.
Sorry, that and the fact that underlying Credit Suisse's issue is the fact that it doesn't actually sit within the European Union or the UK regulator. It sits in the Swiss regulator, and so it's traded like an American bank would. To put it into context, its assets are about 4 times the size of SVB. I think it's about $900 billion. But how it trades is very different, and it doesn't quite sit under the state. It sits under European Union rules, but it sits under the Swiss regulator. So we don't know what's going on because the Swiss regulator is quite private. So it tends to be that you tend to hear about bad news with Credit Suisse very late because the regulator's saying Europe's going to be annoyed with us unless you tell them, and so you tend to hear about it sometimes even after the Swiss regulator or the central bank there's known about it for a while and can't fix it internally. So it's Credit Suisse is a unique thing. It's definitely having a drag on banking stocks, and I think the timing was just horrendous. I don't think they're actually directly correlated.
Do you think that the Credit Suisse decided, hey man, everyone's concerned about banks, let's just jump right in on this now, and we might as well kind of, you know how when one individual company will write off as many bad things as it can? Do you think they did that on purpose, or do you think they had no choice?
News day. Yeah, Monday was a great bad news day, right? So if markets were going to go down, you can be like, oh God, there's a fire. My goodness. Well, I've got this, extra wood going I need to burn off. So let's just throw it on. And, then the fire brigade come out on Wednesday. And, I think they also knew, because of the way the Fed had acted on Sunday, the Swiss central bank was probably going to act the same way. So even though it's a ridiculous notion, if the Fed hadn't, actually the best thing for Credit Suisse was the fact that SVB went bust on Friday afternoon.
It gave them cover.
1,000%. What they can do is they can make it look like a systemic issue when we know it's a historic issue. The regulators don't have to jump in, because otherwise the public thinks there's a massive contagion happening, when actually they're just wildly unrelated.
I mean, I actually think it is systemic to some degree, in the sense that when Fed starts raising rates, now it happens every time. There's like a lot of businesses that were sort of like making okay with cheap debt, cheap money. It starts to reveal the problems on their balance sheets, right? And so like the unique problems of Credit Suisse are very different from the unique problems of Silicon Valley Bank. But the consistent thread is just in a higher interest rate environment, it starts to reveal basically like who is swimming naked. So I think you're going to see more of those issues where it's like the story's different every time. The consistent thread is just like they could paper over those issues when debt was cheap, interest rates were low, and now they can't.
I think to your points, Armand, just like the in addition to that, fate loves irony, right? So the ironic thing would be that a massive contagion happens on a series of sort of related instances, not on actual proper contagion, but perception's reality. So, if you're absolutely right in terms of policies have definitely got us here. There's no doubting that. Banks aren't particularly innovative things, so they tend to, work around policy. But so definitely the Fed's policy, and actually all central bank policies, Europe was a little bit slower on upticking interest rates, hasn't gone as high, but that's definitely having a drag effect on these banks and their liquidity issues. We were talking to Grant yesterday. They've clearly got a valuation issue on their balance sheet for assets that they have to mark to market at some point, which is going to be horrendous. And then probably they've chosen Monday to let the cat out of the bag on some more bad stuff that's happening. But ironically, that would just be enough for the market to think that there's a general banking issue, which there absolutely is. But I think it's probably just sped up a bit by unrelated bad news. I think this would probably have been a slower burn over a few weeks instead of, Monday to Wednesday would be my guess. But, some people know better than me on that one.
And what's the adage? It's like, is the dog wagging the tail or the tail wagging the dog, right? I think this is economically, if we look at, loan portfolios, if people start getting laid off, which Grant will throw the hammer down on with the $2 million intention, or 2 million jobs intentionally laid off. It's like, if we're portraying that in order to get to where we want as the U.S. Federal Reserve needs to be, is that inciting kind of like, normally the market is a 6-month forecast of what is intended to happen, right? So are we forecasting essentially what is anticipated to happen economically right now? And I think most banks. Yep, go ahead, Dennis.
I mean, this does not feel like, let us wisely forecast what's happening 6 months out front. I mean, this is pure knee-jerk reaction to fear. This is neither bull nor bear. This is gazelles running away at the slightest wisp. I'm worried with what Rob Nunn just pointed out, though, this idea that, one bank, falls, so we'll go ahead and announce some of our lesser problems now to get in on that. But then the media, I was on the media for years, ends up seeing it. Two of anything nowadays is a trend. And then suddenly you have far more fear fanning than needs to be, because I think the banking system is in vastly better shape than it was 08, 09.
Yeah, and just on your point there, Dennis, sorry, just on that point, Dennis, I think
I just wonder how you break that cycle. Yeah.
You can't. I just think it's a reality of differences to 08. The banks are in a much different position. We have way better connectivity with each other. Information is way more instant than it used to be. Your ability to withdraw and move money, even as a big business, is now in your pocket. And so we've
$42 billion in 2 days, was it?
Yeah, and I think the biggest one was Washington before that, right? Which was 16 billion over 10. So like just the scale in 10 years of like, you know, the amount of withdrawals, that was the biggest previous instant withdrawal. So that's just the nature of things. I think the reality is the management of these banks now need to learn the new reality, not that we need to change the new reality. That would just be my guess. And I think that as a lot of these people get, frankly, and I'm going to probably sound a bit young and obtuse here, but as these guys get a bit older, I think they're probably living a bit old school 15 years ago and not really thinking, you know, hold on a minute, there's tweets exist and people, you know, like the general public actually look at them now and people know what, you know, they can Google what mark to market means and valuations are and LTVs are, and they actually understand this stuff. And so we have to actually, like, you know, educate ourselves on how to deal with that. And I think as a new generation of management comes through, which you're probably going to see after whatever events unfold now, this will go away. I think it's like to coin the Fed, a transitory communication issue.
I do want to. Yeah, I want to give a shout. I'm going to say two things. Number one, I was going through the audience just not long ago, and I saw a bank executive of one of the banks we mentioned in the audience. Obviously, I don't want to scare them off, so I won't call them out. But one thing I highly recommend is, and that's not just, you know, for me to have a bank here on stage, but I genuinely recommend it, and not only for this space, but all media. When there are crises like this, I think communication on places like this, I could be wrong. I haven't worked in crisis management, but it seems necessary now, considering how fast fear spreads and where people get their information from. And so just an observation. Also, I'm going through the audience and some incredible minds listening to the space. I want to remind anyone, unless your SPF who fucks up. And anyone in the audience, if you want to come up on stage, because I see some incredible minds, do DM me, because we cannot see requests. When we hit big numbers in the audience, it glitches out. So I keep forgetting to mention that. But I want to go back to another point. And again, considering there's a lot of people in crypto today and they're celebrating this week, I want to ask Vinny and Simon the question. I asked Simon to come back, and I appreciate you coming back, Simon. And Vinny, I sent you an invite and he came in. The narrative of crypto, of Bitcoin, and hopefully Vishal's not here because he's going to go crazy on me. But the narrative, Bitcoin came out in 2008 because of the obviously the global financial crisis and the narrative back then. Considering a similar narrative today, with the fear of bank runs and you know, having your money in a bank and the risks involved, could that be the what Bitcoin, I asked this a few days ago, but could that be what Bitcoin needs to become a store of value and kind of detach from risk assets? Again, I know a lot of people would disagree with this statement in the traditional financial world, so I would love different perspectives as well from the panel if someone disagrees with that statement. But maybe, Vinny, you want to kick it off?
Yeah, so thanks, Mario. Look, I have a weird belief that if Bitcoin winds up attacking the banking system, that's when the governments will, you know, rise up and over-regulate it and ban it. And, you know, there's 180 odd governments around the world. So you're going to have this like visceral attack on Bitcoin if it becomes a threat to the banking system. So I'm not of the opinion that Bitcoin wins in that sort of, you know, game theoretic scenario. I think Bitcoin wins in a scenario where the banking system collapses under its own weight, and then everyone goes, where to next? So you know, I kind of like the idea that Bitcoin basically becomes very stable at these levels, maybe a bit, you know, maybe slightly higher. But you know, if in the event that the banking system is collapsing, you don't want to see, you know, the funds flow into Bitcoin too aggressively, because the governments will step up. They will be like, we're losing money, Bitcoin is going up, let's ban the on-ramps, let's ban all these things, etc. I just don't think that's a plausible path. I mean, I can't see how governments would just allow Bitcoin to continue on that path. So my belief is that it's a longer term thing. It doesn't happen in an instant. It takes years. And
Another decade or so.
Maybe a decade, maybe 5 years, maybe 7 years. There's going to be some inflection point, and we may be at the inflection point right now. It's hard to zoom out from where we are right now, but I just think the banking system is at some point going to collapse under its own weight because it's highly over leveraged, and money moves a lot faster today, and bank runs can happen. And if the only option really is the Fed has to cut rates, you know, into later this year and ease the liquidity in the banking system, because under the current strain that it's taking right now, any further rate hikes, I think they can probably get away with 25 more. Anything more than that is going to put a lot of strain on the global banking.
Talking about rate hikes, the Moody's agrees with you. Moody's, that was a few minutes ago, less than 10 minutes ago. Moody's says Fed's inflation fight remains a priority, but financial stability risks complicate rate path. They expect the Federal Open Market Committee to raise the Fed fund rate by 25 basis points in the March 22 meeting. And then continues to say, if banking stress intensifies, the Fed may well pause rate hikes to assess the situation, which I think is most panelists agreed with this. It says Fed and other central banks could convene emergency meetings to provide guidance and stem potential panic. And a few minutes ago as well, Telegraph put out a piece, Bank of England in emergency talks as crisis deepens at Credit Suisse. But to and then we'll move on back to the discussion of Credit Suisse. Simon, do you share Vinny's perspective that it could take a lot longer for Bitcoin to, no longer become a risk asset and move towards a store of value, as many have been preaching for many years?
Well, Bitcoin is a return to savings, so it sits between spending and investing. We've taken savings out of the equation because we have a currency which is you can't hold, so you have to speculate and invest. Whereas if you have a longer term time frame, then Bitcoin has squarely served me for the last 13 years in the saving side. Now I know people find it a bit hard to think in that way. Going to Bitcoin is that it has its moments to shine when people realize that they don't own their money and that they can't spend their money, or that they just need to predictably know the money supply into the future. And so those are the three things that have driven Bitcoin adoption over time. Now, short term, it's been an absolute nightmare for managing your personal finances. So it's why we've had, the other types of things that have come from Bitcoin that are more threatening to the banking sector, which is central bank digital currencies. If central bank digital currencies become a thing, I think banks will be rioting in the streets because it's the biggest threat to banking the world has ever seen. Bitcoin is not. Bitcoin is, and people don't save in dollars anyway. They save in the stock market or real estate. So it's more like, it's more bringing the ability, and it's an innovation on top of that as well, because you can use your Bitcoin as collateral in order to borrow. But people can't manage their personal finance where their expenses in one currency, and because you can't take trading risk, and the value you're saving in is in another currency. So it's interesting short term to look at narratives, and Bitcoin has really is uncharted territory, and is the reason it's so speculative is because people don't know how it's going to react to quantitative tightening, and it also has this fundamental value that doesn't tend to come out in the short term, but has prevailed because it's been in a 13-year bull market ever since it's been around, since 2008. So it's easy for people to understand, but it's not really a threat to banking any more than gold is a threat to banking, because it's just a more efficient way of complete auditability without the track record and without the history. So it causes a lot of speculation in between. So I don't really. It's why my theory has always been, since I wrote the first published book on Bitcoin in 2011, that we end up in a CBDC and Bitcoin world, and Bitcoin regulates CBDCs and CBDCs regulate Bitcoin, because you need them both, and they can work pretty harmoniously. And it's probably only in times of mass conflict, when nobody trusts any of the fiat currencies, that you end up probably settling in Bitcoin, just like after previous wars you end up settling. In the last World War, the losing country had to settle the debts of the winning country, and the only currency that people trusted to settle international was gold. But Bitcoin's just a significantly superior way of being able to transact in a time when fiat currencies are not trusted.
Yeah, I think Simon and Vinny make really great points. And kind of to add to that, I've spoken before about, our issues over the weekend, given that, we were banking with SVB and our trading counterparties weren't willing to trade with us because, our access to TradFi was suddenly broken, right? Because they need to re-KYC us with our JP Morgan account. But the interesting thing about that is, how do you risk manage, right? What's risk management look like in a native crypto way, right? If your TradFi rails go off. And so I've both gotten a lot of more faith in decentralized finance, but also a lot of questions about DeFi over the last several days. And I think the big thing is like how, if you don't believe USDT and USDC, right? If you believe that there's existential risk, as we believed on Friday night, right? Because USDC was touching 89 cents and in some exchanges was going much lower. But if you're sitting there as an asset manager, even a traditional one, you're like, well, what do I want to do? I want to optimize my Sharpe ratio, or get a nice mix of risk assets, right? Stocks, bonds, and commodities, et cetera. Those things are beginning to be made, and there are wonderful projects in crypto. Things like Pax Gold, where they're actually putting gold with every kind of token that they issue. So those are great. But the thing from a risk management perspective is, if you're stuck in native crypto and you actually are doubting now the assets like USDC that have TradFi rails on it, how do you create synthetic things that will allow you to risk manage, right, in the way that you can in traditional finance, right? There's no, 10-year treasury version of a token, right? I mean, there's these oracles that give prices, and actually some of those broke down, right? DYDX, for example, a famous decentralized exchange. They quote stuff and they settle trades in USDC, but their oracle quotes prices in US dollars, right? So the interesting implication of that was your leverage remained the same, but your trading position actually went down, right? Of USDC, for example, or really any asset on their platform, because of their settlement in USDC. So
Eugene, sorry, I was just going to say, Eugene, you should jump into our crypto space, the one we rescheduled from today. Didn't know you're that deep into the space, so I'm going to tell the team to DM you. It'd be great to have you as a guest. And before continuing down that rabbit hole, because I know where that can go, I want to just welcome. Sorry, Simon. I just welcome Danish to the space. So Danish, after Simon Dixon responds, I'll just tee you up with a question. I mentioned earlier how fast information is spreading. By the way, Tom Fitton is requesting to speak. So Tom, as soon as I'll bring you up in a bit. Would love to have you back on stage. It's been a while, Tom. Danish, my question to you is that I'll ask after Simon jumps in, is regarding how fast information spreads. Can you give us, right after Simon, an idea of your experience during the space? Because Jason was talking about, I think it was Jason, he was talking about how the speed of fear that we have today is a problem that the regulators have never had to deal with in the past. And that's, for me, I find it to be the kind of the most concerning revelation we've seen, or the biggest lesson we've learned from the failure of Silicon Valley Bank. So such a massive bank run in such a short period of time is unheard of, except for 2008, I think. So I'd love your thoughts on this, because I know you experienced it yourself and people in your network experienced it as well. But Simon, the mic is yours.
Yeah, so the question is great, and you touch upon the key point, which is it is risk and portfolio management. So just as in my personal life, I risk, I manage three risks. I have a US dollar portfolio, assuming the US will continue rolling over what I call the Ponzi scheme. I also have a gold portfolio, which is preparing for a change in empire. But the vast majority of my wealth and what I play in is in my Bitcoin portfolio. And my Bitcoin portfolio manages several risks and uses innovation. Bitcoin is my core saving mechanism, which I never want to sell. And therefore, when I need some spending money, then I have to borrow against it. In order to borrow against it, you need to risk a bit of it in order to play in the wider crypto market. So you can wrap some of it into Ethereum, and then you can take out a decentralized loan, or you can take out a centralized loan. So those are two risks to manage right there. And then you can take out dollar risk as well by having a gold-backed stable coin. Then you can generate yield in either a centralized or decentralized way. And all of it, I guess the challenge in risk managing it is, in the traditional world of finance, the world just tends to outsource that to portfolio managers, because most people are not full-time at this stuff. But when you combine the jargon of finance and the complexities of all the different risks and financial products with technology, you end up with financial technology, which is a bunch of jargon in technology and a bunch of jargon in finance. And combining those two together is where we need entrepreneurs to build the next wave of financial products, so that when we enter a world, which I do believe we enter, where artificial intelligence is outperforming anything that a portfolio manager can do, then you end up in this final part of the world that I believe we end up in, which is where artificial intelligence does most of the management and the building. And then you need two forces that regulate each other. When you have artificial intelligent investment bankers, central bankers, which are managing the central bank digital currencies, then you need Bitcoin's proof of work in order to regulate those and provide an exit. And then if fiat currencies get too honest and too draconian and too and move us more to a more communist way of managing an economy, then you need Bitcoin, which is the ultimate freedom to transact, freedom to spend your money, and a monetary policy that's known into the future. So it's all the complexities of the traditional market, but you get to do it on your own. You get to tinker a little bit. So I suggest just start simple, which is simply converting a percentage of your fiat in a reasonable amount that's right for your portfolio into Bitcoin. Don't trade it. Don't try and sell it. Don't try and time the market. And if 10 years from now that turned out to be your best retirement plan, then figure out how to do some of the innovative stuff on top of it and tinker bit by bit.
I want to go to, so before we continue down the Bitcoin rabbit hole, I want to go to Danish. So Danish, in a few hours, I've actually just realized I'm jumping on a panel with, man, my memory's bad. Scaramucci, Anthony Scaramucci, Gaurav Dubey, and another incredibly respected gentleman. Please mute your mic, guys. Yes, and the reason I'm going on that panel is to discuss the speed in which information spreads and capital allocation and in this new world that we have. So probably a good timing to kind of give me your thoughts, so you can give me some talking points that I'll use in a few hours. And don't drop out now. Yeah, great. All right, Joanna, she dropped out again. Let me accept your invite. All right, it's glitching. Great. I teed you up for the perfect question, man, and you dropped out. In the meantime, I'll go to Trevor. I know, Trevor, I interrupted you to ask that question of Danish, but he no longer deserves the mic. So the mic is yours, Trevor.
No, I was just going to say, I think the rotation into new asset classes is kind of ripe. I think people are looking for exposure in new markets, and I know that there are a lot of with Grant's exposure to real estate. Like we have to look for the same way that crypto and I think the point of this isn't necessarily to get down the rabbit hole of crypto per se, but banking is a very fragile mechanism, right? Either the nationalization, which we've seen from the Fed and through the Swiss bank, comes in and says, we are going to help you through this turmoil, which is not necessarily the ideal scenario, happens, or you move into a more precarious situation, which is now we have speculative asset classes that could potentially rival a fiat currency, right? And so I think, again, to EYC's point, I think the confidence adoption, right? You're not putting 100% of your cash into Bitcoin, just as you went with 100% of your gold, right? Diversified. Once you get to a point where you have enough, cash or assets, you're trying to diversify to optimize capital and the return on that capital. Whether the risk drawdown is your biggest concern, you don't want to have 50% of your portfolio draw down 70%. And I think in 2008, as a construct, may have gone down far more than people were anticipating. When you had 401ks that were down 30 to 50%, the difference here is that I think people are more aware of diversification to where asset classes, if they do have drawdown, can be hedged and or diversified against, right? You have inverse correlations. This is my biggest pet peeve with hedge funds, is that there are a lot of hedge funds that claim that they're doing positive alpha, and they're merely beta followers, right? They're trying to follow the trade instead of finding unique perspectives to push new alpha instead of following beta. So I think this is something, and whether it's a hard asset or whether it's a liquid investment, I think this is something that Bitcoin and other assets have been so lucrative because they are perceived and potentially they are as either neutral. So as the Fed continues to push rates upwards, right? Bitcoin got hurt. But the second that there's wind that the Fed may pause or inverse, right? Now all these crypto assets are starting to come back, and all these speculative assets that were more of a hedge against the Fed and against a fiat currency are becoming more palatable for investors to diversify risk into.
All right, so Danish, you sent me a message. Eugene, I don't want to go down that rabbit hole. Danish, you sent me a question saying, what was the question again? I heard it was an awesome setup. I just don't know the question. I'm about to block you. No, I'm joking, man. Like, the question is how fast information spreads. We've seen it here on Twitter, and I want to get your experience because you talked to me about it. Remember after our first space for like 20 hours, whatever it was, you were telling me about your experience of how fast information spreads. I'm going on a panel in a few hours to discuss that exact topic. So, yeah, I'd love your experience. Maybe you'd give me some talking points. And I think the audience would love to learn your experience. Regulators in the audience, and Jason would appreciate it as well, because they're gonna have to learn how to deal with it. And there's a couple of banking executives as well, so that learn a couple of things.
So very, very simply, there is a confluence of issues going on right now, which is concentration of wealth, which I know people don't like to hear, but when you look at what happened with SVB, 97% of people had more money than what the FDIC insured. And so that, coupled with a lot of those companies were connected through their networks, either through YC or Techstars or Founders Fund or other VC funds. And so as soon as the switch hit at the LP level, Peter Thiel, it went down the VC level, which then went down the founder level. And those founders were running out crazy quick. Now, I'm not going to speak about where I heard all of this before everything went down. Mario, you know that, people, so we're a Techstars company, but we also have other VCs. So you have no idea where I found this out. But we knew, the ship was going to go down before it went down. We knew that something was going down. Not that it was going to be a bank run or something like that, but a lot of people did. And we knew that because you can work your way back up the chain. And it was, one thing is talk of the town, and that has existed forever. But to give you guys some context, one LP invests in 10 VCs. One VC invests in 10 startups, right? And so per fund. And so if they've got 5 or 6 or 7 funds, right? Like they've invested in sequential funds, you're literally causing a ripple effect that's occurring in the VC, that side of the world. Now, that is specifically SVB, but this same sort of risk, I mean, we saw one investor pull out, the biggest investor pull out of Credit Suisse, and it threw everything out. But as soon as this one event occurs, now retail investors, so we talked about corporate investors and how quickly that moves, retail things moving very, very quickly. And just like, and I hate to say this because I know I'm a doctor, but just like a virus, it is a contagion that spreads very, very quickly. So the way to think about this, and I hate to say this because people hate talking about viruses, given we all have a little PTSD from the last few years, but just like any other contagion, there is both a transmissibility and a virulence, which means how severe it is. And transmissibility is how quickly it goes from person to person. And what we're seeing is that we have seen these skyrocket. And with Silicon, the virulence was very high in the sense that every person that acted on that suddenly hurt. Banks that are more dependent on corporate people, bigger bank accounts, less people are at more risk because the transmissibility is so high. I don't know if that all made sense, but that's how I think about the problem. Is it's like when you think about any contagion, there are two main things: how quickly it spreads, which is the transmissibility, and how bad it hurts when somebody acts on it, right? And so with SVB, it spread really, really quickly because there was only so few key players in that ecosystem, and it really hurt because if any money from SVB, it hurts SVB. So that's that's what actually happened. If you really want
Am I, just before anyone responds, just want to know whether the whole space is glitching or it's my end or it's Danish's end. Did Danish glitch for anyone else? Can someone let me know from the panel? Was he like cutting in and out?
Yeah.
Oh, okay, cool. I freaked out because we had another speaker drop out and then Danish started glitching. But we heard everything you said, Danish, and I think it's really well articulated. Send me some talking points, man. I have to talk about it in a panel, and I didn't know about it till a couple of hours ago. So help me out.
I will.
And yeah, but this is so. My next question to you. My next question to you is how can not only regulators but how can banks deal with it? So how the next Silicon Valley Bank, whether it's next week, next month, next year, and in a few years' time, how should they respond to that, to the way this information spreads? Because on one side, I said earlier, they should jump into spaces like this and live shows and other shows on YouTube, and answer questions and give kind of reassurances. But on the other hand, if they do this, that could be seen as a form of panic. So it's a really tough position to be in. What do you think is the best way for them to respond?
It's being set up correctly.
I don't.
Sorry, Trevor. Go ahead.
No, I was just going to say I don't think that banks like SVB should have necessarily been public to begin with, because the large sell-off in their stock. Once this thing started to curtail, a venture capital supported bank should not have been publicly traded to the effect where withdrawals and the capital markets, the market cap of the company was slashed in half in one day, and then another, 2/3.
Yeah, but Trevor, it didn't fail because of the market cap. Didn't fail because it was public. It failed because it had few shareholders that each represented large amounts of money. I mean, there was a bank run.
Right. I'm not saying that there wasn't a bank run. So make that be clear. What I'm saying is that the impact for them was that there was a bank run and their stock caught wind of it. So people started selling off. I'm assuming that a lot of people that were depositors were also shareholders in SVB, right? So you see this correlation. Most people would not have known that depositors were pulling their money out. $1 billion just gets moved. The notion of we've got an insight to one in every has moved their money outside of SVB before they went. Startups who are valued at SVB and who are in the startup space, that the second that they work effect that begins to transcend what I don't think was necessarily intended per se to happen, where startups say, well, I got to pull my money out. I'm going to move it to Brex, or I'm going to move it to JP Morgan, or somebody else who secures more money. that was not necessarily the intention per se, but as a publicly traded company, you cannot negate the fact that if they were not publicly traded, they may not have had the significant impact that it did, because if they weren't publicly traded, people would not have, shorted their stock or sold their stock off as quickly as they have, and it wouldn't have been public, right? You're talking about, okay, like a Silicon Valley lender, may have liquidity or solvency issues. That's a different story, right? You're talking about a publicly traded company that went down, from 300 to 20 in 2 or 3 days. It's a
But
much
Trevor,
different
to push back a little, I get your, I think, underlying point, but they're the 12th largest, they were the 12th largest bank in America. It's not unusual for a bank that size to be publicly traded. And so, and usually any good banker would easily take that company public, right? So
Right,
I just think
but
it's going to be difficult to be able to regulate that, right?
What was it because of the profile, though, of the requirements that they had that said, in order to be a funded company by SVB or to get a loan, that you require the depositorship of that startup, right? They had certain requirements that were a bit unorthodox and I think often overlooked, where
sorry. I want to kind of jump in as a client of SVB for many years and as a founder, kind of seeing what we did on the ground to kind of tie in with what you're saying. I mean, there's kind of two different category questions here, right? Like if you look at SVB's, right, at the end of 2022, you look at their common equity tier 1 capital ratio, unadjusted, it looks kind of like other banks like B of A and Wells and other ones. But if you adjust it for unrealized losses, of course, it really SVB is in a category of its own. I think this has been kind of beaten to death. But when you look at the blame on the other side, right, to Mario's actually initial question around the sort of the acceleration of information, I think the interesting thing, the viewpoint as a founder, right, it's easy on the outside to blame big bad VCs and think that there's this kind of mafia and even words like PayPal mafia are thrown around. But on the ground, being part of a lot of founders groups, I think the kind of panic that resulted, I mean, it was just pure panic, whether you're an investor or founder, if you think to last week, because all your money is in there. And I think that behavior is, to answer the broader question, and a lot of people have expressed this fear, the broader behavior of information traveling, right? I mean, just because there's these WhatsApp groups, et cetera, a lot of that information was just being spread, on Twitter and increasingly on Twitter, right? If we look at what happened with, First Republic over the weekend, for example, with, normal citizens just lining up outside, trying to get their money out. So I think the one of the interesting existential questions is how much of SVB is idiosyncratic? Probably their balance sheet is idiosyncratic, but how much of the behavior that happened last week because of the rapid spread of information through things like not only WhatsApp groups and Telegram groups, but also just Twitter and the media in general, I think that's actually a valid concern for really any bank and really the financial system going forward.
Yeah, but
Could I
we've
add something
seen
to that,
this.
guys?
I'm sorry, go ahead, Dennis.
Thank you. I just wanted to point out, and I think that's a great point about how fast information moves. What surprises me is that in an open, free market for information, that there was, in this case, no counterpunch saying, wait a minute, I believe in this bank, it's strong. Let's remember, this bank, $200 billion in assets, it lost $1.8 billion on long-term bonds because it ran out of cash to give out because its companies were having a harder time. And then the run happens, $42 billion comes out. One question I have, we've got the SEC and we've got the Justice Department looking at criminal possibility. They're going to look for that inside the bank. Okay. And we've got people investigating the regulators. My gosh, although I've always felt a screw up like this is the fault of the company, I see no criminal interest in looking at this run. Was it really created in good faith by people protecting their clients and wanting to come out? Or was this run in part contributed to by short sellers on banks, by someone, others who were doing it on purpose? And did they manipulate? Because how is it that information marketplace had nothing on the other side?
To be fair,
Dennis,
Rob, go ahead.
Sorry, thanks. I just think we're correlating. I think we're actually probably thinking a bit too much like this was sort of the people in the. I don't know how to word this without coming across incredibly rude. Like they actually were thinking about this in a joined up manner. I don't think they were. I think what they did And at the management of this, they may be culpable for something. I doubt it, though. I guess that from their perspective, they were seeing things going wrong for a little bit longer than we would. That's quite natural. They've got themselves into a mess after a period of time where who was going to question in the run that we've had up until maybe the pandemic, and even during the pandemic, deposit safety in the 12th largest bank in the US. It was very geared around VC land, which was fine in terms of requiring deposits. It was a little bit unorthodox, but kind of part of its charm was the fact it was unorthodox. I think the wheels just ran off it, and I think the management didn't really think that through. The worst, back to Mario's original point, I think the worst thing we could have done was come onto one of these things and say we're absolutely fine, because that's like, like the CEO of Credit Suisse has been out all day saying that there's absolutely nothing wrong with my bank, which basically means please stop taking deposits out, because it's if you keep on taking deposits at the rate we are, we're going to have a problem, is what he's actually saying. Otherwise, he wouldn't be out saying it at all. So, I think there's always going to be a problem. They had a correlatory between it being a public company, so they had to be open whilst having really kind of niche depositor issues, and it kind of ran off the wheel. I don't think there was. I think it was just probably a series of unfortunate events that led them into the position they're in, and it ended with a humongous bang, with the biggest bank run ever, like as fast as it was, probably sped up by a whole host of issues which nobody's going to be related, and they're probably very unique to that bank. I don't think JP Morgan needs to be if we were to take like a macro bank issue on it and say how do bankers and regulators do it in the future, I just think like there's just no way they need to be sitting there and worrying about the type of deposit withdrawals that a very niche bank with a very specific set of clients had, and take that as a model for this is how we communicate during a crisis. I do agree they need to get better at it, because obviously it's the world has changed since 2008. If we are heading into another crisis, that's fine. But broadly speaking, this was like, I would put it down to a series of unfortunate events plus poor management, poor communication, poor deposit. There's a million and one reasons, but I don't think they're necessarily linked to the entire banking system.
Rob, I just thought of a good counter argument there, is that the speed in which fear could spread and the amount of transparency there is holds these institutions more accountable. So it's probably a good counter argument that it could bring more good than bad. Just a thought that I had as you were speaking to Rob.
Yeah, I agree with that. I think also, like, we're going to see for a little while now deposits move to bigger. It's going to become more centralized, sadly, which is going to pull money out of local markets. We were talking about this yesterday, which is going to affect the everyday person. And I think that once they realise that if my deposit doesn't go into First Republic or my local regional bank, they won't offer me a mortgage, they won't give me a commercial loan, they won't give my small business a debt. These big JP Morgan guys have to play by different rules, and therefore, they're not going to give me stuff. Then they'll realise that their deposits are safer back at regional banks again. We just have to go through this breathe in and out process. And unfortunately, it was exacerbated by what was, frankly, and I'm going to be quite candid, a really, really bad weekend for everybody involved with that bank, whether it was the management, the main depositors, the VC. It was just an absolute shit show of communication breakdown.
Hey, Rob,
and I hope that people don't do that again.
I wanted to share something very interesting timing for this announcement. I put it up in the nest. I'm not sure if you all discussed this yet, but they announced this around 5 o'clock Eastern, so about an hour and a half ago. After everything that has happened, Fed Now is finally announced. So for people that don't know, Federal Reserve digital payment system will debut in July. They've been talking about this for a while, but very interesting timing. I have my tinfoil hat on, ready to go. And it gets way
I mentioned this, Danish. I mentioned this and no one responded. I'm like, okay. Am I the only one that thought that was big? Can you tell me? Yeah, tell me. I'm glad I don't feel like I'm an idiot anymore. Go ahead.
No. This is let's put the tinfoil hat on. All right. We just had a banking crisis. I don't know if the PR teams aren't talking to each other. I don't know if the Fed is just messing with everybody right now and they just want to change. They think that this is going to be a bigger deal, but everybody's still stuck on this. But let me tell you what Fed Now is. So Fed Now is a payments platform that the words are resilient, adaptive, and accessible. Very interesting. The resilient being the most important word because right now we're in a banking crash. All right. The system will allow bill payments, money transfers such as paychecks and disbursements from the government, as well as, and this is where it gets good, a host of other consumer activities to move more rapidly and at a lower cost. And the article, and this is again probably approved by them, some Fed officials say that the program might even supplant the need for a CBDC. Central.
Really?
That's why this is important. So this is actually all about a central bank digital currency. And, that's why, again, my tinfoil hat is on. I have it nice. I've glued it to my head now. Yeah. So this is kind of an important one. So for people that don't, I'm sure people have heard of CBDC, but Rob, did you have a thought on this? Like, why is this timing so weird and interesting?
Well, I think there's two things going on. First, this feels like ChatGPT 4 announcing just after Google did. Google did this big announcement and they go, hey, well, look, we've got this new product. So I guess it's just distraction would be the first order of the day. We've got something. Oh, we're working on something that takes away all these problems. Have a look at this instead. They're going to chuck everything at the book. We're banning TikTok. Aliens are invading us. Whatever. To try and stop looking at the Treasury and the Fed's balance sheet for
now I get your joke about the aliens. It didn't click earlier.
Yeah,
I get it.
Anything. They're going to have a Pentagon official out tomorrow with a really fancy uniform, some guy you've never heard of, and he's going to go, hey, we've just found aliens, and they're going to go, wow, it's amazing, and hoping that every mainstream media broadcaster goes with that instead of the Fed's balance sheet now is entering negative territory. Anyway, so that's step one. And I guess the second part I do agree that a central bank currency is coming because they've told us it's coming, and this is probably step one to onboarding us to that idea. I think the practicality, again, we spoke to this yesterday, the practicalities of this, and I work in engineering infrastructure and other things. I mean, fundamentally, the amount of energy required and the amount of infrastructure changeover required to enable a central bank digital currency to actually work for everyone in real time with checks and balances on the floor from everyone from a mum and pop shop in Pittsburgh right the way through to your main banks from day to day is enormous. So I don't doubt this is coming, but it has to come in intricate waves, and we have to do it with a massively updated grid. The data pulling alone is enormous. So this is a great test run. I think it's a conditioning tool. If we're going to put tinfoil hats on for a minute, and I don't wear them very often, but let's say that we are now entering a sphere where digital currencies are going to come, a central bank digital currency is going to become the primary mover. And actually, let's face it, there's no downside for the central bank to not do that. So that makes a lot of sense. The process of it will need to be condition people to accept it first. Then you can do adoption infrastructure later, and then you can do the sort of tinfoil hat brigade in terms of controlling spending and whatever else. We used to do it with tax. We're going to do it with something else. We're going to do it with how you spend money. So I think there's a bit of time between those things, but this certainly feels like step one, beta prototype, and a big distraction.
But Rob, tinfoil hat is on. You didn't say any tinfoil hat related stuff. So let me tell you what the tinfoil hat says. They just got rid of all of these crypto ramps. And then the day after Signet goes down, Mario, FedNow is open. I'm just saying, is this not the world's most ridiculous timing? Because is it?
Yeah, no, I don't think that the timing is suspicious. I think it's blindingly obvious.
Rob, I don't know about you. I think all my crypto friends are probably sitting here being like, 1 second, they literally just killed SVB. FDIC went took the charter down.
I'm literally saying, I don't think it's suspicious in the sense that it seems blindingly obvious.
Believe it. Yeah. I get it. I thought you meant no, it's just coincidence.
If we're going to go tinfoil hat, they're going to control everything we spend, and the currency, every currency is going to be
there we go.
Removed. I think the practice, yes, if that's true and that's coming, and I don't see it, I can't see any disadvantage for them doing that. They're going to do it. It's just the practicalities of that rolling in is that there's no requirement for the government to operate in any sort of normal lifetime period. If you think about like the federal government believes it's going to be around in 300 years and it likes to control people, it has got absolutely no need to do it in even a quick period of time. They can do it over multi-generations, and that means that conditioning happens quicker. And this feels to me like it would be a step, if that's where it's going, it feels like a step 1, 2 preconditioning.
It's literally in the press release that they said that this would supplant the need for, I mean, it's interesting, but Wolf, would love to get your thoughts on this as well. Since you've had your hand up forever.
you on a topic that I was going to speak on, which is the timing of this. And I wasn't even going to point out the events that you stated. I was going to more point out the timing of a federal digital dollar right after trust has been broken in the last stablecoin, right? USDC, I think for a long time, listen, we've had discussions around USDT. We had a discussion like 2 months into Twitter Spaces being alive, like 2 years ago, about how much we distrusted USDT, about how non-transparent Tether is all around. Then you had UST, right? Another one coming there at $1. That completely is destroyed and gone. And so the last savior and the remainder was USDC, right? It was, look at USDC, look how much strength they've shown. They are backed by the biggest names, BlackRock, Circle. And now we've even seen that USDC is susceptible, right? All it took was showing that it could move off that peg a full 10%. And now there's going to be a distrust. I was holding USDC. I'm no longer holding USDC. The risk to reward has changed, right? Of just sitting in there and the APY or whatever else you can get off it. So now in comes the government, right? Ready to seize the day. If I was behind the scenes, I have a feeling that this was scheduled and that this was going to be discussed and that the timeline got pushed up. And the idea was this needs to come out this week. While there's distrust in crypto, we need to push this agenda. So yeah, I think you're spot on with all of the pieces coming up. This is not coincidental timing.
And do you think, sorry, Wolf, do you think like if this is intentional in terms of like they're trying to hide the news, or that they're trying to show that, are they trying to be like white knight to the people who sort of want to get on the crypto journey but don't like crypto as it is today? Or is it they're trying to sneak the news in under the barrier by saying, look, we were really public about this later, but it got lost in all the noise?
Yeah, I think it's a little bit of a combination of both, right? We've known that this is coming. There's been a discussion. Now, this is a little bit of a variant from what we expected, right? We were expecting maybe some other type of digital coin, and now it's changing the format of what it is. But I would venture to say that that format is changing because partially due to the events that we've seen. And I think you make a great point, Rob. This is just becoming the nicely wrapped package of crypto that they can throw at, like you said, small business owners, a bunch of different people, and say, this, like, you could never trust crypto. And now they're going to have a full case study. They're going to say, this is why you can't trust the stable coins of other companies, this, and this. And then they're going to point at the US never defaulting on its debt. Then they're going to point at treasuries always having paid their interest. Yeah. They're going to say, that's what this is, just a digital version of that. They're going to equate the two in people's minds, and they're going to pitch it to them.
Diana, hold on. Fed, look, I was just looking at previous articles. Dennis, check this out. March 8th, Fed chairman, so Powell says, don't expect a CBDC soon. Quote, we're not at the stage of making any real decisions. That was on March 8th.
A week is a long time at the Fed.
Yeah. The Fed no kidding. It's based on what side of the bedroom Powell wakes up on. So March 8th is forever ago.
Essentially, what they're saying is
you
can't trust cryptocurrencies because we can break them.
I think you guys are misunderstanding this announcement a little bit, to be frank. Like, FedRAMP has been in the works for a very long time. It's the United States as ACH, which sucks, right? Like, it takes multiple days to get bank transfers. One of the reasons that crypto took off is you could move crypto a lot faster. One of the worst money transfer systems in the world. And they're trying to FedRAMP so it works more like it does in Europe or Japan. And what they're saying in the announcement is that they're just saying that it could obviate the need for a central bank digital currency. So I'm not sure that this is an indicator that they're pushing forward central bank currency. If anything, they're arguing they might not need it because of that.
I don't know if you've noticed, Armand, that they never tell you what they're going to do. So I think the fact that it was even brought up, I don't know about you, but I think we've lost a little bit of faith in the Fed. So I actually think that's why everybody is automatically assuming that this actually means that this is the first step towards that. That was sort of my point. But I think that ultimately the timing of this, I think we've all known the Fed now is coming. They mentioned it. You can actually find news articles about this months ago. It's more around the fact that it's getting started now. It's kind of fascinating. July, but why would they put this out now? Why would they go about it? We are in the middle of a banking crisis. They just built a new fund for banks that are failing. I think it's incredibly interesting.
Yeah, I think it's fair that the timing's really weird.
No, it's not weird. Maybe it's just hold on. Maybe it's just smart marketing. Someone, I can't remember who said it, but they found an opportunity and they announced it at the right time. So they've been working on it for a while. They're like, holy shit! All these crypto.
Because of fear. They see the fear out there. I think this was intentional. For the life of me, I'm sorry to be naive on this, people, but I don't know why the federal government has any business doing this at all. This seems like a private market pursuit. I just
hold on. We've got an interesting perspective.
Their payments are entirely efficient right now. Okay, they could use TradeShift as their platform. They don't have to reinvent this. They're trying to replace it. And one more thing, I'm sorry, but the actual digital print version of the US dollar and the $20 bill and the $100 bill, their value goes up to more than $100 on a $100 bill in cash if this thing ever takes hold. Cash, actual dirty cash in paper, becomes more valuable than ever because it's the only privacy left.
Joe, Mr. Kalsari, I've just sent you through an invite. I know you're trying to come up to set the record straight. He sent me the following message, and I'll read it out. And I've just sent you an invite via DM, Joe. But Joe's message to me. So Joe is a commercial litigator, loves crypto, and he says this is not a CBDC. FedNow is different.
Sure,
it'll come up. I've sent you through the.
I mean, that's what Armand was saying, to be fair.
Yeah.
No, it is different. I just want to be very, very clear. It is different. It's just very interesting that this conversation even came up about CBDC. I mean,
yeah, exactly. So they mentioned, yeah, it is different. You're right. You're right. So, how did they? Can you mention again the context in which CBDCs were mentioned that could facilitate CBDCs? That's what they said.
The very last.
No. They said it was supplant the
line
need
that
for
says that it'll supplant it. Yeah.
Yeah, it would supplant it. I want to be very, very clear. Their point was that, hey, us going down this direction might actually make it so that we don't actually need CBDC. But that my tinfoil hat, Danish, which, by the way, doesn't come out very often, but the last few days have been very interesting. The tinfoil hat, Danish, is saying, hold on, why did they even talk about this right now? Like, literally, there's a bank crash going on, and we're talking about why we don't want to do CBDC? Sorry, that was my main point. Joe, go ahead.
No, I just wanted to point out, okay, this is not, in many ways, someone said it earlier, this is an upgrade to the ACH system, and it integrates fully with banks, okay? So you're not developing a token, you're just a signaling channel for how to communicate transactions. And by the way, this has been in the works since 2017. And when somebody was citing like Powell's statement about, we don't think a CBDC is necessary. In fact, they've said numerous times that the Fed lacks congressional authority to do a retail-based CBDC, just said it last week at his semi-annual report on monetary policy for Congress. There's no relationship between the FedNow program and a CBDC. In fact, you should look at this as an upgrade to the ACH channels.
Hey guys, I do want to mention another announcement. Sorry, go ahead, man.
Go ahead, Mark.
No, I think it's worth mentioning. So Fidelity just announced they just went live, giving millions of retail customers access to Ethereum and Bitcoin. Now, I was looking at whether that offers an on-ramp and off-ramp. So I'll read out what the article says. The launch coincided with an increasingly hot regulatory environment in the US and the collapse of two of crypto's biggest banking partners, Silvergate and Signature. And then it says the application, including no, where is it? There's a quote in there. I'm trying to find it again, but it says directly, you will be able to sell crypto for fiat money. So essentially, that makes it an onboarding, offboarding platform, doesn't it, Danish? It does say you will be able to sell crypto for fiat.
Well, I'm assuming, and they're not making you switch it to USDC before you do it. It's direct fiat to. There's nothing going on in the back end. How?
Hold on, I just brought up Fidgetal. He could probably explain it a bit further.
Sorry to interrupt you, but just some breaking news here from Bloomberg. So, Bloomberg says First Republic is considering a sale. That's one of the regional banks that's been targeted over the last few days. So that stock is skyrocketing here after hours, up 10% now.
First Republic is considering a sale. Didn't they just raise money?
They're considering selling themselves to a bigger bank to prevent, I imagine, a potential insolvency issue.
I
wonder if that bank's going to be JP Morgan.
I do think it might be not to one of those large banks. I think that might be like a part of this. So not to like one of the big six. I was seeing that around part of it as well.
Just going to say this though, but JP Morgan has provided an awful lot of liquidity to them over the last few days. So I think they might have first dibs on whether or not they at least get a major shareholding if it's going to sell off.
The reason it's not likely to be one of the top banks, just quickly, the same reason that Silicon Valley Bank had issues this weekend, is that once you enter into the globally significant, or whatever, one of the top banks that basically is regulated in a different way, you have to get specific waivers to be able to acquire those smaller banks. And apparently that was like a hurdle over the weekend for SVB that they didn't get permission until like late into Sunday.
But by the way, just to go back for a second here, Mario, I just posted the fact sheet from the FedNow launch about this. I mean, and it explains the 365 nature integration with the financial system and banks of all sizes, small, medium, large, 365, 24/7 settlement and transactions. And the big takeaway for this is, if this is the case, what is the need for a CBDC? I think I agree with Chair Powell when he says that there's limited benefit to a CBDC when you have the FedNow program up and running and all integrated throughout the financial system. And for the tinfoil hat folks, this fact sheet was published in January of 2022, so well over a year ago. So this is not a new development.
Do we know whether this will be based on blockchain?
It absolutely will not be based on a blockchain. Far ineffective too.
That would be sick if it was.
Yeah, read the sheet.
Why not? See,
it uses Joe. It uses the Dogecoin as the blockchain for the transfer. But this is before anyone goes and buys Dogecoin and blames me. It's a joke. I should be careful on these spaces now.
You're pumping Doge. This is not good.
How are the? By the way, you know, Danish. You know who the first person to ever pumped Doge on my spaces? You get one guess, Danish. Yeah, Elon comes on. The first thing Elon came on, the first appearance he made on the space, the first thing he comes on and says, Doge to the moon. And then everyone just goes and buys Doge and it pumps, of course. And then my space ends a few hours later. And then people are listening to the replay. And then it pumps again when people hear it again in the replay and the press starts to put it out. So then the next time Elon comes, and I think I can mention the story. The next time Elon comes, my team, not my team, a couple of people in my network, they're like, "Hey Mario, ask him this question. It's about Doge." I'm like, "Cool, all right, I'll ask him. It's a good question." I'll ask him the question, and he answers it, and then Doge pumps again. I'm like, "Holy fuck! Like this is crazy. I'm not a trader, so I don't know this stuff." And then they go to me after the space, like, "Mario, thanks for asking the question. We made some money." I'm like, "Wow, what do you mean you made some money?" He's like, "Hey, we actually bought Doge. When you asked the question, we expected people to buy Doge." I'm like, "Jesus fucking Christ, you guys are my friends and you just used me to pump Doge. And I didn't even make money off it since I'm not a trader." Anyway, I've digressed a bit since it's getting a bit late here, but that's a bit of a story on Doge.
So on the banking side, I would implore everybody to look at FHN and the TD acquisition potential for FHN. So, if we're talking about bank consolidation and a potential more efficient capital system, I think most people would be all for that, right? Like if you're talking about an ACH transfer taking 2 days, I don't think many people are very excited about that. So I think one of the things that, is provided with capital efficiency is the fact that when we start to look at consolidation of banking, you can get more detailed and more, I guess, focused on improvements of how money is moved, right? Fast and slow, there are pros and cons to that, obviously. But specifically, I think this is a very interesting timing to everybody's point, because there were some mid to large tier banks, TD included, who were looking at regional acquisitions. I think if I can recall correctly, and somebody call me out on this because I'm on my phone, but TD was anticipated to acquire First Horizon National for, I think, 25 a share. And now they have pushed the buyback and M&A process about a month, right? So all of these repricings of these smaller to regional banks who were anticipating to be acquired, JP Morgan, if they're getting the flush from the Fed, think about what every other bank is getting, right? If you're a secure bank, what is this giving you the right to do? It's basically giving you the right to look at more attractive regional and sub-regional or local market risk and adopting that book of business, so to speak. So I think one of the things that, we've talked about with this crypto thing is, if we're moving money as quickly as we are, is it justified, public versus private market? And are there ramifications to, people's investment that dictate the policy and procedure for that bank to operate? And I think this is a huge conundrum that the market hasn't really decided on, right? Do banks have what we would call federal policy dictating, their ability to operate, or is it local and regional saying, hey, we want to be aggressive infrastructure in a market that doesn't necessarily have the lending capacity that you would normally have? Because realistically, in all aspects of American infrastructure, people would be aggressive. Is that a federal progression, or is that a localized progression that says, yeah, we've got 50 potholes, but you're talking about $1 billion investment in like a new interstate route? Like, where's the trade-off there? I think this is something that's specific to local and regional banks. And there was a really good talk with like 250 people in a room, where a local credit union or regional bank, he was on the board of 2 or 3 regional banks, and I think the South in Texas specifically, where the market is hot, said this is a very real issue, because if depositors pull and we have to pull out of these, things that we've worked out in terms of localized deals with the state or the regional government, there are facets of that government that do not have the ability to finance that type of improvement. So the question is, on an infrastructure basis, are we limiting ourselves to the banking policy, whereas a normalized person who says, I'm going to buy a crypto, or I'm going to buy something that has a facet of some sort of return, not a negative yield, right? We're talking positive yield and something that's valuable to everyday people. And I would question the people who aren't Wolf specifically, like, what is the minimum rate of requirement and return of investment for the average person once we move into this next generation of fiscal policy, where it says, like, if I am somebody who wants to no longer work at 65 and I've got 10 to 15 years, where do I park my money? And I think this is a delineation that not many people think about, because many people who are at their 401k and have had to extend work, which I think the Swiss or somebody, some of the countries in the EU have dealt with, where do I go work, right? Like, I'm 65 and now they've extended it to 67, that I have to continue to work. What are the implications on a grand scale that if that came back to the US, would be? I think it's pretty significant. So, I think there's a dilemma, domestically in the United States specifically, where regional and local banks, if they get consolidated on, are the lending practices and policies going to be the same? And if they are not, where do the adjustments come from, where there's more autonomy from the individual level to say, all right, I've put $100 into your bank. Where do I feel comfortable with putting my risk, right? And I don't think this has ever been talked about.
Yeah, Trevor, the only challenge is that boom and bust cycles are common. And this is how the game works. I mean, we see this every time. We've had years and years of boom. And so you saw a lot of local banks start springing up. And then the bust happens, and people that have poorly laid out money, either duration issues or, they're just like over leveraged, it causes trouble. So, the hard part is do you regulate this to leave? You know, this is not it's not a utility company, but it sort of is a utility, and so it's sort of asking the broader question around regulation. And I'm just not sure. We're already backstopping all of these banks. You know, the next obvious step is regulation. And so now they have access to a discount window. Now they have access to all these other. I just think that they're going to start regulating the crap out of these banks, and these banks are going to become utilities.
But I think most people here would agree that they would rather leave it up to personal autonomy to dictate the risk rate from a personal level, right? So what you're looking at is essentially like, if I put $100 into a local bank here in Tennessee, which has an aggressively growing market, and I know the infrastructure needs to be improved, and I'm proposed as a depositor where this debt is going to be financed, I think this is the difference, right? The transparency, we've talked all night long about, and Dennis has brought up great points about communication channels. Local and regional private banks giving facilitation to projects or incentives that make the infrastructure more palatable for large investment to flow into is an afterthought, right? Like if a person who has let's just say $1,000, right? I'm going to put it in, or let's just say 200 and, well, let's double it. Let's say $500,000. I put it into a local institution, and I've worked my ass off to get to where I am as a person who's 40 or 50 years old. So my spread is that my risk on is $250,000, that if my local bank fails, I lose that $250,000. But I also am incentivized by understanding the risk profile of that bank. I'm not talking about regulation per se. And I think this is the discrepancy, is that I don't think that we should be overly regulated, but I do think that banks that are local and regional should have a better communication channel to what they are invested in, and the return on that investment to not just the depositors, but the bank itself, regardless of if they're public or private.
Yeah, I mean, the approach that they. Sorry, am I still on there? Can you guys still hear me? Yes. Okay. No, I think this is a fair question about the role of local banks, especially in rural areas. But the hard part is you can't stop consolidation from happening. I mean, First Republic is literally about to get bought, probably by Goldman Sachs, since they gave them all this money. I don't know who's going to buy them. By the way, does anybody know? Did they Stock Talk or Wolf? Has anybody, or stock market news, any indication in any of the news who's going to buy them, or they're just like up for sale right now? Do we know? Any of you guys? All right.
Sorry, you're saying First Republic, right?
Yeah,
the
First
only thing I
Republic.
was
Do we actually
seeing
know
wasn't
who's
is
gonna
that
buy
it
them?
wasn't going to be one of those super large banks, that they were trying to avoid that, probably like the big six, So I would say look for those like 7 and under type of.
We could place bets and speculate. I can't see it.
No, Dennis. Dennis, we don't do any of that here.
Oh, just kidding. But I mean, here's what I've wondered. I think Silicon Valley Bank is a great property. I think really it's basically a $2 billion loss. Otherwise, it's hold to maturity assets. If they didn't have the cash drain, I feel like, why hasn't Jamie Dimon stepped in and snatched it up and bought it? And then you're reminded that in 2009 or so, or 2010, after he did the patriotic thing, after they rescued Bear Stearns, after they bought the consumer business of WAMU, he gets called on the carpet and takes a public beating from Elizabeth Warren in Congress, in the Senate. And maybe they're saying, you know what, not this time, not going to do it. So I'll be surprised if they do step up.
I'll step back on that, Dennis, just for a sec. I think Jamie Dimon and the JP Morgan example is probably, I think we should talk about the top 5 and then JP Morgan, because they're just in a different world onto their own. The reason I'd put the context in there, they're not going to step in this early because they're longer term banking play. And I appreciate the big 6 are in general, but they're JP Morgan. They just don't have to do anything yet. We're only Wednesday after this thing collapsed. They don't mind if it moves around. It could very well easily be bought up by another bank and then become an asset for sale again. So they can sit and watch this field. They're not going to jump at anything. And I think also JP Morgan's now, since 2008, got so big that any major quick moves in the market would be seen on a tumultuous day, like we've just had, and on Monday, would have been seen as a massive negative for them and for the wider market. So they've got to play this sort of weird underwriting position as like Fed 2.0 or Fed Light. So they're just not going to, if they're going to do anything, you're going to see it happen very,
Hey,
very
Rob,
slowly.
breaking news. Bank of England just confirmed that they spoke with the Swiss authorities and that the SNB agreed that if they will provide Credit Suisse with liquidity if needed. And so just as a reminder, earlier today, I'm sorry?
Sorry, I thought I was muted.
Oh, okay. Yeah. So, the Swiss National Bank and, SFMA, SA, the Swiss Financial Market Supervisory Authority, they actually came out earlier, as everybody knows, in a joint statement saying there are no indications of direct risk of a contagion. But then Bank of England reached out and they said, oh, no, we'll take care of the liquidity issues if they come in. It just gives you a sense of what they have to say to the public versus what they say to each other.
That, and also the fact that, essentially what the Fed said on Sunday was that, the underlying banking system is fine, but we're going to have to shore it up because we don't know if we trust anyone. And so, the Bank of England and the Swiss authorities coming out on a really bad day for Credit Suisse saying, we're going to provide you liquidity if you end up getting into trouble, is basically indicating that they had to have a meeting to discuss it. And so that's, it will shore up the share price, and I'm sure that will bounce tomorrow and everything will be fine for a week, but it doesn't actually solve any of the problems in any of these banks. What it's basically saying is, guys, this market, typically the fire brigade don't turn up to a fire and say, we're potentially going to have to put water on this, if they haven't been called. And so everybody goes, why is the fire brigade outside if there's no threat of a fire? It doesn't make any sense, or this makes no sense at all, apart from the fact that they clearly think that there's a bigger, wider problem that could fold out. And they're now publicly having to admit that a bit. The Fed did it on Sunday. Now the Bank of England and the Swiss authorities are following suit. I'm waiting for the ECB to do it straight after they if they up interest rates tomorrow and then go, hey, we're going to up interest rates. Oh, by the way, we're going to have to provide liquidity because we're creating a problem. It'll be interesting to see how it rolls out.
This is the problem with addiction to cheap capital. And I think we have been on the run for several years of a repricing of what reality settles in at. And I think innovation has been stifled for, let's say, 20, 30 years, right? Like the commoditization of products and services have been widely debated. And I think we're getting to a point where people are starting to invest more in, like, think about it this way. In the 1930s and 40s, right, you did not have the type of communication channel that you do today. Mind you, if you are buying any sort of consumer good, the question to retail investors is, am I buying this product or am I not buying this product, right? And I think this is a curious question for a lot of people on this panel. What percentage of people in this room of 8,000 people have money in a regional bank versus a top 5 institution? And in the event that they get scared or nervous or sit in, a panel like this or a discussion like this, are they getting nervous? Because I think to earlier points which Dennis made was the transmissibility of fear is far more leveraged than we have ever seen in any time period in history. And this is a notion that I think Rob and I have talked about, on our last conversation, which is we could be perpetuating the same fate to advancing a concern in the market that we haven't necessarily understood. And 11 or 12 years of quantitative easing and removal of bounds and understanding of Econ 101 can do that to pretty much anybody. And I think this is where we get into a very, bifurcated, political spectrum, which is, okay, do we raise or do we lower interest rates? If we lower interest rates, asset prices go up, it becomes more expensive to live. If we lower interest, or if we raise interest rates, it becomes more of a employment issue and businesses begin to contract their R&D spending and innovation. The trade-offs are neutral, right? Like there's a wash. Either way you go, the Fed has induced a period of incentive to waste capital in areas that have been inefficient for several years.
On that point, what's really interesting is, kind of related. I mean, we talked a little bit about fractional reserve banking and things like that. But one interesting case study is the narrow bank from several years ago, or TNB, which was a bank whose sole purpose was to take deposits and then put 100% of them into the Fed, into basically backstopped entirely by the Fed. But and you think that this would be a good thing, right? Basically, it's a 1x leverage bank. But of course, the Fed didn't grant the charter after several years of trying to do it. And I'd love to ask this to the rest of the group, right? Because one question related to what you're talking about with the regional banks versus globally important banks is, if that narrow bank existed today and it was functioning as well, I mean, can you imagine the amount of deposits that would be flowing into that bank? So ironically, the Fed wants, secure banks, well capitalized banks, but perhaps not banks that are too well capitalized.
I mean, the biggest issue is something like a narrow
Armand,
bank
before
is
you jump in, just wanted to give people a quick update. Armand, I'd love to hear from you on that question that UIC just put up, but just want to let people know that I posted up in the Nest, Asia is set to open and it's down significantly because of the fears of the contagion continuing to spread into global markets. Sorry, Armand, go ahead and answer. I apologize for that.
No worries at all. That's a big deal. So I was just going to say the reason that something like a narrow bank doesn't work for the whole economy is because you need, like, if you think about it, if everybody had that money in a narrow bank and that narrow bank put their money in the Fed, literally the only entity that has access to any capital is the federal government. So, I mean, I guess if you want to produce communism, I guess that's a path, but like, fractional reserve banking is really, really tricky to manage with. You have to raise rates, decrease them, a whole host of regulations, but it's the way that you generate, ideally like loan activity, business investment, innovation, all of that.
I think it makes a lot of sense. I mean, capital formation, of course, can't happen really without leverage, or at least rather leverage helps speed up the rate of capital formation and ideally innovation. But then I think it goes back to the question of productivity growth, right? All the increase in money, where is it going? Is it going to productive assets like companies that might produce productivity gains? Or does it go into overvalued houses and other assets like large TVs that are much more discounted, or NVIDIA graphics cards that you can get for much cheaper than you could get a year ago? So I think that's an open question.
Just Trevor, before you jump in, sorry, this Asian market thing is developing. So if other people can start keeping an eye on what's happening, it's dropping pretty quickly. It's now down. It's pre-market, but it's down about 2 to 3%. Which, if anybody knows Asian markets, specifically Australia and ASX, but it's pretty big. And so, just want to let people know that we're going to see some effect of this spreading continually. We saw it go from Silicon Valley to regional banks to the generalized banking sector to Credit Suisse. And again, can we say it was a contagion effect? Probably not. It was just bad timing, possibly. But actually, that's my question.
It's definitely contagion.
Rob, technically, Credit Suisse we've been talking about for how long? Right? Like, months.
I know. I do agree. I'm not suggesting that the events aren't a contagion. I'm suggesting that the contagion has got into the psyche of everybody in the market, which is a contagion. It's just maybe not found on
and this
a series of unfortunate events, but the contagion is established in terms of the markets are spooked, and we're now entering the fourth consecutive day of spooking, apart from a weird rally Tuesday where the European markets were flat. America was up because it had a bit of a refresh, and the Asian markets were flat. So we had a flattish day on Tuesday. Apart from that, Monday, Wednesday, and now looks like what's opening up in Asia on Thursday is going to be down.
I just want to quickly note. Oh, go ahead.
Go ahead. I was just going to say something very brief. Two things, actually. First, Stock Talk, trying to bring you up, man. Would love your updates on the Asian markets.
I've sent you through an invite. And also, in terms of Credit Suisse having issues, but whenever there is a contagion, the sick fall first. So I just don't think that. I think that both points are true. That Credit Suisse has issues. Credit Suisse was dead a million times over the last decade or so. But at the same time, the contagion, it's one of the early ones to fall, if we can call this a contagion. But yeah, go ahead, Arno.
I was just going to quickly clarify that I feel like we have sort of two tracks of contagion. The first contagion, which we seem to have contained, is sort of just withdrawals, right? Like we're not hearing about more bank runs, but even though that seemed to have gotten calmed down, it's caused a panic in the equity markets. The contagion is now not happening in terms of people pulling money out of banks. It's happening because people believe that the banks aren't worth as much as they are, and the value of the people are selling off their assets.
Armand, if you don't mind, I wanted to just add a layer to this conversation. I haven't heard someone kind of touch on this, but if I were to bucket sort of the first leg of what's happened so far, it's all generally been rates driven, right? The held to maturity assets are worth less because you had a big move in interest rates. I think where this seems to be evolving into is now credit risk, not just interest rate risk. So, essentially, if you have less deposits at regional banks, there's less money to be lent out. And as you lend, there's less credit available. You could theoretically see defaults of people who live on credit, companies, small businesses. Eventually, you can even take that down to large corporate issuers, right? So if you just look at where the high yield index is today, triple Cs today are borrowing at north of 10%. That's very hard to pay that kind of interest on borrowings. So I'm just watching this evolve from what was interest rate risk primarily driven to more credit risk, and what that really means for growth, global growth, but also what that also means to unemployment.
Yeah, I'm just going to jump in as well. Just there is two types of contagion. The first is, you're absolutely right. Deposit contagion was broadly speaking resolved by Sunday evening, although there were deposit movements to big. The second contagion probably was preemptive as well, with the president's words when he said that and quite rightly, but he said, and probably a bit unnecessarily, because it was obvious to everybody who owned shares in banks that was the case, that shareholders wouldn't be bailed out, and that was at risk. He was obviously doing that for public appeal, but in doing so, he's definitely spooked the market in terms of ownership of the risk and deposits. So we've now got lots of money moving around, and deposits are broadly protective, but we've also got this sort of generalized risk, which is now clearly that's the psyche that's spreading. You've then had Credit Suisse add to that, and other people. We've now got other central banks, having to voice that they're willing to provide liquidity to a top 50 global bank, that might be in trouble, whilst all saying everything's fine, but we'll bail it out if needs be, which is a bizarre thing to say, but everything's fine. And so that's the second contagion. Is definitely a psychological one in the minds of the people who own the shares in these banks, the owners. That's why the Saudi National Bank was straight out there saying, absolutely not. They gave a reason, which was they didn't want to go over the EU's 10% threshold for extra regulatory, but I noticed that they already own shares in other banks that are over 10%. And so it spread risk for them. And so that's clearly not the only reason. I think it's a convenient reason. And so there's just a lot of shareholder spook, I think, in that, which is causing this issue.
Hey, Stock Talk, would love for you to give us a rundown, if you're available, of the Asian markets pre-open. It's affecting. Sounds like banking sector is being affected across Asia. Do you have that up and ready to talk about yet?
Yeah, I mean, I don't have Asian markets pulled up here in front of me yet, but I can go take a peek. Give me a couple seconds and I'll let you guys know.
All right, awesome. I think the big question really is this really around investor sentiment? Like you said, first depositor sentiment. Now we're talking about investor sentiment. There should not be, could anybody give me an example of some sort of infrastructure related reason why there would be any issues in Asia right now? I can't even think
100%.
through that. Trevor, walk us through the logic of of how this is affecting the Asian banking sector.
And Grant's been a speaker in here for a while, and he's well invested in Nashville and other infrastructures. But if you look at where Asia as a whole has invested the majority of their development, it has been in real estate. And they have looked at a return basis that has been correlated heavily with the United States market, right? It's like, all right, if we can build these types of infrastructures around multifamily, around single family, this is going to be lucrative. And I think that the problem right now with Asian markets specifically is that you look at Japan versus China, which are entirely different markets, but you look at Pacific America, whatever, there is a huge bifurcation between what China does and their leverage ratio and what they perceive to be as the economic value and the return of what they're pushing money to be as to what the United States is. If the United States is forcing 2 million people to become unemployed, Grant will have his opinion on that, and many people will, pro or con, invest their money in a certain area to align with that. In China, the national government that funds these like loan underwriting vehicles are all, China is the best place to be. You want to be here. But the problem is that the United States is underwriting a lot of all of the imports that we are getting from China. And if there is a slowdown in US domestic production and we start realizing, oh, hey, maybe it would be at parity or equal or maybe even more advantageous to produce goods in Mexico or the United States, there's a huge trade-off that China has put a long bet on that I don't think a lot of people are talking about. And
so again, I'm struggling to understand why it would affect their banking sector. I understand why it would affect perhaps their your point is that they're banking for the manufacturing sector that then provides the supplies for our real estate. I mean, is that, I just want to understand the thought process here.
Their banking sector has underwritten several 100,000 multifamily units in the greater China area, right? Like this is not a question. You can look it up. You can look at the vacancy rates of massive, multifamily units in China, and it'll show you that, there's a large vacancy rate. I think this is a notion of what is to come. And Grant made point to, and he's been quiet this call, but you look at hot markets like Manhattan and California and Seattle, where there are significant pulls away from less lucrative markets to participate in. And this is why the Southeast has been regionally more attractive for businesses and headquarters to be moved to, because the fiscal policy is different. The same way that any other national institution at a banking level suggests an incentive for you to participate in a region, and you can find the infrastructure and the cost basis to be more lucrative, you will do it, especially in times where it's tough. Not in great times, right? In great times, everybody's sitting back and having a good time. But in times of difficulty, people find more efficient ways to deploy capital, and inevitably what that becomes is an investment into a smaller community, regional area that has more opportunity to yield a higher basis against their capital injected originally. And I think this is the rotation, right? We've seen Silicon Valley is a great example, SVB and other areas. Like, do you really have to be in San Francisco to be funded $100 million to participate in the next leverage of startups? And I think Indianapolis, Austin, and other areas where it's become more exciting for startups to be at, the answer is no. Now the question, I think, is talent, right? And I think this is an entirely different discussion. But when you get back to banking, banks on a local and regional level are willing to invest at a level that JP Morgan may not invest in. And I think this is something to really take home to anybody who's listening, is that you can't go to JP Morgan with, I've raised $200,000 in capital and I've lost $50,000 over the year, and raise capital from them. They're not going to do it. But an angel investor in the local or regional market may participate. And if they do participate, it's a vote of confidence of appreciation of value in that specific space or that sector that is being underserved. And the rotation out of places like New York and San Francisco or Seattle and Chicago, like we're seeing, into other regions is really kind of pushing the narrative to, are these services and products being undermined by, wow, how quickly can you move into the next segment and make more money?
So, Trevor, I wanted to kind of go back a little bit to the Asian banking sector and trying to understand why, again, going from, we understand, and it's really, really hard to figure out still. For me, I think I understand the Rob, your point around going from, this is primarily sentiment and headline driven, but why it's spreading to Asia, Rob, will be helpful to get your thoughts.
So I'm not as attuned to Asian markets, although we do have some exposure to Asian markets. The primary reason, there'll be two. I would guess, just on a basic psychological level, there might be a third one creeping in, which is North Korea's got active drills and firing missiles randomly at Japan around the Japanese coastline today. So that might be also causing some disruption there. But broadly speaking, if the American market, the undeniable fact is the reason that we have such a tricky relationship with particularly the Chinese, is that we're so intertwined with each other. It's pretty much impossible for a huge event and the last few days to happen in the US markets without that spilling over into the European and Asian markets. I think we're probably just seeing that play out. And a lot of that, in fact, all of it, I think we can all broadly agree that very basic maths is not adding up, and that very basic psychological needs of people are not being met. People feel panicked. And so I think in the Asian markets, it's probably just reflective of that. They might also be seeing some deposit movements, because at the end of the day, if you look at China's real estate problem, the fact they have a huge issue with banking and their currency is not exactly the most stable at times, then you're probably looking at confidence in general just waning on all aspects. They're probably just reviewing all aspects of that, and it's causing some uncertainty, and that's going to cause price fluctuations.
Rob, if you don't mind me, I'm going to put Tyler on the spot here because he's been spending a fair bit of time in the Asian markets himself. Tyler, do you have any thoughts on what's going on in Asia in general?
Tyler, are you there?
Hey, I don't have anything in particular right now, but obviously I'm watching it very closely. I don't see any reason why, this is going to stop. And I think ultimately all the central banks are going to have to bail out their banking sectors. And
do you think it's going to break in Japan specifically? Topics is down now 2%. But is there any specific, in Europe, people are looking at Credit Suisse, here, obviously Silicon Valley Bank, First Republic. Are there specific banks that you're watching closely?
Not that I could say at this time, but I'm obviously bearish on the whole area.
Yeah, I mean, it's fascinating. If we start seeing more bailouts, it's going to be quite. I mean, it's just confusing about where this is going. Is this just shoring up deposits for now? Are there going to be bank runs? I mean, if you're sitting in Japan, and this is kind of what I was trying to get to, so I'll just say what I was thinking. If you're in Japan and you have millions of dollars, are you moving your money into different banks right now? Largely, just like we have had a flight to quality in the U.S. from local regional banks. I'm sure Grant started moving his money into the big banks. People are doing flight to quality right now across the banks. Are we going to see the same thing? They have Chase in Japan too. You know what I mean? And ultimately, are we seeing a flight to quality even in those banks?
I don't.
Yeah,
Yeah,
there's
I
actually
think
something interesting about Japan in particular, and I actually have a friend who works, in investing in hedge funds in Japan. He's Japanese American, but he's lived there for a decade. So he tried, of course, given what's happening, he tried to he's trying to move his money around in Japan, but it's kind of incredible because Japan still relies on good old pen and paper. It's one of the few countries that's still do, and it's extremely conservative. Wire as long as it works, right? As we saw with SVB, which didn't work for us last week, but that banks are actually just he couldn't figure out a way to move money around, right? It was kind of like going around in circles, and he'd go to the bank teller. He had to actually physically go to the bank, and even then, he wasn't able to do things because of a variety of reasons, which I'm happy to talk about. But broadly speaking, the bug suddenly becomes a feature, right? The sort of bureaucracy around Japanese banking now becomes a feature in a world like the one we're experiencing now.
And just to add to that, I mean, deposits are moving around. We have KYC rules, and the Japanese have got some really killer ones in terms of if you're a foreign national and you're trying to move money in and out of Japan, it's like you have to it feels like you have to go to like a seance and pray to whatever money gods they've got in terms of getting money moved on a reasonable time period. If deposits are moving around right now, which they are, it's undeniable, and they're flowing into people, these deposits can be held whilst KYC is being done. That's going to be slower, whatever. So any sort of money movement into markets is going to be trickier anyway, just because the money's being held whilst these people get approved for account openings and God knows what else. So there's going to be tons of reasons why markets are down. It's not the overarching though. I think will be people just don't feel very safe, and so when they don't feel very safe, they move things around. And what's happening is they don't feel very safe in bank stocks because US banks, which are like gold standard of banks, are questioning whether or not they need to shore up deposits in some of the largest institutions. Everybody else looking at that's going to go, well, what about my position in Credit Suisse, or what might my position in whatever the bank is, and they're going to flood out of that and into whatever they feel safe in. And that's really, at the moment, there's no clear path as to what the safest place to put your money is. So it's going to go scattergun. You're going to see people rush into crypto if they think that's safe. You're going to see people run into gold if they think that's safe. They're going to see treasuries. You're going to see lots of things that aren't stocks, and they certainly aren't banking stocks. And I think that's just flooding over into Asia. It's going to keep on flooding. The big thing for the central banks is they can't contain it within the next, let's say by the end of the week, they can't get a real wrap on it. Certainly by the end of next week, we're going to see quite a slow continual burn on this, because I don't see how the sentiment changes without something big. And to do big, they have to be able to afford it, and that's going to cause huge problems in treasuries. They've really cornered themselves, and I don't envy any of these central banks' jobs who are having to provide liquidity for Credit Suisse, as if they were thinking, even in their position, as if they were thinking that. I think Asia's just woken up and gone, what the heck happened overnight? Okay, well, I'm moving my stuff to Bitcoin. What are you doing with your money? And that's just what they're doing.
Yeah, I mean, it's fascinating. Is this really just that was what I was trying to tease out. And again, we don't know yet. I mean, Stock Talk messaged me on the back end and said, look, this is similar to what we're seeing in the US right now. So it's, we don't know if it's investor sentiment or if it's actual deposit changes, but just thought it was interesting that we're starting to see Asia wake up, like you said, Rob, and be upset. Another sort of,
remember Asia, I remember Asia woke up after the, after the good news. Like, we saw the National Bank of Switzerland step up and offer support for Credit Suisse relatively quickly. So I thought, wouldn't that mean, maybe Stock Talk, if he can hear me, he's on the panel. Yeah, he is. A Stock Talk, shouldn't that mean that the markets should respond more positively in Asia if considering that the support is there? No, he's not there. No, cool.
I'm just going to, sorry, Matt, I'm just going to say on that, absolutely right. Technically, that means the bank's been supported. So that you can feel more comfortable that the liquidity is there. In reality, though, how many human beings think that logically about their own financial position? Whether or not that's your job, where you're managing other
No,
people's funds and they're emailing you or whatever.
but Rob, we're talking about equities now. We're talking about stocks. Like the response after the support for Silicon Valley Bank was astonishingly positive. Like everything
But
rallied
only
like
for a
crazy.
day. Yeah, no, I'm talking about stocks. If you're in a position where you're managing your money and that's in a banking stock instead of cash or Bitcoin or whatever else, and you've seen the central banks have had to step in, which, you know, even the fact they're having to release statements that the banking system is secure means that they probably don't feel that fundamentally. There's an underlying issue, and you're sitting there owning it as a bank owner. You know, I own the bank today, whatever, how many shares of that. I'm going to sit there and go, wow, the deposits are moving around. I don't understand this well enough. And from a fund management perspective, or whoever, pension fund, they're not going to sit there and hold these huge. Even the Saudi National Bank, which is flush for cash because this oil situation is going, actually, no, I don't know what's going on in that bank. Now, if the Saudi National Bank doesn't know, if the chair of the Saudi National Bank says he doesn't know what's going on inside Credit Suisse, and then the CEO,
well, I mean, I would hesitate. One thing I'd push back with on that point is that the Saudi National Bank's refusal to dump more cash into Credit Suisse wasn't purely a function of them not knowing what was happening. It was a function of them not wanting to take a greater than 10% ownership in the bank, which would introduce a host of new regulatory concerns. But
yeah,
you know, on the equity reaction,
I do agree with what he said, but the tone was the first thing that came out of his mouth was absolutely not. And then he gave a regulatory reason, even though prior to this, the Saudi National Banks held more than 10% stocks in European banks. Now, I don't disagree, but that's not exactly him. And the CEOs basically said, we don't know. Yesterday, into yesterday. On Tuesday, it was good news. We thought it contained. Then Credit Suisse comes out with this information. If you hold banking stocks around the world, you're probably just not thinking, I have huge amount of confidence in how this goes. And I think also people are still kind of burning a bit from 2008. It's still ringing a hole in their ear a bit. And I think they think any fragility in the banking sector means that we're back in 2008 again. And the problem with that
that's what concerns me. That's what concerns me.
Yeah, the reality is that we're not in 2008, but in people's mind, perception is reality, and if they perceive that we are, we kind of are in many ways. So I think that's probably what we're seeing with bank stocks.
And just to add some sort of layers to what Rob is saying, that the typical hedge fund manager, when they look at the world and they see a whole bunch of unknowns, in this case, the big unknowns are how does this affect growth? How does this affect unemployment? Those are the big unknowns at this point. The first reaction is take gross exposure down, right? It's not add exposure, it's to take gross exposure down. And the way you take gross exposure down is reducing longs and shorts, and to having less exposure to the market in general. That's what you normally see.
So guys, Vinny would love to hear from you in a second, but I was going to tell you that unfortunately, it's very sad, but Cramer just came out and said that the Fed is going to have to take drastic actions and that it will be awesome for your portfolio next week. I'm so sorry. Everyone's portfolios are going
to needs to be banned from Twitter, doesn't
he? So inverse Cramer, which is more predictive of the market than Cramer ever has been, means that next week is going to be awful. Vinny, go ahead. Sorry.
I mean, yeah. So I think this is very different from 2008. 2008 there was a crisis because obviously the value of the assets the banks had in the books was, we weren't as high quality. A lot of mortgage-backed securities, which was said to be AAA rated, but weren't actually. This is a duration issue, and the counterparty risk between banks is they didn't trust each other because they didn't know what was sitting in the balance sheets, and so we're in this borrow short, lend long environment right now, which is very different to I don't know how you would characterize 2008, but. That really means this is the current banking crisis is a liquidity issue because the Fed basically yanked all the liquidity out of the market and changed direction. If you look at the direction the way they changed, it was a full 180 degrees in a year, and that just that whipsawed everyone. And the only real play right now is Fed to say we're not raising more rates or do a small raise. 25 is what I expect. and then we're going to pause for a while and see how it plays out. And these, and the duration on these, you got to hope for some like I don't know, some sort of unwinding of these long duration securities in some way. I don't know how they're going to do it without the market pricing in, and it already is pricing in back down to the threes, the three handle by end of the year. So market's pricing in significant cuts, and that'll alleviate some of the problem. But the systemic issues, I think, like if you look at individually at Credit Suisse, look at Japan, look at other markets, I don't see how these things are related. And so someone can enlighten me on that. I don't see how it's all linked to the interest rates, obviously, because it's created stresses for the bank. But I don't see how Contagion spreads out of the U.S. regional banking system into the rest of the world.
Well, Vinny, I think Vinny, could it not just be flight? So just a second, I'm sorry. Stock talk. Go ahead, and then I'll go.
Yeah, it's not the actual objective contagion that spreads. It's the fear in depositors and shareholders that spreads, right? There's a big distinction between central banks or the FDIC guaranteeing depositors beyond an insured amount versus the government protecting shareholders of these banks. And so what happened after the collapse of Silicon Valley, and everyone was waiting for the US government's response, the second the US government came out and made it very clear that they'd make depositors whole but would not protect investors in Silicon Valley or in Signature Bank, the narrative for investors around banks changed more than it did for actual users of bank or depositors in banks, right? I mean, sure, we saw plenty of clamor and noise around the idea that there were bank runs, and conceptually, I actually think that's worth talking about, how much easier a bank run is today than it was in 2008. But outside of that, I mean, it's really the shareholder narrative that's driving the move in these banks. When we wake up in the morning and we see U.S. bank stocks trading down like they did today, or like they did on Monday, or like European bank stocks did today, or like Asian bank stocks are doing now, it's shareholders that are driving that move. It's short sellers and shareholders who are driving that move based on a shift in perception of risk. If you're a shareholder in any of the big four, or you're a shareholder in any of the major banks, you know that the chances those banks face an insolvency issue as a result of their exposure to treasuries is much, much lower. Because what happened to Silicon Valley Bank was 42 billion withdrawal requests intraday, right? And that forced them to realize the losses on their treasuries that they otherwise wouldn't have had to realize. So, I mean, we can point to these structural issues and say, look, the move in rates has created this international conundrum in banking where banks are faced with, this hold to maturity problem versus realizing the losses. But that trigger really only hits if you see the type of withdrawal volume that you saw. And keep in mind, that doesn't happen every day or every year or even every 10 years. In fact, that never happened in 2008. The biggest series of withdrawal requests in 2008 was Washington Mutual's, 16.5 billion over 10 days. It's 42 billion in one day. So I think that there's kind of a conflation of the issue here in certain respects, but also, more importantly, it's not the risk or it's not the objective idea that, hey, a problem with Silicon Valley Bank could spread to Credit Suisse. That's not what happened at all. It's the idea that any bank today with any sort of potential solvency issue, any kind of signal in the credit default swaps from the market, any kind of potential issue with treasury exposure is going to be exposed quickly by the markets. Now, I don't believe in perfectly efficient markets, but they're pretty good at identifying these things. And short sellers will launch campaigns and jump on top of these stocks at even the blip of the slightest sign of weakness, because you've added an element of binary risk to owning any regional bank stock in the world. And somebody made this point earlier, and it's a point I made in one of the previous spaces, but there is not a bank on earth, let alone the United States, not one bank on earth that can survive 25% in withdrawal requests, right? You just can't. It's not the way banking works, commercial banking at least. And so there are structural issues I think that you need to identify, but when you're looking at the contagion spreading into markets, that's not depositors spreading that contagion. That is not an actual objective systemic issue that's spreading that contagion. It's simply shareholders of the banks that are fueling that contagion in international markets.
All right,
Well,
guys.
also, I
Yeah,
mean, banks also
wanted
have
to-
counterparty risk to each other, right? That's where all this
the
stuff.
counterparty risk. It was what happened today with. I mean, we saw BNP do that with Credit Suisse. But guys, just wanted to make sure that I just put it up in the nest. I don't know. I'm looking at the story, and there's one clear sign of it. But Virgin Orbit furloughed all of its employees and shut down today. So Virgin
I don't know if
Orbit
it's shut down completely. Dan, the CEO, I know quite well. Well, I say quite well. That's not true. But look, he's put up on his LinkedIn. I think I saw that, or somebody's tagged him on his LinkedIn that they're looking for emergency funding, which would be incredibly sad if that goes, because I think that could be a good British. No, to plug in the British for a second, a good British American venture, but they haven't been able to get it up.
Let me share what happened exactly, according to CNBC. So agreed with you that they struggled to raise funding, but it was interesting how this all played out. So Virgin Orbit pauses operations for a week. That's what they're saying. Furloughs, I mean, when you pause your operations for a week, but then furlough the entire staff, things aren't looking great. Company executives brief staff on the situation in an all-hands meeting at 5 p.m. Eastern on Wednesday. And company had $71.2 million in cash on hand at the end of the third quarter, with a 42.9 million adjusted EBITDA loss. Of note, and this is the main point that I was going to get to, and this is kind of talking about how one part of the system affects the rest of the system. Since the fourth quarter, the company has steadily brought in funds in the form of debt from Virgin Group. They raised 25 million in an unsecured note. Then they raised 20 and then 10 in December and February. I guess debt is no longer as easy to get. So,
by the way, also the stock, Virgin Orbit is public. VORB is the ticker. It's down 35% in after hours right now as well. It's at 66 cents. So a very small company at this point.
How is it only down 35% when they've got rid of all their staff? How is that not going to how?
Oh, because because they technically have only paused operations for a week. So there's people that are holding
go
on.
home, everyone. Okay,
exactly. But then they furloughed their entire staff again. I don't know how related this is. They must have been looking for a debt facility. As everybody knows, interest rates have been so high, they might not have been able to secure a debt facility, especially one that's a convertible debt facility. So, which is what they've been working off of, which is convertible notes. And so, I
think maybe this is the wrong week to be asking the market for debt. I just think they've fallen, their cash flow problems have hit on Monday, and they're all like, oh, damn, we're going to go to Silicon Valley Bank for the loan.
Rob, I'm glad you brought that point up, even if you did facetiously, but that is, to me, when people talk about contagion and the real implications here, in the very, very short term, volume of lending is the primary concern here. To the extent that you believed, and some people believed we were headed for recession at the outset of this year, others didn't. But to the extent that you had X probability assigned to that, that probability should have gone up broadly, because look, and again, I'm not guaranteeing we will or won't have a recession, but the drop off in lending volume and the extent to which lending standards have been tightened over the last 8 months is one of the most dramatic ramps in modern U.S. history, because the ramp in rates has been so aggressive that it's spelled a consequential effect for lending volumes. And if this event in banks globally is any indicator, then those will just tighten further. And that, I think, is a factor to consider about in terms of global implications. If lending becomes tighter and tighter and tighter, headed into an economic slowdown that is already being engineered by monetary policy, that could be a collision path that we don't want to be on. Now, I don't know the extent to which they actually will impact. It's very hard to objectively measure that in the short term. But that, I think, is a big thing to take away from this. And the second thing, and maybe a deeper issue, is that after banks have been exposed to this ramp in rates, they've kind of come to the realization, or they should have, that the buck's got to stop somewhere. I mean, either banks come up on their return for depositors, or every time this happens in the future, depositors are prepared to know, look, I can just move my money to money market funds and get an actual return on my money versus giving it to a bank who's going to take my money and do that with it anyway, except I won't see any of that return, right? I mean, banks can't afford to keep giving people nothing on their deposits if these types of move in interest rates are going to become regular, because it's already exposed a risk to the U.S. banking system and the global banking system that should have been obvious. But now all of us are sitting up here talking about it like this was a known quantity for banks globally. It wasn't a fear, because the idea that you could have 42 billion in withdrawals at a hair trigger is something that just happened in the last 10 years. And even people who went through 2008, you have tons of people who went through 2008 who are coming up here and preaching about, the likelihood of a bank run or the fragility of the banking system. But there's no credence being given to the fact that the digitization of banking has dramatically changed the very concept of a bank run. It can happen in 5 minutes today, where it used to take 6 hours of people lining up and banging on teller windows. So, these are the big takeaways, I think. What's the impact on lending volume? What's the impact on the returns banks will be forced to offer to depositors in the long run? What's the impact on the general exposure of banks to U.S. treasuries? What's the broader impact of U.S. treasury demand in general as a result of this? Those are the objective things that we can talk about that will actually have implications, rather than a lot of this, fairy tale stuff.
Yeah, Ram, would love to get your thoughts on this. I mean, we see Virgin Orbit, and before Ram, you go on, just wanted to plug the newsletter. Check it out. It's up in the nest. Ram, one of the big questions that I have is around, what does this mean? I mean, America, I don't want to say is the world's bank, but we're sort of, especially with Silicon Valley Bank being such a big debt provider. Now we see Virgin Orbit go down. They couldn't secure debt to keep their operations running. Or is this the real contagion? Is this the real concern, just like Stock Talk mentioned?
Well, let me, first off, the debt cycle and the default cycle and the debt cycle is going up. That's not a surprise, by the way. Even the ratings agencies know that. It's been forecast for this year. Look at Carvana. That's another example of an issuer in the debt cycle. But let me zoom out for a second. I want to first go back to Stock Trader's excellent point. I've also been focused on this, which is there's a central tension between the regional banks and the Federal Reserve. And this is the tension. If the regional banks don't raise interest rates, then deposits move to money markets. Here's the issue. If the regional banks raise interest rates, they lose money. The Federal Reserve is losing money now, because the break-even interest rate for the Federal Reserve not to lose money is 3% on the Fed funds, and it's approaching 5%. The average return on asset for a regional bank is around 2%. The Vanguard money market fund is 4.5%. So to make incentives neutral for a consumer, the regional bank would have to be upside down, and they cannot do that. So the higher rates go, what happens is regional banks break in two ways. The value of their loan and securities portfolio drops. We already saw that last year, and their mortgage and treasury holdings. And of course, that led to the issues around the banks we've been talking about blowing up last week. But also it means their earnings drop. So that's why the Fed is in this checkmate position. On the other hand, if they lower rates, then inflation continues and they lose their credibility. That's the number one thing to focus on, longer term in markets. Shorter term in markets, what's happening is really incredible, of course, around banks. I'd like to kind of focus more on market reaction and is this another 2008 and the banks. And let me tell you what I'm seeing there. So first off, what happened this morning is you had a sovereign, Saudi Arabia, say they're not willing to invest more in Credit Suisse. They're not willing to go past their 10% limit. We don't know the rationale.
Hey, Ron, sorry, before I'll let you continue, but just not to interrupt, just a headline here. Credit Suisse to borrow up to 50 billion Swiss francs from the Swiss National Bank as an immediate step to shore up liquidity. So just wanted to throw that in there.
Yeah,
but go for
thank you.
I pinned it in the cup.
So look,
everything's fine here.
My headline on markets is that this is fear and lack of liquidity trading. So there was a headline came out that the sovereign that oversees Credit Suisse is providing liquidity to Credit Suisse. And that's exactly the point you raised. So CS has access to liquidity. And of course, it's part of the bank resolution regime. So if shareholders get destroyed, that's not going to impact the banking system. So I think CS is the cause for the fear today, but I believe that fear is misplaced. That's one headline. If you look at European CDS index on senior financials, it's widened, but it's not near 52-week highs. Now in the treasury market, you're also seeing this panic, right? The 10-year got as low as 3.4%. By the way, last week was 4%. These are massive moves in the most significant fixed income market globally. And the 2-year just finished off the lows, down about 35 bips after already making a record decline. Again, the 2-year was at 4.5% just 2 weeks ago, and now it's like 3.8%. So this is price insensitive buying. This is when people are willing to buy treasuries without accounting for the yield and they're buying any price. That's price insensitive buying. That's indicia of fear and a flight to safety. So that's my big read on this. I think tactically financials are attractive now, although that larger tension around markets and the Fed is a legitimate issue to be mindful of.
Sorry, did we lose Ram in the end?
I got a phone call come in.
Yeah, I thought it was.
Hopefully that was helpful.
It does.
Ram, I've got a question for you.
Pretty big, by the way. They're kind of
Yeah, the Credit Suisse news is
$50 billion.
Yeah,
France is about $53 billion USD. Just quickly.
Yeah, and it's so quickly as well. Like I wanted some thoughts on this. Like we were just talking about. Like it started off with some fear, and then the national bank came in and says, "Hey, we're happy to jump in, but it's not needed." Correct me if I'm wrong, but that's what I remember. And then a few hours later, like throughout this space,
that seems to be more of a political statement that was initially made by this.
Yeah, I know. It's always like it's just like when they make these political statements year after year, that now no one listens to them. It's like when they make those statements, the opposite effect.
Believe them. No one's going to believe. I mean, the Swiss National Bank statement from earlier this morning, for those that don't remember, was, let me go back and read the exact statement. The Swiss National Bank and the Swiss Financial Markets Supervisory Committee assert that problems at certain banks in the United States do not pose a direct risk for contagion to the Swiss financial markets. And this part is, I guess, the exact part. The strict capital and liquidity requirements applicable to Swiss financial institutions ensure their stability. Credit Suisse meets the capital and liquidity requirements imposed on systemically important banks. That's obviously fucking bullshit. If they said that 9 hours ago,
okay.
Now
Okay. So this is where I want some clarity, Ram. Stock Talk, can you do me a favor? If you can send me through the article that you just read now, or the quote, just copy paste exactly what you sent me, and then Danish, if you can send me as well the announcement that you just read out, because I heard it, I had you on speaker and I heard it and I came back on the headset. Because Ram, for the speed in which things are moving, is that common? Because I'm not going to compare it to 2008, but I'd love your thoughts of how common it is.
I'm going to take I love Stock Trader, I love the takes. I'm going to take the other side of that. So look, after 2008, the Basel regime instituted globally in this global coordinated harmonized campaign to raise tier 1 capital liquidity ratios for banks. And it's true. For example, over-the-counter derivatives, which destroyed banks in 2008, they don't happen anymore. They're centrally cleared. They go through a clearinghouse. Banks are really boring as compared to they used to be. So what they were doing is reassuring markets. They're saying, hey, we're here to supply liquidity to CS if CS needs it. CS is saying, oh, we don't need it. So I think here's another kind of fun fact to look at. I was looking at Charles Schwab data today. And by the way, Charles Schwab is, I think this is publicly known, as one of these banks where they've got significant losses in their hold to maturity portfolio. Like they're insolvent if you mark to market on the bank side, not the brokerage side. Keep that in mind. So if you've got funds at Charles Schwab brokerage, you're going to be completely fine. They're segregated, right? But here's the interesting thing. So if you look at Charles Schwab's deposits, their deposits declined 20% year over year. And their money market fund went up 170%. And that's what's happening. There's this movement, a slow movement. It's not a bank, it's like the slow migration from deposits to money markets. Now imagine, look at Customers Bank. Customers Bank is a regional bank. They don't offer a money market. If money market was offered at Customers Bank, they would lose deposits and they couldn't use those deposits to fund their assets. Because once those deposits go into a money market, then it's in a securities and brokerage account. So banks can't rehypothecate with that. That's a very key idea to understand about how the banks work. And there's this competition taking place between capital markets, the bond market, money market specifically, versus banks.
Yeah, I mean, it makes it very complicated because obviously they have to chase yield, right? But I'm just very confused right now about where we go from here. If we're gonna just keep bailing out the banks, then are we gonna over-regulate them now? I mean, like that's like
no. So the banks, the equity shareholders, all these banks will be zeroed out if they make mistakes. No equity bank shareholder has been bailed out. Customers, like depositors, are being made whole. That's it. And the depositors being made whole, that fee to make them whole is being assessed against the banks themselves, against the banking industry.
So I understand that, but this move by Credit Suisse or by the Swiss, I mean, isn't this effectively a bailout for the shareholders too?
No. So let me walk through how credit facility works. It's a good question, right? So like when the Federal Reserve announced they're providing a credit facility to First Republic and also JP Morgan's, let me just kind of walk through what happens there. So JP Morgan has high quality liquid assets like treasuries and mortgage-backed securities. That's a well-defined regulatory term. It's called HQLA. This also came out of the 2008 crisis, right? The regulators got together at Basel and they said, how do we make sure banks don't blow up again? Let's think through a regime. And they said, hey, banks, you got to have these high quality liquid assets so that you can sell them if there's a bank run, which has happened now. But banks also have to make loans in their communities, and securities are not loans to the community. Securities are loans to like Apple and Google. And really loans are what drive small business credit creation and growth, let people get homes, cars, and other things, and cell phones, right? So what happened is the HQLAs, as we discussed, the rates went up and they lost a lot of value last year. Now you have a bank like First Republic, and what does First Republic do? They have jumbo mortgages. So a jumbo mortgage is a mortgage that's not liquid. It's a mortgage that Fannie Mae or Freddie Mac will not buy because it's not what's called a conforming mortgage. Conforming mortgage has very specific rules. The size of the mortgage, the underwriting, the amount, the interest rate, it's got to be a 30-year fixed rate or 15-year fixed rate mortgage, right? Not jumbo mortgages have non-standardized terms, so Fannie Mae and Freddie Mac won't buy that. What that means is those jumbo mortgages are not liquid, and that's the issue. So if you have a bank run, you can't sell those jumbo mortgages, even if you're making money on them, okay? Now, of course, rates went up, so they took a hit on that. So what JP Morgan said is, hey, First Republic, we like jumbo mortgages. JP Morgan's the best bank in the United States, actually, for their mortgage business. They have a fantastic mortgage business. They said, look, we're going to give you a credit facility. And here's how the credit facility works. They'll say, we're going to give you, say, call it, I'm making up numbers now, a $20 billion facility. And the way it works is First Republic can put their jumbo mortgages that meet qualifying terms, okay, into this credit facility. And then JP Morgan will advance a portion of the face value of that mortgage back to First Republic. Simple math. First Republic puts in, say, $20 billion in mortgages into the credit facility, exhausting the credit facility, and then First Republic gets $20 billion. It's a loan from JP Morgan. That's what they're getting. It's a security
I get
loan.
that, Ram. But let's play hypothetical here because I get exactly what you're saying. But had they done the same thing with Silicon Valley Bank before they took it out, wouldn't that have saved Silicon Valley Bank? I'm just being honest.
Yes.
Yeah. So therefore, I'm just saying that they're concerned and they're doing. That's what I meant by a bailout. I know people don't like that. They're giving backstop, whatever you want to call it, whatever is politically convenient right now.
I don't think
in reality. we're essentially bailing these banks out so that so that depositors.
We have just bailed the shareholders out for sure. But I'm just going to push back on Ram. I get what you're saying on the technicals. 100% right. They have not provided any direct financing or assurance on financing or de-risking to shareholders. What they have done, though, is they've created a scenario where the bank can't fail, which is a direct benefit to the shareholders, which I think is the point.
The equities
It gives them time to get out.
Wiped out. Hold on, the equity shareholders are wiped out, right? But
yeah,
the
an
jobs
SVB, but like if Credit Suisse was not getting liquidity today, what we're saying is if Credit Suisse, if SVB had got liquidity prior to close, the shareholders wouldn't have been zeroed out over the weekend.
Exactly.
And this would have resolved as they would still have equity in that bank, and they would have been able to sell that or recondition it however they want to, and the bank would have survived.
And then there's no value judgment here, right? Like I get it, Ram. Like, you know, there's no value judgment here. But First Republic, and I don't want to hate on First Republic. Please don't do bank runs, guys. We're not pushing bank runs. My point is that you know, First Republic, it could have just as easily has shut down had this discount window not been opened, or they wouldn't have put this backstop with this new fund, correct? I mean, like, they literally needed the money from JP Morgan.
First Republic would be gone without this credit facility. But here's the thing. Look, so SVB, just to be clear, it was both solvency and liquidity. Both solvency and liquidity. And that's the key. That's why
the same as Credit Suisse.
Well, we'll see. I don't know. I haven't looked at their balance sheet. If it's the case that they have negative equity value, that's the first time I'm hearing that. That might be the case. I've not heard that.
Not completely negative, but it's certainly not the value of the bank.
Right. It's a $5 billion market cap bank, between 5 to 10 billion. But still, the markets are assigning positive value to it, right? Even though they've destroyed the market cap, markets are still saying there's equity value in that business. The book value, I believe that's positive. I mean, so Credit Suisse has got an asset management business, structured products business. They shut down their trading business after 2008. Again, because of all these regulations that are punitive on these investment banks. Morgan Stanley is a wealth management business. It's not really a trading business anymore. So the regulators aren't bailing out the equity. If the equity is worthless, then then the equity at some point in time, would get wiped out. What they're doing is creating liquidity for those illiquid assets. Like what the regulators trying to say is like, you've got a business and something went bump in the night, and you've got assets, your money good assets, but you can't liquefy them. That's the issue. So you've got this temporary market issue, and the regulator's saying, well, should that business go away because of that temporary market issue?
That's the same problem that Silicon Valley Bank had.
SVB was an outlier in so many ways, guys.
No, I understand. I don't know if you heard me earlier. The concentration of risk, the fact that they had all of their deposits were greater than 250K, 97% of them. I mean, there's like a lot of other things. I get
and
it.
Mismanagement, egregious mismanagement of the treasury function.
I mean, to be fair, everybody does transformation in that exact same way. I mean, Ram, that's how banks work. Right, like
as
you get short-term liquidity and then long duration. They play that game. That's like they did it really, really aggressively. But that is a common game.
They did it to the level of gross negligence.
I want to go back to the question again. I might be the only one that finds this very weird. Just 5.5 hours ago, I'm going to quote exactly what the Swiss National Bank said. Credit Suisse meets the capital and liquidity requirements imposed on systematically important banks. So despite them meeting those requirements, they withdraw 50 million, they borrow up to 50 million francs, or about the same dollars.
Yeah, that was my point. That was my point in saying that was that was my point in saying that was a political statement from them, because these guys are privy to markets as well. They saw the stock down massively, right? They saw the stories that were floating. They saw what was happening to credit default swaps. So when you see all of that as a national bank or as the Swiss banking regulator, you're like, look, we need to shore up sentiment on the stock, and we need to shore up sentiment on the bank, and that's what they did by saying, look, they're in they meet the capital requirements. Clearly, they were having some kind of liquidity or solvency issue, considering what we saw in the credit default swaps headed into this event, and considering the fact that they're offering to lend them up to 50 billion Swiss francs. I mean, the money. And so clearly, yeah, I highly doubt you would open this kind of relationship between the Swiss National Bank and Credit Suisse at this stage if there wasn't actually an issue. This is an awful lot to do if your only intention is to say, oh, we just want to reassure the markets. I imagine that there was an issue. I imagine that that's what the markets were seeing in short selling the stock and targeting the stock. I think the credit default swaps are probably an indication of that as well. And we know, again, somebody mentioned this earlier, Credit Suisse is a notoriously poorly managed bank. I mean, they've been in the headlines for the last 5 months with just a ton of just terrible decisions, a terrible risk profile. It's been a bad bank for a long time. You know, a lot of my friends joke and call it Debit Suisse instead of Credit Suisse. But you know, it's been an issue for a while.
So let me chime in.
Just also on that, but
Saudi Arabia.
Ron, why don't you go first, then Joe, and then Rob? Go ahead, Rob.
I'll be brief. So here's the event. Here's a chain of events. Saudi Arabia, it was leaked, is not investing further beyond its 10% ownership interest in CS. That was the first event, set against this backdrop of banks blowing up in the background and fears of 2008 impacting psychology. Then the second thing that started happening is crisis of confidence. So customers of CS, which are ultra high net worth investors, say, hey, I want money out. That creates a liquidity pressure, and then that forces CS to tap their sovereign. That's a chain of events, but it's local to Credit Suisse is the point I'm making.
But we're going to keep seeing this, Ron.
Yeah.
Just to fight back on that just a little bit, Ram. Sorry, and I'm sorry to interrupt you.
Go ahead,
the first key event on the Credit Suisse was the fact they announced overnight that they were investigating multi-year, up to 9 years of financial irregularities on top of the 8 existing investigations they already have. That's what triggered the Saudis to say no more this morning, and the CEO to openly admit that he didn't quite know what the total unrealized losses on his balance sheet were, which is kind of his job. So he's kind of, if he was to market now, he wouldn't have a clue what those assets were worth. And he had to sort of publicly admit that because of the banking regulations. So that was the first trade. The other thing is, I can't help but feel like this announcement for the 50 billion has come after the Asian markets open, the futures of opening. And I can't help but feel like they're seeing that this is continuing into the next day. And I wouldn't even be surprised if they don't even need the money at this point. They're just being given it as a real bonanza. Here's money. We've shown you that we've provided liquidity. Shut up. Try and get markets to shut up. They open in the morning.
I agree
would be my guess on that.
No one's saying buy CS. CS is a poorly run, but there are a couple other banks like Deutsche Bank and some of the European banks have got issues too. Yes, that's right. Look, there are banks buying bonds at negative interest rates. So if they hold those bonds to maturity, they'll actually have an impairment on their balance sheet. So I think what I'm trying to focus on is from a markets and investing and trading perspective. So when I look at this, I say, okay, there's a dislocation in CS. There's a panic in the market. I look at the behavior in the bond market. I look at the VIX index, and I see the baby getting thrown out the bathwater with quality names that are actually getting deposit inflows. And I say, that's pretty interesting. I want to take a look at that. That's my kind of broader perspective on this.
Where I'll push back on the narrative a little bit is that, when Silicon Valley went under, the first, narrative that emerged was, look, it's a hyper-specialized bank. There's no $200 billion bank in the world that is this specialized in terms of industry. There are deposit concentration risks. There are risks in the loan-to-deposit ratio. There are risks in their treasury exposure. There's risks in their failure to hedge their treasury exposure. And all of these factors make Silicon Valley Bank a unique case, and therefore Contagion is unlikely to spread. Then the next day we had a huge sell-off in banks, and then we had the Signature Bank as well, grouped into that failure. And then, a couple of days later, we have this Credit Suisse event. And now with the Credit Suisse event, we have people saying, and again, all of this stuff is true, by the way. All the statements I made about Silicon Valley Bank are true, and I agree that it deserves to be made a distinction because of that. But then we're on to Credit Suisse, and now everybody's saying, well, Credit Suisse is poorly managed. The credit default swaps were signaling an issue at the bank for many months, et cetera, et cetera, et cetera. Now, I agree with all of those as well. But here's where the narrative is missing the point, is that in focusing on all of the nuance here and in attempting to distinguish the candidates from bank to bank and say, look, that's a weak bank, or that's a bank with a solvency issue, or that's a bank with a liquidity issue, they deserved this, right? The issue there is that we're throwing away the knowledge that every bank in the world has this issue at its core. Every bank in the world is overexposed to long duration treasuries. Exactly. with their deposit inflows being the only thing that's protecting them from this event. So if we believe that every bank in the world has some sort of potential solvency issue, potential liquidity issue, potential risk management issue on any side of the business, this becomes more a narrative of picking out those things and the market jumping on them, short sellers jumping on them, which is what's happened. And I think that trend can continue. So I think the story should be less about, are Credit Suisse and Silicon Valley one-stop cases? Are they isolated cases? Are they specialized cases? Sure. But I don't think that doesn't mean that the contagion can spread, because I don't think the contagion here is what happened or if other banks share those characteristics. I think the contagion here is the idea that if there are vulnerabilities at any banks in the world during this type of climate, short sellers know that they're one hair trigger away from a massive, massive boost in withdrawal requests, and the same insolvency issue that Silicon Valley Bank faced.
And Ram, before you jump in, one thing I will say is something that Mario said earlier. And as you may have noticed, I never give Mario a compliment, but I will right now. One thing he said earlier was that the sickest banks will be the most vulnerable banks will die first, will get hurt the most. And I think that is perhaps one of the most important parts of this story, which is, again, like any virus, it affects the most vulnerable the most. And I think that is sort of what we're seeing. So Ram, both can be true. There can be a contagion, and it can be affecting the worst companies, worst run banks first. Ram, would love to hear your thoughts.
I agree. Let me reconcile that. I fully agree. Guys, I could tell you the next 5 banks will be in the headlines in the next 2 months. Western Alliance Bank, Charles Schwab Bank. You can do an analytical filter on Bloomberg Terminal and sort by unrealized loss in the hold to maturity portfolio. So in that sense,
what are the other 3? Ram, what are the other 3?
Ram, what the hell, man?
I posted this in a prior thread, like on your space, I think on Sunday, Mario. I'll dig it up. But the point is, look, I agree. Like when the tide goes out, you know that expression. You see who's naked, and you're right. Look, there are the fact that we had 14 years of QE and ultra low rates, and banks were required to buy these high quality liquid assets, and are now getting burned, is a common factor. However, you're not going to see JP Morgan go down, or Bank of America, which took in $15 billion in deposits, right, over the last few days. So that's the point I'm making, is that it's not systemic. When we use I'm trying to be precise in the words. When we say the word contagion, I see this as weaker banks.
But Ram, saying the big four are immune does not mean it's not systemic. Everyone knows the big four are immune.
Yes, I don't think you're going to see. Let's play this out a little bit further. This is great, and now we're getting to the heart of the issue, right? So look, there's 5 other banks that have real challenges and issues, and that 5 could be 8, right? But if you sort the banks in the United States, we'll leave aside global for now, you can identify those banks. So what would cause those banks to blow up if there's a bank run? That's number one, because that forces the realization of these unrealized losses, and then they go away. So the FDIC has showed their hand, and they showed their hand through SVB last week, as well as Signature. They've said, we're going to make depositors whole. And they're saying to the public, you can trust your banking system. So my interpretation is that the FDIC will do what they can to stop a bank run. However, the thing the FDIC cannot control is that earlier issue we were talking about, which is money market funds are more attractive than deposits. And there I agree with you that there's like this corrosive effect on deposits because the incentives are to go to money markets.
Yeah, I mean,
that's
the reason the big four, I think we generally agree. I think maybe just we disagree slightly on the rationale. But I mean, the big four, in my view, are immune, not necessarily purely just because they're seeing deposit inflows, which they are. Like you said, 15 billion to Bank of America over the weekend, and JP Morgan is likely seeing the same thing. But, you know, it's simply the public's inability to differentiate these things. I mean, the public in these types of situations is going to naturally perceive smaller banks as higher risk. It's just logic, right? From a you know, an unscrupulous financial mind, that's going to be the first conclusion. Look, if I have my money at a smaller bank, it's higher risk. I'm going to move it to a bigger bank. So yeah, they're going to get deposit inflow benefits here, right? But the real reason the big four are immune, or the real reason the big four are differentiated from these mid-sized banks or regional banks failing, is because of deposit concentration, right? And the diversity of their deposit profiles. The same way that we saw the risk with Silicon Valley Bank, where 10 phone calls led to $42 billion in withdrawal requests. You can't do that at a major commercial bank. You can't do that at the big four because, you know, they are dealing with, you know, whereas Silicon Valley Bank had 4% of deposits under the $250,000 FDIC insurance, banks like Bank of America, JP Morgan, Wells Fargo, Citibank have 30, 40, 50%, you know, sometimes almost up to 60% of deposits under 250K. So it's a different deposit profile. You know, I made this point, I think, in the first space that we were on. It is much harder to convince 10 million Americans to go withdraw all their money than it is to convince 5,000 companies to do the same thing. It's about, you know, volume of actors that you have to convince into one narrative. It's the same way it works in any other, you know, walk of life. But yeah, that's the reason that they're immune. It's not necessarily because they have managed their treasury risk better. Again, when we push these banks to the point of insolvency, when we push them to be forced, in theory, to realize their loss on these treasuries, every bank in the world is insolvent.
Yeah, well, the major question is this: are there bank runs going to happen or not? Right. So right now, the FDIC is running Signature and SVB, so they're reassuring the public that we're open for business. Don't worry about changing your deposit account. Incidentally, regional banks like PNC Financial and Citizens are also seeing some deposit inflow. So if the FDIC's message to the public is, hey, the banks are safe, your deposits are safe, then what I'm saying is that's going to lower the probability of bank runs, enabling the banks to hold this customer.
All right, Ram, I'm gonna play a different approach here. Clearly, we're seeing this contagion spread. We just saw the Asian markets; they're gonna open lower. As Talk said, it's not, you know, incredibly lower. It's about 2%, which again, as a reminder, for Asian markets, 2% movement is more drastic, especially for the Japanese markets. But so let's say that, you know, that is just sentiment driven. Let's say that Rob's expecting it's largely sentiment driven. What if it's actually not sentiment driven? And what if people in Japan, people in other countries are going to their local banks and they're saying, hey, we don't have the same systems as FDIC does. FDIC is willing to. You want to know what the place is? Hold on.
The point you're making, though, doesn't make sense because the increase in withdrawal requests would not directly reflect on the stock. The stocks.
No, I agree. That's literally what my point was. Actually, my point was that the stocks actually are not reflecting.
Seeing the bank stocks down in Asia, all that means is that shareholders and traders have the same thesis in the Asian markets that they do in the European and American markets.
So just want to be very clear. I'm gonna make sure that it's very clear. What I was saying was, again, that Rob is correct that it's largely sentiment driven. So that 2% does not reflect what's happening at the bank. Just want to be clear. What I was saying was, but in the background, what is not being taken into account is that sentiment is changing also for the depositors. That's what I was saying, that's not reflected in the stock price, right? And there's actually a contagion occurring in the background. That was my main point. Actually,
I don't think we can say that yet. I don't think we can
I don't think we can say that. My point is, just want to be very clear. The challenge is that in other countries, having lived outside the US for many years, you know, a flight to quality can occur, usually there's actually significant disparity between the rich and the poor. So there's actually, like, if in India the Ambani family makes a decision, that bank is fucked. Like, I'm just being honest. Like, we there are specific families that represent a significant portion of the deposits within a specific local regional bank. And if there's going to be a flight to quality that occurs in these other countries, we could start seeing a flight to quality occur again. And that was my only point. We haven't seen any sign of this, but I will say that it could happen in other countries as well, just like we saw it happen in the US with local regional banks. They also have local regional banks. Ram, give me a sense of how realistic of a scenario is this, and are you concerned at all about that?
It's a good risk
can I just give you a personal story?
Joe, let Ram respond to that, and we'll go right to you. Promise. Go ahead, Ram.
I'll give you a quick reaction, and then I got to jump, but you guys are so much fun. This is great. Thank you. So first, mom and pop, Joe Sixpack, they're not doing any bank runs right now. Talk to your neighbor, talk to people that are not on crypto Twitter. They're not. The movements are being driven by corporate treasurers, because as corporate treasurers, those CFOs have to compare money markets and deposits. So it's the commercial banks that have exposures to large commercial deposits that are most at risk. And the national regulators understand that. They'll take efforts to reassure their depositors. They'll change the laws if they need to, because every country needs to ensure that the deposits in the banking system are secure and safe. It's a good risk to highlight. I'm not worried about bank runs en masse. But I got to run. But terrific. Great.
Appreciate you, Ram. Thank you so much for joining us, Joa. Quick story, and then we've got to introduce Pedro. So Joa, go ahead.
Yeah, just from a. Do you guys hear me? Yeah. Just from a personal note, I was born in the U.S., raised in the U.S., and then I moved outside of the U.S. And a lot of my family is outside of the U.S., kind of all over the place. England, Dubai, kind of everywhere, Brazil. And I had 7 different aunts and uncles call me today and ask me what they should do with their money in the bank in the U.S. And I asked, why are you asking? And they're like, because the news is saying that things are really bad, and it might not affect the local bank, but it could. So people are like, this was national news. This is international news, and people are scared. These are not people who have ever called me for advice on money, ever. So I do think there is going to be a risk of this spreading internationally, because I've never gotten these phone calls in my life.
Tell me. Okay, so based on what Joa just said, tell me if this statement is correct, Danish. And I think Stock Talk made that statement. Like, every bank has the same treasury exposure as Silicon Valley, just not to the same extent. Okay, statement number 1. Jump in if I get any of them wrong. Every bank, depends on deposits to keep liquidity. Every bank has to follow fractional reserve banking laws or requirements. So doesn't that, first, are my 3 statement correct, Danish?
Every bank does maturity transformation. Yes. If that is what you're referring to, Mario, where they take short-term liquidity and then they do long-term maturity.
Yeah.
Yes, every single bank does that. That is a correct statement.
Okay. And some mitigate their risk more than others. So considering those 3 statements, it becomes a game, and I've said this before, it becomes a game of, avoiding withdrawals to keep liquidity, essentially avoiding a bank run.
Exactly.
So if you start having fear that Joa just, kind of hinted towards, and I'm not sure if others on the panel have had, friends and colleagues that usually don't talk about these things, come up to them and ask them for similar advice. Be interesting to know. And if anyone in the audience has similar experiences, I want to go through the comments for a bit. It's been a while, so put them in the comments in the purple circle on the bottom right corner if you had similar experiences. Because considering what I just said, and I'm not sure if Stock Talk could hear me. Actually, he dropped out. I'll send him an invite. Oh no, he's there. Considering what I just said, doesn't that lead to just a game of confidence that I've said before hours ago? A game of confidence where the dominoes will fall, not based on the contagion similar to 2008. The dominoes will fall on based on the liquidity of various banks and the trust that they have.
Yeah.
starting with the ones that are sick.
Yeah, I mean, look, the fractional reserve banking system, which is the global banking system, is entirely dependent on confidence. Yeah, it's not just this blip of 3 months that illustrates that. I mean, maybe now we've highlighted it more, with a heavier pen per se, but
now it's become shaky. It's become the shakiest it's been in a while.
Right. We've known for a long time that banks don't have all of the money that they're supposed to have, right? I mean, the notion that everyone who banks at a given bank can show up on the same day and ask for their money has never been true, right? That would make any bank in the world insolvent. Now, that issue has been magnified by banks, as you said, taking short-term deposits and converting those into long-term treasuries. For a long time, rates were relatively stable, and we had near zero rates for a long time, and rates were low, and that exposure to long-term treasuries was not an issue. Now, because of the rampant rates, it is. But the underlying point of all of this is that the average depositor is not aware of that nuance. In fact, to the extent that maybe somebody's in this space and hears us talking about it, they would be, right? But when you're talking about the millions and millions and millions of bank account holders in the United States, right? When you look at the United States, for example, only 4% of our population is unbanked. So 96% of American households have a bank account of some kind, right? So when you're talking about the masses, they don't have the analytical prowess or the financial literacy to make the kind of conclusions or deductions that we're making in the space. So the contagion, quote unquote, and I'll put it in quotes for a good reason, the contagion that you're seeing in European banking stocks and Asian banking stocks now, just earlier, is not a contagion amongst sentiment in depositors. It's a contagion amongst sentiment in shareholders and traders internationally. It is a changed perception and risk of the risk-reward profile of owning these stocks. That's all it is. And to the extent that that contagion spreads to depositors, it will be immediately obvious. You'll see a lot more than a couple pictures of people at First Republic banks in line. You'll see it globally. And I imagine that we probably won't get to that point. I think the contagion, to whatever extent it does continue, will continue in shareholder sentiment and in trader sentiment more